It's biggest in the United States. Also keeping an eye on the insurance and Generali profit beats from those two, but Allianz has an income miss, and maybe that outweighs the PIMCO flows in the eyes of investors this morning. Just finally, Lanxess, the German chemicals maker, EBITDA for the second quarter meeting estimates. They've confirmed their full-year guidance, but is the result going to be positively received in these markets? We shall see at the open, Anna.
Of course, which adds a big global macro data point later on in the trading day.
Let's get started.
So perhaps,
here's
well,
the deal.
days like this, we
if you have an amazing startup
idea
and need funds to fuel it, we're here to help.
The case. So the FTSE 100 not moving all that far this morning. Maybe the data points out of the US then take on greater significance because we don't have quite so much forward guidance from the Fed as we used to. A detox, Scott Bessent has been calling that particular phenomenon. So whilst we're in the midst of that detox, maybe these data points take on a whole lot more meaning and can provide more volatility. Maybe the market acutely aware of that and therefore reluctant to position particularly aggressively ahead of the data. So we're up by 0.1% on the stock 600. The FTSE making very modest gains. The CAC 40 also up 0.1%. In fact, that seems to be the size of it then, Lizzie, this morning. All the markets that are open up by 1 or 0.2%. What do you see in the sectors breakdown?
Well, we've got fewer than half of sectors in positive territory. Energy leads the gains today, as you would expect, given that we've got higher oil prices off the back of the latest in the Middle East, the disappointment that there isn't progress on a deal, and the fact that there has been this step up in tensions. So as we see Brent trading up 1.2% at $83 a barrel, we see energy at the top of the sectoral basket up 0.7%. Healthcare and tech not far behind, basic resources as well, but bottom of the basket today you've got media, consumer products and services, retail, travel and leisure. And if we just go back to some of those individual names that we were flagging, waiting for many of them to open up in Germany, as is per usual. But we do have Monte dei Paschi shares up 0.7% off the back of their earnings. And we're also looking at Porsche shares up 0.3%. We've heard their results out today. VW at a crossroads, according to the Porsche owner, got to change quickly, but we saw a first half loss after tax for Porsche this morning.
We've got some interesting moves in healthcare. You mentioned the sector is in focus, and in fact to the upside, the biggest points contributors on the upside of the stock 600, we've got at least 3 healthcare names within the top 6, I think it is. So certainly a day where healthcare is doing pretty well and bringing a lot to the stock 600. Let's talk about where we are on these markets more broadly. Farhad Kamal joins us, Chief Investment Officer over at Coutts. Farhad, nice to speak to you. So broadly speaking, you are overweight risk because you still think that growth is very positive, labour market data remains supportive, and AI investment continues. So that's a positive cocktail for you. For how long does that cocktail endure, do you think?
Well, it's been going on for 3 years, frankly, right? And we've been overweight risk for 3 years on exactly that. Not that there haven't been risks, not that there haven't been lots of things to worry about, as they are today. But frankly, the underlying macro picture has been so supportive, and that's been really, really good for earnings. The AI trade is adding a huge multiplier effect on top of everything else. And for the foreseeable future, that continues. Everything that we've heard in the earnings reports would suggest that this carries on for now.
Okay, and what would make you question that? What would make you turn more cautious? I'm thinking in particular, you said about CapEx and AI CapEx. What is it specifically about AI CapEx that improves our risk sentiment, and what detracts? Because it seems to be, in particular, the cloud providers that were met with positive market response to their earnings. So what are you watching for in AI?
Look, we obviously, at the heart of everything right now is this positive macro story. An enormous contributor to that is this AI story, right? So we're talking about, in the US alone, something like 2 or 3 percentage points of GDP growth being generated just by this, 700, 800, almost $1 trillion worth of AI spending every year. Now, if that starts to reverse or go the other way, it's the opposite of the multiplier. It becomes the divider effect, right? And then suddenly the chances of recession, slowdown, labor market weakness, etc., start to exacerbate. That's the biggest risk, right, is recession, and AI is a massive contributor to that. In addition, obviously we are clearly, like everybody else, focused on what's happening in the geopolitics of the world. Who knows, right? We're on our 10th round of negotiations or whatever, and it's been going on for a while. At some point, the boy that cries wolf is clearly the parable that comes to mind. But that's the other worry that's on the horizon. Not so much because of the geopolitical tensions being what they are, but clearly its impact on inflation. That is, and the monetary paradigm that may result is the other big worry.
But let's say you get the Strait of Hormuz reopening to shipping, not just for friends of Iran and Oman, but more widely as well. How much would that change your outlook for the second half of the year?
Yeah, but amazing, right?
Yeah.
I mean, like I said, there's a pretty good picture already forming, right? Macro, labor markets, etc. You take away the geopolitical risk premium, and you're off to the races even harder than we've been for some time. I think obviously the friends and family discount that's being discussed right now is interesting. I don't think that'll be acceptable, frankly, to the U.S. But I think Iran is playing hardball. In the end, though, our base case is that there is going to be a negotiated settlement that everybody can live with.
Whenever that may come. And just going back to AI, how are you thinking about the threat from Chinese competition to American AI? Is it like good enough and cheaper will win?
Who knows? I mean, I think one thing is pretty clear. We don't need frontier, next-level models to check up, butter chicken recipes, right?
Is that what you're doing?
Yeah. I mean, is that not what everybody's doing? But so clearly there is no question about the fact that there is going to be a paradigm that results that you don't need this a Ferrari to go to the grocery store at every time, right? So that's going to change, and clearly this is good. I think the competition and the questions that this asks is good. Nonetheless, this is an innovative frontier technology. The U.S. remains in the lead, and that's where we think that that's the paradigm that we see going forward. Yes, the Chinese are asking very interesting questions, but that's part and parcel of innovation, and that's good, I think, for the broader macro picture. Ultimately, the real win for us is not who's going to win, which companies are going to make the best chips. It's the productivity gains that come to the macro, to the global economy.
But when do we get them?
Already happening. Okay. It's already happening.
Where do you see that evidence? Which data do we mine to see that then, Farhad?
I mean, even just yesterday in the productivity print in the U.S., the Fed, you clearly saw quite a strong gain. There's undeniable. Even if you look at a 10-year smooth productivity chart, you're seeing a clear upside happening, right? One of the greatest ways to quantify that is margins. Look at the margins of the S&P 500, 16.5% right now. That's a record high. Usually we'd be really worried about margins that high because they tend to mean revert. But they're not mean reverting. They keep going up. Clearly, companies are finding productivity gains. AI is part of that story.
But when does that become a viable argument for the Fed then, as Kevin Walsh would like to make, to not need to be hiking rates?
Well, clearly, if productivity gains are coming, they're not necessarily inflationary, they're disinflationary, right? So that will come eventually, and that will feed through to the data. Right now, clearly, because we've got this huge AI capex spending, as well as productivity gains that are just beginning, there's a balance to be had. I think in the very short run, a lot of this AI is probably inflationary, so the Fed needs to worry about it. But in the long run, 3 years, 5 years, 10 years from now, the productivity gains become quite disinflationary.
You think a lot of the froth has come out of, and I guess retail participation might be one way of measuring that, come out of the AI trade. Is that just in reference to Korea, Farhad, or is that globally you think we've kind of, after July, we've backtrack sufficiently to regroup and move higher again? Is that the story?
Well, Korea for sure, right? I mean, Korea for sure. But also, I mean, just look at even last week, the hedge fund, the situational awareness. Yeah. Clearly, that alone, I mean, obviously, we didn't know in real time, but in hindsight, we could see a lot of what was happening was a result of this enormous forced deleveraging that was taking place because of just that one fund alone, right? Clearly, there has been a huge amount of retail froth and hedge fund excesses, etc., leverage built in the system. I think over the month of July in general, we saw a lot of that unwind. Yeah. It would appear.
And what do you make about broadening narratives, Fahad? Do you think they are healthy because but the AI boom can continue as the market broadens at the same time, or is the broadening a reflection of doubt in AI?
Not at all. I mean, I think it's a super help. Look, for the last 3 years, everybody's been super worried about how concentrated this market was, right? Yes. You can't have been worried last year about concentration and now be worried about the fact that it's broadening. You have to pick. We are definitely in the camp that we were super happy when it was concentrated because we were riding the wave up, and the fact that it's broadening out right now is just a reflection of the thesis that the underlying macro picture is broadening for everybody and earnings are improving quite broadly.
Can I just finally ask you about defence? Because we've got the Rheinmetall CEO on the show this morning. How are you feeling about this? Because it's been one of the standout trades of the past 2 years.
Look, ultimately, all equities on Earth, any sector, it's ultimately a function of what you expect the future earnings to be. Clearly, the geopolitical paradigm shifted quite dramatically since the new administration in the U.S. came into power, and that has been massively earnings positive for defense. That's a fact. And it's not just one company, it's quite broad across the sector. We know everybody is going to be spending a lot more in defense in a world where the liberal rules-based order that we've been used to for the last 70 years is disintegrating. That is going to happen. That's good for defense and good for earnings, ultimately, and that's, quite clear.
Okay, Fahad, really nice to have you on the programme this Friday morning. Fahad Kamal, CIO over at Coutts. Thank you. Well, speaking of Rheinmetall, let's check in on the Core 6 this morning, and its shares are up 1.2%. We have gains for Novo Nordisk today of 3.8%, but not a lot moving when it comes to ASML or Schneider Electric, or indeed Nestle this morning. So let's look for a bit more excitement, shall we? We can go to our individual stocks on the move with Alex Morgan. What are you watching, Alex?
Well, good morning, Lizzie. Let's start with energy this morning. And an interesting picture here, a jump for General Energy after rejecting an approach by Norway's DNO. You're seeing General up around 5% this morning, straight into the green, but the jump actually is around 14% after the rejection of the approach from Norway's DNO, saying that was a £202 million approach. And you can see in terms of what that's done for General this morning, given them a lift. DNO, though, still, of course, up around 2%, also in the green. Let's turn over to chemicals. LANXESS is here down around 2%. The German manufacturer of chemicals, but also rubbers and plastics. They're in the red this morning, down, as I say, around 2%. Let's keep the German theme and turn over to Daimler. Now, Daimler Truck. Yeah, we had those that missed this morning in terms of the profits going forward, looking to North America in particular with the talk of tariffs. We've heard from the CFO on the analyst call about this new factory that they're going to be building out there, going to be the largest to date. Yes, in a bid to get around the tariffs and to mitigate those impacts, but also talking up the technical capabilities it'll provide them. But Daimler Trucks in the red this morning as we open around about 2%. Let's turn over to Genmab, the drugs manufacturer. They had earnings after hours yesterday, which beat estimates up around 7% this morning. Of course, they are heavily in the cancer treatment. Their earnings, you can see, really giving them a bit of a lift this morning, beating what analysts were expecting. So some after-hours impact into early Friday. And finally, let's finish with... It's Friday. Let's finish with biscuits. Lotus Bakeries, of course, the maker of Biscoff, they beat this morning, up around 3%, straight in the green this morning. So a bit of a blend for you there, but yeah, finishing off with Lotus in the green.
Thank you very much, Alex. Yes, appropriate for this time of day, I suppose. Alex Morgan with the stocks that are moving this morning. Lizzie was just talking about the defence sector, and we'll pivot back to that theme shortly. Coming up on the programme, Rheinmetall CEO says he is very unhappy after losing a €10 billion naval contract We'll have more from that exclusive interview here on Bloomberg. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. It's Jobs Day, and Bloomberg has the report under surveillance.
The labour market backdrop, still pretty decent.
When you take a look at wages, when you take a look at the JOLTS data today and the quits rate, that's going to matter.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labour market seems okay.
We don't see any wage pressures in the economy.
We're all building up to one thing.
The July Jobs Report, today on Bloomberg.
Back to the opening trade, 16 minutes into today's session, and this is the picture across European markets. Just 17 minutes nearly into the open, and we're up 0.25% on the stock 600. It is a quiet day for earnings here. We're waiting really for the US payrolls print later on today for a bit more action, but outperformance in Germany. Anna, I think you're minding the Italian banks this morning.
Absolutely, keeping an eye on what's happening to Monte dei Paschi, the share price there, because we've had numbers out from that business. So the share price is up by just shy of 1%, but there's a lot more than just the earnings contributing to the Italian banking story right now. The Italian bank did report profits that exceeded analysts' expectations. The earnings beat provides a tailwind for the CEO, Luigi Lavalli, while he considers how to respond to a takeover offer from rival bank Intesa. We're joined now by Bloomberg Rome Bureau Chief, Chiara Albanese. Chiara, good morning to you. So what are the key takeaways from the earnings? Because we'll get on to the takeover story in a moment, but what do the earnings tell us?
The earnings are painting to us a very good picture, a picture in which all the banks that have reported so far, so most of them have beat the estimate on the back of a strong quarter and a strong semester with interest rates rising again. But there is more to the picture because what the market and analysts were really looking for in these reports were indications about all the M&A wave that is taking place at the moment, which mostly rotates around Monte dei Paschi di Siena. And we have the CEO Lovaglio speaking just now as we are on air.
Yeah, I mean, take us through the latest there on the takeover story, because, of course, these numbers are a tailwind for the Paschi CEO, but where are we on the bids, the strategic options that they say they're considering?
That's a great question. So Monte Paschi has been subject of a takeover offer by Intesa Sanpaolo, which will formally kick off in autumn. And at the same time, it was in talks with Banco BPM for a potential merger of equals, which though has been abandoned. So there is a lot of speculation about whether Monte Paschi could still do something with Banco BPM to fend off the offer by Intesa, or what it will do next. And of course, in this picture, there is UniCredit that is continuing to pursue Commerzbank, and what will it do after the Commerzbank deal has been sealed is the big questions everyone is after.
Yes, Chiara, it's interesting, isn't it, how, well, what's the Italian government's attitude to this consolidation within the Italian banking sector? Because we've had a number of guests who talk about the need for consolidation cross-border, but then we get examples of consolidation even within country that seem to be challenging.
Yes, so the Italian government has been trying to remain on the sidelines of this action. It has a stake, residual stake in Monte Paschi that it is aiming to sell in the next months, just also to project the sense that it is not going to interfere with private decisions. But we know that, of course, officials are fully briefed on the latest and are involved and monitoring closely, because what's at stake is the stability of the Italian financial system.
Chiara, thank you very much. Thanks for joining us. Chiara Albanese, Bloomberg's Rome Bureau Chief.
Well, let's turn from Italian banks to German defence. We're looking at Rheinmetall shares higher this morning, up 1.7%, but they took a hit yesterday after they cut their full-year outlook following Germany's withdrawal of a €10 billion naval contract. Bloomberg's Francine Lacroix spoke exclusively to the CEO, Armin Papager, yesterday, where he discussed his thoughts on that contract loss.
I am very unhappy that we lost the F-126, but at the end of the day, there is an impact, but it's not a huge impact. The naval business is at the moment the smallest business of Rheinmetall, and we will have an impact this year of about €300 million in sales. This is exactly what we took out also from our guidance. But this business is on a level of 10%, so between 20 and 30 million, with an EBITDA of 3 billion. So you see the impact is very small on the profitability.
Could this actually lead, though, to a slowdown of the production ramp-up?
No, not really, because we have such a wide product portfolio that I'm sure that we can, over the next years, compensate or overcompensate also these areas. We are fighting hard, and I have a great team, and the people compensate a lot. So we stay on the expectations, and for next year and also the years after next year, my expectation is that the growth rate is still more than 30% per year.
So what exactly will compensate for this loss of contract? Is it autonomous vessels? Is it smaller boats?
This is one point. On the other point, we are looking for international and other national contracts. And I'm sure that also Germany will give us some contracts, because we have the biggest shipyards over water here in Germany. And Germany needs these capacities, and I'm sure that we will find a good way.
Have there been any developments on your bid for the German naval yards?
We gave a non-binding bid on the German Naval Yard, and at the moment I can make no decision because I have to wait that we get more contracts. With the F-126, it was a need. Therefore, that was the reason that we gave this bid. Now we have to wait, and we will see over the next 2-3 months if there are new contracts coming in, and if yes, then we will continue.
Do you worry, sir, that actually there are, other things like the frigate, F-127 that will be called into question by German lawmakers?
I have no idea at the moment what really is coming with the F-127 because the German government at the moment is looking forward to say, okay, we have to reduce the cost structure. And we are in negotiations at the moment. You know that we are in a consortium with TKMS on the F-127, and we want to do what is good for the customer at the end of the day, but we are also flexible.
I mean, Germany appears to have also decided to open the tender up to others for the procurement of the collaborative combat aircraft instead of going with the Rheinmetall Boeing product from the start. What do you make of this?
Competition is always good. Germany is looking at the moment for different solutions, and at the end of the day, the best solution should win. We go with Boeing Australia in that area because we believe that this system at the moment is a modern system and is the most qualified system at the moment, but it seems to be that Germany wants to go like on the drone business with 2 or 3 different competitors, and that's really good, and that's fine for us.
Rheinmetall CEO Armin Papiga there speaking to Bloomberg's Francine Lacroix. Well, it takes us to a broader conversation about defence, I think, and the future of the defence industry in the context of what the future wars are going to be in the world. And there's a really interesting piece from the Wall Street Journal this morning saying that there have been these US intelligence reports that Putin in Russia could try to test NATO by launching a limited assault on an ally in the next few years. And that's been something that really has been dismissed for a long time, but it doesn't have to be a low-level land assault. It could be a cyber attack, and we just don't know what the response from NATO would be. How does Article 5 stand up if it's just, she says, just a cyber or a hybrid threat?
Yes, and people are have been asking questions for some time about the hybrid nature of the warfare that might need to be fought against Russia, and to what degree is Russia already experimenting in that regard with small incursions of drones into parts of NATO airspace. Yeah. We saw that the shutting of the Leipzig airport this week, and a lack of clarity really as to what exactly happened there, but there did seem to be unexpected objects in the air. Ukraine, it seems, is asserting itself back onto the market's radar as well because of their success in hitting energy infrastructure in Russia, but then their lack of success in firing at Russian missiles or bringing down Russian missiles because, of course, they don't have enough interceptors, and that takes us back to the Iran conflict.
Yeah, but it also takes us back to this Wall Street Journal story, because why would Putin want to look at NATO members? Because he is increasingly squeezed in Ukraine and he needs to secure a victory at home.
So a lot to think about when it comes to the defence landscape right now. Coming up on the programme, we will pivot back to markets and to M&A in particular. We see more undervalued UK companies becoming takeover targets. We'll talk to Kate Cooper, a partner in the M&A team at the law firm Freshfields, about what is driving this wave of M&A, including around EasyJet. This is Bloomberg.
Western countries, all of them are cutting funding to Africa. And And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC. Africa CDC is the leader in terms of public health in Africa.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg. Welcome back, everybody. This is the opening trade. It is Friday. It's jobs day in the States. So not expecting a huge amount of movement, perhaps, on European stocks in advance of the jobs report. But actually, things do look more positive than they did at the start of the trading day. We opened pretty tentatively, bit of a Friday feeling, perhaps, to these markets. But the DAX now up by around 0.5%. Overall, on European markets, up by around 0.25%. Healthcare stocks seem to be doing pretty well. Energy stocks not doing too badly. We see a higher oil price, again, to do with a lack of progress in the Middle East. And so we see energy not doing too badly. The opposite side of that is travel and leisure not doing too well. But healthcare is the best performing sector across European markets then, Lizzie. What do you see under the hood?
Well, by way of illustrating what a quiet day it is as we wait for that payrolls print out of the US at 1:30 p.m. London time, just look how low volume is, down nearly 30% this morning, but a pretty even split between members to the upside and the downside. Again, it seems like we're waiting for a catalyst here in this market. So let's take a look at some of the individual movers for a little more excitement. We've not got that many earnings out today, but Genel Energy up 13%. It's rejected an approach from DNO, so that's what's moving that stock. Genmab is higher on a higher outlook, up 6.4%. And Goodwin, the industrial company here in the UK, has started a strategic review. Shareholders like it. We're up 13% this morning. Now, flipping over to the laggards, we've heard from various insurers, but Munich Re is one of them with results. Revenue, we've beaten estimates when it comes to their results. So we're down, though, 2.7%. Lanxess, one we'd flagged, second quarter adjusted EBITDA, meeting estimates. They've confirmed their full-year guidance, and yet they're being punished, down 3.5%. We've also had a revenue miss for Daimler Truck. Those shares, a bit more of a logical reaction, you might say, down 2.8% at the moment, Anna.
Let's get an update then, Lizzie, on some of the other stories we're following this morning. I mentioned oil prices on the move, and they're extending their gains, a jump sparked by Iran attacking, quote, hostile targets in the Strait of Hormuz. Tehran is also reported to be seeking to bar US and Israeli ships from the waterway in a deal with Oman. According to the Financial Times, the European Central Bank was only made aware of the coordinated US-Japan yen intervention, where the US sold euros to buy yen after it was executed. The yen has now given up half of its post-intervention gains, in part after the dollar notched its best day in 2 weeks. Alphabet has sold $25 billion of investment-grade bonds in one of this year's largest order books for AI-related debt. Helped by generous yield payouts, sources say Thursday's offering attracted some $115 billion of peak demand. The sale lifts Alphabet's debt issuance since 2025 to more than $114 billion, making it the biggest seller of AI-related bonds over that period. Lizzie.
Well, let's turn back to the M&A story now. Apollo agreeing to buy EasyJet for £5.7 billion, clinching a deal that's likely to shake up the dynamics in Europe's highly competitive market for budget airlines. We can go now for the detail to Bloomberg's aviation reporter Danny Lee. Danny, what do you think put off Castlelake in the end?
Well, Castlelake had a very different plan to Apollo, who was the victor for EasyJet. And I think for Castlelake, balking at putting in a higher price, given that there was speculation they may look to potentially break up the low-cost carrier, they felt like maybe the valuations required to buy EasyJet relative to everything it has, its assets, was probably a little bit of a bit too far. However, one of the key parts of this is also the fact that EasyJet also had, Stelios, the founder of EasyJet, had come out in favor of Apollo. So with 15% of the shares, the largest shareholder, that really put Castlelake into a corner. And on top of that, it also has this question around its shareholding, potentially as a foreign entity, non-EU shareholding, which would have made it very challenging and put scrutiny on regulators of this takeover as well.
And so what does the success of Apollo, what does that mean for the future of EasyJet then, Danny?
Well, I think for EasyJet, the fact it now has a very well-capitalized new owner waiting in the wings, so to speak, the fact that Apollo has outlined its ability to support EasyJet and to do so, allowing them to grow behind the scenes without having to have shareholders demanding more and quicker returns. So at the end of the day, EasyJet has a lot of support to grow sustainably and potentially to grow more ambitiously. The fact that you will have them already in a lot of major European airports, they'll be in a better position to put up more of a fight to a lot of the legacy carriers. Of course, you've got the low-cost carriers like Ryanair as well. But yeah, the fact that Apollo does have a plan to double down on some of its bets related to EasyJet, and that will be sharpening the competition in the European landscape.
Danny, appreciate the context. That's Bloomberg's aviation reporter, Danny Lee. Well, EasyJet isn't London's only takeover battle. Foreign and private equity buyers are aggressively snapping up undervalued UK companies at record pace. With London's IPO market frozen, these buyouts are rapidly shrinking the exchange while leaving investors with few other ways to exit. Kate Cooper, a partner in the M&A team at law firm Freshfields, I'm pleased to say, joins us now. So, Kate, this really is your expertise. And you've said that we're in the year of the bear hug, where you have foreign investors wooing shareholders in London-listed companies with takeover offers that are basically too good to be true or seem like it. Just first off, for anyone unfamiliar with a bear hug, what's the difference between that and a pure hostile bid, and why has it become such an effective tactic right now?
Yeah, well, thank you. This is something that we're seeing this year more than we have done in recent years. Really, if you think about it, most takeover approaches, they're always unsolicited because, people don't put themselves up for sale. Companies aren't out there saying, please buy me. But what happens is that bidders are coming to companies in private. Generally, they attempt to get the board to agree a price. They give them a whole bunch of commitments about what they're going to do to get the deal done, and they try to convince the board that they're the right custodian of the business going forward. And obviously, there are transactions that play out that way. Like, we saw the Swedish industrial tech company ABB offer for MITI a couple of weeks ago, exactly that playbook. But what we're now seeing, and has been really a feature of the last sort of few months of activity, is really determined and assertive bidders, and they're deploying these bear hug strategies, right? And those are where they're going around the board and they're going, to do exactly what it sort of sounds like. They're making a very public declaration of love for these companies in the shape of offers at a real premium to the trading value. And they are saying to shareholders, this is what we're prepared to do. And they're asking the shareholders to put pressure on the board to engage. And so in the same way as a bear hug, you know, that's actually a pretty suffocating embrace to be on the receiving end of if you're a target board, right?
Yes.
And it takes the control out of the target board's hands to a greater degree and really sort of just turns the tables slightly in favour of the bidder if, of course, shareholders are vocal and in support. It's a judgment, but if they are, then that's really can be really quite helpful. And we've seen it deployed time and again this year. You know, Zurich Beasley, EQT, the Swedish buyout group's offer for Intertech. You know, there's Prologis Segro. There's happening a lot.
Well, let me take the Prologis Segro example then, because I think it was multiple bids it took to get that over the line. When you look at the board, does it make you think that they're just getting in the way, or is it actually that they're doing their job by getting in the way and really considering trying to get the best offer?
Look, I think it's the latter. You know, boards have a duty, right, to extract the very highest price they can, but they've also got a duty to, you know, deliver the deal. So they're going to look really forensically at whether a bidder can actually come through with the offer, like you're seeing with the EasyJet situation. You know, you can see that the board there have really scrutinised the deliverability of that deal by Apollo in the announcement. But, you know, there comes a point where boards are under pressure themselves. They've got a shareholder register potentially that's quite sort of fractionalised. So we've got fewer long-onlys sitting in stocks who are, you know, the ones who traditionally back the boards, the insurers, the pension funds of the world. There's a greater proliferation of shorter-term investors. They want action now. And actually, boards are sort of saying at a certain point, well, it's over to you. You're going to have to decide whether this is something that you want to accept. I think the key thing, though, is that these are not opportunistic deals. You know, private equity in the past, I think, has been accused of opportunism. You can't make a bear hug with a skinny premium. You are going with something that's really, you know, a full offer. Otherwise, shareholders are going to laugh in your face.
And so we are seeing then a lot of private equity bidders in the London market. Is that the case then at the moment, Kate? Because on the other side of things, we're seeing a low level of IPOs, which means when those private equity companies want to get out, exits are more challenging. They have to find another firm to sell it to, another company within the space, or another PE, another private equity business. But is that not weighing on their willingness then to get involved in M&A in the London market?
I actually don't think it is at the moment. I mean, if you look at the last sort of few months of activity, you know, private equity have been right at the heart of it. So have the strategic acquirers as well, frankly. And, you know, we're seeing the strategic acquirers potentially using M&A again as really, you know, a way to fuel growth. And it's a good ballast, often scale in amongst macro uncertainty. But for the private equity acquirers, you know, they are out there. There is both debt and equity available to fund these. I mean, you can't do these very large take-privates like EQT's bid for Intertech unless there's a great availability of capital. So the appetite is there. And I think there are some really, really high-quality assets that, you know, private equity can't ignore because they need to deploy capital. And then they have to think about the exit in due course, of course, but they're not going to not deploy.
Is the conversation very much around the UK just being very undervalued at the moment, and that's why the opportunities exist here, or is this a broader European story, do you think, Kate?
I think it's a European story. I mean, look, London is a global financial centre. There are, you know, international capital flows coming into it. The companies that are being acquired at the moment are sitting at the higher value end of that spectrum. They're FTSE 100 companies. They are internationally relevant businesses with big footprints, diversifying risk, and those are incredibly attractive. And what is happening is that the premia that are being offered are really very full at the moment. So there's, you know, 40, 50% plus. Look at the EasyJet offer. You know, you can pick your number there. And so I don't think it's a case there of those companies being undervalued, but the value is genuinely being recognised in these transactions in a way that perhaps it wasn't before.
But specifically in the UK, to what extent does the relative political stability that we're starting to see with the Burnham government change the picture for deal decisions? You know, I think you've talked before about how the political uncertainty can be bad. Now that you've got Labour recovering in the polls under Andy Burnham, is that good for the deals environment? And when you're thinking about how to stop the hollowing out of the market, how would you advise the Burnham administration to stop that?
Well, that's a very difficult question, isn't it? And there are going to be people far more qualified than me to answer that. I'm an M&A lawyer, so I see this as, really a natural flow of capital. The answer to this is not to think about, stopping M&A. It's about thinking about what are the incentives to bring companies up and into the market in the first place. Other people are far more qualified to answer that. It's a myriad, lots of different solutions that there could be out there. There's pension fund allocations, there's, looking at stamp duty, there's looking at the investment incentives, lots and lots of things that can be done. But, if you're actually looking at M&A, that's a good thing, because actually it shows that the businesses that are in the UK and that are headquartered here, are very high quality businesses. And I think the other thing that I find slightly difficult as a characterization is that this is foreign bidders taking over UK companies. This is international acquirers taking over international businesses. They happen to be headquartered and listed in the UK. Yeah. And actually, one of the things that we see here, again, the Apollo commitments in relation to EasyJet are a good example of this, is that UK investment is not changing. In fact, it's being enhanced in a lot of these takeover situations. They're putting capital in. They're trying to grow the business over here. The headquarters are not changing. The R&D, the employment isn't changing. So I think it's a bit of a mischaracterization.
Okay, yeah, really interesting on that pipeline of new businesses coming in. I was looking at some stats on this. The share of UK companies that are listing at home was 46% in 2025 and 71% in 2019. So that has really declined.
Yeah,
US companies, especially if they're tech focused, increasingly, drawn to the magnetism of New York.
And just look at Nscale, targeting
exactly.
a September IPO in the US. Just the latest case of a big UK AI company looking elsewhere.
Kate, thank you very much. Thanks for joining us. Kate Cooper, partner at Freshfields on the M&A stories here in London. Coming up on the programme, we'll get back to the oil narrative. Oil climbs as a deal to reopen the Strait of Hormuz remains elusive. We'll bring you the latest. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacqua, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacqua. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Increasingly, extreme heat and drought affect refiners' ability to produce fuels efficiently. So we have simultaneous raising of demand and constraint in supply.
We do everything we can to absorb those costs, but yes, food pricing has become more volatile, also driven by weather volatility.
In order to drive down energy prices, we also invest into sustainability measures. You may have read in our press release that we have now put some wind turbines in one of our German plants in order to drive down the energy cost and make us more independent from market fluctuations.
It's something that we have to deal with in our supply chain, but not something that I would dare to predict for the coming years.
Now is not the time yet to verify and see evidences of El Nino, right? I mean, this is something going to materialize inflation-wise, output-wise, towards the end of the year, beginning of 2027. I do believe, and I take El Nino risks as one more reason for central banks to be cautious out there.
To really give you numbers, it's too early. I mean, things are still happening here. But what is important here, we need to understand the risk, we need to mitigate the risk, and then we need to basically give protection here. And there's still a big protection gap here that people are not covered for the remaining risk here.
A few of the guests we've been speaking to this week discussing the challenges facing Europe amid extreme weather volatility. And Lizzie, the place where climate meets markets, we've heard quite a bit this week, haven't we, around climate change, heat and drought. That's one way that these themes interact, but also everything we're seeing in the Strait of Hormuz and the availability of energy out of there increases the need for more resilience at home.
Absolutely, and we're looking at oil higher again today, up 0.9% to $83.25 the barrel on Brent. The gains continuing because we've had Iran saying that it's going to seek to restrict US and Israeli ships from the Strait of Hormuz. We've also got a deal over the vital waterway really remaining elusive. So let's get the very latest. We can go to Dubai and speak to Abir Abu Omar, our Horizons anchor. Abir, we've got conflicting comments from Washington and Tehran. It seems like what Tehran's proposing, Washington couldn't possibly agree to. What do you make of it all? What's the latest?
Good morning, Lizzie. Yeah, despite the fact that historically U.S. and Israeli flagged ship never really made it through the Strait of Hormuz, but it will be very unlikely for President Trump to agree to the latest from Iran. Again, those are Iranian media remarks about the latest draft between Iran and Oman, saying that Iran is going to have an agreement on the Strait of Hormuz that will bar U.S. and Israeli ships from making their way through the waterway, but it will also have tolls or charges on countries that it deems hostile. A lot of traders are viewing that as a sign that it might be GCC countries and their tankers and vessels. Now, you're seeing the impact on oil prices. They're up today. You're seeing Brent about 1% higher, $83 on the barrel, so above that $80 mark yet again. So not a lot, but traders are still assessing what exactly this deal will entail. And you're also seeing that traders are reluctant to fully unwind long positions for the fear of being really wrong-footed, Lizzie, by a sudden escalation yet again in the Middle East. So we have that when it comes to the oil markets. We're seeing tankers and vessels either paralyzed in the Strait of Hormuz, trying to go through with their lights switched off. We're not seeing a lot of trickle of movement. We have heard from the UK Navy earlier saying that 2 ships have been attacked. Iranian state media also saying that it targeted 2 ships that it deemed hostile. So you're seeing the threat of getting ships and vessels hit in the Strait of Hormuz still very much prevalent in the waterway, which is why a lot of ship owners are reluctant to make their way through, despite those signs of a deal coming through over the next day or so. That is something we're still monitoring. We don't have the final terms of that agreement. And then parallel to all of this, the Red Sea, which Saudi Arabia particularly had resorted to in the past 6 months or so to get its oil exports through, is getting parallel aggression from the Yemen-based Houthis, of course, a militia that is backed by Iran. We know also that we had some casualties in Yemen itself with the Houthis targeting the government that is backed by Saudi Arabia, despite the fact that Saudi Arabia has been trying to speak to the Houthis via Oman over the past couple of days. That is what we reported through Bloomberg, according to our sources. So aggressions and the war really widening its parameters all over the Middle East. Lizzie.
I'll pick up. Abir, thank you very much. Bloomberg's Abir Abu Omar. We'll see what the weekend brings when it comes to the developments in the Middle East. Before we get there, of course, we have a jobs report to deal with here in global markets coming from the United States. We're looking ahead to July's jobs report later today. Economists polled by Bloomberg expect hiring to accelerate to over 80,000 and the unemployment rate to hold steady to hold pretty steady. For more, let's bring in Bloomberg's Jill Desis, who has details of what to expect. Jill, I saw after the claims data dropped yesterday, Bloomberg Economics saying that the labour market remains stable. Are we expecting that kind of picture to come through in the jobs report today? What do you see?
Yeah, and I think, look, if you look at the broad consensus among economists, you mentioned looking at an uptick of 85,000 for payrolls here. That would be a pretty significant increase over June payrolls that came in lower than expected at 57,000. I will also point out Bloomberg Economics actually expecting a small uptick in the unemployment rate to 4.3%, although, again, broad consensus is at 4.2%. So, looking at this data here, maybe you do see that pickup in hiring that does seem to be the strong consensus here. And then if you're the Fed, if you're sort of searching for reasons to raise interest rates, remember at the meeting last week, while it was a hold, you had 3 policy makers vote in favor of raising rates. Maybe that resilience in the labor markets, some broader resilience in the economy, some concerns about inflation, that's contributing to your calculus for potentially raising rates later this year.
And we've heard from various hawkish Fed speakers over the past couple of days, Jill. I wonder how you would factor in the geopolitics into that picture on top of the jobs data that we're waiting for later when it comes to the September meeting.
Yeah, Lizzie, obviously we're all keeping an eye on oil markets. You're seeing that uptick in Brent today up 1%. I think that, particularly when it comes to these ongoing concerns about the Strait of Hormuz, do we get a deal? Do we not get a deal? Are we actually seeing anything sort of freeing up there that does have to play into the calculus again for some of these Fed policymakers? I'll also point out the Financial Times had a report out this week saying that, Kevin Warsh is prepared to raise interest rates, to sort of try to build consensus there. If we're seeing hotter than expected inflation prints over the coming weeks. And so I think all of that has got to be weighing on the minds of these Fed policymakers as they look toward their next decision. Again, inflation obviously front and center. And so if you're seeing that uptick in oil prices start to sort of bring that pressure back again, I think that's something that they're definitely thinking about.
Okay, Jill, thanks for the preview. That's Bloomberg's Jill Desis. Those numbers coming at 1:30 p.m. London time. And a reminder that Kevin Hassett, the director of the White House National Economic Council, will be joining us on Open Interest at 3 p.m. London time.
Yeah, putting the Fed narrative and what the Fed does in response to the data. We're not supposed to think that way anymore, are we?
No.
That's what Kevin Warsh says. But I just did. That puts that front and centre, doesn't it? Interesting that we've got lots of reporting suggesting that President Trump, who enjoys calling a lot of people, has been enjoying calling Kevin Warsh as well to express his views on, well, who knows, but maybe monetary policy. We'll see if that influence lasts. But a lot of hawkish voices out of the Fed of late.
Yeah, I'm trying to remember all of the many over the past week. I know that there was Neil Kashkari,
Alberto
Daly,
Muslim, yeah.
Mary Daly, Lisa Cook.
Yeah, exactly.
Not everyone as hawkish as Kashkari, but, it looks like September might actually happen a hike.
Quite the roster. That is it for the opening trade. The Pulse is up next. They'll continue to take you through these markets and onwards to the weekend. Have a good weekend when we get there, everybody. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersachi in El Ula, Saudi Arabia, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Tensions resurface. Iranian media say Tehran is looking to bar U.S. and Israeli ships from the Strait of Hormuz as reported strikes push energy prices higher. Well, traders turn their attention to the U.S. jobs report as they grapple with continued silence from the Fed chair, Kevin Warsh. Plus, Alphabet actually sells $25 billion of investment-grade bonds in the year's largest order books for AI-related debt. Of course, we'll get the latest on tech as well. So this is what's going on Friday. It's also about the jobs report, and so we look at the U.S. 10-year yield, 4.6698. We're almost at the end of earnings season, so it has been quite tumultuous, certainly when it comes to tech stocks, because of spending, because of valuations. Gold close to that 4,300 handle, and then Brent crude 83.27. If you look at what's going on in the European markets map, a lot have been really tracking what we're seeing in the U.S. Because S&P futures are pretty much flat. We're also seeing the European markets actually a little bit, not unchanged, but they're not gaining or losing by that much. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, it's Jobs Day in the U.S. We'll dive into the markets in a moment and talk payrolls, the Fed, and tech with Robert Dishner from Neuberger Berman and Catherine Agundia from Barclays. But first, Iran says it wants to bar U.S. and Israeli ships from the Strait of Hormuz and require payment from hostile countries to sail through it. Well, European natural gas futures have jumped. Oil is higher as traders, of course, await the U.S. response. Before those reports by Iranian media, the U.S. president was asked about whether a deal had been agreed to reopen the strait.
I don't want to say it has been. It's sort of open right now. You know, we have a thing called the blockade headed up by the U.S. Navy, and we control it. And now we control it, but they can always shoot something. They always have something or drop a mine. I think we're doing very well. I'm involved in the negotiation. I think we're doing fine. It could be soon.
Let's get more from Abir Abu Omar in Dubai. Abir, good morning. So conflicting comments from Washington and Tehran. What's the latest?
Good morning, Francine. Yes, conflicting statements yet again from President Trump and the Iranian side. Now, two important caveats in this deal that you had spoken about in your intro. This is according to Iranian media, right? So we don't have the formalized draft that Iran and Oman have been discussing over the past week or so. What we know from Iranian state media is that essentially Iran wants to bar U.S. and Israeli flagged ships from crossing through the Strait of Hormuz, and then it wants to have tolls or charges on ships that it deems hostile. Now, a lot of traders are perceiving this as a sign of Iran saying that it would bar or that it would ensue tolls on ships from GCC countries and their oil exports. Again, none of this is verified. We have to wait for the formalized statement from Iran. It is now with the Iranian parliament, so that is something that is pending for the time being. Meanwhile, you're still seeing signs of aggression in the Strait of Hormuz, Francine. You're seeing the UK Navy that said that it had monitored 2 ships being attacked, and then Iranian state media also saying that Iran had attacked 2 hostile ships. We don't have clarity on what kind of ships those were, but we're seeing signs of aggression in the Strait of Hormuz. The threat of Iran attacking ships is still very much there. Meanwhile, of course, President Trump says that he's part of those negotiations, something that Iran has refuted over the past couple of days. And you're also saying that he had remarked that a deal is close. Iran also saying that Washington is not involved in those negotiations that are taking place primarily between itself and Oman to temporarily open the Strait of Hormuz with those contingent lines, of course, that were reported by the state media.
All right, Abir, thank you so much. Abir Abu Omar there with the very latest, of course, on what's happening with the Strait. Now, between earnings season and the U.S. jobs data coming out today, the markets have had a lot of information to digest this week. Joining us now to break down the trends behind the numbers, Robert Dishner, Senior Portfolio Manager for Multi-Sector Fixed Income and Head of Trading for London at Neuberger Berman, and Catherine Ogundia, Senior Thematic Equity Strategist at Barclays. So thank you both for joining us. Robert, when you look at the Strait, and again, geopolitically, it's unclear what happens, and then you also have quite a lot of pressure on Kevin Warsh just to say more on what he's thinking. Like, what's the state of the markets right now?
Yeah, the market is somewhat, I don't want to say on tenterhooks, but it's a bit of an unstable equilibrium, right? Because they're trying to figure out what the reaction function is. We sort of know if there are second-run effects, the Fed and ECB and other places will hike rates, but they're not exactly sure because they're used to being told what to think. So it's a little bit of a learning session for the markets as well.
Thematically, Catherine, again, geopolitics, the market really latches onto good news or encouraging news, and then it's unclear where we go from there.
Completely agree. We recently published our update looking at global thematic AUM allocation, and we're definitely seeing greater shifts in allocation towards themes which have really got a geopolitical lens. A big focus has been on strategic autonomy, and we're seeing that across all 3 regions, in addition to a big focus on tech.
So what do you want to hear from the Fed? Or actually, what do you want to, if you had one question to Kevin Warsh, because he's getting quite a lot of pressure from bonds.
He is and he isn't, right? The question is this part of the intended reaction, right? Are we getting tightening of financial conditions as a result from his silence, and is that something that's a feature, not a bug, right? So the question we would have really is, how do they see the economy playing out for the rest of the year? We last got forecast in June. It's now July. There's the difference in June was we had MAU. Now we don't have, sort of an MOU. So what does that look like? And today's labor report and next week's CPI are going to be very big inputs into that September decision.
But you think the Fed holds, or does it really depend on the jobs report?
We do think the Fed is on hold. We think the data will support that. However, if the data does turn out to be better, then certainly markets are priced for about a 60% chance of a hike. Those odds probably go up.
Catherine, what's your take on the Fed? And again, actually, when you look at central banks, it could be Bank of England, the ECB. The Fed is, of course, the big one that everybody really watches for repricing. But how much is it about central banks and inflation? How much is it on earnings?
I think inflation is critical at the moment. If we're looking at how global thematic investors are prioritizing, looking at that allocation into different categories, inflation is really where it's going on. The interesting thing when we're thinking about global thematic investors is because they're looking across multiple different areas, thinking about consumer spending and where the priorities are. The consumer as sort of a thematic category has been incredibly weak, so the data that we expect to see will be helpful to see this sector move forward.
Yeah, and I understand that also different regions
yes.
invest thematically very differently.
100%. So if you look at Europe, which is really the heart of global thematic investing, they've got over 50% of global thematic AUM. They are very diversified, looking at everything from materials to technologies to space and the emerging thematics. The US, on the other hand, is very much focused on tech and technology. No surprises there, with a shift into energy as we think about the sort of powering AI thematic. Asia is slightly different, where the big focuses are on structural infrastructure, key materials, and innovative technology.
So interesting. When you look, Robert, at, again, if we go back to the Fed, I mean, you know, there are concerns about jobs, and I don't know whether this is because of AI or something more fundamentally a structural shift.
Yeah, that's exactly right. What we've seen over the past number of months is a decrease in the participation rate. Right. That's coming both from older people, but also younger people as well. So the question is that AI? Is that something in the data? Is that a structural shift in that? And actually, one of the bigger numbers we're on the lookout for today is the unemployment rate. And the unemployment rate will be dictated to a certain extent whether or not we get a further drop in that participation rate today. So there are structural things that feel like they're at play that are different. And the only other thing we'd note is, if you think about today where 401ks are relative to post-GFC, remember, people were working longer because they had to pay back. They can maybe retire a little bit earlier now.
Catherine, I mean, do you see these structural, I mean, it could be, again, demographics. It's just we should look at the economies maybe differently than we did even 4 years ago.
Certainly, depending on how people are thinking about allocating their capital, but also who's really playing in this market. Yeah. You see this particularly in the US with a lot more of sort of retail investors really shaping how we're seeing it flows into some of these passive thematic strategies, whereas in Europe, to your point earlier, we're definitely seeing a bigger focus on the core traditional thematic categories.
From the fixed income point of view, so tell me what you do with treasuries right now, and then we'll go on to UK and Japan.
Yeah,
it's
sure.
All very, there's a lot to talk about.
Exactly. So, for the time being, we like being in shorter dated treasuries. Right. There's just concerns on the longer end, even away from some of the concerns that people have noted from the Fed, but we do have U.S. fiscal, we do have some of those other things. So we do see better opportunities in that sort of 2 to 10 year part of the curve. And but again, even if the Fed were to hike twice, a lot of it's already in the price already.
I mean, on yen intervention, were you surprised actually that Treasury got involved?
Yes and no. I mean, they've been sort of hinting at this, but they need something else. But already we've retraced about 50% of the intervention level, right? There, someone put a very good quote. There's a level of yen that fixes JGBs and a level of JGBs that fixes the yen. So, that was, that wasn't mine, but it was somebody else's. But I think that's sort of right. And so they need some more support. So not a surprise. I think the one surprise was why they did it euro versus the yen. And so we're still trying to get some answers around that.
I mean, politically, it might be difficult for the U.S. to actually use the U.S. currency, right?
Exactly, but that was really sort of the question.
Catherine, overall, I mean, something like Japan, that we've been spending a lot of time talking about it, I mean, does it really factor in your thematic investing, or is it just really like country-specific?
It's a really good question. Japan's quite an interesting case, and it really ties to some of the thematic work that we've been looking at, particularly when it comes to looking at rare earth materials. Investors have really seen the growing focus on securing your own supply chains and seeing the work that Japan has done in terms of thinking about resource resilience, extracting critical raw materials. Namibium has really been sort of the benchmark region as more countries try to shift their supply from China. So that's been a really interesting way that Japan's being looked at.
Let's also talk about tech. And Alphabet sold $25 billion of investment-grade bonds after generous yield payouts helped secure one of the year's largest order books for AI-related debt. Well, Matt Bloxham from Bloomberg Intelligence joins us now. So, Matt, thank you for joining us. I mean, this is a huge, actually, bond sale. It was met with a healthy investor appetite. What does it tell us about AI CapEx spending in general, that people feel more comfortable with it? Maybe.
Not, maybe. I think it tells you something.
Fran, you're way too optimistic.
A little bit about Google, a little bit about CapEx. And what's interesting is the spread over treasuries. So I think that there was a healthy premium here of what you typically expect for Google bond. Yeah. I think I was just looking at it now, and the average spread over treasuries for Google bonds is around 75 basis points. I think for the longest maturity in this new issue, it's about 130 basis points. So quite a big premium. So even Google is having to offer investors more to get funding for its AI CapEx. But I think on the positive side, I think people still see Google as a key player in the future market. Otherwise, they wouldn't be investing in such large size in their debt.
And Robert, are you seeing actually more and more? I mean, there is quite a lot of debt. I mean, it's finding a home. I don't know how is this a good sign or actually are you just waiting and see?
Well, we do expect further supply from the sector, right? This is one of the biggest stories, frankly, and the story's not going to go away. It started sort of end of last year, and it's going to continue through 2027. And part of this really is when does the cash flow, these companies went from large cash flow positive to now cash flow negative due to the capital expenditure, and when do they flip back to that cash flow positive number? And there'll be some data that support that. But again, the desire and the need for capital for these is somewhat insatiable.
Yeah. But what does it mean for corporate bonds? Again, is that part of when you look at allocating capital? Where do corporate bonds come in all of this?
A little bit of both, a bit of focus. But if we focus maybe more, on the equity side, where we're sort of thinking about particularly the sort of allocation of, say, thematic capital, tech makes up about 50% of this allocation. The main issue has been thinking about stock crowding. So actually we're seeing as much of the focus is on this key sort of obvious tech names, investors trying to look at the sort of broader supply chain to get exposure and reduce crowding.
Meanwhile, IPO, like SpaceX is just the most incredible IPO. Yesterday, they released more than 900 million shares from lockup, and the shares went up.
Yeah,
what does it tell us?
I think that's probably more about what happened to the shares the day before when they announced the results, and you had this kind of unexpected view on the capex spending on AI, and a huge release of new shares. So technically, the free float's kind of gone up to like something like 1.5, 1.6 trillion versus kind of 600 and something billion. It's a massive increase, but the question is how many of those insiders actually sold, or was a lot of this short sellers covering? So some questions there about where the volume came, but because there was a lot of volume in the market and the shares did respond positively to it. But I think to some degree, this was about a kind of a bit of a bounce post the kind of results sell-off, and perhaps a lot of retail investors who in the IPO were disappointed in their allocations, being able to actually tap into some additional liquidity.
Yeah, and I have to say, when we think about this, a lot of the times of course, it's a tech story, but it's a financial story, just because of the large amount of these IPOs and what it means for markets and therefore also corporate bonds in the future. Will the market absorb whatever?
The market will absorb. They'll absorb a lot, but for example, right now, given some of the spreads that were just mentioned in the long end, we're starting to see some value in some of that longer end. So while we may not necessarily love long end treasuries, there are some values emerging in some of these long end hyperscalers, and so if that's the case, then that sort of means the market's open. And what we're going to want to see is whether or not there's discipline regarding issuance. As you noted, the order books were very large, and so that suggested there was some discipline around the issuance numbers from yesterday. So we are, it's a daily conversation.
Okay, that's very diplomatically put. Catherine, when you look, again, tech, it's AI, it's big data, it's digital infrastructure, it's cybersecurity, it's then all the add-ons. Like, where do you see value?
We see value across all of these areas, but it's taking a step back and not thinking purely about the sort of the key names. And by that, I mean the big play, the big trade at the moment is clearly the powering AI thematic. From our perspective, looking beyond the tech names, trying to get exposure to, say, the water cooling, the data center cooling companies, thinking about the core infrastructure that is required as we see this sort of capex spend. Where is it going to be deployed? That's where we see sort of opportunities around the fringe.
Do you see it the same way, Robert? That actually it's kind of the I guess, AI adjacent?
Yeah, no, we're seeing a lot of these deals already. So it's in securitized space and some other parts of the market. So yeah, there are a lot of add-ons, if you will. Well put. Yeah.
And then, Matt, everything's changing so fast because also OpenAI came out with its first consumer tech. What is it?
We're still, they're still waiting for the actual product to kind of hit, and it's also kind of Bloomberg exclusive to some degree on what this might be, a $300 to $400 home speaker. A kind of fairly crowded market across all the major tech players. So it's going to be interesting to see what it has that's novel enough to draw people in, because it's quite an expensive speaker compared to what you can get from the likes of Google or Amazon. You know, pitches it at very much the premium end versus Apple, who they're obviously in a big lawsuit with. So I think it's going to, and also it's going to be a way to try to kind of draw people towards the Chat GPT product away from other AI assistants. So it's going to be interesting whether it's got anything in it that's novel enough to kind of really pull people towards it. It's talked about it being a kind of a hockey puck-sized donut with a few kind of moving parts, and maybe that's going to be enough to kind of bring some curiosity in. But yeah, you know, that market's pretty well established in terms of the home speaker market, so it's hard to see that it's kind of really changing the kind of, or creating a new product category, if you like.
So Matt, I mean, is there a danger that actually have these mega companies all going for the same segments because they just need to make money? So
yeah, and I think we've seen that probably over the last 5 or 6 years, that, you know, where each company, these big tech companies had a much clearer domain that they controlled because the market's got more competitive, because growth in those markets slows. They're encroaching on each other's, and now you have all these big tech players that largely look a lot like each other, and they're getting incredibly vertically integrated.
Thank you all for a terrific panel. Matthew Bloxham there from Bloomberg, as well as Robert Dishner, Senior Portfolio Manager for Multi-Sector Fixed Income at Neuberger Berman, and Catherine Ogundia, Senior Thematic Equity Strategist at Barclays. Now, coming up, a profit beat for the world's oldest bank as Montepaschi faces a takeover bid by rival Intesa Sanpaolo. Details next, and this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Italian bank Montepaschi has exceeded profit expectations in the second quarter. Now, the earnings beat provides a tailwind for the chief executive, Luigi Lovaglio, who, well, he considers how to respond to a takeover offer from rival bank Intesa Sanpaolo. Now, we're now joined by Stephen Ahrens, who leads our EU finance coverage. Steve, no rest for the wicked. I mean, there's always something new. What are the key takeaways from the earnings?
Well, the key takeaway from this set of earnings is that they didn't really say much about the way forward. They, they beat on profit, which is great. The stock's up a bit. And Luigi Lovaglio, the CEO of Montepaschi, is doing a pretty good job at the bank. He recently bought Mediobanca, another Italian bank, and it's integrating well. So that is all going well. But the big question he's facing is what to do about a takeover offer from Italy's biggest bank, Intesa. And he didn't really say much about that.
What's the latest on the takeover story?
So Intesa has tabled an offer that's valued the bank at about 36 billion Montepaschi. That's pretty much in line with the market capitalization, and that's going to go to investors at some point. Lovaglio was actually hoping to sort of see off that bid by trying to merge with another bank, Banco BPM, but Banco BPM withdrew that proposal last week, and so that option, that potential path against Intesa fell away, and now he's sort of left without a really good option to see off the Intesa bid, and all he can do for now, I guess, is try to boost the share price to make it more expensive for Intesa to buy Montepaschi.
Steve, thank you so much. Stephen Aarons there with the very latest, of course, on Italian banks. Now, Apollo has agreed to buy UK budget carrier EasyJet for £5.7 billion in a deal likely to shake up the European airline market. It comes after rival bidder Castlelake said it was pulling out of the chase. Let's bring in Bloomberg's aviation reporter, Danny Lee. Danny, good morning. So talk us through the events of the last 24 hours with the Castlelake bid cancelled and Apollo set to take off.
Yeah, good morning, Fran. Clearly, there's no shortage of drama as well in the European airline space as well. The fact that Apollo trumped Castlelake coming in earlier in the month with its own last-minute bid to take over EasyJet with the support of management, a higher offer. Clearly, that proved to be a higher offer too far for Castlelake at the end of the day. And very much different proposals, in a sense, put on the table, and particularly the speculation that Castlelake would look to potentially break up the budget carrier. For Apollo, though, at least it's looking to support management with its growth and potentially accelerate the levels of growth it's looking to pursue and also the levels of profitability. It does believe it can create more value by supporting the management and doing a lot of the growth and expansion in private, away from the shareholders and away from demands to do things in a much quicker way than maybe someone like EasyJet can do. And of course, the fact that EasyJet has been under pressure for some time now, and particularly as you have seen with its share price falling, the fact that it is now going to be hopefully soon in private hands as well. So yeah, very much two different dynamics, and Apollo there, the victor.
Danny, what does this mean for the future of EasyJet, but also for the highly competitive European aviation market?
Well, for EasyJet, it now potentially has a very well-funded owner that can really help support it in a much, much bigger way. The fact that it has around 350 aircraft, it's in a lot of these major European airports as well. Some very attractive assets it has. The fact that it can now be put to work, and even though it has a different business model to the likes of Lufthansa and Air France KLM, it really could put an even bigger challenge. And the fact that Apollo has highlighted the fact that it could use bigger planes and really double down on a lot of the routes where it feels it can create more value. Yeah, the fact that there could be a challenge for the legacy airlines and also for other low-cost giants like Ryanair and Wizz. So therefore, it's potentially a new evolution for EasyJet in its growth story, and one that can be put to use with the likes of Apollo.
Danny, meanwhile, the U.S. aviation regulator has asked operators of Boeing 737 MAX jets to undertake checks for component cracking. So what more do we know?
Yeah, this is a component that is around one of the door frames of the 737 MAX. And so there is some cracking around that, and therefore the FAA does want operators of some 471 jets to just undertake some checks and see whether there may be implications for the fuselage. And the risk is that with this cracking, it could undermine the structural integrity of aircraft. So as a precaution, the US regulator does want these checks to be done. And this is all being done with support of Boeing as well. So not too much of a cause of concern, but at least one that they want inspections done as soon as possible.
Danny, thank you so much. Danny Lee there with the very latest, of course, on transport. Coming up, our exclusive conversation with the chief executive of defense giant Rheinmetall. We discuss the loss of a multi-billion-euro German naval contract. We'll also discuss much more. That's coming up next, and this is Bloomberg.
my old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. Tensions resurface. Iranian media say Tehran is looking to bar U.S. and Israeli ships from the Strait of Hormuz as reported strikes push energy prices higher. Traders turn their attention to the U.S. jobs report as they grapple with continued silence from Fed Chair Kevin Warsh. Plus, Alphabet sells $25 billion of investment-grade bonds in one of the year's largest order books for AI-related debt. We'll get the latest on tech. Now, oil has erased some of the declines from earlier in the week after reports of strikes by Iran in the Strait of Hormuz. Let's get more from Will Kennedy, our EMEA news director. Will, I mean, it's just unclear, frankly, what exactly is happening. So another volatile week for this elusive deal.
That's right, but prices are only a little bit above $80 on Brent and below that for WTI, and these are not very high prices in the context of the war and what we've seen this year, and I think that probably reflects an underlying feeling that there will be some kind of deal that allows more oil to escape from Hormuz in the coming weeks, and also that despite everything, the global crude market remains fairly well supplied. Where there is more tension is in the global product market, what people are paying for diesel, gasoline, and jet fuel, and those prices do remain very high. So oil is not that high, but it will have an impact on the economy through those product prices.
I mean, it's impossible to know what happens, but actually it's also geopolitically impossible for the U.S. to take the deal as it is.
That seems to be right, and the negotiations seem very slow. What we don't really understand are the deliberations inside Iran, the different factions inside Iran, how much hardline voices inside Iran are really pushing for a deal that the U.S. cannot accept. It's slow going. Earlier, Trump said this week that it would move in 48 hours. That hasn't happened. We'll wait to see what happens today and over the weekend, but I don't think anyone's expecting a flood of shipping through the Strait anytime soon in the coming days.
We've also seen European natural gas rising.
That's right, and I think that reflects a concern about the coming winter. When the Strait was briefly open a couple of months ago, a few weeks ago, there was optimism that Qatari gas would be able to get out and help replenish European supplies stockpiles before the winter. That prospect has dissipated a lot. Stockpiles in Europe are in the sort of 50-something% range. You'd normally expect at this time of the year to be higher, perhaps 70-something. And as we get closer to those winter's months, if we don't see those flows of LNG, there will be concern that Europe's going to have to spend a lot of money buying LNG through the winter, which will bring up energy prices across the continent.
I mean, in general, when you look at oil, how has it been moving actually from the Gulf during the Hormuz closure?
So it is escaping, not at the volumes we would have seen before the war, but perhaps at volumes that are higher than people expected, and it's happening in two ways. Those pipelines, both through the UAE and through Saudi Arabia to the Red Sea. Despite the Houthis, that oil still seems to be flowing, and then we are seeing some oil come through the Strait of Hormuz itself. It's hard to detect because the ships are going through dark with their transponders turned off, but there does seem to be these shuttle runs which are getting some Emirati oil out as well. So there is oil, it's not a complete blanket. There's probably Iranian oil getting out as well. And as I said, the crude market globally isn't enormously stressed right now, but products markets are a little bit more so.
Well, thank you so much, as ever, for joining us. Will Kennedy, their EMEA news director. Now, unusually low river levels across Europe are also disrupting trade, forcing curbs to nuclear power generation and exposing how vulnerable the region's infrastructure remains to increasingly frequent droughts. Many companies are falling back on workarounds to prevent larger disruptions, but they also may struggle to do so if levels drop further. Well, levels, for example, on the Rhine, one of Europe's most important trade arteries, have fallen to their lowest on record. We're now joined by Rico Luhmann, a senior sector economist for transport and logistics at ING's. Rico, thank you so much for joining us. Now, at the moment, certain ships can actually still pass through the Rhine. If it stays as dry, do you think there will be a point where transport is just no longer possible?
If we look at where we are now, extreme lows, capacities are reduced to, let's say, 20-25% when sailing to the upper Rhine. Well, you can always sail on the Rhine, but load capacity will reduce further if we go down further in water levels. So that's what will happen over the next couple of weeks if nothing changes.
Rico, overall, what industries do you think are more and most vulnerable to prolonged lower water levels?
Yeah, if we look at what is being transported on the Rhine, it's particularly mineral oils, chemicals, raw materials such as iron ore and coal, but also containers. And well, the first package of liquids is maybe most vulnerable because those shipments are also sailing to the Upper Rhine, to regions like Ludwigshafen and Karlsruhe, which are limitedly available and reachable at this point because you need to cross Kaup, which is a choke point on the Rhine. So these raw materials and liquids particularly are most vulnerable. If we look at containers, they can easily be shifted on rail or on the road, on trucks. So these products and these goods are more easily transported by other means and by other ways.
Rico, I mean, what are the, I guess, sectors that can cushion some of the disruptions by, for example, relying on inventories?
So if we look at the impact, industrial sites are most impacted, right? So we're talking about companies like BASF or ArcelorMittal, ThyssenKrupp, so the steel manufacturers, but also other manufacturers. So it's a massive cluster which is located on the banks of the Rhine. So it's quite an impact, and we have seen several companies already announcing production curbs on as a result of this. So we will see impact for production and also for economic development as a consequence of this.
Rico, are there any measures that politicians or companies can actually, take now to make it a little bit easier?
Yeah, it's not that difficult because we're dealing with raw materials, so that's massive volumes, right? So it's very difficult to shift these to other modes. And often it's also a matter of location on the water side. So that's not reachable by other means. So yeah, when we look at this, it's a matter of just building up more buffer stocks in the future. But that's something for the future, right? So that's not a detour for now. So now it's a matter of trying to get more barges on to just transport more on these barges. And then for the future, we will have to look into infrastructure adjustments and also adjustment of the Rhine infrastructure.
I mean, does recurring low water change this really, the long-term role of inland shipping? Do you think trades and actually routes will have to change in the coming years?
Yeah, the problem is really these volumes, because these volumes are massive, right? So it's not easy to put this on trains. We can't easily do this. There's not enough capacity available and not near enough. So that's not really a solution. Yeah, we will need to look into other options and alternatives to deal with this and to turn more resilient, because this is going to happen more often than in the past. We've seen it twice now over the last 10 years, and now again. And this is already more than in the last 50 years. You can imagine that climate change is going to have an impact even more in the future on the Rhine. So we will need to prepare for this, and that's also a message to policymakers.
I mean, again, are there actually, when you look at the next couple of months and quarters, what are the industries that you worry about the most? I know we talked to the ones that are most, vulnerable, the ones that have inventories. It just feels like it just adds on another point of pressure, given what we're already seeing with, the Strait of Hormuz.
Absolutely, yeah. It comes on top of other disruptions that we have across the world, particularly the Middle East and the Hormuz disruption, which impacts energy markets, of course. But more structurally, the competitive position of Europe is in play as well. If we look at companies like chemical industries along the Rhine or steel production, this is also one of the things that's important for choosing a location to invest in. So it really matters.
Rico, thank you so much for joining us. Rico Luhmann, they're Senior Sector Economist for Transport and Logistics at ING. Now, Rheinmetall has cut its sales forecast for the year after losing a German naval contract worth billions of euros. Germany's biggest defense company has positioned itself as a key provider of weapons to Europe. It's now seeking to secure additional contracts for its naval division. Now, we spoke exclusively with the chief executive, Armin Paperger, about the loss of that naval deal and what's next for the company.
I am very unhappy that we lost the F-126, but at the end of the day, there is an impact, but it's not a huge impact. The naval business is at the moment the smallest business of Rheinmetall, and we will have an impact this year of about 300 million euro in sales. This is exactly what we took out also from our guidance. But this business is on a level of 10%, so between 20 and 30 million, with an EBITDA of 3 billion. So you see the impact is very small on the profitability.
Could this actually lead, though, to a slowdown of the production ramp-up?
No, not really, because we have such a wide product portfolio that I'm sure that we can, over the next years, compensate or overcompensate also these areas. We are fighting hard, and I have a great team, and the people compensate a lot. So we stay on the expectations, and for next year and also the years after next year, my expectation is that the growth rate is still more than 30% per year.
So what exactly will compensate for this loss of contract? Is it autonomous vessels? Is it smaller boats?
This is one point. On the other point, we are looking for international and other national contracts. And I'm sure that also Germany will give us some contracts, because we have the biggest shipyards over water here in Germany. And Germany needs these capacities, and I'm sure that we will find a good way.
Have there been any developments on your bid for the German naval yards?
We gave a non-binding bid on the German naval yard, and at the moment I can make no decision because I have to wait that we get more contracts. With the F-126, it was a need. Therefore, that was the reason that we gave this bid. Now we have to wait, and we will see over the next 2-3 months if there are new contracts coming in, and if yes, then we will continue.
Do you worry, sir, that actually there are, other things like the frigate, F-127 that will be called into question by German lawmakers?
I have no idea at the moment what really is coming with the F-127 because the German government at the moment is looking forward to say, okay, we have to reduce the cost structure. And we are in negotiations at the moment. You know that we are in a consortium with TKMS on the F-127, and we want to do what is good for the customer at the end of the day, but we are also flexible.
I mean, Germany appears to have also decided to open the tender up to others for the procurement of the collaborative combat aircraft instead of going with the Rheinmetall Boeing product from the start. What do you make of this?
Competition is always good. Germany is looking at the moment for different solutions, and at the end of the day, the best solution should win. We go with Boeing Australia in that area because we believe that this system at the moment is a modern system and is the most qualified system at the moment. But it seems to be that Germany wants to go like on the drone business with 2 or 3 different competitors, and that's really good, and that's fine for us.
But what does it mean for you? Are you still confident that you will be given the order?
I think that the order will be first split to have a pre-phase order, and then at the end of the day, the winner takes it all. And I'm always convinced. If I'm not convinced that we are able to win, I should not go into a competition.
I mean, that's good life advice in general. Now, by collaborating with Boeing, it also means that you're no longer developing this collaborative combat aircraft with Anduril. Are you working with other things still with Anduril?
Yes, we spoke with Anduril about different things. We didn't find on the Fury a final decision in this area. That's the reason that we stepped in with Boeing. But I'm always very open with corporations, also with Untitled. At the moment, we have no product that we can sell immediately, for example, to European customers.
But what does that partnership look like? Do you have any concrete ideas in your mind of what you could be developing with Untitled?
Yeah, usually we develop our own stuff, but usually we use technologies which are ready. Because Europe at the moment is looking to have ready products and not is looking to have huge development products. And if you see the ministers of NATO in Europe says, okay, let's go forward and let's deliver. So we must be ready with our deliveries in 2029. So I have not a lot of time to develop. I have to implement technologies that partners have ready.
Could you give us an update on the state of the large Arminius contract?
Yes, sure. The Arminius contract will be in the second week of September. There will be the final negotiation on the contract. The German parliament should make a decision beginning of December, and also in December, the contract should be signed. So the first contract for Rheinmetall will be on the level of fixed contract on 12.4 billion. There is also a service contract for Rheinmetall of 2 billion. This is add-on, so we speak about 14.5 billion euro, and that's a huge contract. And then there are options. There is an option 1 and an option 2. This is up to 35 and also up to 40. So it's a very, very long-term contract. If the government signs also that options, it would be what we always expected, nearly 40 billion euro.
Well, that was the Rheinmetall CEO, Armin Paperger, speaking to us exclusively. Now, coming up, we look ahead to July's U.S. jobs report due later today with Ven Ram from our MLive team. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance. Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
It's Jobs Day, and Bloomberg has the report under surveillance.
The labour market backdrop still pretty decent.
When you take a look at wages, when you take a look at the JOLTS data today and the quits rate, that's going to matter.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market seems okay.
We don't see any wage pressures in the economy.
We're all building up to one thing.
The July Jobs Report, today on Bloomberg.
Welcome back, everyone. Now, this is a pretty incredible story. North Korea's Kim Jong-un may be isolated politically, but Bloomberg Economics estimates his family raked in as much as $22 billion between 2022 and 2025, despite a slew of sanctions. That windfall is a focus of a Bloomberg Originals documentary.
North Korea. It's a bit of an enigma. A sealed-off society on the doorstep of a global superpower. A minuscule economy, but a nuclear arsenal that commands global attention. And despite a mountain of international sanctions designed to crush it, the Kim regime has begun to thrive.
The entire North Korean government is in stronger position than at any point over the last 35 years.
Following a brief surge in 2016, crippling UN sanctions and pandemic lockdowns sent the economy into a prolonged slump. But by 2023, something changed and the regime oversaw rapid GDP growth.
North Korea's trade and overall regime revenue sources have shifted significantly. A rich North Korea has the potential to be a much larger threat.
If the world once viewed Kim Jong-un as the lonely dictator of a hermit kingdom, his recent schedule tells a very different story.
This is an amazing comeback story for leader Kim Jong-un. We're seeing Kim more
more powerful economically, militarily, politically than ever before.
His newfound cash is funding a massive military buildup and the Kim dynasty for another generation, potentially in the hands of his young daughter. So how did one of the most isolated, heavily sanctioned regimes on Earth pull off a multi-billion-dollar economic turnaround?
Well, subscribers can watch that documentary in full right now on the terminal and at Bloomberg.com. Now, we're looking ahead to July's U.S. jobs report later today. Economists polled by Bloomberg expect hiring to accelerate to over 80,000 and the unemployment rate to hold steady at 4.2%. The data comes as markets also face a lack of guidance from the Fed chair, Kevin Warsh, but a number of officials have said action may be needed to tackle inflation. Let's bring in Ven Ram from our MLive team. So, Ven, great to speak to you. Happy Friday. Plenty of cautious Fed speak this week. Kevin Warsh still avoiding forward guidance. How does that change the setup for the jobs report?
Morning, Francine. Great to be talking to you. I think that, the markets are looking for an improvement in the number from over June. But what I'm personally interested in is the actual number for June, because I think that the markets were disappointed last month because the number undershot expectations. But if there is going to be an upward revision to that number, and a significant one at that, I think that the markets will firm up conviction towards a rate hike. And at the moment, the markets are thinking it's going to be a rate hike either in September or October. But if the markets bring it forward, then obviously that'll have implications for treasuries. As you mentioned, there's no forward guidance coming from Warsh himself. But if he stays true to his previous pronouncements that look in running inflation hot is a choice, then it's logical to expect that the Fed will be hiking rates soon.
Ven, the yen has also given up nearly half of its intervention-driven gains. So, why has this happened? And could we actually see authorities step in the market again?
Well, I think if the reaction to what we have seen so far is anything to go by, I think that the authorities may think, is the risk reward worth it? Because, the yen has advanced all of 0.5% this week for all the pyrotechnics that we had at the end of last week. And it's drifting back towards those weaker levels, so which is not what they want to see. In fact, if you look at the previous 5 interventions in the dollar yen, I think in the 1 month after that intervention, the dollar yen has had little to show in terms of gains in the yen. So I think that, the point of this repeated intervention is lost on the markets. What they need to do is to raise rates sensibly and at a faster pace. And until that happens, I don't see how the yen is going to turn around its fortunes.
Ven, thank you so much, as always, for joining us. It's going to be a big day at the end of a big week when it comes to, of course, the U.S. jobs data today. Ven Ram there from our MLive team, of course, with all of the things that we need to watch out today, but also into next week. This is a picture for U.S. equities across the board. Look, they're a little bit muted. European indices also muted before the U.S. jobs data, but also gaining. Oil is gaining as prospects for a lasting agreement to reopen the Strait of Hormuz seems to be pretty elusive. I'm looking at Brent. It's at $83 a barrel. You can see the CAC 40 gaining a touch. It's nothing huge. They're kind of, I guess, in a wait-and-see situation. Also, because of that key monthly U.S. payrolls report. Up next, Bloomberg Brief, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Is there anything that humans today can do? Yes. That will change the lives of the humans currently on the Earth?
Well, first of all, people who switch over are getting the benefit right away. But coming back to the point about the fossil fuel industry and our debt to them, there's an old saying that came from the king of Saudi Arabia years ago. The Stone Age didn't end because of a shortage of stones. It ended because something better came along. Something better has come along now to replace fossil fuels, which are dirty and polluting and threatening humanity's future. The cheapest electricity in the history of the world is solar energy. Second cheapest is wind energy. And now batteries, the only thing that's come down in price faster than solar is utility scale batteries, doubling every single.
Why are we ending the wind farms that are now being built off the coast of the United States? We're ending them.
Because Trump is insane.
On another subject,
you don't want to explore that, but let me add one point on the solar. If you look at all of the new electricity generation installed worldwide last year, I often ask people what percentage of it was renewable, and people say, you know, they're looking for a high number, say maybe 30%, 35%. Correct answer is 93%, because it is taking over the electricity generation industry.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting, rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
The trading day is about to start.
And you're already looking for that edge.
The Opening Trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your Opening Trade.
Only on Bloomberg.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Countdown to the payrolls report. Markets await the latest data with the whisper number at 78,000 jobs added in July. Oil rallies after a report Iran attacked hostile targets in the Strait of Hormuz. Tehran also seeking to bar U.S. ships from the waterway. And the yen gives up almost half the gains driven by the U.S.-Japan joint intervention. A mixed picture across Asia in the Friday session. Let's check in with Winnie Su in Hong Kong. Winnie.
Yeah, good morning, Bonnie. Well, we are seeing a bit of a cautious mood in Asia today, especially with oil rebounding on these geopolitical uncertainties and ahead of that U.S. jobs data. Now, for the Kospi Index, we did end it in the red. However, we saw SK Hynix trimming some of those losses in the post-market trading after the company filed plans to announce details of shareholder returns for third quarter and also a separate plan to spend $38 billion for its chip-making facilities in South Korea. Chinese onshore stocks are a bit of a bright spot today. We did have quite positive trade data for both imports and exports, seeing double-digit growth on these on the global AI demand. Now, flip of where we take a look cross-asset because we have Asia bonds tracking these losses in the treasuries overnight, but also the Japanese yen, as you mentioned, still under some pressure, having weakened past that 158 level against the dollar.
All right, Winnie Su, thank you so much, and have a wonderful weekend. Now let's get a read on the European session to London with Justina Lee. Justina.
Good morning, Bonnie. Now, it's a pretty quiet day ahead of that U.S. jobs report, with the bond yield kind of rising just a little bit, reflecting some gains in oil. Now, when it comes to the stocks, Europe 600, it's on track to wrap up a fourth straight week of gains. And today it's led by a lot of those healthcare names, you know, like Roche and AstraZeneca and Novo Nordisk. Now, when you flip the board here, I've been saying all week that the Stocks Europe 600 is reaching new highs. And we can see here that it's been like steadily climbing recently. And what you cannot see in this chart, though, is actually a lot of those gains have broadened lately to a lot of different names and a lot of different sectors. And that's on the back of what has been the best quarterly earnings season in a few years. Bonnie.
That's for sure, and we're not done yet. Justina, thank you so much, Justina Lee there. Here in the U.S., a relatively uneventful session before the non-farm payrolls. We are seeing a nice gain for futures, though, this after modest declines yesterday for the major indices. Let's take a look at yields, though, because we did see a 5 to 6 basis point increase in yields across the curve. Uneventful, as I say, this morning. We're just down by a basis point on the 10-year, 466.78, but that is relatively elevated. This partially on oil, higher. We're around $83 and change a barrel now on Brent. Also, though, after the productivity numbers came in better than expected, and also the unit labor costs weren't as maybe dangerous as the Fed was maybe worried about. So let's now get a check on individual pre-market movers. Back over to London and Chloe Melly.
Good morning, Bonnie. We are seeing Airbnb up this morning after it lifted its guidance for the second time this year. It's really benefited from solid demand for travel in the US and Europe, despite those higher fuel costs, despite that weaker consumer confidence. And so we are seeing quite a lot of enthusiasm around that stock this morning, up about 9%. Moving on to Cloudflare, which is jumping in pre-market trading this morning after boosting its guidance. We're up about 15%. It seems that as AI adoption grows, there's also a growing need as well for those digital defenses. And so we're up there quite strongly. And finally, the digital advertising company Trade Desk is down this morning after some disappointing guidance. And we had Bloomberg intelligence analysts also saying that the company's turnaround is currently losing credibility. So we're down significantly there this morning, almost 28% for Trade Desk.
All right, that is a massive decline, a very volatile stock. Chloe, thank you so much. Chloe Melly there. She'll be back later in the hour. Also coming up this hour, Rory Blundell, CEO of Gravity, joins us on AI security risks. And we'll look ahead to the jobs report with Christopher Hodge of Natixis. Oil extending gains as Iranian media report Iran will seek to bar US and Israeli ships from the Strait of Hormuz. Iran also attacking hostile targets in the waterway. Meanwhile, President Trump insisting the war will end, quote, pretty soon. Bloomberg's Abir Abu Omar joins us from Dubai. First, these attacks. Abir, what can you tell us about them?
Yeah, good morning, Bonnie. So essentially what we know is that the UK Navy had in the morning said that the 2 ships were prone to getting attacked in the Strait of Hormuz. And then Iranian media itself said that it attacked 2 hostile targets. Now, we don't know what kind of ships those are. But what we know for sure is that in the Strait of Hormuz, vessels making their way through or trying to make their way through are still prone to getting attacked by the Iranian army. We're also seeing that the US naval blockade is still very much in place. And that is why we haven't seen a massive trickle of movement over the past couple of weeks or so. Now, this is all happening while we understand that negotiations between Iran and Oman have led to some kind of resolution. A big caveat there is that we're now going by the word of Iranian state media that suggests that Iran will bar US and Israeli ships from going through the Strait of Hormuz, while also establishing some kind of toll system to ships of countries that it deems hostile. Now, a lot of the traders are assuming that by the term hostile, Iran could be referring to tankers coming from GCC nations. Nothing is sure yet. We still need to find a formalized statement from Iran. Our understanding for the time being is that that statement is with the Iranian parliament. Washington had no involvement in those negotiations. They merely happened between Iran and Oman to find some kind of mechanism to get ships and tankers moving through the strait.
Yeah, this even as President Trump continues to say there is a deal at hand. Now, the Houthis have also conducted a large-scale attack against forces from Yemen's Saudi-backed government. Tell us about the attack and what it portends.
Yeah, some casualties there as well, Vani. This is the biggest escalation between the 2 warring parties. That's the Saudis and the Yemen-based Houthis since 2022. That is the year when they reached a truce. So we have reported that the Yemen-based Houthis had attacked the government in Yemen, which is backed by the Saudi coalition. As a matter of fact, just at the top of your show, we had a story from our energy colleagues suggesting that tankers that are entering the Red Sea, now the Red Sea is obviously the pathway that Saudi Arabia has resorted to throughout the course of this war to get its shipments across. It has been getting attacked by the Houthis, or is under the risk of getting attacked by Houthis, the northern part of that. And those tankers that are entering the Red Sea are increasingly signaling other places to go. So another risk at another waterway, possibly driving energy prices even higher than what we're seeing right now.
Yeah, exactly. Abir, thank you so much. Bloomberg's Abir Abu Omar. Let's get a check on the yen right now. We are seeing that it's lost nearly half of its gains. It's above 158 since last week's intervention. Fueling speculation authorities may take action again. Joining us now is Bloomberg's Ven Ram. It was pretty controversial last week, Ven. Would the US get involved again so quickly, given that the first intervention really hasn't done the job?
Well, I think that, the authorities are quickly finding out that, look, there is no bang for this buck, really. You can keep intervening in the markets repeatedly and throw good money at the markets, but the yen is not going to replace that repay that faith in that comes from intervention, because what we have seen in the 5 prior episodes, starting from June 2022, when they started intervening, is in the 5 prior bouts, the 1 month return on the yen has been negligible, next to negligible, except for 1 episode when other factors came into play. So really, there's no historical evidence that these interventions work in favor of the yen. And I think that the real answer lies in with the BOJ, not Japan's finance ministry. The Bank of Japan needs to put up rates at a fast pace, at a fast enough pace to take it to neutral. That will solve a lot of the problems that the Japanese authorities are trying to save themselves from. And it is, so that is where the answer lies. And until such time that happens, the yen is not going to see its fortunes turn around.
Then I have to ask you what you made of the FT report yesterday on Kevin Warsh and the potential for a September hike. Did it change your opinion on how likely it is that we'll have a hike in September?
Well, if you're going to assume that the Fed is independent, Bonnie, I think that, the chorus of voices coming out from the Fed is pretty clear. I think more and more are leaning towards a rate hike sooner rather than later. We already got 3 dissents last month. So I think that, if the US economy continues to grow at the resilient pace it has been, and we'll get evidence of that with the non-farm payrolls report today. And I think that if that resilience continues, you've got an economy that is growing solidly above trend. You've got the AI boost to productivity, and yet you have had inflation running amok for the past 5 years above target. So the question is, what's not to raise rates? So I think that the Fed should be looking to raise rates here.
All right, Ven, thank you so much. Bloomberg's Ven Ram. Now to other top stories trending on the terminal this morning. SpaceX shares giving up some of those gains after the lockup expiration. Nearly 912 million shares were released, worth about $100 billion. Despite a roller coaster ride since the IPO, many of the company's early investors are sitting on paper gains. SK Hynix will invest $38 billion to build new semiconductor fabs in South Korea. It's part of a strategy to expand mid to long-term memory production capacity. Bank of America's bull and bear reading climbs to its highest level since 2021. Strategists saying investor bullishness is so extreme that traders should start reducing exposure to risky assets, instead investing in defensive assets. Coming up, Rory Blundell, CEO of AI agent management platform Gravity, joins us on the growing threat of AI-driven cyber attacks. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersetchi in El Ula, Saudi Arabia, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
It's Jobs Day, and Bloomberg has the report under surveillance.
The labour market backdrop still pretty decent.
When you take a look at wages, when you take a look at the JOLTS data today and the quits rate, that's going to matter.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market seems okay.
We don't see any wage pressures in the economy.
We're all building up to one thing.
The July Jobs Report, today on Bloomberg.
Over 17,000 different actions taken over 4.5 days. So the speed and the volume of the actions taken were nowhere close to what like a human cyber attacks could be. Sometimes we ask agents to think outside of the box, but we don't want them to think outside of the sandbox.
That was the CEO of Hugging Face there, warning about the growing security risks from AI agents after the company was recently hacked by OpenAI. Joining us now is Rory Blundell, CEO of Gravity, an AI agent management platform. And thanks for joining us. This morning, we learned that Chinese firm Moonshot's Kimi K3 has now also broken out of its sandbox, Rory. So that's really all of the major companies that are doing this. What are we supposed to take away from the fact that they can break out and hack or, you know, get up to some mischief? Seems like we might have a little bit of an audio problem with Rory, so we're just going to hang on for 1 second. And in the meantime, I would like to give you some headlines from a President Trump interview with Punchbowl News, and it's specifically on Kevin Warsh and the Federal Reserve. He was responding to a question on rate hikes, and he said it's not completely up to Warsh on whether the Fed hikes rates. He says that he won't criticize Warsh. He says, quote, he's great, but he also said that it's not completely up to Warsh and that obviously he would like for the Fed to have lower rates. Once again, this is President Trump in an interview with Punchbowl News saying it's not completely up to Kevin Warsh whether the Fed hikes rates before the vote. It's not clear if he's speaking about the rest of the FOMC, the other board members, or in fact himself. And we know from reporting that he has been calling Kevin Warsh in bouts. He goes quiet and then he calls him several times over some days. Not clear whether they speak about monetary policy. Let's get back to Rory Blundell now, CEO and founder of Gravity. So once again, Rory, why should we be concerned? It seems like all of these major AI models have the capacity to break out of their sandboxes and create some mischief, get up to some, you know, malintent in the world.
Well, firstly, good morning. Lovely to meet you. I don't necessarily think that we should be concerned, actually, in relation to this. I think that what this really tells us at the moment is how powerful these models are, yes, but also it tells us to get real economic benefits from all of these models and from AI at the moment. The thing we must be focused on as a society is governance, security, and control. That is what this really highlights to us at the moment.
So in that sense, who are we supposed to count on for governance? Because it seems like every sovereign wants to govern their own AI, and at the same time, they also all maybe want to have open sources available to everybody. So how does it all work, Rory? How are we going to get regulation?
That's a good question. I think the last word that you used is part of it, Vonnie, but I don't think it's the total answer. What it requires is businesses to recognize that the security and governance controls that we built over the course of the last, let's say, 20 to 30 years for the internet age, don't forget about those security guardrails and the things that we did. So as an example, if you were a CIO or a CTO in a business in, let's say, the year 2010, you would never have dreamt of allowing an organization or a person direct access to your data. But what people are doing in the agentic era is allowing organizations, these agents, whatever it may be, other humans, direct access to models and direct access to these agents. And what you need to put in place, these layers of governance, security, and control. And that comes from companies like us at Gravity that ultimately provide these services that enable you to implement things like Guardian agents, that enable this layering and strength in depth that enables you to have the control that you need over your AI systems.
Rory, let me ask you, if there isn't a human behind the hack, if it's just the AI hacking, does it really matter?
Just repeat that for me, Vonnie.
If there isn't a human being behind the attacks or the hacks, then does it really matter? Does the AI agent know what to do with the information that it might have access to?
That's a good question. There's one thing that we must clarify here in relation to this, that we shouldn't confuse agents themselves or AI systems as sentient beings, and we shouldn't conflate humans and agents. But to answer your question directly, does it matter? It does matter. It does matter, the fact that whether it's an agent or a human, the impact, if you look at one of the hacks that happened this week with the Anthropic model that happened as it was deployed by the UK's AI Security Institute, what really showed, this was something that happened in the real world. This went and tried to provide a malicious piece of code in GitHub, a code repository that is in the real world. So it has real world impacts. If that software, if that piece of malicious code was implemented in a piece of software, you would now have a bug in that software, and potentially that would spawn a lot of things. So it'd have a potentially very large economic impact. So we should be concerned, but the way that we gain the economic benefits that you can from AI is through this security, governance, and control.
Are companies efforting for this to happen? I mean, like Anthropic, you know, Moonshot and so on. Because if AI agents are breaking out of their sandboxes, why do they automatically want to hack? Why don't they want to do something else? Are they prompted to hack?
Yeah, it's actually how they were set up. So your question is the right question, because what's happening here is these are in environments where they're actually testing how powerful these models are. They want to see that if you have the guardrails taken off these models, so if you take any of these models that we're talking about at the moment, when any user, you or I or any of the listeners and viewers would go and use these models, what happens is there's not just a single model that you're interacting with. You've actually got many guardrails around it that are determining, hey, is this trying to do something that it should, is this user or this agent doing something that it shouldn't be doing? And so what we actually see here is the net result of this is making sure that all of these models, you have the guardrails and security and the governance and everything like that around these models. That's the way that really you get the benefit associated with them.
You actually say a human being should be responsible for the models. How would that work?
That's a good question. I think that fundamentally that must come back to some aspect of regulation. But how it would work in practice is that I believe quite firmly that where we need to get to as both organizations and in society is where agents that are operating on behalf of organizations, they need to have a register within organizations that are outlining what is the agent, what's it doing, and who is the accountable human being for this agent alongside the organization.
All right, Rory, thank you so much for joining us this morning. Rory Blundell, CEO and founder of Gravity. Coming up, a look at what's making headlines in your front page news next.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together And there is no reason for the US not to work with Africa CDC. Africa CDC is the leader in terms of public health in Africa.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting, rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
This is Bloomberg Brief. I'm Bonnie Quinn in New York, and it's time now for your front page news. First up, the Financial Times reporting that a New Mexico judge has ordered Meta to pay an extra $567 million in compensation and safety features to address the harm caused to children. That brings the total penalties from the New Mexico lawsuit to nearly $1 billion. The suit accuses Meta of exposing children to sexually explicit content, solicitation, and human trafficking. Next up, the Wall Street Journal is reporting the U.S. says Russian President Vladimir Putin could try to test NATO's resolve with a limited assault on an allied country in the next few years. New U.S. intelligence reports posit possible scenarios ranging from a cyber attack to a small-scale land incursion. And finally, the New York Times on President Trump's two executive orders targeting birthright citizenship weeks after the Supreme Court rejected the president's previous efforts. It wasn't immediately clear how the twin orders could realistically be enforced. The orders would restrict citizenship to children of staff working for foreign governments on U.S. soil and babies of mothers who lie about their intentions for visiting the country while pregnant. Let's take a look at the macro picture as we approach non-farm payrolls in just a few hours. We do have NASDAQ 100 futures pointed higher after just a modest sell-off yesterday and a lot of volatility this week in chip stocks in particular. Brent crude has been rising once again, modestly, but we are still above $82 a barrel on attacks, fresh attacks in the Strait of Hormuz and also Houthi attacks in the Red Sea. And the two-year yield, while it's unchanged right now, it did move up 5 to 6 basis points yesterday. So the market pricing in partially this oil hike, but also the possibility for a September rate increase at the Federal Reserve. Coming up, we're going to drumbeat to that report with Christopher Hodge of Natixis. This is Bloomberg.
Some people have written that your bank, Revolut, is worth $75 billion. Have you ever thought of taking your organization public?
Well, the way I think about it, we kind of will be ready probably in 2 years' time. But then again, depends on how good the market is.
Since you don't have an IPO, how do people who work for you make some money? Do you make a market for people to sell their shares internally?
Yeah, so we do secondaries every 1 or 2 years when people can sell certain portion of their stocks to external investors.
So you've done secondary sales for your employees, so employees can then get some liquidity. Do you expect before you go public you'll do any more of those, or are you just going to wait till you go public before you liquefy any more stock?
Yeah, I think so. We might do secondaries as well before we do IPO, because we do it every 1 or 2 years, so we might do secondary as well.
All right, well, if anybody wants to sell their shares to me, let me know. And have any investment bankers told you why they're the best to do the IPO for you?
Yeah, obviously every single one is the best.
Everyone is the best. You're not in a rush to do it. You don't need the money.
So we're a bank, and then for the bank, it's super important to have trust, and then public companies are trusted more compared to private companies. So that's the reason.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Countdown to the payrolls report. Markets awaiting the latest data with the whisper number at 78,000 jobs created in July. Oil rallies after a report. Iran attacks so-called hostile targets in the Strait of Hormuz. Tehran also seeking to bar U.S. ships from the waterway. And the yen gives back almost half the gains driven by U.S.-Japan joint intervention. Let's take a look at those markets then. It's a pretty uneventful morning as we await that payroll data, but we are seeing some bounce back after yesterday's small declines for the major averages. The Nasdaq 100 in particular looking for some nice gains at the open. Had a very volatile and choppy week, particularly for the AI-related and chip names. Yields-wise, we did see a move higher yesterday, 5 to 6 basis points across the board. Pretty unchanged today, but that 2-year yield has crept up to almost 4.24, and the 10-year yield back almost at 4.67. Never mind the 30-year yield, which is really pretty elevated now at 5.21 and change. Again, Brent almost at $83 a barrel, and WTI following it. Let's get to some individual movers now. Over to London and Chloe Melly.
Good morning, Bonnie. Airbnb has lifted its guidance for the second time this year. It seems that despite those higher fuel costs, despite consumer confidence taking a bit of a hit, there's still very resilient travel demand, especially in the US and Europe. And we are seeing that reflected in that guidance raise and that share price this morning. Moving on to Cloudflare, which is another company that is moving higher this morning. We're up about 15% in pre-market trading, a cybersecurity company that has boosted guidance. It seems that as we see this growing AI adoption, there's also rising demand for those digital defenses and cybersecurity systems. And so we are seeing that that really drive those shares this morning for this company. And finally, the digital advertising company Trade Desk is down significantly, taking a major hit this morning. We're down almost 28% after giving quite a disappointing guidance that actually prompted at least 4 downgrades on that stock. And Bloomberg Intelligence analysts said that the company's turnaround is losing credibility. So we're seeing a lot of volatility in this company this morning and a huge hit in pre-market trading.
All right, Chloe, thank you so much. Chloe Melly there taking us through some of the pre-market movers. Well, we're just under 3 hours away now from the July payrolls report. Joining us on set is Christopher Hodge, Chief U.S. Economist at Natixis. Pleasure to have you in studio for the first time, Chris.
Thanks,
Very nice
Bonnie.
to chat with you. What are we anticipating? What's your baseline number today?
Our official forecast is a payroll gain of 65,000 jobs. That's slightly below consensus, but within the realm of normal. We do think we're going to get an uptick in the unemployment rate. There was a remarkably strong slowdown in the prime age participation rate in the last reading. We think that's a bit of a statistical anomaly that's going to bounce back, and more people entering into the job force we think is going to put upward pressure on the unemployment rate. But ultimately in the realm of normal, so not really going to move the Fed's thinking too much.
We're not seeing a huge amount of fragility in the data yet on the labor market. Do you anticipate that we will at some point? There are still voices out there saying it's coming and before the end of the year.
Yeah, the labor market's been remarkably stable. And I think we've seen a slowdown in labor demand, but we've also seen an attendant slowdown in labor supply. So that has kept the unemployment rate within a very narrow range throughout the past year or so. But I, like a few others, do think that there is a underlying weakness there. That if you ask consumers about their confidence in their ability to find a new, better paying job, that's been flagging a little bit as well. So ultimately, I do think it's right in the sweet spot for the Fed, that it's a labor market that's stable, but it's not contributing to any inflationary pressures in our view.
Yeah, well, we definitely didn't see any inflationary pressures in the unit labor costs yesterday. The revisions for June, are you anticipating that we'll see an upward revision, and would it have to be a lot upward for the market to price in a hike?
Yeah, historically speaking, over the past 10 readings, 5 of them have been revised up for June, 5 have been revised down. So it's sort of a crapshoot either way. But I do think there's a little bit of folly in looking at just 1 or 2 numbers. I mean, this is a labor market that throughout 2026 has created on average about 92,000 jobs. That's certainly at or above most estimates of the break-even rate. So nothing terribly concerning. I think we'd have to see a pretty shocking downward number to really shake what the Fed is thinking right now.
A downward number. Speaking of crapshoot, is September a crapshoot? Is it a coin toss at this point, or is the bias more towards a hike?
I think the bias is probably more towards a hike right now, but this is a Fed that's more data dependent than ever. The press conference in July, I do think added a little bit of credibility concerns about Chair Warsh. Now, I think those are going to be fleeting. I do think he is very serious about getting the inflation target back down to 2%. And we're cautiously optimistic about the next 2 inflation prints. So we don't see a whole lot of inflationary impulse from the major components of inflation, and we're optimistic that there will be a slow grind down to 2%. The question is the Fed going to get frustrated with that progress, that it's not moving fast enough? But right now, we have an extended hold in our forecast for the Fed.
So the FT report yesterday, I know you saw it, it seemed to suggest that perhaps there was some dissatisfaction at the Fed as to that news conference that you just mentioned. I mean, what does it say to you that that report came out?
I think it's sort of clear, the report was that Chair Warsh could have done a few things differently and maybe could have been explicit about if inflation stays sticky or reaccelerates, the Fed is going to be hiking. So I think this happens with almost every new chair of the Fed, that the communication is a little bit rocky at first, but ultimately I think this is a chair that wants to speak less, and I think we're probably going to see less press conferences in the future.
Why do you think he did speak that way? I mean, on the one hand, he's not cagey at all. He's, we're price stability focused. That's what we're going to do. We're going to bring inflation down. Yeah. And at the same time, some of the comments from that press conference came off as just a little bit, coy, a little bit cagey, a little bit, well, we don't know what we're going to do. Is he speaking to different audiences? Is he also targeting the president, for example, at these conferences?
I think there's a lot of both internal and external stakeholders that he has to cater to. I think he also wants to gain credibility with his colleagues as well. And if his colleagues are going to be speaking and he's not going to be as forthright, then that void is going to be filled. So I do think that he is speaking on behalf of the committee when he's speaking at the press conference, and I think he's sort of still getting a handle about how he wants to communicate. And I think a lot of the task forces are going to do a lot of that work to establish how the Fed's going to be communicating in 2027 and beyond. But until then, I think it's going to be a little bit of a crapshoot.
The president just telling Punchbowl News that it's not completely up to Warsh on whether the Fed, changes interest rates, that obviously there's a committee there, but that he won't be criticizing him. He says, quote, he's great. So in that sense, it seems like he has a free hand. But if he outsources sort of the hiking impetus to other people, then perhaps it takes the pressure off him a little bit, or is that too much of a political reading of what's going on?
I think that's probably a little bit too much of a political reading about what's going on. I do think, Warsh has been a hawk for most of his career. This is probably a job that he's wanted for the past 20 years or so, and I think he's doing the job right now for posterity's sake, and he knows that history is going to be viewing him and his efficacy as chair of the Fed in whether or not inflation comes back down to target. So I don't think he's a political actor, but it's a very tough political area right now.
We are seeing things like incremental tariff threats and so on coming, weekly at this point.
Yeah.
Are we through the worst of the inflation, at least headline inflation fears?
I think that we are. Really, for the tariff threat, the effective tariff rate hasn't moved a whole lot since April 2nd of 2025. We've really just swapped out the legal authorities in which tariffs are being applied. So it's not like once the court struck down the emergency tariffs that businesses dropped prices, they just stopped increasing them at that rate. So, inflation is a rate of change in prices, and I don't see a reacceleration there because the effective tariff rates really haven't changed a whole lot.
So the yield curve as it stands now, we were up 5 or 6 basis points, in the last 24 hours. Is this reflective of reality, or is this pricing in some fears?
I do think it's pricing in some fears. I do think the FT article yesterday probably quells a little bit of that, some of the fears that Warsh might be a dove in hawk's clothing. I don't think that's actually the case, but there's a confluence of events from Japan to worries about the fiscal outlook, et cetera, et cetera. So there is a bit of an uncertainty premium that's starting to be priced in right now, but I don't think that's going to be permanent.
The long end of the curve is absolutely, it's quite elevated at this point. Historically, maybe that's not, a huge amount to have to pay for 30-year debt, but at the same time, relative to recently, it is. Does it come back down? Does it need to?
Yeah, ultimately, I think that it will come back down. We've shot up a lot in the past few weeks, but there are policy tweaks, both at Treasury and at the Fed, that could help bring that down, and that is a very politically hot-button issue that I think all policymakers are going to want to tackle.
Yeah, all right. Chris, we have to leave it there, but thank you so much. We'll be looking forward to looking at the results of the non-farm payrolls report after your analysis. That's Christopher Hodge of Natixis. Now to other top stories trending on the terminal this morning. President Trump says it's up to the Fed Chair Kevin Warsh, quote, a little bit but not completely, whether the Fed should hike rates before the November elections. In an interview with Punchbowl News, Trump said Warsh has a board that's very political. He also said he won't be criticizing Warsh, saying, quote, he's great. The Trump administration is considering issuing an executive order on vaccines and autism as soon as next week. Sources telling Bloomberg President Trump wants to see additional action on the matter. An order on vaccines and autism would put a spotlight on the topic officials had previously sought to downplay ahead of the midterms. Allianz posting record second quarter profits. Results were boosted by investor demand for fixed income. PIMCO, which is owned by Allianz, attracted 31.7 billion euros from outside clients. Coming up, oil gaining as Iranian strikes in the Strait of Hormuz cast doubts on negotiations between Iran and the U.S. That's next. This is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
I don't want to say it has been. It's sort of open right now. You know, we have a thing called the blockade headed up by the U.S. Navy, and we control it. And now we control it, but they can always shoot something. They always have something or drop a mine. I think we're doing very well. I just, you know, I'm involved in the negotiation. I think we're doing fine. It could be soon.
President Trump speaking about a deal to reopen the Strait of Hormuz. Iranian media reporting soon after that Iran wants to bar U.S. and Israeli ships from the waterway as part of its deal with Oman. Bloomberg's Abir Abu Omar is back with us from Dubai. So give us what we know exactly, Abir. Iran and Oman are about to come out with a deal that apparently is struck. What exactly is in that deal that we know?
Good morning, Gwani. Yeah, look, according to state media in Iran, this is what we know, right? This is not a formalized way of us looking at this deal between Oman and Iran, but according to the state media, the deal will include two major clauses. One is Iran is considering barring U.S. and Israeli flagged ship from crossing through the Strait of Hormuz. And then the second big part of it is that Iran is also considering charging what it considers hostile vessels making their way through the Strait of Hormuz. Now, for the first one, historically speaking, we don't really know about a lot of evidence of U.S. or Israeli flagged ships that had made their way through the Strait of Hormuz. So it could be a symbolic move of Iran trying to assert its dominance. But for the second one, the second part in this, Iran trying to charge hostile ships, according to that draft, according to state media, that is what could be dangerous because this is the largest oil exporting region in the world, and traders are really considering that hostile ships term as Iran's way of saying that it will have to charge vessels from GCC nations. And so we'll have to wait and see what exactly comes out in that draft. President Trump did say a couple of days ago, over 48 hours, that we'll know more in 48 hours. Now that time window has gone. We still don't have from the Iranian side that draft. And then again, Iran, through officials multiple times, had said that that agreement that is taking place or that has been with the parliament over the past few hours or since our early morning is merely an agreement between Iran and Oman to find a mechanism for ships and vessels to make their way through the waterway.
Yes, and you know, the oil market is reacting to all of the headlines that become public, but there's so much that we still don't know. Now, the Houthis also conducted a large-scale attack. Tell us where this attack was centered on.
Yeah, so this is the biggest escalation since the truce that was reached, Vani, between the two warring parties in 2022. So quite a big escalation that is quite concerning, widening the parameters of this war. Now, of course, the Houthis are Iran-backed, based in Yemen. And what we know is that they attacked the government in Yemen, which is backed by the Saudi coalition, leaving some casualties there, admittedly also by the Yemeni government. Now, what we understand and what we have reported on over the past week or so is that Saudi is trying to speak to the Yemen-based Houthis to find a way back to diplomacy via Oman. So Oman is mediating those conversations as well, according to Bloomberg sources. Those don't seem to be bearing any fruit because those latest escalations happened overnight. The Houthis are not only attacking the government in Yemen, but they're also threatening to attack ships, Saudi ships, in the Red Sea. Now, the Red Sea is the pathway that Saudi Arabia had resorted to throughout the course of this war, Vonnie, staying away from the Strait of Hormuz. And so even that waterway, Bab el-Mandab, another crucial waterway, is now prone to those attacks by the Houthis, possibly leaving an impact on Brent crude prices. We're not seeing a lot of that now. As a matter of fact, we're seeing Brent crude about 2/10 lower at this point, but still above that mark of $80 on the barrel.
Yeah, and they had migrated as well, not just the Bab el-Mandab, but they had also started attacking more northern ships. Abir, thank you so much. We'll obviously continue to monitor. That's Bloomberg's Abir Abu Omar. Turning to tech, this week's rally continues to persist with futures still rising this morning. Joining us now is Matt Bloxham of Bloomberg Intelligence. Matt, will valuations on all of these AI-related names and chip names, memory names, will they continue to be as volatile going forward, or are we anywhere close to price discovery on some kind of a stable valuation?
I think we should still assume quite a high degree of volatility, certainly in the second half of this year and probably into next year, because there's still a huge amount for investors to figure out about the size of the AI opportunity, the relative opportunity that different players have within that, and how they're executing against it. I think there's probably still more surprises to come in terms of capital spending and some kind of polarization in how people are getting returns against those investments.
And China's potential for dominance in any of these fields, will we know a lot more in 3 to 6 months whether China can actually take market share internationally?
I think we're definitely going to get a lot more clarity on that. Obviously, we've started to see some IPO activity against some of the Chinese technology names. I think that's going to grow in the second half of this year and into 2027. So we'll get a lot more insight about the capabilities of the companies that are operating out of China, and to probably kind of find out about some companies that weren't really that well known before either. And I think China's clearly investing heavily in the space. They're doing it in a very different way to the US companies. And I think that probably over time, the gap is going to close. Obviously, they've taken quite a different approach on AI models, going for a much more kind of efficient, cost-effective approach relative to the kind of big hyperscalers in the US. So I think the competition between the US and Chinese domicile technology companies is definitely going to grow over the next 12 to 18 months.
And China ramping up things like memory production as well. Now, the Nasdaq was down yesterday, but SpaceX certainly wasn't, and closed up 6.7% on the day, which wasn't fully half the drop from the previous day, but nevertheless it was higher. Your reaction to this, $100 billion lockup expiring and it being digested like that?
Yeah, I think probably most of that reaction we saw was really a recovery from that big drop on earnings day. I think to some degree, this release of additional equity into the market helped to provide new shares for people to trade. I think some of that was probably short covering, but perhaps also retail investors who'd been disappointed through the IPO allocations, getting an opportunity to kind of buy more exposure. And I think, still, if you bought this in the IPO, you were buying it for a long-term story. And if you see a dip, you'd probably be, if you have the cash, you're probably going to be thinking, well, this is a good opportunity to increase my exposure. So I think perhaps not such a surprise that we've seen that reaction given the weakness the day before and the retail investor appetite we've seen for the last few months.
And we're just at the beginning of what's going to be so many lockup expiries, ending with Elon Musk's own 6.4 billion shares of Class A common stock next year. But I want to ask you about the short sellers. You mentioned them. They apparently are taking advantage of this. So S3 data on Wednesday showed that short interest was at 36%. Give it to us. Is that relatively high short interest? I mean, obviously it would only take 3 days of turnover for that to expire.
Yeah. I mean, it certainly does sound like a very high short interest. This is a volatile name with very limited information. It's been quite polarizing. There's been very different views out there about the forward opportunity for SpaceX and whether it's priced correctly or not. And if you're a short seller, you have to have high conviction and a lot of bravery. But I think certainly, I guess that they kind of saw that perhaps the near-term numbers weren't going to be particularly supportive of the kind of longer term upside opportunity and kind of put that trade on. But yeah, I think that's a pretty high short interest.
Yep, exactly. Matt, thank you so much. Matt Bloxham there of Bloomberg Intelligence. Coming up, we wrap up the week with the jobs report and Fed Speak on deck. This is Bloomberg.
The most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Now a look at what's ahead today. As if you didn't know, the main event, July payrolls, coming at 8:30 a.m. Eastern. We also get some Fed Speak with Richmond Fed President Tom Barkin speaking at 10 a.m. And looking ahead to the weekend, Berkshire Hathaway earnings on deck for Saturday. Let's take a look at some pre-market movers. Airbnb lifting its outlook again. US and European demand going to be stronger in the second half, and that's the second time this year that Airbnb has lifted its outlook. Those shares up almost 10% in the pre-market. It's the return of the software makers once again, and it continues this morning with Atlassian soaring after solid results and a great forecast. Digital advertising company Trade Desk, though, is a different story, down almost 30% now in the pre-market. Analyst downgrades are piling up. It gave a weak forecast. It had weak revenue growth. It's still in that dispute with Publicis, and it's just a negative outlook for Trade Desk. Let's take a look at your macro picture as we head towards payrolls ever so slowly. NASDAQ 100 futures pointed higher after yesterday's small decline, and as results start to get behind us now, we do have the two-year yield really unchanged today, down about a basis point, but up 5 to 6 basis points from yesterday. And Brent crude just reversing now. It's down ever so slightly, having been elevated after reports of attacks by Iran on what it calls hostile countries.
with being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it, you know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these. Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise ahead or Gattaca?
Maybe somewhere in the middle.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We think we're in store for some weaker reports upcoming.
The labor market's still relatively sideways.
The signals are muddled. They're not telling you what they typically tell you because a lot is going on.
Things could change. The U.S. labor market can turn around quickly.
This week, it's all about Friday.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, it's Payrolls Friday. Economists are looking for a solid 80,000 jobs added in July as a boatload of alphabet debt is helping to keep bond yields elevated, and additional hawkish Fed officials are lining up to share their views on the Fed's next move.
Yesterday, we heard from St. Louis Fed President Alberto Musalem talking about how it's just been a really long time where the Fed has been above that 2% target, and is saying against this backdrop, it is crucial that monetary policy put a meaningful restraint on underlying inflation rather than tolerating somewhat higher inflation. In other words, seemingly lining up behind the idea of a more hawkish reaction function. I do wonder whether the market's listening, whether the market cares. It really is only the cadre of members at the core, which is the governors, that really at this point will move the dial. Nonetheless, moving toward trying to up the probabilities of September rate hike.
The committee is changing, just not in the way that was originally envisioned, perhaps by the incoming Fed chair. The weight of the Fed is becoming more evenly distributed across the individual voting members and beyond the voting 12. That's the problem that the Fed chair's got right now. He wants to go in one direction, reduce the communication, reduce the dependence on the institution. Everyone else is still heading in a different direction.
Yeah, although you aren't necessarily seeing the odds of a September rate hike rise to where they were before the press conference. This is what's notable. There still is a great degree of ambiguity baked into this market, with almost a coin flip it being baked in to September. So here is the issue that I have with today's data. How much does the labor market data matter? How much is this entirely the CPI print? And if you get above a certain metric, suddenly you have officials lining up saying, this is my tolerance for impatience, and we're there.
The labor market data today doesn't really matter. Potentially, it can help the Fed in terms of directing policy towards September. But we already heard basically from Kevin Warsh yesterday, through people familiar with the matter, talking to the Financial Times, that he's looking at CPI. And if inflation readings released in coming weeks are hot, according to the Financial Times, and markets ratchet up their expectations for borrowing costs to go higher, then potentially that's when we can get this hike.
I'm pumped about payrolls.
I am too.
8:30 Eastern Time. Start the show, Bramo.
I think it's really important.
Come on. 8:30, nothing else matters.
I mean, to me, this actually is the key question, because we're looking at the actual economy and what the different dynamics are underpinning it, not just whether the Fed will hike or not.
80,000 is the median estimate in our survey. The range still pretty wide, 157 at the high end, at the low end, 40K. Let's move on and talk about the supply monster. Love talking about the supply monster. The supply monster right now is Alphabet. Alphabet issuing another $25 billion worth of debt. It follows $50 billion plus through the first half of the year, on top of an $85 billion equity capital raise earlier this year. That is a lot of money that a single company is borrowing at the moment.
Yeah, Alphabet is the leader among all of the hyperscalers and other tech companies in terms of total debt and equity raised so far this year. Interesting to see that this was a well oversubscribed deal. Yes, they all are well oversubscribed. It's a question of how much you have to pay to get that oversubscription, and it does seem like they did have to pay a premium. Nonetheless, still plenty of demand. And here is the ultimate crux of the issue, and Vishy Tirupattur of Morgan Stanley is coming on later this hour. There is so much debt that still needs to be financed. We're not even halfway through. Question is, what will it cost to get there, and who is not going to be able to afford it along the way? Not necessarily whether the market's going to completely close.
Yields elevated across the curve. Check out 2s, 10s and 30s this morning. 2s down about 2 basis points, pushing higher through yesterday's session. On 10s this morning, we're down to back to about 466, but still very close to 470. If you're at the Treasury right now, you're contending with a lot. Not just the issues, the perceived issues at the Federal Reserve, but also the situation in Japan, the situation with Alphabet. That's just keeping yields at the long end slightly higher than they otherwise would be.
Yeah, absolutely. And the fact of the matter is, potentially we're going to have to see another yen intervention given what's going on with dollar yen, and this concern from the Treasury market and from the Treasury Secretary that potentially are they going to have to at some point maybe dump Treasuries in order to defend the Japanese yen.
We're going to have that conversation in just a moment. We'll catch up with Chris Ferrone of Baird Strategas as equities and bond yields rise. We'll speak to the former senior U.S. intelligence official, Norm Rule, as Iran moves to block U.S. ships through the Strait of Hormuz, and Oscar Munoz of TD Securities predicting a softer July payrolls report. We begin this hour with stocks pairing modest losses, holding their all-time highs. Chris Ferrone of Baird Strategas writing, with the S&P 500 rallying with such potency, there's also likely some value in identifying what is not exhibiting similar vigor. Chris joins us now for more. Chris, good morning. Good to see you.
Great to be here.
What is not exhibiting similar vigor?
Well, I would say on balance, this has been a very good rally, certainly the last week, but just go back the last 6, 7, 8 weeks, they threw everything they could at this market, whether it was bond yields, whether it was oil, whether it was the war, and the best they could do was maybe a 2 or 3% drawdown in the S&P. Extremely rotational tape. You know, we've been observing for weeks and weeks that the internals have been getting better, not worse here. Now, there are some pockets of maybe the market that are a little bit squirmy here. The utilities, as an example, I think there's a political crosswind that started to impact a number of those names, particularly on the power producer side, the CEGs and the Talons and the Vistras. But I'd say on balance, you know, 75% of the S&P is above the 200-day right now. That's about as broad as we've seen in 2 or plus years.
Is this bond market close to becoming a problem? Speaking of squirmy,
you know, it's funny.
The yield curve in the last week. Go on, give me your thoughts.
I'm going to tell you something that I think might surprise you here. We're 400 days since Trump 2.0 started in January of 25. That 400-day period, the range of the 10-year yield is 85 basis points. It's the lowest 400-day range in history. Go back as long as you want. Bond vol is very, very muted right here, right? I think when you look at what the reaction function from Treasury or from the administration has been, I think the goal is to limit bond vol, preserve optionality. And when you look at one of the tightest 400-day ranges in history, I think that certainly speaks to that.
Wouldn't you think, though, that less communication would introduce more vol?
So you'd think so, but the market response has been entirely different thus far. I mean, even from the Fed last week, 2-year yields are lower, not higher. 30-year yield is flat. Double B corporate spreads, you know, talking about Alphabet going to the bond market, why wouldn't you? Double B corporate spreads are on the tights right now. So I think the things that we look at to kind of gauge the health of the economy, the bond market, and the equity market are still pretty much in check. I mean, every bank stock around the world is at new highs right now. Credit conditions everywhere are about as benign as it gets. I'm not saying those things can't change, but if you're looking at the landscape today and trying to evaluate in the present moment, are conditions still supportive? I think they are.
Well, I think that the equity market is telling you that with the fastest kind of whipsaw back to oversold that we've seen in modern history, or one of the fastest reversals. Bank of America's index says that we're now the most oversold or over bullish in terms of sentiment going back to 2021. Is that a sell indicator to you, the same way that it is to Michael Hartnett?
I think you need bulls for bull markets. So I'm not as convinced that, you know, when you look at, and, you know, we've dived into this for years and years and years, Sentiment at tops is not very helpful. It's very helpful at lows, right? Fear and panic is a much more actionable emotion than the greed that's often found at top. So listen, we're very mindful that as this market has made new highs, you have certainly, I think, seen the attitudes get a little bit spicier here. I would yet to say that we're in that, everyone is completely all in. There's no buyers left. I don't think we're at that point yet.
When you look at that narrow range on the 10-year and you say that the reactionary function from the administration, is that the reactionary function that this bond market for this administration still remains the key? It's the biggest check on Trump and the Treasury.
I think it's interesting, Emery, because you brought up Japan and yen, which I think certainly playing a role in some of this. Go back and look at the last 2.5, 3 years on the yen chart. I mean, it's every time you're in this 160, 162, and I know we pushed 165 a couple weeks ago, where you get kind of either BOJ or Treasury a little agitated here. And I think the actions of the last week or so certainly reflect that. But I would just make an observation. I think all these calls out there that higher JGB yields are about to blow the world up are so hyperbole and so misleading.
What are people getting wrong?
I think people are getting wrong that we're in a reflationary boom in Japan for the first time in 30 or 40 years. And
so
yields
why is
should
everyone
be up.
so freaked out by what's happening?
I think it drifts with yields in Japan higher. I think it raises the floor on yields around the world. So I understand the agita there. But as far as Japan, Japanese bank stocks trade great, Japanese insurance stocks trade great. So if there was something truly systemic about higher JGB yields, I think it'd be showing up in those avenues. It hasn't.
This sounds like more like a counselling session for the Japanese officials and Scott Bessent than it does people on Wall Street. Because the concern that I've seen at the moment over the last month or so stems from the Treasury and stems from Japanese authorities. I haven't actually heard too many people around this table freak out about the situation in Japan.
I think what's pretty remarkable, and we said it off air, is Japanese 10s are about to cross German 10s for the first time in a very, very long period of time. I mean, which economy is in better condition right here? I would argue what's happening in Japan is a massive departure and change from what we've seen from that economy in 30 years.
Part of the problem is that you can talk to the 10-year and how range-bound it's been. The 30-year has not been range-bound. And this reflationary boom is happening in the backdrop of massive capital raise. We talked about Alphabet and the $25 billion of bond sales. I just wonder, how much does that constrain some of what the Fed and Treasury can do? Speaking to what John was saying, the concern about the reflationary boom that they're seeing in Japan.
So nominal GDP is what, 6.5? Where should 30-year yields be with 6.5 nominal? I think you could make a very valid case that 520 is by no means extraordinary. You kind of go back and you look at the kind of great decade of the 1990s. There wasn't a day in the 1990s where the 10-year yield was under 5%, right? So I just think we have to put this in a little bit of context. I've always been of the view when you look at these kind of bubble-like equity environments or melt-up-like environments, they tend to end with both equities going parabolic and bond yields going parabolic. I think 87 it happened. In 89 in Japan it happened. You had the Nikkei double that year. JGB yields went from 4 to 8. In 99 it happened. The NASDAQ clearly did what it did. But people forget, U.S. 10-year yields in 99 went from 4 to 7. So that's how these typically end. I don't think we're in that explosive bond environment just yet.
Debt to GDP ratios have changed.
Yeah, fair.
We're running persistent 6% budget deficits even in good times. That's problematic. Clearly, the Treasury is very uncomfortable about allowing people to monetize their dollar reserves at the moment based on the access the Japanese have been given to a particular vehicle over the Federal Reserve. That would speak
Although
to
not
unease.
used. I believe it hasn't been used.
Hasn't been used.
FT reports this morning has not been used.
But it speaks to unease of the Treasury. And some people might say for good reason that these yields are getting away from them at the wrong time when the backdrop for fixed income right now has changed. There are problems in Germany, there are problems in Japan that we didn't have to otherwise confront. And you know where I'm going with this? Because 15 years ago, when we would all sit around this table and people would complain about the deficit and, the supply concerns, and a lot of those concerns were misplaced, but the backdrop for fixed income was so different. We had an anchor in Japan, we had an anchor in Germany, and the biggest companies in this country weren't issuing debt in quite the same way. There's competition for capital in a way that did not exist 10, 15 years ago. We have to confront that. The Treasury does too. And there's obviously a reluctance for them to term out the debt as well. So you say this is normal. I don't think the Treasury thinks this is normal at all, which is why they won't extend duration at all. And they keep guiding the Treasury market to expect the same kind of issuance because they're nervous about what's happening with long-end rates.
Well, if you look historically, the issuance on the short end is still running below the long-term average. And this is, it's really no different than how the Yellen Treasury funded the government here as well. I think what's interesting, and we use the term, we're entering the alpha market, right? This is a market where, I think ambiguity is greater than people are used to. I think it's an environment where there's no free lunch. You have to pick stocks. This is no longer the kind of 15 years of QE and forward guidance that everyone gets trophies. So I think it's an important shift, and one will have to adjust. There are so many moving pieces here at the moment. In this 10-minute discussion, right? We've talked about Treasury yields, we've talked about yen, we've talked about equities. I think you've really got to stay on your toes here. And I kind of liken this from the transition from the 50s into the 60s, where you had a very docile decade in the 50s. Bond yields got to about 5.5 or 6 in the early part of the 60s. You bounced around for the next 6, 7, 8 years. It was a decent decade for stocks, but you had multiple corrections, multiple bear markets, multiple economic cycles. I think that's the environment we're in. Think about the equity market this year. It's been all E, not PE, right? PEs are down, E's up a lot. That's inherently a more cyclical economy. I think it's one that we ought to get used to.
Chris, appreciate it.
Always great to hear, yeah.
And right so far. Chris Verone there of Bear Strategas. Thank you, sir. Let's give you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Concerns of a widening Middle East conflict growing. The Houthis reportedly attacking Saudi-backed government forces in Yemen and a southwestern region in Saudi Arabia. The Iranian-backed militant group claiming drone and missile attacks killed and injured hundreds of troops in Yemen. Chip giant SK Hynix is planning $38 billion in spending to double production capacity in South Korea. The company saying in a statement that construction on 2 new plants is in response to continuously growing demand for memory in the AI era. The US and Japan's historic currency intervention coming to the surprise of key allies. The Financial Times reporting policymakers in Europe were blindsided by the arrangement, with the US not informing the ECB that it sold euros to buy the yen until after the transaction. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate the update. Up next on the programme, a diplomatic deadlock in the Strait of Hormuz.
It's sort of open right now. We have a thing called the blockade headed up by the U.S. Navy, and we control it. I think it's going to end pretty soon. I don't think they can go much longer.
Up next, we'll catch up with the former senior U.S. intelligence official, Norman Rule, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets?
we are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Payrolls at 8:30 Eastern Time. We're looking for ADK, and then it's on to CPI a week away. CPI on August 12th. September 4th, another payrolls report. September 11th, another CPI report. And then on the 16th, a Federal Reserve meeting in the middle of September. That's the runway. That's the path to the Fed's next decision. Equity futures this morning on the S&P positive by about a tenth, on the S&P 500, on the Nasdaq positive by 0.4. Under surveillance this morning, a diplomatic deadlock in the Strait of Hormuz.
It's sort of open right now. You know, we have a thing called the blockade headed up by the U.S. Navy, and we control it. I think we're doing very well. I just, you know, I'm involved in the negotiation. I think it's going to end pretty soon. I don't think they can go much longer.
So here's the latest this morning. The president claiming to have control of the Strait of Hormuz as Iran seeks to block U.S. and Israeli ships from transiting the critical waterway.
And there was also apparently some attacks as well at the opening of the Strait of Hormuz yesterday, which is why you saw oil prices move higher. The fact of the matter is, the president said yesterday it is sort of somewhat open. It sounds very much like concepts of a plan. They have an idea of how they can get traffic back through, but the fact of the matter is, if Iran is not going to allow U.S. or Israeli ships, what insurer is going to allow other ships even to want to transit through the Strait of Hormuz? Very, very messy situation.
To build on that, the former senior U.S. intelligence official Norman Rule writes the following. The U.S.-Iran conflict now has many fronts where violence is intermittent but could flare up with strategic consequences. Norman joins us now for more. Norman, welcome back to the program, sir. How would you characterize this particular agreement? Would you even call it an agreement?
Good morning. Well, we certainly have a greater possibility of a diplomatic agreement now than at any time in recent weeks, but the maximalist demands of Tehran and its use of intermittent regional violence is making the conclusion of the agreement unpredictable. Likewise, we should note that just execution of this agreement will require Treasury to issue rules as to how firms could pay if fees are paid. And if fees are not paid, then we have to prepare for additional violence by Iran in the future. Iranian decision-making is not unified on the need for concessions, and indeed there is no sign of a concession, a pro-concession party in Iran at this point.
Norm, how can Treasury green light these fees if Iran is not allowing U.S. vessels to transit?
That's an excellent point, and we should keep in mind it's U.S., Israeli, it could be U.S. or Israeli related. The definition of that concept could be quite significant. And in essence, what Iran is doing is not only keeping the U.S. out, but dictating to Gulf states who can deliver their food, their energy, their trade partners. This would have a significant impact on global commerce, so it can't be conducted. We can't rule out that this is just a negotiating threat by the Iranian parliament. It doesn't have decision-making authority, but there have been examples of Iranian parliament making decisions, such as 60% enrichment, that have been executed by the government when approved by the Supreme Leader and the National Security Council.
Norm, there have been some Gulf countries that have been able to get oil and other products out, namely the UAE. How have they been able to do this?
Most of the Gulf countries that use the Strait of Hormuz have exported oil in recent weeks. They've done it quietly through the Oman Channel in close coordination with the U.S. military and obviously the government of Oman. But Iran has intermittently used its degraded missile and drone capability to demonstrate that it has a capacity to strike some of this shipping. And that capacity has the greatest impact on LNG, which has essentially been shut down in the Gulf.
Norm, we've heard about a toll being unacceptable, not only to the U.S., but other Gulf countries that are neighboring Iran. Is a service fee acceptable? A 5 to 7% service fee is currently being proposed by Iran.
Certainly not. You can call it whatever you wish, but it's a shakedown. And that fee can be changed. Now, Iran is entitled to compensation or to charge if it were to take care of a pollution issue, a security issue, rescue a ship in danger. That's not unreasonable that any country would ask for that. But Iran is providing no services. And to be clear, the last time anyone charged a fee in the Strait of Hormuz was April 1622, and that was the Portuguese.
How do you see this evolving, given the fact that it seems like President Trump has some reluctance to engaging in kinetic warfare again? There's been a discourse about whether that's tied to the munition stockpiles, questions around whether anything additional can be accomplished with airstrikes that hasn't already been accomplished. What do you see as a potential path of travel should these negotiations not yield anything?
Time, tenacity by the diplomats and the intermediaries. The United States is certainly pursuing a diplomatic route along with the Gulf parties, but events may shape that into a different direction. The Houthi attack on Saudi Arabia, we'll have to see if the Saudis follow through with retaliation. The reported attack that took place yesterday on shipping, and will the U.S. retaliate? If we don't, Iran will continue these attacks, and it's not sure that diplomacy will succeed. But at the same time, the diplomatic path forward will require concessions from Iran. If that doesn't occur, we're in a new normal.
Where has the U.S. set deterrence then? Because the IRGC is still going after vessels through the Strait of Hormuz, and at the same time, the Houthis are now involved.
Well, that is true, but the nature of the attacks are limited, they're infrequent, they're usually singular, they're not involving saturation strikes. There is no question that Iran's military capacity has been significantly degraded, but degraded does not mean eliminated, and that's really the question.
Norman, we always appreciate your time, sir. Thanks for sharing it with us this morning. The former senior U.S. intelligence official, Norman Rule. Based on what we've seen develop in the last week, we've seen little evidence that we've managed to break out of what we've called on this program many times, that uncomfortable status quo, that uncomfortable new normal since the end of February.
Yeah, we're going to be living in this purgatory, because even if we were to see potentially a resumption of ships being able to pass through the Strait of Hormuz, there's no evidence yet that the IRGC, maybe they're discussing this in Parliament, but that the IRGC is not going to use asymmetric warfare and go after a boat or two. And the second one vessel gets attacked, they might as well all have been attacked, because that is when the transit stops.
Chris Rowan was talking about the range on treasuries throughout this administration. I think he said something like 85 basis points. I'm fairly certain that the low and the high of the administration has come in the last 5 months. And that range has been dominated to some extent by developments around this story. The low on yields was in the immediate aftermath, just around the invasion. And then it was up, and away, and we never really looked back on 10-year treasuries. We never really erased that decline. And I think that speaks to the concern on this issue against a pretty unforgiving backdrop around the bond market too.
It speaks to the impatience by Fed officials after more than 5 years of above 2% inflation, but it also speaks to supply shock after supply shock. And if you have supply shock after supply shock in an otherwise robust economy, those supply side inflationary drivers can take on a life of their own. And that is the fear, even though typically central bankers look through this.
People have said this countless times, but how exhausting has that story been?
It's, I mean,
crazy.
I get messages about it every day. Really? You're still doing this?
Deal.
Like,
what?
Okay, I know, you're preaching to the choir. The issue is, this is a story and it does continue.
Up next, Vishy Tirupattur of Morgan Stanley, as demand for Alphabet's AI debt outpaces some expectations.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Futures positive this morning, up by 0.2% on the S&P. On the Nasdaq 100 so far, we're positive by 0.4. 2 days of very muted losses on the benchmark stateside, pulling back from all-time highs, but still on track for a second consecutive week of gains on the S&P, heading towards the best weekly gain since April. That's the stock market story. Let's get you some single names, your morning movers, with Yahira. Hey, Yahira.
Hi, John. We start with Cloudflare. Shares are rising at nearly 16% in the pre-market after the cybersecurity company delivered a beat and a raise. Remember, this was one of the first companies alongside the fintech block to make a big bet on AI replacing some internal work. So it cut about 20% of its workforce earlier this year. Initially, investors had questioned whether that would hurt growth, but these results appear that it hasn't. I will also say the bar was pretty high, with shares up 45% heading into the results. Meanwhile, in another sign that travel demand remains healthy, Airbnb raising its full-year outlook for the second time this year after another strong quarter. So we are seeing shares up 7.5%. That was due to strong demand in the US and in Europe, but it also says that it got a boost from first-time users staying in Airbnbs during the World Cup. It echoes what we heard from Booking Holdings at Expedia, which also had good results earlier this week. And we end on a big mover to the downside. Sweetgreen down more than 15% in the pre-market after it's cut its outlook, saying that recent food safety concerns are keeping customers away from its restaurants. The company had already been grappling with traffic decline, so it had been trying to revive that by introducing cheaper menu items, but this latest outbreak affecting lettuce and now apparently a recall affecting jalapenos is really complicating this turnaround story. John.
Yahara, thank you. Not going to lie, quit salad.
Because of cyclosporiasis?
I did.
Really? Well, so did everybody else. Salad and Co. filed for bankruptcy?
For the last couple of weeks, yeah.
Really? But it's just, hold on a second.
Difficult, Bremer.
Okay, first of all, it's just the iceberg lettuce. If you have lettuce that actually has nutritional value, you're fine.
Yeah, so you want to do that at home. Why would I go trust other people to follow those rules?
Precisely.
So at home, I'm eating salad.
Yeah, honestly,
out and about, I am not eating
I've got no leg to stand on. I never
Not as trustworthy as
yeah, no, I understand. But
Bramo,
really?
About the food supply.
You really?
Are you okay?
Hold on a second.
When was the last time you ate at Sweetgreen, Lisa? I plead the fifth. Exactly. She's doing the same thing we are.
There she is. Come on.
Anyway.
On a radar this morning, Iran aiming to prohibit American-Israeli ships from the Strait of Hormuz in its latest demands for a peace deal. Tehran also pushing for compensation from hostile countries before granting them access to the waterway. Elsewhere, US and Japanese intervention into the currency market coming as a major surprise to the Europeans. The Financial Times reporting the US waited until after it sold euros to buy the yen to inform counterparts in Frankfurt. And finally, the president renewing his support for Fed Chair Kevin Walsh.
It's up to him a little bit, but not completely. Here he's got a board that's very political. The United States should pay the lowest interest rate in the entire world. I think he's great. I won't be criticizing him.
The Fed chair's communication style divided Wall Street and Washington. Uncertainty adding to bets the Fed will hike rates at least once before the midterm elections.
Yeah, and potentially putting the emphasis on other Fed officials who have been speaking and had a more hawkish tone over the past couple of days. Key questions here. Number one, a lot of people who have talked with Kevin Warsh and have had communications with his camp recently sort of reiterate that he is independent, et cetera. There is a feeling right now that potentially there could be a more hawkish shift, but he's in a very tenuous spot because of the pressure coming from the president, whether it's directly at him or not. The other question I have is, what is the benchmark to hike rates, right? What is the definition of impatience after more than 5 years? What is exactly the threshold going to be?
Well, for the president, we've heard this before. He has now really backed off on criticizing the Fed chair directly, and he's going after, he said this line a ton of times, that it's a very political board, which is interesting because some of those individuals that are on the board were actually appointed by this president in his first term. I also think it's a little interesting. I learned a new word through this entire interview. The president said the Fed is now bekakt, which means extremely messed up or poorly managed.
Or something else, which we won't talk about.
Or something else if you look at Urban Dictionary. But he thinks he wants to go back to this old world, and he continuously talks about this, where good news comes out and people aren't immediately selling off in the stock markets because they think the Fed is going to hike interest rates.
The issue that I think the president has, and I'm sure that countless people have tried to explain it, from what I understand and what I see and what I hear from him every time he talks about the issue, he appears to confuse credit with developed market sovereign debt, and the way that credit responds to good news and the way that developed market sovereign debt responds to so-called good news. If you are a creditor, if you're issuing credit and your balance sheet is getting stronger, not worse, you should receive a lower interest rate. That makes sense, right? But if you are the treasury market, say, and the data gets better, I'm going to put money elsewhere, right? If inflation risk starts to build a little bit more, I'll move out into risk assets. That tends to be how it works. In treasury markets, of course, when the data is really bad, treasuries rally because people flock to the safety of treasuries. I mean, that's sort of like 101 of the bond market, credit versus developed market sovereign debt.
Yeah, I feel like the bond market and markets in general kind of treat President Trump's comments on the bond market like they do a grandfather who's telling them something that they know
that
isn't
accurate. Was for anyone who accidentally tuned into Bloomberg this morning.
And sort of, they're like, oh, that's nice, you know, that you think that, but it doesn't really affect my life, and I know that you're wrong. At the same time, I think that there is a feeling, what is his influence over actual policy in Kevin Warsh? And that, I think, is the ultimate debate that a lot of people are trying to parse through.
What is Warsh's influence over this bond market right now, given the issuance we just saw in the last 24 hours? Alphabet, of course, reigniting investor appetite for hyperscaler tech debt. The Google parent company receiving roughly $115 billion of orders for its latest mega bond sale, more than 4 times the expected deal size. Vishy Tirupattur of Morgan Stanley writing, surging supply has been balanced by robust demand, keeping market-wide spreads anchored even as AI-related debt underperforms. Vishy joins us now for more. Vishy, good morning.
Good morning.
Let's just start with the supply, just the raw numbers here. The amount of money that is being raised, the amount of debt that is being issued. Just walk us through that and how much more you're expecting of it.
We are expecting a lot more of this to come through across the credit ecosystem. So we look at the total CapEx needs of the AI ecosystem, and we'll put that number between 2026 and 2028 at $3.2 trillion. And that needs to be financed through equity and credit channels. We think credit is going to be 1.75 trillion of that 3.2 trillion is what we pencil as the credit mechanism. And when I say credit, I just don't mean public investment-grade credit. I mean investment-grade credit, high-yield credit, leverage loans, public, private, structured, securitized, all of the above. So we expect this to, this issuance and the behavior is not going to be uniform across all these pockets. Some are insensitive to the level of rates and level of spreads in a broad range. Some parts of this ecosystem very sensitive to the ultimate level of yields. So there's the multiple things going on here.
Well, let's talk about what's changed in the last 5 months or so. Since I would say SpaceX, when they IPO'd and then subsequently offered some debt, there was some pushback. The demand was, let's say, below expectations and below average for what we've seen through most of this year. Then Amazon came out and they had to offer more concessions. I believe that Alphabet had to do the same thing in the last 24 hours. These aren't major moves, but they're incremental and heading in one direction. How much more of that do you expect to see for the names that are coming to the market, one? And two, do you expect it to influence borrowing costs for other companies outside of tech issuing into this market?
So the first one, we do expect this, what we call high-quality hyperscalers, the Microsoft, Meta, Google, Amazon, who average trade quality is about AA, and we expect that they are less sensitive to the level of rates or level of spreads, and they have a tremendous amount of needs for capex, and we expect the market is open to them, and we expect that to continue to be there. Wider spreads are the pressure release valve. So we expect spreads on those things, to those names, or the high quality hyperscaler debt, to continue to widen. And where we think is that it will eventually drag the non-IG debt, non-AI related debt, also to widen somewhat. So far, non-AI debt hasn't moved much at all. We expect that to change a little bit. We expect that we are, in the cash index, we are high 70s-ish, about around 80 basis points of spread. We expect that to be in the 90s by, in the next 6 to 12 months.
There's a sort of belief right now that a lot of these AI-related companies are rate insensitive when it comes to their borrowing plans. Is that true?
It is true for some of them. It's not true for all of them. It is rates insensitive. I wouldn't say rates insensitive. In a certain range, in a fairly broad range, the very high-quality hyperscalers are insensitive to the level of yield they have to pay out.
Up to what, like 9%?
Up to, for example, the 10-year Treasury in 350, 455, probably not that different, right? If you think in those terms. But if you go down in the ratings category, go below the high yield names, there is a level at which it's not economical for them to keep issuing. So we expect issuance to continue, but bulk of that issuance from the higher quality names as opposed to the lower end names.
I've heard from a number of investors that increasingly investment grade looks like it potentially has more risk than high yield. And this is coming at a time of mass issuance, of an increasing proportion of the overall index coming from technology, and frankly, really long durations. You also have the duration risk. Do you think that right now, investment grade bonds are riskier than high yield given this backdrop?
I wouldn't say riskier. I think I look at the prospect, we can measure risk in many different ways. If you look, are they riskier from a sort of a default probability perspective? They are not. They are not riskier than high yield. On the other hand, if you look at the direction of travel for spreads and perhaps ratings, there is a greater potential for some of the higher quality names to take, one or two rating notches downwards. Whereas within the high yield spectrum, there are the Bitcoin miners, the neoclouds. It's a large ecosystem. Those Bitcoin project finance type of bonds that are coming in the high yield space, there is once the construction stuff is done and who are the leasing the facilities is in place, there is a possibility for an upgrade. So that's the differentiation here. And the high yield, this part of this, the avalanche of supply is really investment grade focused. It's not in the high yield focused. So technicals are in favor, and there's a potential for upgrades. So that means that the prospects are better for, we like high yield portion of the AI related bonds more than we do high grade.
Vishy, can we finish on rate sensitivity? There is a massive difference, of course, between being rate insensitive and not being very rate sensitive. At some point, everyone's got a price where they have to defend their rating, and they start to respond to the pushback. Where do you believe that level is?
So I think the rating itself, some of these companies, as I said, the 4 firms I named, average grade quality is about AA, and some of them are trading closer to single A names. So the market is already treating them lower, and their business models are perfectly intact, even if they're 1 or 2 rating notches lower.
Right.
So they're, if you're a AAA company and U.S. Treasury is AA, so therefore, that there's some scope for.
Think more of the oracles of this world.
Right. Oracle is a very different story. Oracle is a very different story. We have been short Oracle debt for some time, and Oracle is in a very tough spot. The amount of their ability to issue debt is very different. And so I want to distinguish between the high quality hyperscalers versus the oracles of the world. That flexibility that exists for the high-quality hyperscalers does not exist for the Oracles of the world.
Are we close to a reckoning for those companies when they have to change strategy?
They are, we got a downgrade in Oracle. Oracle, S&P downgraded them to BBB minus, which is the cusp of below investment grade.
And that debt is trading like junk already, right?
Right. So that is definitely a challenge. If you go below that, it's a very challenging situation for Oracle.
Vishy, appreciate it. Thank you, sir. Vishy Tripatul there of Morgan Stanley, really framing what's happening right now in corporate credit. Some issuers have got some privileges that others don't.
What's fascinating to me is we still have $1 trillion to go. This is just the beginning, right?
That's a lot
So we
of money.
keep talking about that, and you start wondering, okay, well, how big is that concession, and sort of who are the casualties along the way?
It's getting bigger. Let's put it that way. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. SpaceX shares rose on Thursday after the release of more than 900 million shares worth about $100 billion from lockup agreements. The stock closed up more than 6% after fluctuating between gains and losses in early trading, with more than 255 million shares changing hands. Meta to pay $942 million after a major child safety ruling. A New Mexico judge is ordering the Facebook and Instagram parent company to pay penalties, set aside money to address youth social harm, and limit how long underage users in the states spend on its apps. Details are emerging on OpenAI's upcoming consumer device. Sources telling us here at Bloomberg the device, which will function like a smart speaker without a display, will come in the shape of a donut and likely cost more than $300. It'll be OpenAI's first piece of consumer hardware and is expected to hit the market next year. And that's your Bloomberg Brief. John.
Vonnie, thank you. Thank you very much. Up next on the program, balancing the Fed's dual mandate.
The labor market stabilized with solid payroll growth and an unemployment rate close to its long-run value. However, inflation is well above the FOMC's 2% target.
There's another one. Oscar Munoz of TD Securities joins us next.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Live from New York City, welcome to the program. Equity futures right now in the S&P firmer by a little more than 0.1%, on the Nasdaq up by 0.4. This from Michael Harner over at Bank of America. We remain in the summer retreat, rotate, not reload camp. We recommend investors retreat from risk assets and or rotate into some defensive duration and the US dollar.
Yeah, he was talking about the sell signal and how people are getting so bullish and so extremely positive on equities. It's one of the most extreme readings since 2021, which gives him some pause. You know, the scale of the move that we've seen since the brief out leverage that we saw with respect to situational awareness.
It was massive.
Gives you a sense of just how many people were lined up for an entry point. You just wonder, how much can a market go down when there still is that kind of momentum in the market?
Have we really cleared the decks of all that leverage that was built up since late February into late March? That move we saw in chips was just a monster move. Let's turn to the bond market. 2s, 10s and 30s. Yields declined this morning, actually down on the week. 2s, 10s and 30s. Up in the last 24 hours. And up in the last 24 hours for a range of reasons, including Alphabet, with a boatload of debt in the last 24 hours. Plus, a lot of questions about the Fed's next move and where Kevin Walsh stands on a few things.
I think it's actually a really important question to ask. How much is the move at the long end because of the Fed conference last week? Certainly there was a correlation with that. And how much is really just simply the supply? If we think about the investment grade bond universe having spreads that widen out, well, think about the competition for capital and what that does to the long end of the Treasury. Alphabet just sort of gave an example, throwed a little lob of $25 billion to give a little demonstration of why this is such a significant issue.
The Fed, I would say, took a back seat to the move in the last 24 hours. I'm more inclined to say the move you're starting to see at the longer end of the curve is becoming more and more influenced by how much debt is being issued by the likes of Alphabet.
The likes of Alphabet, the likes of Japan, the likes of Germany. Yep. I mean, at a certain point, can you disentangle sovereign and corporate debt in a real material way if a lot of the buyers end up being some of the same?
If I was going to write a book about being bearish bonds, it would be called Anchors Away.
Ooh.
All of the bullish anchors for bonds, they're gone. They're gone. Everything we talked about over the previous 2 decades, gone.
Anchors away in bookstores.
Does that work for you? Do you remember the yoga book that I never wrote? Do you remember that one?
Yeah, I do. But this was going to come out.
TK got everyone thinking I was writing a book about yoga. Unreal. Under surveillance this morning, balancing the Fed's dual mandate.
The U.S. economy has been resilient in recent months. The labor market stabilized with solid payroll growth and an unemployment rate close to its long-run value. However, inflation is well above the FOMC's 2% target, and the balance of risk is tilted towards inflation remaining above target.
I'm sure Alberto's got tons of character and charisma, but when they read these things, it's deadly, isn't it?
It's almost funny you say that after listening to him.
It's pretty deadly.
Yeah. Well, I think that
after you hear that, you're like, maybe Kev's got a point. Well, like, we should do less of this.
Maybe, you're right. I mean, at the same time, people took a pretty loud message from that.
Payrolls a little bit later on this morning, 8:30 Eastern Time. This is Oscar Munoz's point over at TD Securities, looking for a below consensus 70,000, writing a stable labour market will keep the Fed's focus on inflation. An upside surprise could add fuel to the fire for hikes. Oscar joins us now for more. Oscar, welcome to the program. Feels like the labour market's taken a back seat to the inflation data more recently. What are you looking for at 8:30?
Yeah, thank you, Jonathan, for the invitation. Right, we're below consensus, 70,000 gain for payrolls, as you mentioned. I think more of the same, very similar to what we saw in June. I think the idea, the message is that the labor market is close to where it should be, close to its steady state. In the first half of the year, you show strong gains in payrolls. So this is by no means, if we're right, we got the 70K on payrolls and 4.2% unemployment rate on the household survey. I think it just tells you kind of the same. The labor market is in a good place, and it's in a place that is not inflationary.
What is sort of the measure that you're looking at in the labor market report that potentially translates into the Fed's reaction function? Because right now it seems like, as John was saying, it really is squarely on the inflation data.
I completely agree. I think I think you can't never downplay the jobs report, no matter what state we are. But again, yeah, I mean the Fed has made it very clear that what they're watching very closely is the evolution of inflation, particularly over the next few months. They do want to see relief on a month-to-month basis, particularly core PCE inflation. Now, anything close to 0.2%, I think, would be good news for them. But the labor market, is also important for me. What I'll be looking at very closely is the unemployment rate. We've seen it dropping a little bit. I think the range between 4.2, 4.4% is the sweet spot. If you start seeing the unemployment rate dropping to 4%, I think that would be concerning for the Fed, particularly for the hawks, is in a world where inflation remains above target, kind of stuck close to 3%. If you see an acceleration in the labor market, I think that will be very welcome by Fed officials at this juncture.
How do you view some of the tertiary or secondary data points that we get? Yesterday, we got a measure of productivity that actually rose substantially above expectations, and unit labor costs actually came in substantially below expectations. And some people were saying, this is a productivity boom. This is the disinflationary growth that we've been looking for. How do you view that kind of data in light of trying to come up with a narrative or a trajectory for inflation?
I mean, you have to take it in strides. I think, productivity growth being strong has been a feature of the economy post-pandemic. I have an issue with people saying that's because of AI. I think it's very early to say that. You're not seeing that translated into TFP, in total factor productivity. So it tells you there's something else driving it, probably capital deepening. So to the extent that some Fed officials are thinking that the supply side of the economy is going to save us from inflation, I think that's a story for in 2 or 3 years. I don't think it's a story for now. That's why we have heard from Fed officials sitting in the center, particularly Governor Waller, President Williams. They're not waiting to see whether the supply side is going to improve here. They want to see disinflation, or at least progress on month-to-month inflation already. That's why the bar has been lower. If you see a core PCE print on a monthly basis at close to 0.3%, one or two of those, I think that would be enough for a number of Fed officials who are sitting on the sidelines to start supporting rate hikes as early as in September.
Oscar, good to see you. Important final note there. Oscar Munoz there of TD Securities. That final note on waiting for productivity to bail us out. That was essentially the pushback from the St. Louis Fed president in that speech.
Yeah, Alberto Muslim saying, look, we're not seeing enough of it yet. And to sort of say that this is going to come back and rescue us isn't going to fly. Again, it goes back to what does Fed Chair Kevin Warsh think about productivity? We've heard a similar tone from other people. Unclear, and I'm thinking of Neil Kashkari in particular, unclear whether productivity is increasing at the pace that AI is boosting inflation. Ultimately, that's going to be a debate that's going to be on the big topics in Jackson Hole. And I really think I'm actually really curious.
Here we go. You're super excited?
I think it's going to be interesting to see how they frame it. The blank page. Thoughts.
Hey.
I am excited to see what fills that
Grandma's
page.
vacation to Wyoming.
Not my vacation. It is a thought exercise.
I've never been. Days you're taking off after the Jackson Hole Symposium.
Todd. Whatever.
Priya Misra of JP Morgan joins us next. The Port of LA Executive Director Gene Soroka joins us too, plus Claudia Sam of New Century Advisors.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
What is Mira Murati's vision for the future?
Predicting dystopia or utopia to me feels very, very simplified, because the truth is we actually have a lot of agency in how we build this technology, in the tools that we're building, how we're deploying it. It's not a predestined outcome. There are certainly those risks. We all understand the potential for greatness that comes with building frontier AI systems, and that's why we're working on them. There's been a lot of talk around the uncertainty, around the downsides, and I agree with a lot of these risks. And perhaps where I might disagree or take a different path, is that I think we have a lot of agency. Like this period of time where both humans and AI systems have their hands on the wheel and we can collaborate is very important time to get right. And the more that we can reduce the discontinuity that comes from new capabilities and huge change in capabilities, the better. And this is why we took this approach with Thinking Machines and why the company exists.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
We think we're in store for some weaker reports upcoming.
The labor market's still relatively sideways.
The signals are muddled. They're not telling you what they typically tell you because a lot is going on.
Things could change. The U.S. labor market can turn around quickly.
This week, it's all about Friday.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equity futures bouncing back from 2 days of mild losses. On the S&P, higher by 0.2, on the Nasdaq by 0.5. In the bond market, yields higher through yesterday's session. 2s out to 30s this morning, lower by a couple of basis points. We're down 2 on 2s to 423, on 10s to 466. Heading into this, 90 minutes from now, the jobs report at 8:30 Eastern time. The estimate in our survey, the median estimate, we're looking for something around 80K.
Yeah, the excuse or the reason why the Fed last year cut rates by 75 basis points was weakness in the labor market. That's why it's all the more important to see whether we're actually reversing that at this point. You're actually seeing a re-strengthening of the labor market that has legs. Does the unemployment rate stay at 4.2%? Is that level higher? Are we starting to see the beginning of wage gains, or are we starting to see a little bit of slack emerging that could give the Fed some breathing room come September?
At the end of the day, though, whatever we get for today, everyone's going to be focused on next week. So today is just kind of the appetizer for in terms of the data. Because Kevin Warsh yesterday, through people familiar, said to the FT that he's looking at inflation data on whether or not they should, you know, increase interest rates in September. So does today's data really matter?
Look, we're talking about Kevin Warsh and the Fed for good reason. I get it. My focus actually increasingly is on the Treasury and less on the Federal Reserve. The problems are starting to build up for the Treasury. You can see that in the way the Treasury Secretary, Scott Bessent, has responded to it more recently. Issues in Japan. Coming out defending the Treasury Secretary, he can see what's happening with the long end of the curve. It's vulnerable to high yields. And we saw that yesterday just with Alphabet coming out and saying we're going to raise some money. You start to see yields on Treasuries creep higher again.
Forget the players. Look at exactly what the backdrop is economically. You have north of 6% deficit to GDP. You have issuance from all over the world when it comes to government debt as well as hyperscaler debt. We have gone from a financialized market to one that is absolutely industrial revolution, where suddenly people need that capital. It isn't just going to go into a stock market, go into a bond market and accrue interest or accrue gains. It has to go into the real world. This is a vastly different, more inflationary world, and people are grappling with it and saying, what is the right value for these bonds, for this rate? And ultimately, we don't know the answer. So I got to say...
Anchors away, Bramo.
I mean,
is away.
I'm here for it. 2028, Penguin,
it's a perfect
House,
thesis.
whatever place you choose.
It's a perfect thesis as well for what is going on in terms of Treasury stepping in and buying yen, but using euros, because for the Europeans, according to the Financial Times, they were completely caught off guard and unnerved by this. Some of them even saying it's striking and sad what the U.S. Treasury did because they didn't get a heads up about this movement. So there are a lot of dislocations right now, but the pressure, as you say, is squarely on.
I'm not going to shed any tears for the ECB on this one. We can have that conversation in a moment. When it comes to the Treasury, we're kind of lucky that we have this guy running the Treasury at the moment because he understands financial markets better than most. I'm very, very interested to see what creative ways he has to correct course here, because the former Treasury Secretary has already made the move. She tightened things up, brought a lot of stuff to the front end of the yield curve. She's made that move. You can't do that twice, so that's happened. Japan gets into some trouble, and you can see there is some unease about monetizing dollar reserves. So you start to point to a facility at the Federal Reserve that would allow countries like Japan to park treasuries there and get access to dollars without monetizing those securities. So you can see the unease there to stop yields from going higher. What other options does the Treasury Secretary have? There is no appetite in Washington, D.C. to reduce deficits. There is no appetite to stop investing at Alphabet, Amazon, and others too. What options does he have?
The hopes and the dreams are that the AI revolution will usher in productivity and growth without inflation. This is the nirvana that could potentially bail out a number of economies and a number of different fiscal situations, because then you could grow your way into the debt without the commensurate inflation that is punitive and politically damaging. And that is the hope. The question is how quickly that kind of scenario can come, or if it will come, and just how levered is the entire economic story to artificial intelligence.
They have one creative solution that I always thought they would use before the midterm elections, but it would be incredibly cute and people might just look through it because it would be purely on paper, and they can remark gold. It's on our balance sheet as $42.
That's a wild card.
And 22 cents.
That's a wild card.
It is a wild card. It would be incredibly creative, and honestly, I could see Scott Bessent doing that.
The other one, and there's a massive trade-off involved in it, but the other one is that you have more coordination between the Treasury and the Federal Reserve. And this is what people have suspected for some time, that the Federal Reserve changes the way they do manage the balance sheet. They start to buy a lot more at the front end of the curve. You start to see even more issuance at the front end of the curve. The trade-off, the obvious one, is the dollar gets hammered in that scenario.
I was just going to say, listen to gold. What's gold say?
Right.
This week, up 6.2%, giving you a sense. Silver, up more than 11%. Precious metals starting to speak again.
Futures speaking as well, positive by 0.2% on the S&P 500. Yields slightly lower going into payrolls in 85 minutes' time. Coming up, we'll catch up with Priya Misra of JP Morgan on what today's payrolls report means for interest rates. The Port of LA Executive Director Gene Soroka, as Iran looks to ban the US from the Strait of Hormuz. And finally, we'll catch up with Claudia Sam of New Century Advisors on the lack of communication coming from the Fed chair, Kevin Walsh. We begin this out with stocks little change following 2 days of muted losses heading into the July payrolls report. Priya Misra of JP Morgan Asset Management writing full employment is still one side of the Fed mandate. Our base case is a low hire, low fire, but balanced labour market that is not a source of inflation. Priya joins us now for more. Priya, good morning. Is that what we have already in this labour market?
I think that's where we are right now. Yes, all the underlying data is suggesting that. But I think the bond market is sniffing out, is the economy overheating? Is the inflation, and you can sort of tell, from all of the Fed officials, they're getting nervous. Is inflation becoming sticky? Is there any overheat that they need to actually push back and raise rates? And I think that's why we'll be looking for, are the job gains broadening out? And so if the economy is hiring across the board, it's not just healthcare and education, then that overheat, is the neutral rate moving high? I think that's one question that the market's struggling with. And the other one is, are wages picking up? And so right now, I think we're not there. But given that there's uncertainty about the economic outlook, the Fed is losing patience on the inflation front. And the fact that we don't know the Fed reaction function, there's uncertainty there. I think the market's going to pay attention to that payroll report, even though I agree the more important number is CPI next week. But I think today is important. We'll be looking at the details of that report.
I'll ask the Lisa question. She asked it this week. When someone says we don't know the reaction function, we don't know the Fed chairs that well. Don't we know everybody else's?
I think we're figuring out everyone else's. And it'll come down to the voters, the non-voters, the big discussion, but ultimately, I think the chair is, it is important to see that if the chair is building consensus, that's part of the job of the chair. How does the chair think, so number one, I think the commitment to inflation is there. And the bond market, I think this is interesting. There's a lot of talk around the confusion, but the bond market, if you look at inflation expectations, very well anchored. I think that's because we understand the rest of the Fed's reaction function. We do want to understand Chair Walsh. The commitment is there, but I think how are they going to get there? I think that's the question. What exactly are they looking for? What's the trigger point? I think that those are things that we need clarity. I'm hoping Jackson Hole provides a little bit of that, but ultimately it's going to come down to the data. Does inflation suggest that it's already peaked and it's starting to head lower? That reduces some of the urgency to hike, and I think then the market can calm down. I think the inflation data is likely to bail the market out, or essentially bail the Fed out a little bit.
How, if the Fed does hike in September, how much would that affect the long end of the yield curve?
Great question. If you think the long end has backed up as much because of this Fed credibility issue, then I think that can help. But here's my issue. If they hike in September, how do they signal how many more hikes? The market's pricing in 2 hikes. If the Fed is not going to give us much forward guidance, I mean, we're still going to get the dot. So we'll be looking for the people who are looking for hikes. How many more hikes do they have? Are they reassessing the neutral rate? In that case, if the neutral rate is moving up, and there are Fed officials who think we may have to hike 4 times, 6 times, let's take out all of the insurance cuts over the last 2 years, then the long end can sell off. But if this is a 1-2 hike, we're just trying to gain credibility, I really struggle with the credibility issue. You don't hike to get credibility. You sort of don't shoot yourself in the foot to make sure your gun works, which would be the credibility hike argument. But I think if it is just a credibility hike, yeah, let's just get a couple of hikes done. Then the long end actually can get anchored. But I think the long end, look at real rates, it's much more about supply. Global bond supply, AI supply, high quality supply. I think it's less about the Fed hand-wringing around their reaction function.
Well, based on that, and that's where I was going to go, how much is the AI issuance sucking the oxygen out of the room for all issuance, in particular on sovereigns? I'm just wondering, does that make you feel like the 30-year is toxic until it gets to a comparable level to some of the new levels that we're seeing from the likes of Alphabet issuing $25 billion of bonds and having to offer a premium?
I think the 30-year Treasury has to give us a little bit more yield, particularly because we've got the hyperscaler issuance, which is in the long end. Whether it's this 144A type deals, these SPV structures, whether it's outright unsecured debt, we're getting not just the term premium on the yield curve, we're getting that spread curve as well. So, there's always a price for something. I mean, I wouldn't say I would stay away from the 30-year. At a certain price, it starts to constrain the rest of the economy. Maybe not AI. The AI build-out seems to be interest rate sensitive, but that's one part of the economy. It's a very important part of the economy. The rest of the economy starts to slow down. I think long-end treasuries can make sense. Right now, we'd actually rather own some of long-dated corporate debt, just because you're getting that additional cushion. If you're getting 100, 200 basis points more than treasuries, it gives us that cushion that if rates have to rise to, essentially price in all that supply, I've got that cushion in the credit side.
Well, this is what I brought up yesterday to another guest. If they hike rates and the AI hyperscalers, all these companies, it doesn't matter. It's only going to hurt Main Street that actually needs rates to come down. Look how high mortgage rates are.
Exactly, which is why I struggle a little bit with the hike, even for inflation, because if a lot of the inflation is coming from semiconductor chips, do a couple of hikes matter? So this is why I think communication from the Fed's that important. Are they hiking just to get a couple done? Or are they hiking to get inflation back to 2%, which will require more than the 2 hikes that are priced in? But yeah, I struggle with the argument to hike to slow down AI. You're going to need a lot more. But here's the thing. The bond market's doing some of that tightening, right? Real rates have risen. I think that's a function of all of the supply. Spreads are widening. Look at new issue concessions. It's largely in the AI world. But the bond market at some point will take those. That's what will slow the AI issuance. It might just take a while rather than a few Fed hikes.
Are you conveying what you think the Fed chairman was attempting to communicate last week?
I was surprised that he brought up the market that much. You can read it a few ways. If the market's tightening, the Fed doesn't need to tighten as much. But I don't like that chicken and egg, because then the market's trying to see, okay, so should we tighten more? I'd rather that the Fed take control of where they think policy is. But I think there was another message that the Fed the Treasury, I think they're looking at the market. This is not an academic exercise of let's figure out neutral rate, where's policy, how much do we need to hike. They're looking at broader financial conditions. You can argue they're easy, and then I look at real rates, and that's not easy. So there is tightening in certain parts of the economy. There's very easy conditions in others. I think the Fed chair is trying to tell us that he's looking at the market. I do still wish we get a little bit more clarity. We don't need forward guidance.
Yeah.
I don't love we're not being spoon-fed. By the way, data dependence was not spoon-feeding. We were looking at the data. So I don't think we need forward guidance. It's just a sense of, you know, how do you react to different economic data points? You know, what is the underlying inflation? Is it PCE? Is it trimmed mean? I think that just would be.
Can I ask you something? This is probably difficult to answer. At some point, obviously, 30-year yields become a buy, but also at some point, you might get to a situation, a scenario where high yields beget high yields and things get away from us for a while. That people start to worry about the financing of the Treasury, yields go up, and then they start to worry even more, and yields go up, and buyers don't step in. Do you envision that kind of scenario playing out, and is there a level where that might click in?
You know, yes, that is a concern, particularly if inflation doesn't show. I mean, we think it's peaked. What if it continues to stay sticky for a while? The Fed starts to raise rates at the same time as you have all of this supply that doesn't stop, and then the long end gets unanchored. You know, where what stops that would be the rest of the financial markets paying attention to it. I mean, for all of the things that have been thrown to the bond market, we've been in a really 4 to 460 type range. You start getting close to 5, I think the rest of the market, not necessarily just credit spreads, I think equities start to pay attention. And then I go back to the bond market being this powerful you know, equilibrating factor. Yeah. I think that comes in. You get the tightening in financial conditions and some of those things that are moving rates higher. Do we get the BOJ to act? I mean, that would be helpful. Do we get changes in issuance patterns? There are policy offsets, but it'll have to come through a broader tightening in conditions.
Self-limiting at some point, Bramo. It's often the case in the bond market, things become self-limiting. Yields go up so high and then it causes problems elsewhere and the money goes back in a fixed income.
As soon as it causes problems in Washington, D.C., then things will calm down.
They might wake up and do something about it. We'll talk more about corrective course in just a moment with Priya Misra of JP Morgan. Let's give you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump reiterating his preference for lower interest rates, acknowledging it's not all on Fed Chair Kevin Warsh.
It's up to him a little bit, but not completely. He's got a board that's very political. The United States should pay the lowest interest rate in the entire world. I think he's great. I won't be criticizing him.
President Trump has reportedly spoken to Warsh multiple times since he took over as Fed chair. Alphabet drawing massive demand for its latest investment-grade bond sale. The Google parent selling $25 billion worth of bonds, attracting roughly $115 billion of peak demand. The company has raised more than $110 billion in debt since last year. The FAA is asking U.S. airlines to inspect their fleet of the latest Boeing aircraft. Operators of more than 450 737 MAX jets have been advised to check for cracks on key components that could undermine the aircraft's structural integrity. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Vonnie, thank you very much. Up next on the program, opening Pandora's box.
I give them credit. Their intervention was very deft. Opening that Pandora's box where you can say, yeah, we don't like the level, so we'll pop into the market with a couple of billion. You know, that carries a lot of risk as well.
Up next, we'll catch up with Priya Misra of JP Morgan on what's happening in Japan and what it means for this treasury market.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
8:30 Eastern Time, the jobs report, 80K, the median estimate in our survey. That number drops in about 1 hour and 11 minutes time. In the equity market on the S&P, positive by 0.2%. In the bond market, 2s, 10s and 30s. Yields retreating just a little bit. We're down a basis point at the front end of the curve and down 2 on 10s to 466. Under surveillance this morning, opening Pandora's box.
There's dangers to, trying to short the yen. I give them credit. Their intervention was very deft. So I think the market is going to be cautious about going in with both hands again. Opening that Pandora's box where you can say, yeah, we don't like the level, so we'll pop into the market with a couple of billion. That carries a lot of risk as well.
So here's the latest this morning. The Japanese yen losing nearly half of its intervention-fueled gains. Last week's effort by the US and Japan coming to the surprise of key allies. The Financial Times reporting the ECB only learned of the move after the US government sold euros to buy the yen.
Yeah, really highlighting just how unusual this moment is. We've been talking about that in general. The first coordinated bipartisan intervention between the U.S. and Japan going back some 30 years. I mean, this question of exactly how unprecedented it is, European authorities saying to the Financial Times that the sales of the euros to finance the yen were very striking and sad, saying this has never happened before, and that typically there always has been close coordination between Western allies. Again, it speaks to the bilateral nature of so many agreements in today's world versus some sort of multilateral kind of coalition type of approach that has been taken in the past.
And maybe at this moment it helps Tokyo and Washington. So you can see why both these governments were in favor of it. But to do it through the Europeans and not give them a heads up, for the Europeans it goes against basically the structure of the G7 coordination, the Plaza Accord, and that is why they are so unnerved by this move. And everyone's asking, well, can we see it again? That's the big question.
Priya Misra of JP Morgan still with us. Priya, let's just continue this conversation. The Japanese have now got access to a vehicle at the Federal Reserve. Make it very simple. You can park treasuries there, get access to US dollars without needing to sell those dollar reserves. Some people are having a debate right now about whether that is good or bad for the reserve currency, given the unease from the Treasury around monetizing those securities. What's your take on that?
I think it's great. I mean, treasuries provide a lot of value to portfolios. Liquidity is one of them. If I don't need to sell my treasury to get that liquidity, that, I think, reinforces that liquidity aspect. And then I go back to the COVID dash for cash. This facility was not available. A lot of the selling of treasuries happened because people said, I need cash, particularly central banks required cash. They were intervening or they just needed dollars. They sold treasuries. The market structure of the treasury market has changed, meaning we just don't have enough dealer intermediation capacity, regulations have changed, and so then all of that selling can overwhelm the market. If you have this other area where you can still monetize that liquidity benefit of treasuries without overwhelming the market with treasuries that somebody has to absorb at the same time as all of the supply, the credit supply is coming in, I think it's actually a very innovative, smart way to reinforce that within the construct of they're not doing anything that the central banks anyway, park their treasuries at the Fed. So this is just allowing them to monetize.
Goldman agrees with you, others do too, and for good reason. And we all remember what happened in COVID, Bramo, that sell what you can, not what you want dynamic, where things started to get bad and then yields started to rise on treasuries too. And there were those kind of moments where you knew things weren't good.
Yeah, and typically if you have a backstop, that's a positive, and the Fed or the Treasury can provide that backstop, and that's a real positive issue. It kind of goes to the crux of the issue that a lot of people are talking about. Does Sell America take hold once again? on the heels of concern about a Treasury-Fed accord or just a lack of certainty, or do you think that those fears have been overblown?
I think they've been overblown. I mean, they were talked about last year. We saw no evidence of that. You know, I look at inflation expectations very well anchored. I mean, is there a repricing in the bond market because of all the supply? I think that's happening. The real rate is showing you that. And that, you know, so that can happen. I might want to get paid a little bit more to give the US government's money for longer, or a high-grade corporate money for longer. But that's not sell America. That's competition for capital, which is happening globally because sovereigns are issuing more, the AI build-out. But that's just, we're all trying to get those same funds. People are looking at all-in yields. And I think that's why we're continuing to see inflows. People see there's income in fixed income. You're getting 6-7%. I'll buy that. So I think sell America is overblown. Now, if credibility, Fed credibility is at stake, which I don't see that. But if that starts to happen, you see clear political interference, that can change. But I don't see any evidence of that right now.
Given the race to capital, we hear about creativity coming from the Treasury Department. We hear about creativity coming from the AI issuers. You hear about creativity from all of the bankers at a time where everyone's looking to raise money. At what point is the creativity concerning?
You know, if we're seeing the impact of all the build-out through productivity, I mean, that's the holy grail. Is this going to just make us all more productive? Is it going to bring disinflation, you know, back in the system? Then the creativity is fine. If leverage starts to build, leverage, I mean, we just lived through the last month where we realized how toxic leverage can be. I think that's where the concern can come in. I still look at much of that creativity is coming from companies with pristine balance sheets, barely any leverage. So I think they have room to run. The US government, I think we've got the safe haven status for us. I'm not sure where, at some point, Congress has to get the memo. I'm not sure that's happening anytime soon. But I'm less concerned about all of the supply right now because there is, you know, there's earnings to back it and there's a good balance sheet to back it.
Priya, just final question on the Treasury. What options do they have left? What does a corrective action look like from here?
So I think the Treasury Secretary, I mean, they want to do regular and predictable issuance, I get it. But I think if they look at the broader fixed income complex of high quality paper, there's a lot happening in the long end. Maybe the Treasury doesn't need to compete for the long end. Issue a bit further in. I know Secretary Bessent didn't like what Yellen did, but you know what? They can do the same thing. They can start to, they can say there's a lot of demand for 5-year paper. Let's increase the 5-year. They don't need the Fed to buy. We'll buy. The index community will buy. So I think reduce some supply in the long end. I think that's coming in the next few years.
Priya, thank you. Priya Misra there of JP Morgan. That is an option available just to do even more.
Well, Gennady Goldberg actually thinks that that's exactly what's going to happen and that the 30-year issuance, like Priya was saying, will come in, not expand.
Interesting. Up next on the programme, we'll catch up with the Port of LA Executive Director, Jean Soroka, as Iran looks to ban the US from the Strait of Hormuz. Plus, Yahira has your morning movers. Chip makers looking to rebound in early trading. Micron up by close to 2%. SanDisk up by 2.5%.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Stocks doing better, up 0.25%. We'll see what the jobs data brings in about 60 minutes from now. We're following 2 days of really muted losses on the S&P. No drama there whatsoever. Pulling back just a bit from all-time highs on the S&P this morning. Back higher again by, let's call it 0.25% and up by 0.6 on the Nasdaq 100. The talk of the bond market right now, less about the Federal Reserve and much more about Alphabet. 2s, 10s and 30s. Yields lower this morning but high yesterday. Across the curve, including at the long end. 30s at 521.
Yeah, Alphabet selling another $25 billion of debt, and this comes after already about $170 billion of debt sold by just 3 issuers so far this year, which gives you a sense of just how significant this glut of borrowing has been. A key question, how much is this the real reason that you're seeing the long end of the yield curve really shift up in yield, just simply because there is so much supply? Ultimately, a significant portion of this is coming at the long end, the longest piece, 40 years. So this is where your duration is, and this is where your supply is.
40 years.
I know.
Where are we in 40 years? Where will we be? Right?
I'll be.
Where will technology be?
Baking cakes.
2066.
Fixing toilets.
Right. You know,
that's pretty much all I can think of.
Fixing the air conditioning at a data center.
Unless the
just
robot
sort of everyone
can
lining
do it
up for
itself.
those jobs.
I mean, that's right. Or building.
Right. We'll be retired in Puglia somewhere.
Hey, we better be.
Yes, that's what we're putting out into the world,
that's
Jonathan.
The dream.
Come on.
We better be. I'll be there. 2 hours away from the cash open with your morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing the chips and data storage companies staging a comeback this morning after yesterday's tough sell-off triggered by results from SanDisk and Western Digital, which were good, but not enough to satisfy investors who were looking for even more from this year's biggest winners. Because remember, SanDisk up more than 350% year to date. Western Digital up 140% year to date. Meanwhile, Hertz is surging again by double digits after soaring 30% yesterday as better than expected results give investors confidence in its turnaround story after it lost less money than Wall Street expected and posted better than expected profit. Also, heading into earnings, the stock had one of the highest short interest on Wall Street, so short covering could be adding fuel to this rally. And we end on software with Atlassian soaring 28% in the pre-market, making back almost all of this year's losses after it was caught up in the SaaS apocalypse. It beat and issued a stronger than expected outlook, and it's a sharp contrast to yesterday when disappointing results from Datadog and Figma sent the software sector sharply lower. John?
Yahara, thank you. I think everyone's still trying to come to terms with Grandma's retirement plans.
It doesn't make any sense.
Deeply depressing, didn't
it? Yeah, cakes and toilets, no thank you.
They really,
I won't be baking any cakes or fixing any toilets in my retirement
No wonder she's so bearish on the future and financial markets. I mean,
just, live within your means.
Okay, on our radar this morning, not that, but this. The president maintaining U.S. control of the Strait of Hormuz.
It's sort of open right now. You know, we have a thing called the blockade headed up by the U.S. Navy, and we control it. Now, we control it, but they can always shoot something. They always have something or drop a mine.
Tehran reportedly attacking, quote, hostile targets in the Strait overnight. Iranian state media reporting the country aims to ban U.S. and Israeli ships from the waterway. Elsewhere, Alphabet returning to the debt market to fuel massive spending on AI. The company raising $25 billion in investment-grade bonds, securing one of this year's largest order books for AI-related debt. The offer attracting about $115 billion of peak demand. And finally, the former PIMCO CEO, Mohamed Al-Arian, claiming Fed Chair Kevin Warsh is, quote, being misread. In an opinion piece with the FT, Al-Arian writing the following: should the market stubbornly fight the Fed, the risk of financial instability that has been building would intensify.
We've seen an increasing number of big thinkers, prominent people in the bond space talk about how Kevin Warsh is being misunderstood, that he wants to bring inflation down, and that the market has just gotten used to being spoon-fed or having sort of their hand held, all this type of rhetoric that we've heard. Ultimately, other people have said, well, it's a reaction function, not necessarily forward guidance. I think the bigger issue is we don't have a sense of what the actual threshold is, and the data is unclear. And frankly, the dynamics are unclear. And my biggest question from the entire thing is just, do you want to lean on the front end to do the work to reducing inflation, or will you let the long end do the work for you? Is that a better way to try to bring in inflation? Because ultimately, that was the interpretation of markets last week, and is that what they want to send out there? And that, I think, is sort of a bigger question.
Mohamed has real credibility in this, not just because of his experience, but because of what he was saying during the Powell era.
Yeah.
For the entire time, Mohamed was begging them, look at where inflation is, look at where inflation is going. And now, all of a sudden, because Kevin Warsh is coming in as Fed chair, everyone on this deliberative body actually now realizes, oh, wow, we are so far above our target, and how the heck are we going to get back to 2%?
I spoke to Mohamed yesterday, and he gave me a heads up that this was coming out. Didn't tell me what was in it, but told me it was coming out. So I read it first thing this morning. And I actually think the most important piece of this piece this morning is at the very end, the last paragraph. And what Mohamed's getting at is less about reaction function versus forward guidance. It's reality. It's the reality of the backdrop right now that is forcing the central bank to go through much needed changes. And I'll share the last paragraph for those who haven't read the piece in the FT this morning. Ultimately, the era of central banks as indiscriminate shock absorbers and perpetual providers of forward guidance is inconsistent with today's geo-economic realities. Success in this new regime requires abandoning the misleading comfort of the old playbook. It is very hard to disagree with that statement this morning.
Yeah, and I would argue, though, to what Priya was saying, it's not as though data dependence has been a comfortable existence for a lot of people. And that is sort of the counter argument to this, is we're already out of that place where people were looking to the Fed to bail it out. No one's talking about more rounds of quantitative easing, I hope not. But right now we're talking about just how do you adapt to a difficult scenario to forecast and difficult moment to understand inflation. I think a lot of people are on board with the 5 pillars that Kevin Warsh is talking about, analyzing all of that. Here's the conflict. How do you navigate policy before you get any conclusion or credos from some of those policy panels? I mean, that's the difficult thing. Do you not act at all, or do you just let the market do your work for you? I mean, these are some of the questions that people are trying to analyze. I don't think anyone would disagree with Mohamed Al-Arian in that last paragraph.
It's a process, and a messy one at that, and we're still working our way through it. Let's talk about a messy process developing in the Middle East. Iran seeking to prevent U.S. and Israeli ships from entering the Strait of Hormuz. A potential deal with Oman could grant Tehran tighter control of the waterway. The Port of Los Angeles Executive Director Gene Soroka writing, regional instability continues to affect global shipping by increasing fuel and transportation expenses. Those higher costs ripple through the economy, ultimately affecting businesses and consumers alike. Gene, I'm pleased to say, is with us here in New York. Gene, good morning, good to see you.
Good to see you, John.
How has that instability changed your world in the last 5 months?
It's been really unbelievable, because while there's about 10% of worldwide cargo that goes in and out of the Middle East, it's taking up 95% of everyone's time in the supply chain. New base cases on prices of energy, new base cases on how waterborne deployment architecture is going to look on these big ships and where they're going and how we're going to handle the cargo. Case in point was this summer. You saw a lot of small to middle-sized importers bringing in their cargo earlier because the fuel prices were going to go up. They lagged by about 3 months in the industry. And you had a target date of those tariffs, the Section 122s, going offline on July 24th. So we saw an abnormal rise in cargo May, June, July, ahead of a traditional peak season.
And we've got problems in the Red Sea now. as well.
4 years now, John.
They're back.
Suez Canal receipts are down 80% on average, which means the shipping lines take a longer route around the Cape of Good Hope of Africa, adding 14 to 17, maybe even 21 days longer on transit time. Now, with the price of bunker fuel up 60% since February 28th, that means the spend on each one of those vessel voyages is so much higher.
Are vessels and shipping companies just prepared to live through this? As you said, 4 years you've been doing the Red Sea. Are they prepared to live through the Strait of Hormuz that's off and on like a light switch?
Yeah, I don't think anybody is sitting back, Anne-Marie, saying, you know what, this is just the way it's going to be. But the amount of time that's being invested in scenario analysis, whether it's the importer, exporter, shipping line, 3PL logistics company, has just been off the charts. What do I do if this happens? There are so many announcements, once again, emanating out of Washington. This whipsaw effect of information has got people just planning as much as they can and then executing to the best of their ability.
How expensive is it to take these routes?
These routes add so much time and the fuel burn at these elevated levels. You're talking about prices that are up 60% over the last 6 months. On average, the transit time has increased by 2.5-fold. And right now, the fuel burn is about 30 to 35% of the cost of a vessel voyage. One ship sailing, 35% is what you're looking at on the energy price.
What I'm struck by is how we've had one supply shock after another. And people keep saying, well, at first it was transitory. The second one, it was just inconvenient that one shock came after another. And now people are saying this is the new normal, that a lot of the old rules are breaking down, the sort of free traverse of the seas kind of dissipating. How do your clients think about these supply-side shocks when it comes to the influence over their prices and how they plan for the future?
The question really is to that, how much more can we take? We go through COVID, we had 109 ships backed up in LA and Long Beach because people were buying so much product and then sitting on it, like a warehouse complex at the Port of Los Angeles. Then we go through the tariff policies and the reaction from overseas markets where we're now out of the ag sector. Soybeans moving out of Brazil, Argentina, almonds from Australia, and then import shifting with windows of opportunity and folks just speeding product to market. So it's not consistent, and that's what many of the questions are. When will we get to a day where there's consistency? And if it's a new normal, at least put these policies in place where we can kind of predict what's going to happen.
Well, I guess that if it's the new normal to some degree, or as people struggle to keep up, can they just raise prices? Is that a lever that they can keep leaning on to offset the extra costs incurred by the inefficiencies and the disruptions?
Not always, and I'll give you one example. With the price of energy across the board going up, diesel prices in Southern California are up by about 1/3. Most of the truckers that do our business at the port, about 2/3 of all the cargo moves in and out over the road. They're small to mid-sized businesses. They can't absorb these price shocks like others can, and they can't necessarily pass it on because they don't have the leverage. So there are different segments in this. The retailer passing it on, absorbing, finding efficiencies in their supply chain, better chance than some of these service providers that are really doing the business every day, our first and last mile ambassadors.
Gene, just final question. It's Payrolls Friday, so we talk about the jobs data. What's the labour market movement look like in your industry at the moment? Are things getting tighter? What's access to talent shaping up like?
Yeah, generally speaking, we're in pretty good shape. These dock workers, the best in the business, moving all this cargo. Our daily stats have never looked better from an efficiency standpoint, how much cargo is moving in and out. Even with the changes in commercial driver's license and truckers, we're still in very good shape for the 17,000 that are registered to do business.
No tightness emerging on the horizon?
Not that I've seen, no.
Okay.
But even at elevated levels, you got to do better with your gate appointments. You got to make sure that you're loading these trains on dock quickly and moving them through the Alameda corridor. It's all about speed and efficiency, and so far we're staying ahead of the curve on that.
A man in command. Gene, it's good to see you. Appreciate it. Thank you, buddy. Gene Soroka there, the Port of Los Angeles Executive Director. On the twin shocks for that industry right now, rerouting is one, the trips are longer, and on top of that, you've got higher energy costs as well.
Yeah, and you've got potentially policy uncertainty with respect to the tariff backdrop and all those other things. It's been a complicated period of time for this, and it's one thing if you're a Walmart or if you're Amazon. It's another thing if you're a small business that's trying to navigate this with smaller margins and less leverage.
The costs are going up. That's the end of that's the end of it. Either you're taking a longer route, which you have to use more energy, or you might actually try to traverse a conflict zone, and then your insurance cost is going to be extreme and probably not what you had it planned or budget for the year.
The trade-offs, it gets harder and harder, that's for sure. Let's get you an update on news worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Kentucky Senator Mitch McConnell has been released from a rehabilitation center to recover from home. The 84-year-old Republican saying in a statement he'll continue physical therapy and his work on Senate business. It's unclear when Senator McConnell will return to Capitol Hill. A hospitalization has kept him away from the job for nearly 2 months. Moonshot's AI model Kimi K3 broke out of a cyber testing environment. The test, performed by Frontier Security, shows Kimi lacks cyber controls. Moonshot joins other AI companies, including Anthropic and Meta, in reporting their models have escaped testing environments. In sports, FIFA's controversial water breaks introduced during the World Cup may be here to stay. Early-stage talks are underway to sell US media rights for the next 2 World Cups together, which would keep the breaks in place after they helped power this year's tournament to FIFA's most lucrative ever. And that is your Bloomberg Brief. John.
No. Vonnie, thank you. It's just, why?
I'm sorry, I'll be right back. I'm going for a hydration break.
You can take as long as you want. I can talk all day about how
can have hydration
bad
breaks
this
with
is.
We could just have, an advertisement. Bake
It's so obvious now, right? Because they're just saying the quiet bit now, out loud. They're not even hiding it. Not that it was well hidden to begin with.
I mean, in fairness, the NFL puts everybody to shame, so it's not exactly like...
I respect them more that they've actually tackled it head on, explaining to us why they have hydration breaks instead of,
for commercial reasons.
all of a sudden,
yes,
all of a sudden the players need H2O breaks when this has been going on for years without them.
You could see how the momentum in those games switched around those breaks. Like you really could. Just watching it as a neutral observer, you could see how the momentum shifted one way to the next based on a hydration break that none of them needed. In fact, the goalkeepers sometimes were signaling for the hydration break because they could feel the pressure building at certain points and wanted a break.
I'm thirsty.
Yeah, I'm just sort of sick of it. Anyway, the World Cup withdrawal for me is over.
Yeah,
so
I think a lot of people. I
was longing for
Premier
Portugal
League.
Uzbekistan maybe like 2 weeks ago, but
not anymore.
Well, Premier League is
too much
just 2 weeks
Infantino
away.
in the news.
It's almost back, yeah.
Yeah, we're fine.
Up next on the program, guiding financial markets.
Communicating your framework, guiding the market as to what your thinking is, what your framework is, not just the objectives, not just the targets, but how you intend to achieve those objectives and targets is pretty important.
Polly Assam of New Century Advisors joins us next.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg this weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg this weekend.
This is Bloomberg Television.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Stocks positive this morning. We're up a 0.25% on the S&P, on the Nasdaq higher by 0.6, with jobs data 42 minutes away. We're looking for 80K. In our survey, at least, that's the median estimate. In the bond market, 2s, 10s and 30s shaping up as follows. Yields this morning down across the curve. We're down 2 on 10s to 465. Under surveillance this morning, guiding financial markets.
Communicating your framework, guiding the market as to what your thinking is, what your framework is, what you're concerned about, I think is important. The markets can then make their own decisions without any commitment. But communicating the framework transparently, not just the objectives, not just the targets, but how you intend to achieve those objectives and targets is pretty important.
So here's the latest this morning. Communication for the Federal Reserve dividing Wall Street and Washington. A growing list of Fed officials sending new warnings on inflation after last month's decision to hold interest rates. Claudia Salm of New Century Advisors saying Fed Chair Kevin Walsh needs to start paying more attention to the people, writing the Fed does not need a new task force to hear from the public. It just needs to listen to the Americans it is already talking to. Unfortunately, the signals they're sending are not very encouraging. Claudia joins us now for more. Claudia, it's good to catch up with you, as always. What's the message from the American public?
I think it's a message of some weariness, right? This is, and Kevin Walsh has talked about this. Inflation has been high. It's been high for 5 years. People have been adjusting to it, but adjustments are costly. Trading down, looking for deals, like that takes a lot of time. And I think that's some of the frustration we pick up in the sentiment series. People are still spending, but they're angry and they have reason to be. And the labor market, while we call it balanced and it's stable isn't always a good thing. If there aren't job opportunities out there, you're stuck in a job, you're not getting higher wages. So under the surface, there really is some strain. And I think it's important for the Fed to be listening to it, especially for the chair. The task forces, regular people, totally missing. Labor organizations, nonprofits, totally missing. So, but all that information is sitting at the Fed. He just needs to spend some time really thinking through it.
Those problems are real. That strain is evident. It's clear to us all. Claudia, what could this Fed do about them?
I think this is one piece where the communication strategy needs to get back on track. Communication is not just about talking to financial markets. It's about talking to the American people. The accountability piece, like, let us believe that you know what you're doing, that you're thinking. Like, we can't just trust you. We need to kind of see that evidenced. And so I think that's one where really getting back on track with the communication would help a lot. But in the end, it's gonna be actions. It doesn't mean that they should be raising rates just to get people on board, but they really should lay out a very clear, well-argued, well-thought-out plan and then move forward.
Claudia, what do you think that plan should be? I mean, if you had to articulate a reaction function right now, what would it be?
So I found the reaction function in the June FOMC minutes a very credible one. They had two scenarios. Either you start seeing inflation coming down soon, and I think it is important to put some timestamp on it. Like, we're not talking about 2 years from now, we're talking about this year. Then you start raising rates as long as the labor market is stable. And if things start to get better, you know, we've got some supply issues. If they're working their way out, okay, then the Fed can sit back and watch that carefully, let inflation come down. But it needs to be scenarios, contingency plans that are tied to the data we have. No, it is not perfect, but it's the data we have, and then you go forward from that. I think that's the way to do this.
What do you think is the more efficient way to control inflation? And this is something that's emerged kind of in markets. Do you think it's the front end of the yield curve? It's the Fed funds rate, which is the traditional tool. Or do you think allowing longer term yields to go higher is a restrictive way to bring down inflation without having to take action on the front end that could potentially penalize certain investors with credit card loans, et cetera.
So the most efficient way to get inflation down is to stop doing policies that pump costs into the American economy, right? Like this has been a real issue, particularly in the last year. But in the Fed, what I think they should really stick to their bread and butter, do this through the federal funds rate. Don't get cute with the balance sheet right now. The Fed has the most impact at the short end, but that's not the only place that it has an effect. And so I think it's just, you know, if inflation is high, if there is a risk that it is getting stuck, you have a tool that is there. You can raise rates. I do think it's important that they're going to need to give some guidance on the fact that we're talking about an adjustment, something modest, not a 5 percentage point hiking cycle, right? Like they need to give some sense of what the Fed is trying to accomplish here. The Fed cannot fix all of this inflation, but it can definitely be part of the solution.
Claudia, when you talk about this accountability issue, isn't the issue with the entire Federal Reserve not the Fed chair because they don't trust Team Transitory and some of them are still there from the Powell regime?
I question that the Fed had that view before. I mean, I know that is the kind of talking point of Warsh, that he's coming into a Fed that's in crisis, has lost credibility. My read of financial market data, financial market discourse was not that the Powell Fed was completely, you know, under the bus when it came out of office. I do think there were periods in 21, 22 where the Fed was really questioned, but they pivoted, they raised rates a lot. Inflation did move down, not all the way to 2%, but I don't think we're at a point where the Fed has been in this crisis moment. And frankly, the reason I point to Chair Warsh as the one who's out of step is the rest of the committee, if you watch them, they really are still communicating as they have done in the past.
Claudia, it's good to see you. It's what we see right now from Fed officials. They won't stop communicating. Claudia Sam there of New Century Advisors. As for the history of Fed Chair Jay Powell, I often say this. They were late. And there were individuals on that committee that suggested they were late because they were waiting for the Fed chair to see if he got reconfirmed.
Exactly.
That's a problem. The other issue I would bring up with regards to this Fed too, and we can't forget it when we talk about these issues, is that the correction we saw in inflation, a large piece of that, particularly on the labor side, was a consequence of some very questionable policies from the Biden administration about how they handled immigration at the southern border. There was a massive supply side story that we see the opposite of at the moment under this admin.
Also extra checks to people who are working at home and receiving income and didn't have anywhere to go spend it on.
True.
That was a huge issue in terms of why you saw costs of furniture and contractors go up. The issue, of course, with Powell was they were waiting for him to be reappointed, so which was politically driven.
We're still doing QE at the time. That's why it was a mess, let's put it that way, a regrettable mess. Coming up, Nadia Lovell of UBS, Greg Peters of PGIM, Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock, the third hour of Bloomberg Surveillance, up next.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacqua, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacqua. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ula, Saudi Arabia, and this is Bloomberg.
We think we're in store for some weaker reports upcoming.
The labor market's still relatively sideways.
The signals are muddled. They're not telling you what they typically tell you because a lot is going on.
Things could change. The U.S. labor market can turn around quickly.
This week, it's all about Friday.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. 30 minutes out from the jobs report, with equity futures on the S&P up by 0.2% on the NASDAQ, up by close to 0.5. In the bond market, yields declining across the curve by around 2 basis points, down 2 on 2s to 422 on 10s to 466. Heading into this at 8:30 Eastern time, we're looking for 80K. In our survey, that is the median estimate. That is up from a previous read of 57.
Yeah, and a real question here about some of the internals, what it will be. Right now, the expectation is for the unemployment rate to stay at 4.2%, the same rate that it was in the prior reading. That will be key to understand exactly the tightness versus slack that could be emerging in the market. And then again, the wages. The wage picture directly goes to the question of how much heat is there coming from the labor market, potentially going directly into next week's CPI and beyond.
I know the survey's for 80K, but the scope and the range is so wide. 40,000 to 157,000. That would be a pretty large number right now. But once again, does it tame down expectations of Fed rate hike, or does potentially it make next week's CPI a little bit more spicy?
We've got 2 more CPI reads, 1 more payroll read after this one, going into that September meeting. And you're hearing from more and more officials that are either ready to hike or close to preparing to hike. That's the overwhelming consensus on the committee right now. And the one person that hasn't really offered their view in a material way, the Fed chair himself. And the only read we've really got at the moment on that, with regards to September specifically, is through that FT story just yesterday.
That he'd be prepared to raise rates should inflation run hot, and that his reaction function isn't that far away from some of the other Fed officials, that ultimately the threshold is inflation continuing to accelerate in the wrong direction. Key question for a lot of people is, why wasn't the communication talking about how inflation still was going down in certain key components, right? In other words, you talk to a number of analysts, and they say they still are expecting disinflation coming from components like the housing market that's only more constrained right now, and a couple other places. If that comes to fruition, does the market price out the potential for rate hikes?
You know what stood out to me about the FT piece? that really spoke to how communication has broken down, that the people familiar with the Fed chair's thinking felt compelled to tell the FT that the primary tool was still the interest rate and not the balance sheet. That just spoke to me that communication's really, really gone wrong here. The fact that you have to say that, like, out loud because people aren't quite sure, that's what went wrong in the news conference last week.
To me, that is the ultimate question. Are you still relying on the front end of the yield curve to control inflation, or are you going to take a look at other metrics? And if you are, then people are going to price in the potential reaction function of the Fed very differently. I think that is the question, not necessarily whether we're going to get reaction functions from the Fed, not how many press conferences there is. It's what tools are you going to rely on, and how do you plan to evaluate inflation and progress potentially in that area?
Above target inflation is a problem. You've acknowledged that. We've seen it. It's in the statement. What are you going to do about it?
How?
Right? And how? What tool are you going to use? Still big questions. Yields this morning down a couple of basis points, 10's around 466. That jobs data 26 minutes away. Coming up this hour, Nadia Lovell of UBS with stocks eyeing a second straight week of gains. Greg Peters of PGIM expecting a rate hike from the Fed this year, and Stephanie Roth of Wolf Research calling for an above consensus payrolls print. We begin this hour with stocks holding steady heading into the jobs report. Nadia Lovell of UBS writing, "We are constructive but not complacent. The Fed likely stays on hold. Earnings remain the market's anchor, and we think the next leg higher comes from continued broadening beyond mega cap tech." Nadia joins us now for more. Nadia, good morning.
Good morning.
We love sharing Payrolls Friday with you. Walk us through what you like and how things have changed since we last spoke.
You know, I think we continue to emphasize this broad in and out story, and we've had increased conviction after this very strong earnings season. I mean, it's coming above even our expectations. I mean, trending close to 30% EPS growth. And I think that the good news in that is that you are seeing that broad in and out of earnings. It's not just about mega cap tech anymore. You're seeing like 8 out of the 11 sectors that are now seeing double-digit earnings growth. The medium companies is seeing earnings growth in sort of the low teens. And I think that that sets up for a better second half from here. And the fact that you have the S&P 500 that is close to all-time highs, but the last couple of months, what's gotten us here? It's not necessarily sort of the old story. It's the financials, it's the industrials, it's the healthcare. So our message remains consistent, and we continue to emphasize that you need to have diversification across the portfolio into all this, some of these other cyclical areas as well.
7,900 used to sound like a big number. We're really close to it now. That's your year-end price target. Yes. When you start to see that broadening out away from mega cap tech, if leadership is elsewhere, does that mean index level gains will be muted from here into year-end?
No, you know, I think that, you know, now that number, I would say, is looking conservative after this earnings season. Even our earnings expectations for the year of 20% is also now looking conservative. So what gets us to the upside from here, I think, is that continued strong economic growth coming through, and we think that happens. A Fed that stays on hold and not flip to a hiking cycle, because then the market will question, is it one hike, is it two, or is it three? And then the Fed reaction function isn't quite as clear in this moment either. And so we think that you need some clarity around that in order for markets to continue to grind higher, and this earnings support coming through as well.
In other words, if you think if the Fed hikes one time even, or even two times, that could potentially stymie the momentum that we're seeing in the broadening out in equity markets more generally?
I don't think it's necessarily one or two times. I think it's more clarity in terms of like, okay, what exactly are we solving for? Are we looking to remove all of the cuts that we've had in the last year or so, 75 basis points or something more? You know, the equity market doesn't need certainty, but it needs some sort of direction of travel of where we're going. The fact that you have earnings growing close to 30%, I think that that's enough to help this market continue to move higher. But what you need is that a Fed that doesn't necessarily, you know, emerge into multiple hiking cycles, or sort of renew a hiking cycle.
Can you have earnings growing by 30% without a heating economy or an overheating economy?
We're here. We're doing it right now. Well, but let me explain. Yeah, let me explain. I mean, we're already seeing it right now, where the economy isn't overheated. I mean, some of the things associated with inflation, we know it has to do with tariffs. It has to do sort of this temporary spike in oil prices, and so we do expect to see the disinflation trend continue. When we look for CPI next week, we're looking for about 2.5% increase on CPI. We think that this is is an economy that can grow in a 2% range. And so I wouldn't put that as an overheated economy. You also have a labor market that is not re-accelerating. It's sort of, yes, the unemployment rate seems to be stabilizing around 4.2, 4.3%. You're not seeing wage growth pressure. So you do have an economy that is moderated, or it's slowing down. It's not overheated. And what's driving the earnings growth is really, one, we know the CapEx coming through from tech, but also the fact that you're now seeing a cyclical pickup, improvements in PMIs as you have clarity around, tariff policies and some other pent-up demand that's actually now being solved for. And we heard that from the industrial companies, that is not only short cycle, but also you're seeing improvement in terms of aerospace and defense, transportation, also related to the data center built out. So I think it's all a combination of that, and you have an economy that's healthy, that's not overheated.
Nani, does it give you pause, though, that the Bank of America sentiment gauge hit the most extreme bullish level since 2021?
Well, I'm not surprised by that, because there are a lot of reasons to be bullish that we just talked about in terms of the fact that you have, 7 consecutive quarters.
But if everyone's lined up on one side of the boat, does that make you a little bit nervous?
I wouldn't say everyone is lined up on that side, because this is despite the fact of what that specific survey they say. And you've seen that.
I liked Chris Verone's response to this. You need bills for a bull market.
Yeah, exactly.
Stocks are going up.
Yeah, but look at it. Look at some of the positioning, the unwinds that we've seen also as well. That hasn't fully been reloaded, right? So I don't think that there's broad-based, overly bullish. There are a lot of bearish
Nadia, that's
still
of interest
in the market.
to people. Can I jump in? Just how much we cleaned out leverage through the month of July? How much of a reset we actually had? What are your views on that, and how do you gauge where we are?
I think that it feels like a lot of that unwind is behind us now. You're already seeing some recovery in the names that have been affected. Could you see another leg, so continued volatility in the next couple of months? Yes, you can, but I think a lot of that is now behind us. We ourselves, in terms of our position, and we had taken down semis quite a bit over the last month or so, started in June, because we were a bit concerned about how fast if they're rally. We still believe in the fundamental AI story, but what we're trying to send through to our clients and in our portfolio is the need to be selective and diversified across the AI space. So I think it's from here on out, it's more selectivity. You're seeing it in terms of even some of those earnings results this week, that the bar is quite high, right? And so companies not only have to deliver on the earnings, but also the outlook, and also show that sustainability of the margins, particularly around the AI trade.
You crushed it with that call. Just finally on the jobs data, 20 minutes away. Yeah. How relevant is the jobs data this morning?
It is relevant from the sense of the unemployment rate and wage growth, right? But it's not the only data that matters next week. CPI inflation will matter, of course. Obviously, we're all watching it closely because we're still trying to figure out what the Fed reaction function is. And so, if you see a tick down in the unemployment rate, we know payrolls get revised all the time. So unemployment rate, then that's, an argument that helps support the more hawkish side of the Fed, like the Kashkaris of the world, that believes that we should be on a path to moving interest rate back up higher. Or, if you see a sort of stabilization, then, maybe you're supporting the Williams of the world, right, who sort of said policy is well positioned. So I think that the fact that we have a pretty, bifurcated Federal Reserve, that those two numbers will be watched closely. But our core view is that the Fed remains on hold for the rest of the year.
Nadia Lovell of UBS, 7,900. What's the bull case? What's the bull case for you?
82.
Okay, it feels like we're leaning towards that. All right, Nadia, thank you. Appreciate it. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Iran looking to block U.S. and Israeli ships from the Strait of Hormuz as part of its proposed deal with Oman. Tehran also moving to require compensation from hostile countries before they're allowed to sail through the crucial waterway. President Donald Trump reiterating his preference for lower interest rates, acknowledging it's not all on Fed Chair Kevin Warsh.
It's up to him a little bit, but not completely. He's got a board that's very political. The United States should pay the lowest interest rate in the entire world. I think he's great. I won't be criticizing him.
President Trump has reportedly spoken to Warsh multiple times since he took over as Fed Chair. Under Armour forecasting a sharper than expected revenue decline due to softening demand in several regions. The athletic retailer now expecting sales to fall by mid-single-digit percentages this year. The company's CEO citing a, quote, challenging consumer environment. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next, the morning calls, plus Greg Peters of PGIM, seeing rate hikes on the cards later on this year with a payrolls report about 20 minutes away. We'll catch up with Greg in just a moment from New York City. You're watching Bloomberg TV.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
We're entering the alpha market, right? This is a market where I think ambiguity is greater than people are used to. I think it's an environment where there's no free lunch. You have to pick stocks. This is no longer the kind of 15 years of QE and forward guidance that everyone gets trophies.
We never liked the participation trophies, did we? That was Chris Verone of Bear Strategas.
No,
it's back to winning, Bremo.
I'm anti-participation trophy. I felt that way with kids too. If you win, you win. If you lose, you lose.
Yes.
Yeah, no, they didn't quit sport again. Yeah.
Right? Oh, they quit sport after that.
Win some, lose
Bring
some.
back the participation trophies. Equity futures look like this on the S&P. We're positive by 0.25%, up by 0.6 on the Nasdaq 100. In the bond market, 2s, 10s, and 30s heading into payrolls later on this morning. That's 14 minutes away, with yields around 420, 10s around 466. Given where we are now, even with the moves yesterday, we're still down on the week across the curve, 2s, 10s, and 30s, just taking back some of that sell-off we saw at the back end of last week.
Yeah, and it just, again, goes to the point of how complicated this moment is. On one hand, you've got issuance. On one hand, another hand, you've got a question about the Fed and all that. And then on the other hand, you've got oil prices and where they exactly are going. And that also is one huge input into inflation and, frankly, the bond yield perspective.
Deal or no deal, the strait's open, kinda?
Yeah, it's great.
That's the last 24 hours, sorta, kinda?
Sort of open.
But not open to U.S. shipping?
Not according to the Iranians.
Right,
and if you're
what kind of deal is that?
And if you're any ship that wants to get through, you have to pay not a toll, a service fee.
It's like being sort of pregnant.
That can't happen.
Well, it's
concepts
not really.
You have concepts of a plan.
Yeah, concepts of a service fee.
That's a conversation I'm not weighing in on. Okay, Brent crude this morning, 82. WTI is 77.
It means it can't happen.
Okay, just going to avoid. All right, let's get you some morning calls. First up, Goldman raising its price target on Cloudflare, seeing opportunities from a new internet business model. Your second call from Citi, downgrading JetBlue to sell, citing a, quote, deteriorating risk-reward for the shares compared to the major airlines. That share's having some problem. That company, Abraham, you've talked about JetBlue a few times.
Well, this is the K-shaped economy, and a real question here about the lower-income consumer, or just even trying to cater to people who are looking for a deal. And that's ultimately, you're getting crowded out. When you go to buy a ticket, you see like the basic.
Yeah.
You don't have any leg room. You can't put whatever, but you're still flying the Delta or the Uniteds of the world, and that's competing with the low-cost
I used to be a Mosaic JetBlue customer, right? Used to be, you know, frequent flyer, vacations,
Mint is
that kind
very
of thing.
good.
Mint's a great product.
Yeah, very
I
good.
speak highly of that product. Then after the pandemic, I lost my status, right? And I remember Robin Hayes, this is another status
Oh
complaint.
yeah, I was going to say, here we
Robin
go.
Hayes, Guy Johnson spoke to Robin. He used to run the company, and Guy said, John's about to lose his status, like he was Mosaic, loves flying with you, blah, blah, blah. And he said he should fly more. And that was the response. And I never flew JetBlue again after that.
Yeah,
but I took my stand. I just never flew JetBlue again after that.
This sounds like a theme.
It is a thing. I'm running out of airlines,
You're
Bramwell.
right. Yeah, I was going to say, where do you have status?
We're back to Delta.
Oh, you're
We're
status
back
at
to
Delta.
Delta.
They give you status?
Sort of similar stories can play out in the next 12 months.
100%. You'll be
Scott Kirby. United, love them. All right. Let's get to the final call. Deutsche Bank raising its price target on CoreWeave, saying it's very bullish on company fundamentals. The stock is up by 3% in the pre-market. Payrolls just around the corner. Let's get to that with Greg Peters of PGIM. He writes the following: the labour market is somewhere between stabilisation and acceleration. Our base case scenario is one where continued growth momentum supports nominal growth and the Fed hikes rates this year. Greg joins us now for more. Greg, welcome, buddy. It's good to see you. What are you expecting to see in about 10 minutes' time?
Well, I'm not really sure. That's the whole, that's the whole issue on the table here. I think there's an inordinate amount of potential volatility just given where this one payroll prints. And we know that this is a highly revised data series. So we're hanging on this fraught number that's highly revised. And so that's the world that we live in. And I would say we better get used to it.
Greg, how material do you think it would be or wouldn't be to the Fed decision that's coming up in September? Ultimately, for many people in the market, that's how they used to look at this data and have looked at this data for such a long time. Is it different this time? Has that changed already?
Well, I think it's always dangerous to hang your hat on one single data point, but I think this single data point is quite critical here. If, for example, if you see something kind of below 50, I think that does change the mindset in the marketplace, at least around the Fed's willingness to, raise rates. Conversely, if you see something above 100, I think that is added fuel. So it is it's important. And normally I don't get all that excited over a single data print on a payrolls Friday, but I think this one carries more weight than it ordinarily does.
Greg, what's your reaction to last week's Fed meeting? I mean, do you think that Fed Chair Kevin Warsh is being unfairly criticized? Or do you think that actually the uncertainty being baked into bond markets has been negative or potentially punitive for growth or potentially even just generally the Fed's objective?
Yeah, well, they say timing is everything, right? So it's very difficult to pull guidance away from the marketplace in a highly uncertain time. So if we were in a much more placid environment, then I think it would go more smoothly. But, we are in the midst of, a war in Iran. We're, seeing above target inflation for the past 5 years, as you mentioned. There is a lot of uncertainty around the labor market. And so the market participants are looking for a little guidance, a little roadmap into what the Fed is thinking. And so we're just kind of left to our own devices. So I applaud in many respects what the chair is trying to do. But at the same time, it's really hard to do that at this particular time in the marketplace.
How much control does the Fed have over the long end of the yield curve? And I'm not saying that they're losing control as much as someone else is taking control, which is the central bank of Amazon and the central bank of Alphabet and the central bank of Microsoft, which have been issuing tons of debt at the long end of the yield curve, overwhelming the market and frankly affecting the dynamics that much more potentially than inflation expectations or some of these other metrics. I mean, how do you view the Fed's actions versus the broader market backdrop?
Yeah, I think that is the story in the marketplace. Honestly, there is this deluge of back-end duration hitting the market. And I think it's important to remember that we're just starting, right? So we're in, let's just call it the second inning. This hyperscaler debt issuance story has really just begun. So that is a crowding out effect. That's additional pressure on the back end. And so, you know, central banks have very little control over the back end other than this idea or this notion of credibility. So that's where the back end, you know, is responding. You're having a twofold hit where there's a question, and maybe it's not quite credibility, but uncertainty, thus risk premia. And then on the other, you have this hyperscaler issuance that's putting a lot of duration dollars into the marketplace. So once again, I go back to this narrative that timing is everything, and the timing is really quite poor in order to enact this new, you know, less forward guidance world.
Greg, do you think that the Fed needs to hike in order to establish that credibility?
If the data doesn't roll over, so you would have to see payrolls be quite weak today. You'd have to see inflation come in really quite moderate next week in order to kind of see that happen. Other than that, I actually think the great irony here, or the cruel irony, is that, you know, getting rid of forward guidance is a way of not painting yourself in the corner. But by doing so, Warsh is actually backed into a corner, right? So I actually think he has to, and the committee has to hike in order to kind of gain that credibility back. And you just can't keep talking about how important it is and not do anything about it. You basically have one shot to do that, and that was the first presser. The second meeting and the second presser, that's why the market reacted as such.
Greg, what would you point to specifically as evidence that this Fed has lost credibility that they need to regain as soon as September?
Yeah, well, you're not seeing it in the normal channels, right? So you're not seeing it in bond market volatility. Those measures are really quite muted. You're not seeing it in break-evens, forward break-evens, so five-year. So you're not really seeing it. It's more of the nominal yields, right? So you've seen a real move in nominal. You could say that a lot of that has to do with the strong underlying growth, but I also think that is kind of capturing some of that risk premium. So there's not clear evidence that there's credibility loss, so let me be clear about that, but there is concern about what the direction is and the uncertainty, and it hasn't permeated and been measured across these normal metrics, but it's happening in the marketplace. So it's one of those things, Jonathan, that it's really difficult to point your finger at one particular item.
Final question, I've only got 15 seconds. My favorite question of the week, and it's Bramos. Do you want some 30-year alphabet debt or the 30-year treasury? Greg, if you had to choose, what would you choose?
30-year treasury.
Greg Peters of PGIM. It's a different answer to the one we got yesterday, isn't it?
It's a different answer to Priya Misra earlier on JP Morgan. This is really interesting. The idea of, would you rather just take the straight duration or would you like the credit cushion? Depends on who you are.
Tune in for why next month when we have time and Greg is back on the program.
Amen.
On Payrolls Friday. And we'll see how they've traded, right? How the 30-year alphabet piece has traded in the market and how 30-year treasuries have traded.
All right,
okay?
game
it's
on.
A setup.
That's right.
All right, cool.
Next week on Real Yield.
You going to host that?
No, but
Scarlett might have something to say about it.
No, absolutely not. I'm sure that that will be addressed.
The payrolls report is just around the corner. Stephanie Roth of Wolf Research joins us next.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Payrolls just around the corner. The report, the number, 20 seconds away. The scores look like this. Equity futures on the S&P 500 positive by 1/3%, higher by 0.66 on the NASDAQ. The main event, it's been in the bond market for the last few weeks. 2s, 10s and 30s. Yields still elevated, down a single basis point on 10s. 467 on 2s, 423. Yields lower by 2. Let's get to this data. Mike McKee has more. Good morning, Mike.
Good morning, John. Well, it is a disappointment, a kind of a surprise here that may throw some confusion into what's going on with the Fed. Negative 23,000 jobs. There have been people who've been forecasting that might happen sometime soon. Ian Lingen over at BMO turns out to be right today. The unemployment rate, though, drops to 4.1%, and I imagine what we're seeing there is another decline in the labor force. We'll take a look at that in just a second. Change in private payrolls, 30,000, and also the 2-month net revision, 103,000 taken away. So what we're looking at is a labor market that is much weaker, at least on the hiring side. The change in private payrolls, as I mentioned, 30,000. Change in manufacturing, 5,000. Average hourly earnings up only 0.1%, so no inflation pressure there. Puts the year-over-year rate at 3.2%. Hours worked at 34.3. That's the same as it was in June. And the underemployment rate, 7.9%. The labor force participation rate does tick down to 61.4% from 61.5. So I'll take a look at the underlying numbers and get back to you in just a second.
Mike, thank you, buddy. You can guess what's happening in financial markets. Let's just start with the headline. There's a lot to figure out here, but for the headline, negative 23,000. The low estimate in our survey was 40. Positive. The median was 80. That's a big downside surprise. So in the bond market, let's start there. 2s, 10s and 30s. You look across the yield curve, you'll notice yields dropping quite aggressively at the front end of the curve as people reduce at least near-term expectations for Fed action, with 2s back down to, let's call it 416. In response to that, equities pick up on the S&P, on the NASDAQ, the Russell, with some outperformance around the small caps off the back of this, up by 0.75%. Lisa, just to work through the data and Mike will get to the details, it's a downside surprise on the headline number. You've got that quirk in the participation rate again. So you've got unemployment falling back from 4.2 to 4.1. We were looking for that to remain steady and unchanged at 4.2%. And then wages coming in softer than expected. Make sense of this puzzle this morning if you can.
No, thanks. I mean, I think that the only way that some people will try to explain this, first, I think that there will be a cohort of people who say it's a random number generator because ultimately it says more about the overarching dynamics of the input of available workers versus the demand on one side. To me, the thing that sticks out is 4.1% unemployment rate. That it ticked down to the lowest level going back to June of 2025, and it raises this question: is it just that people are dropping out of the force? Well, it looks like actually the number of underemployed went down, or at least the percentage. So this, to me, looks kind of like the productivity report yesterday, which speaks to a robust market that is not inflationary. Again, this goes to this question of, are we seeing what people are hoping for, which is increased productivity, more disinflation, but a solid economy?
We're in the process of digesting this data. This is the first move. We always say it, not necessarily the right move. A bit into the front end of the curve, a bit into bonds across the curve, but you see the bigger move at the front end, just dropping by 7 basis points on twos. Equities responding positively to this as well. Mike, there's an obvious question when you look at data like that, whether it's the headline read, what it's happening with unemployment. Am I seeing the consequences of a supply story or a demand story or both, Mike? What do you see in the data?
Well, I hate to say this. I hate to use this word because everybody hates it, but seasonals. There was a decline of 50,000 jobs in local government education in July. Now, usually those people would tend to fall off the payrolls in May or June. And so I think what we're seeing here is a sort of a distortion in the overall numbers. If you add that 50,000 in, it would be a low 20,000 jobs or so created, but much better than what it looks like now. And when you look at the underlying categories, what you're seeing is slower job growth. So you're taking away probably from the demand side. The construction jobs were up 22,000, which you'd expect given the way construction is going these days. But a low hire in manufacturing and a whole loss of jobs, 19,000 in the retail business. And then in terms of leisure and hospitality, 40,000 jobs lost after 43,000 jobs lost in June. And we don't know exactly, but that may have a lot to do with the timing of the World Cup and people who were hired earlier in April and May to work on that. So it's not as bad on the top line as it appears, but it isn't great news either way.
Mike, we'll give you some more time. I'll come back to you in just a moment. We've got Stephanie Roth of Wolf Research with us around the table, combing through the same data. Stephanie, good morning.
Good morning.
A weak report or a report I can ignore?
I think it tells you that the labor market is softer than it appears earlier in the year. And to Mike's point earlier, like there appears to be some seasonal issues in the data, just generally speaking. The trend is probably a labor market that's a lot cooler than people had previously thought.
The bias would be, what does it mean for September for this Federal Reserve? Difficult to look at this morning, Stephanie, and say the labor market's a source of inflation that we should worry about. How would you characterize things?
I think that's exactly right. I think it tells you that if data looks somewhat softer in the next couple months, especially when it comes to the inflation side, they're probably not going to want to hike in September. They're probably going to want to just see how the data progresses. Now, that's going to probably have to mean core PCE tracking below 0.25% roughly over the next 2 prints.
Just want to keep going over the path to September, Lisa. We've got one more jobs report after this. We've got 2 more CPI reports, one next week before that September meeting. And there is a big Jackson Hole speech, which will be attended and given by the Fed chair, Kevin Warsh. There's a lot of work to do between now and then.
And frankly, the labor market has not been the source of inflation throughout this entire period. So how much does this matter? And Stephanie, that's what I would ask you. At a certain point, if you haven't seen the labor market as a source of inflation, but inflation's been persistent, is it sort of the breakdown in the Taylor rule? Is this sort of a breakdown in the relevance of this metric?
I think it's a reminder that there's a lot of supply issues that's driving inflation. It's been a combination of tariffs, we've had the Iran war, and then on top of that, you've had AI adding to inflation. The combination of these things add about 100 basis points to inflation. So if you strip that out or realistically just move through time as those shocks subside, then you're back to inflation that's a lot closer to 2% without the Fed having to act.
What do you make of the fact that the participation rate in the labor market fell to the lowest level since February of 2021, explaining why maybe we saw the unemployment rate come in even with a very disappointing overall headline number?
Yeah, I mean, I think it might be to some extent noise. We also had I mean, to be fair, we also had a similar trend in the print before this. I think to some extent we have to kind of smooth through that, and it's an environment where you know, participation is a little bit softer than where it's been, but nothing that is so onerous. My guess is in the next print or so, you'll see a bit of a bounce back. The household survey is very volatile, so I wouldn't be surprised if we saw a big jump in the next print and we're kind of back to a more normal level of participation.
This morning, UBS's Paul Donovan put out how firms do not simply tell the BLS about their payroll numbers. So do you think, because this report feels so out of the ordinary, people are going to start to question once again how credible these BLS numbers are?
I think they're definitely going to ask about the credibility of the numbers. I mean, especially since you just continue to get whipsawed around. I don't think it is a real like broad-based issue when you extract out and you look at the trends, but clearly there are issues when you look at the month-to-month data, and you have to sort of smooth out kind of what's going on. There were some theories that earlier in the year, immigration was boosting the numbers to some extent in terms of the establishment survey. So it's possible that it was artificially inflated earlier in the year because people felt more comfortable in this. Maybe they got their change in their status, and therefore they were able to actually report employment in a legal way, and therefore that's kind of rolling out. Now we're seeing what's left under the surface, which is a labor market that is fine.
If you're just tuning in, welcome to the program. It's fine, but it doesn't look fine when you first had a look at that number. It's negative 23K against an estimate of 80. 80K was the median. The range was pretty wide in our survey, 157 at the high end, 40 at the low. So well below even the lowest estimate in our survey here at Bloomberg. Quirks here, there and everywhere throughout this labour market report this morning. Unemployment dropping back to 4.1%, which is incredibly low, but it doesn't come with the wage pressure you might expect of a move like that in unemployment. Wages actually declining relative to expectations, softer than expected, still positive by 0.1 month over month. We were down from the expected 0.3% and the previous read of 0.3% as well. So that's the labour market data. You push that through this market this morning and you'll see a pretty big move at the front end of the curve, down 8 basis points on Tuesday this morning, back to 416, a move further out along the curve as well, 10's down 6 or 7 basis points to about 460. We've got a CPI read next week, which is still really, really important, and one more payroll report after this before you get to that meeting in September for this Federal Reserve, and an additional CPI print as well just before on September 11th. Mike McKee's had another read of this. Mike, on the third read, are you in a better place to explain what this is all about this morning?
A little bit. One thing with the unemployment rate is again, it's a function of the labor force, which fell by 264,000 last month, according to the BLS, compared with a negative 720,000 in June. The employment level was negative 87 in the household survey, but that's much better than the negative 507 that we saw in June. And unemployment in the household survey down 178,000. But it's the drop in the labor force that is really affecting the unemployment rate. So it's not so much that more people are getting hired and the labor market is tight. It is just that fewer people are looking for jobs, and I'll leave it to others to try to explain that in the short run. Looking at some of the establishment survey jobs, the one that always gains is healthcare and social services, but this time it was only 22,000. We've been in the 40s, 30s and 40,000s for months and months, and now we're at 22,000 for that one. And I mentioned the seasonal adjustment factor with local government education being down by 50,000. And then the leisure and hospitality does show signs of maybe part of this being the World Cup effect. Arts, entertainment, and recreation fall by 16,000. Food and drinking services places fell by 26,000. So maybe people hired up for some of the World Cup visitors, and now they don't need them anymore. So there are some things in here that do, as you mentioned, sort of take the edge off it, but it's still not something that's going to push people to raise rates or lower rates one way or the other.
And Mike McKee, well said, appreciate it. This from Kevin Gordon at Charles Schwab Bramo just moments ago. There is no signal to take from this jobs report. This shifts 100% of the focus to CPI next week.
And a lot of people seem to agree. I've gotten other comments, someone saying this completely conflicts with what they're seeing from their companies as an investor. The labor market seems fine to improving. Some skepticism about the timing, and then someone else said economics, the science of predicting the past. So it seems like a lot of people are looking at this and saying, okay, we're not getting much from this, let's move on. In other words, when you asked me to interpret it and I said no thanks, I think maybe everybody else is too.
I'll tell you who's happiest this morning. Do you know who it is?
Kevin Warsh?
It's their evening. They're in Japan. It's
Tokyo. Yeah, that's for sure.
Dollar yen down at 157. We've got a 0.8% move on that currency pair this morning. Stephanie Roth of Wolf Research still with us for a final beat on the data and not the jobs data. Let's move on to next week. What are you expecting to see in the CPI print?
Yeah, so we think CPI will come in around 23 basis points, which, based on our sort of mapping to core PCE, which is, of course, what the Fed cares about most, that would be kind of a similar 23 basis point number, which is just below the threshold where we think they'll feel more comfortable staying hold. Given the data that we got today, if our forecast is right on CPI, I think there's a much greater likelihood that they end up staying on hold and just see how all this messiness shakes out. To what extent is the labor market actually showing signs of softening? I think what they'll ultimately find is that the labor market is okay, not as robust as it seemed earlier. It's improved versus last year, but not strong, and certainly not generating inflation. And the inflation backdrop will probably look a lot better. The seasonals are very much in our favor through the back part of the year where inflation is just very likely to naturally drift lower.
Steph, it's good to see you. What is this? Thank you. Stephanie Roth there of Wolf Research. We've got a decent understanding of where things are with inflation at the moment. And we've got a decent understanding, I think, after the FT report in the last 24 hours about what it might mean and what it might not mean for the Fed Chair, Kevin Walsh. 2 hot prints, and they'll be hiking in September. But that's going to be quite a high bar, given the expectations that Stephanie and others have for the next few CPI prints.
A lot of people seem to think that sequentially and this sort of a year-over-year comp, you're going to get lower CPI prints and that we've already seen the peak in inflation and that they probably won't get that. This seems to add to that, this labor market report. I find it really interesting how many people are just saying disregard. Confusing. It doesn't make sense. Neil Dutta actually has a different take on it where he comes out and says, actually, this is indicating some weakness. And this speaks to what Andrew Hollenhorst is saying as well. So again, this is the question that the Fed's asking with respect to the framework. What data do you use? How do you consider this? How do you measure inflation? And right now, this morning, this is evidence the market's grappling with the same thing.
I'm waiting for Citi and Andrew to publish any moment now, because this is kind of what he's been waiting for, right? And he's still looking for cuts
yeah, exactly.
later this year. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. So recapping the jobs data then, July non-farm payrolls coming in with a downside surprise, dropping by 23,000 versus estimates for growth of 80,000. Employment declining in education and retail, trending up, though, in healthcare. The unemployment rate ticked lower to 4.1%. The yen jumping against the dollar following that data. The US, Japan's historic currency intervention coming to the surprise of key allies too. The Financial Times reporting policymakers in Europe were blindsided by the arrangement, with the US not informing the ECB it sold euros to buy the yen until after the transaction. The hottest buy of the summer, apparently, is the $10 Dunkin' gift card, thanks to a marketing campaign by Pays. The digital wallet is offering a $10 reimbursement for spending $10 or more at specific retailers. Savvy consumers are taking advantage, with some redeeming hundreds of dollars in credits. And that's your Bloomberg Brief. John.
Vonnie, the important stuff. We appreciate it. Vonnie Quinn, thank you very much. Did you know that?
I spent a disproportionate amount of time trying to scan that story quickly. I still didn't understand how it worked to get free cash. Do I buy a Dunkin' or do I get something else?
Still trying to make sense of this jobs report. We'll do that next with BlackRock's Jeff Rosenberg. As yields fall this morning across the curve, particularly at the front end, on a negative payrolls print.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. rates, risk, and the cost of capital on Bloomberg Real Yield, and personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
The labor market is softer than it appears earlier in the year. There appears to be some seasonal issues in the data, just generally speaking. The trend is probably a labor market that's a lot cooler than people had previously thought. If data looks somewhat softer in the next couple months, especially when it comes to the inflation side, they're probably not going to want to hike in September.
That was Stephanie Roth of Wolf Research tuning in and joining us just moments ago. If you're just joining us now, this is the data, the reality in the American labor market, according to this report, negative 23K. Against an estimate of 80,000 in our survey. That's a big downside surprise on payrolls. Unemployment fell back too. Some quirks in this one, down to 4.1%. The expectation was for that to hold steady at 4.2%, and wages coming in softer than expected at 0.1% month over month against an estimate of 0.3%. And then the emails started to come through. The terminal subscribers started to type away. And they're all saying the same thing. No signal, ignore, focus on something else.
Well, it's just difficult to interpret this because it's sending a lot of conflicting signals. And frankly, there are a lot of bigger questions like what is the employment base and what is the break-even rate of job creation that's necessary for a full employment market. So you can ask all of those bigger picture questions at the same time that you're looking at the headline numbers. That said, there are some people saying actually there is weakness under the hood, or at least it's not as strong as people thought. And you're certainly not seeing the inflationary input. That said, it has never come from the labor market. It's always come from the supply side shock. So again, there are a lot of different crosswinds here, which is the reason why people are saying it's Friday. I want to just go to the beach.
Get to the beach. Might be there already, Bramo.
Yeah, no, right?
I know some of you are. Let's get to the equity market, yes. We're positive by 0.5 on the S&P 500. I'm jealous. We're up by 1.2 on the NASDAQ. We're buying equities off the back of this. Small caps doing well, up by 1%. In the bond market, here's your bid, the rally. 2s, 10s, 30s. Yields lower at the front end by 8 basis points. We're back to 416. Jeff Rosenberg of BlackRock, always with us on Payrolls Friday. He joins us now for more. Jeff, welcome. Is this something you can ignore? Or is there some information that's worth paying attention to?
Yeah, I think the headline is a bit confusing because you've got the drop in the unemployment rate on a very weak headline and a weak revisions. I'd be hesitant to just write this report off because I think that the revisions in the headline number are pointing to weakness, while the drop in the unemployment rate is really about the supply side and the drop in the participation rate. So I think you can have those two things happening at the same time, and that's how you square the message there. And I wouldn't completely ignore it, and the markets are not completely ignoring it because you're seeing a big hike probability come out with the front end rallying here, and I think that makes a lot of sense.
Yeah, it was more than 50% chance that there was going to be a September rate hike, and now I'm looking at less than a 40% chance currently being baked into Fed funds futures. Jeff, what's your understanding of what the tell is here for inflation? How much does it matter to have inflation coming from wages versus the supply side when it comes to whether the Fed will hike and how they view the state of the economy?
Yeah, well, you know, it's both. And we've had a serial set of supply side shocks since COVID. And that's really been what's been holding up inflation. But the labor market is relevant as well. And so the wages picture here is a little bit positive. I think that's contributed. Let me be more clear here. So you had a little bit disappointment in terms of the wage figure in the payroll report today. That features into longer run services inflation. And that's helpful with regards to the expectation on the inflation front. And as you know, you were talking about in the earlier segment with Stephanie, you know, it's really
portfolio companies say that they see robust hiring. We were talking about Neil Richardson seeing 7% wage growth for people who switch jobs. You saw the quits rate come in. You see these other metrics under the hood that point to quite a bit of resilience and even rejuvenation in pockets of the labor market. How do you square that with sort of the weakness that this implies?
Yeah, it's a little bit hard to square those two things. I think, you know, when you highlight job switchers, it's important to kind of distinguish that there's always a premium for the job switcher. The job switcher labor wage inflation rate isn't the broad economy wage inflation rate. So those two things will always be a little bit of a measurement difference. And when you're looking at specific companies, remember that this payroll report is very broad in terms of its capturing across the economy, individual sectors and companies. Those anecdotes can always be somewhat different from what you're seeing in the broad-based data like we're seeing today. So you can have those differences. I think the overall trend and what we had seen had been a little bit stronger, more of a stabilized labor market. The report today kind of points to some slowing. So, 1 point doesn't make a trend, but it is something to pay attention to, particularly, on the revisions. It's a noisy data set, so we don't want to overstate that, but I wouldn't completely toss it out of hand.
Hey, Jeff, you're right, and I think that's the point of debate that we've got to have going into the weekend. You were right to point out the market's not ignoring it, but let's think about what the market's doing right now. Twos are rallying because we're taking out the prospect, the potential, or at least reducing the likelihood for an interest rate hike from this Federal Reserve. But at the same time, equities are rallying because there is a belief also there's nothing really concerning in this labour market. That's where there's space for debate, I think, Jeff, this morning. Are we seeing some slowing momentum that might be on the margin concern for you, for others? And we should have that debate into the weekend, I think.
Yeah, and I think we'll have that debate. The payroll report always sort of sets the monthly tone in terms of the growth side of the economy. What's happened in the post-COVID environment for markets, and particularly for bond markets, is just the growth side of the picture has taken a second footing to the inflation side, particularly because of the Fed and, you mentioned the FT reporting and potentially what we would expect to see from Fed Chair Kevin Warsh in terms of the inflation piece. So I think that becomes more relevant. And this report, we'll debate it over the weekend, but it'll quickly become yesterday's news. And the more focus will turn to the inflation side, as has been the case really for the last 5 years, as we've been in this above inflationary target environment.
CPI next week. Jeff, looking forward to it. Thank you, buddy. Jeff Rosenberg there of BlackRock. At the moment, and this is early days, things can change throughout the session, but at the moment, the market sees the best of both worlds. Reducing the likelihood of an interest rate hike in September off the back of this, but not much signal, nothing to really worry about based on the feedback we're getting so far. That's where there's a bit more space for debate.
Yeah, especially when we get the CPI reprints next week, because potentially we will get that upside surprise, although a lot of people are saying that's not likely. I will say it does seem like things are kind of going the Fed's way to remain on hold, and that's what the market's pricing in.
And the administration, lower unemployment rate, construction 22K, manufacturing 5K. That is a good story to tell.
Should we shut it down?
Shut it down.
Shut it down. Let's get to
Happy
the weekend.
Friday.
There we go.
Friday.
There you go. Nah. Still, nah.
How to get it in?
I don't like that phrase. You know? Anyway.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Now, some people have written that your bank, Revolut, is worth $75 billion. Have you ever thought of taking your organization public?
Well, the way I think about it, we kind of will be ready probably in 2 years' time. But then again, depends on how good the market is.
Since you don't have an IPO, how do people who work for you make some money? Do you make a market for people to sell their shares internally?
Yeah, so we do secondaries every 1 or 2 years when people can sell a certain portion of their stocks to external investors.
So you've done secondary sales for your employees, so employees can then get some liquidity. Do you expect before you go public you'll do any more of those, or are you just going to wait till you go public before you liquefy any more stock?
Yeah, I think so. We might do secondaries as well before we do IPO, because we do it every 1 or 2 years, so we might do secondary as well.
All right, well, if anybody wants to sell their shares to me, let me know. And have any investment bankers told you why they're the best to do the IPO for you?
Yeah, obviously every single one is the best.
Everyone is the best. You're not in a rush to do it. You don't need the money.
So we're a bank, and then for the bank, it's super important to have trust and then public companies are trusted more compared to private companies. So that's the reason.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Happy Jobs Friday. 30 minutes ago until the start of your cash trade, stocks move higher. I'm Danny Berger.
And I'm Michael McKee. Happy Jobs Friday?
Sad Jobs Friday?
Bloomberg Open Interest starts right now.
Coming up is, Mike was so rightly putting it, maybe not a happy day. A surprise setback for the labor market. Employers unexpectedly cut jobs in July. Meanwhile, prospects for a lasting agreement to reopen the Strait of Hormuz remain elusive. And earnings season winds down with a mixed picture from corporate America. Let's look at the reaction thus far that we are getting in these markets because of the jobs number. A surprise contraction. Stocks move higher, up about 0.5%. NASDAQ, that outperforms, considering this is a longer duration asset class. Two-year yields come in by 7 basis points. Should this hold, this would be the biggest move down in front-end yields since June 11th, when the president said the war in Iran was coming to an end. And gold, the asset class du jour, up nearly 3%, trading above 4,300. Mike, let's go over these numbers. A surprise contraction for the month.
Surprise contraction. I mean, some people had been waiting for it, given some of the trends in the labor market, but nobody was expecting a negative number. And we did get a negative number, 23,000 down, and we saw 103,000 jobs removed in the revisions over the prior 2 months. That chart isn't wrong there. It's negative 23,000. But the unemployment rate falls to 4.1%. The labor force falls by 264,000, and that's why we saw the drop in the unemployment rate. The average hourly earnings also dropped. They were up only 0.1% during the month, so 3.2% on an annual basis. Now, what moved? Local education. Now, that's a bit of a surprise because those people tend to fall off the payrolls in May and June, not July. So they've made a seasonal correction here that shows 49,000, almost 50,000 jobs lost in local government education. Construction jobs were up 22,000, and almost all of those were in the groups that put together things like the AI data centers, not housing construction. Health and social services is always a big number. It's the strongest hiring category, but it slipped a little bit, 22,600. That's slower than the pace that we have seen. Retail jobs is something to worry about, maybe 19,000 jobs lost. And leisure and hospitality, a loss of 40,000 jobs. A loss was kind of expected because the Cup was over. Right. So maybe that plays a lot into it. But I think what the bottom line of all of this is going to be is all of the economists are going to be going in and doing their MRIs and X-rays on this. And this may not be as bad as it looks. It isn't great news. It clearly shows hiring slowing down, right, and fewer people looking for jobs.
Okay, forgive my ignorance here, and this is not to attack the economists of the world, but something like local education, you said it was a quirk. But isn't that a quirk that we could have foreseen, and maybe the estimates could have been more accurate if this had to do with summer schools?
Well, it depends on what the seasonals actually were, and I haven't looked into the background, but usually the seasonals would take away jobs. They'd technically they'd add back jobs into June because that's when everybody goes off the payroll. So I'm not sure why it was delayed to July, but it does seem to have had an effect on the overall number.
Well, let's continue the conversation and bring in Bloomberg macro strategist Michael Ball. Michael, is this exactly the market reaction you'd expect? Yields down, gold up, stocks marginally higher?
Yeah, exactly. And I think we saw basically September odds now drop to 40% from 50. So that actually was a little surprising. You would have thought maybe more, but then it's been sort of a fluid situation. We're all waiting for Jackson Hole there to get more clarity. But exactly what you would expect. 2 years really where you want them to be now, dropping, taking out cuts for next year. And effectively, kind of everyone now on pause, to Mike's point, trying to understand. The revisions are actually quite sizable as well. That adds to the complexity of the debate now. But when we look at things like Beige Book or NFIB, and we just went through the earnings season, none of this was really echoed on sort of the company level or smaller business level. So this kind of caught people off guard, as you guys just noted. But the overall price reaction so far is what you would expect, but it's not out of size to what we just received.
Yeah, I think what we're seeing here is the slower labor market, but the question that the markets are going to try to guess at, even though he doesn't want them to, Kevin Warsh doesn't want them to, is how's the Fed going to react to this?
I think no hire, no fire. If this is kind of what we're seeing now, if that continues, then they can still be patient. But again, we just don't know. And this is the big crux since the July FOMC. What is his reaction function? Not that we need forward guidance, but we need clarity on what he's actually thinking about doing if we get X, Y, Z in the data, or so something like comes out of the blue again with oil or some other shock comes to the system, how is he going to think about it? And we just don't have that, and that's been the biggest gripe and why it was sort of a missed opportunity in July.
I mean, he hasn't talked about the labor market much at all, except maybe we know he doesn't really believe in the Phillips curve. But because he's been so concentrated on inflation, is the right move really to price out rate hikes? If that is what he's concentrated on, and who knows what we get next week for CPI?
Well, it's hard to say that, like, obviously we're going to have two prints and we'll see what we get next week and how that feeds into core PCE, but it's hard to say the conditions then weren't there in July if you're that focused and you're that worried about this gap that has persisted. But then he's also muddying the water by saying he wants to look at a broader set of inflation kind of metrics, which is why he has the task force. Now, as we know, the task force doesn't get done to next spring. They're going to have to deliberate among the committee for a couple months. So we're looking at only next summer when we start to actually see the results of a task force probably explained properly from the chair himself. So there's a long period of uncertainty still, as we know will add volatility, but then again, this is the opposite of that. This is not a volatility-driven market right now. We are one that is, again, risk on.
We'll see you in Jackson Hole, basically.
Oh, I was going to say, it's very simple. He cares about PCE until he doesn't anymore at some defined point in time when the various task forces come back. Mike, thank you so much for joining us. Michael Ball from our macro team. Let's now get to the D.C. reaction. Joining us now is Bloomberg White House correspondent Jeff Mason. Jeff, a lot on the White House's mind, not least of the latest in the Iranian war. But let's start with this jobs picture, because we know that this is a Fed chair who has been communicating with the president. Do we know at all if monetary policy has been discussed or what the reaction might be given this weaker jobs report?
Well, no reaction yet, Danny, but I think we'll be hearing from administration officials in the coming hour with a reaction. And my guess is they'll put a positive spin on this contraction in the labor market. What I would want to say as a sort of fact check, both for the labor aspect but also inflation that we've been talking about, is I do hear some Republicans still trying to blame President Biden for the increase in inflation. And of course, that was a huge weakness coming out of his administration. But this is very definitively President Trump's economy. He's had the tariffs, he's had the war in Iran, and so those impacts, or the impacts from those policy measures, are certainly having an influence on this economy now.
And having an influence on inflation, of course, and we get the inflation report next Wednesday. The president, in his latest comments, suggests there isn't much change in where we are with Iran right now.
Right, and that is sort of the state of play right now. We've spent the whole week hearing that there is progress, anticipating that perhaps there's a deal about to be arranged. The latest details that we are reporting is that the Iranian parliament is looking at essentially a draft agreement, and there are some aspects that are being proposed by lawmakers that I suspect would not go over well here at the White House, including charging a fee for what are considered hostile countries by Iran, and also putting some limitations or an overall limitation on cargo that would be going to Israel. So that's probably not this type of the type of factors that President Trump is expecting or wanting to hear. That said, he has also been flagging that the U.S. is involved in these negotiations and indicating that a deal could be close.
Jeff, elsewhere in Washington, D.C., we've all been tracking the nomination of Todd Blanche as Attorney General. The latest development this morning, Senator Lisa Murkowski posting on X that she will not be supporting his nomination. Jeff, why the change, and what does this mean for his road ahead?
Well, first of all, it's not necessarily a change. We were waiting to hear from Senator Murkowski about what she was going to do, and she was still a question mark, and that question has now been answered with her saying that she is not going to vote for the acting Attorney General. That is certainly a blow to his chances of becoming the confirmed Attorney General and to this White House's desire to make him the permanent Attorney General. It doesn't mean it's over. It just means it's really, really, really close right now. He can only afford to lose one additional Republican, and the remaining question mark right now in the Senate is Senator Cassidy. And he has expressed similar concerns to what Senator Murkowski has said with regard to the politicization of the Department of Justice and the acting Attorney General's involvement in the IRS deal for President Trump that also created this fund to help pay back people who may have been involved in the January 6th riots and also anyone else who feels they've been unfairly treated, I should say, by the previous administration. So that's hanging over this, and the Murkowski news is really a big blow to this White House, and also very interesting coming from her right now.
When do they anticipate a vote, very quickly here, because they want to leave town today?
They do want to leave town, and there was an expectation that there would be a vote before they left town. I think the answer now to your question is TBD, whether or not they pull that vote because of this latest development from Senator Murkowski, whether they get clarity from Senator Cassidy. It's probably unlikely that they hold the vote, and when I say they, I mean Republicans now, unless they know that they're going to be able to get a yes.
Jeff, really appreciate it. That's Bloomberg's Jeff Mason in Washington, D.C. At 10 a.m., we're going to hear from Kevin Hassett, director of the White House's National Economic Council. We'll get his reaction on the jobs report and other White House goings. Let's get a check on your markets this morning. Again, it is in reaction to that negative 23,000 payrolls print that we had. It means that bonds and equities and gold are all rallying this morning. Two-year yields up by 7 basis points at 417.44. The odds of a rate hike go from 58% for September before this report to now 40%, so a less than 50% odd that we will get a hike. S&P, NASDAQ futures move higher. We are sitting about 0.3% under an all-time high for your cash session. And gold also gets a bid after this report, up 2.5%. Let's take a look at some of the individual movers. With that this morning is Nora Melinda. Hey, Nora.
Hey, Danny. Good morning. We're starting with the laggard this morning. Sweetgreen having a rough morning. Shares tumbling double digits after the company slashed its outlook, saying people have been less willing to eat in store during the Cyclospora outbreak. And if that wasn't enough, Sweetgreen also pulling jalapenos from a supplier tied to a separate salmonella outbreak this week. Not exactly the headlines that you want to see when you are selling salads. Now let's talk gaming. Video game maker Take-Two's earnings came up short, but the stock is actually higher after the company maintained its outlook. All eyes are on Grand Theft Auto 6. Take-Two thinks it could be the biggest video game launch of all time when it arrives in November. I know gamers have been waiting forever for this one. Shares of Take-Two up about 1.5%. And finally, here's a stock absolutely taking off this morning. Doximity is up about 78%. That's after raising its outlook for the year. Analysts saying that's a good sign. Its AI investments are finally starting to pay off. And this is a stock that did need some good news. It's lost more than half its value this year. Those are your morning movers. Danny?
Nora, thank you very much. We'll catch up with you later in the hour. Coming up, we're going to break down the market moves and jobs data. BlackRock's Rick Reeder will be joining us. This is Open Interest.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm
Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Now to high interest, a look at what's making headlines around the world. SK Hynix is planning to spend $38 billion on the expansion of its chip-making facilities in South Korea. The move is part of the company's efforts to rapidly double its production capacity and ease a global shortage of memory chips. President Trump reiterates his preference for lower interest rates, but acknowledged that it is not Fed Chair Kevin Warsh's decision alone. In an interview with Punchbowl News, Trump said Warsh has a board that's very political. He also said he won't be criticizing Warsh, calling him great. Bank of America's bull and bear reading climbed to the highest level since 2021. Strategists say that investor bullishness has become so extreme that it's time to start reducing exposure to risky assets. They pointed to broadening equity markets and tighter credit spreads as reason behind investor optimism. Speaking of optimism, let's look at the market rally so far this morning. Again, that is off the back of weaker than expected jobs figures, a surprise decline. So S&P futures up 0.3%. NASDAQ outperforms as yields come in by 5 basis points for your 10-year yield. Joining us now is BlackRock Chief Investment Officer of Global Fixed Income, Rick Reeder. So Rick, the unemployment rate goes down, but a surprise contraction in jobs. Last time we spoke for last month, you said the employment picture is stable, broadly unimpressive. Has your assessment of this labor market changed since then with these numbers in hand?
No, broadly not impressive, I think is the right terminology. In fact, I was thinking about it. I think it's actually remarkable how unremarkable the data is. Listen, I think, when you look at, people say, well, gosh, we're not hiring many people because we have a supply issue. And you saw some of that play through today. But that being said, you're not seeing any wage growth. So meaning there's not that demand for labor that you would expect when you got an economy that's doing as well as it's doing. I mean, we're going to grow. I think you're going to see 6% nominal GDP. You've got corporate top line revenue that's strong. Earnings are strong. But you're seeing operating leverage for companies kick in like you read about. I mean, you look at all these earnings reports, particularly in the tech space. Companies are growing. They're spending immense amounts of CapEx. But you're actually cutting people in many cases. So anyway, I think we're seeing a productivity revolution, and I think we're watching it play out month in and month out. I mean, to have only 20,000 jobs on a 3-month moving average, you strip out healthcare, you're having negative job growth in aggregate. So anyway, I think listen, I just think we're going through. I think when they summarize this years from now, you're gonna witness something that is productivity. People say it's AI kicking in. I actually think it's just been an ethos around companies growing their business and seeing how you can operate without that much employment.
Well, also, you've got the fall in immigration that is probably contributing to these big declines we're seeing in the labor force. But the people who want jobs are apparently getting jobs with unemployment at 4.1%. So I assume this tells you, as well as the Fed, that we don't have a problem with the labor force side of the mandate.
Yeah, I mean, I think that's right, Mike. I mean, I've been pretty adamant about I don't think the Fed needs to hike, and I don't think you really will solve the inflation dynamic. Part of why I think these task forces will be so powerful is you'll get into what are some complex subjects. When you break down inflation today, you look at the difference between services and goods. You think about what's still sticky in inflation: education, healthcare, insurance. Because you're moving the overnight funds rate up, really do much. And you get to the point being, if you're restrictive on rate and you're driving mortgage rates higher, I just don't see that as really effective trying to bring inflation down. You've got what I would argue is, yeah, maybe it's an okay labor market, but you still need, particularly when you have this much debt on the country, you need to grow faster. You need to put more people to work. And I think that, to me, is the philosophy that the Fed has to employ today.
Well, on the inflation side of things, Rick, I know you've been a big proponent. Again, the type of inflation we have isn't something that's fixed by hikes, but perhaps by policy, not monetary policy, but fiscal policy. Well, what is the policy you think that could start to eat away at inflation? Is it just like ending a war, basically?
I mean, listen, the war is a big deal. I mean, obviously, not only do you get higher prices in terms of fuel, but there's a transmission effect through that when you talk about, obviously, trade getting slowed somewhat. So anyway, the war is a big deal, obviously. So that will change. Then the dynamic, and people will focus on tariffs. The goods inflation, when the U.S. economy is not that large of an importer of goods. So yes, and I think people got really worked up about that last year. So what do you do? And how do you create fiscal velocity? There's a bunch of things you could do, and I think, quite frankly, deregulation is powerful. I think the idea around how do you help with housing, things like zoning, permitting, et cetera. How do you get like some of the stuck student loan asset or liabilities on that young people have? How do you transition some of that? How do you help with some of that? I think there's a whole series of fiscal dynamics that can help with inflation, but I don't think moving the overnight funds rate will really do it. And we've seen that before. It doesn't really have that much of an impact.
I guess I would ask you then in that case, because I agree that there's probably not going to be anything happening on the fiscal side because they can't even vote on an attorney general at this point. And the Fed is maybe leaning now towards a hold in September. We'll see after the Wednesday CPI report. But that leaves us with an inertial economy. And what do you think happens to the economy if there's no movement on the fiscal or the monetary side?
Mike, I think you're unbelievably good at analyzing this, and I always appreciate the questions you ask at the FOMC meeting, et cetera. The only thing I will say is I'm not sure I agree with the inertial concept. I actually think the economy is operating at an amazingly strong level. And, you look at the CapEx, it's obviously a big driver of that from AI that's getting into, straight growth of the economy in so many different forms. And then you look at consumption today. Consumption, you see this, particularly in areas like leisure and hospitality. You see this in some of the transportation dynamics in terms of travel. Listen, the economy is operating, and actually the thing that was pretty amazing to me in the last 2 months is some of it had a fiscal tailwind, but the actually had lower and middle income that was actually starting to accelerate, and we see that in we use a lot of this high frequency data. You actually saw consumption in a pretty good place. So listen, I think the economy is operating at an extremely solid level. You would think in the second half of the year you'd start to moderate a bit post the fiscal tailwind. But boy, you see this. I mean, this was a pretty amazing quarter of earnings reports that not pervasively across every single company or industry, but boy, I thought it was pretty darn good. And part of when you look at the equity market having a pretty good run, particularly recently, you're actually looking at multiples that are coming down because these companies are earning so fast. So anyway, I'm pretty enthusiastic about where the economy is today.
And I'm assuming that enthusiasm over equities translates into your world of credit, Rick. You have Bank, of course, a fund that has been outperforming the broader benchmark by a healthy clip for the past couple of years. I know last time you joined, you expressed skepticism on U.S. IG credit. You like carrying higher income. I think all of this is so interesting at a time, Rick, where, as you point out, so much is happening because of AI, especially in debt with the huge issuance we're seeing from the hyperscalers. We got another $25 billion that this market easily took up from Google just this week. And at the same time, we're going to get more issuance from the Treasury next week. What are you thinking about where you want to place Bank, just given the sheer amount of issuance that continues to hit this market?
Danny, I would say one thing about, because you've had a backup in rates, you're able to hit your yield targets. I mean, talk about we're hitting almost 7. I mean, 6, high 6s in terms of yield. And so a couple of things we've been doing is you actually don't need to go down in credit quality. You don't need to go that far down in terms of the liquidity in the portfolio. So, we've been keeping it, we've been adding a bit in terms of European fixed income. I think emerging markets are interesting, particularly if you assume the dollar is not going to be moving aggressively. You made the point right. I think investment grade credit, given the amount of supply we're going to see, data center, hyperscaler, investment grade credit's not that interesting at all. But in the securitization market, they securitize assets both in commercial real estate, ABS, resi. Those markets are in pretty good shape. So, we're in an environment we don't feel like we got to stretch a lot. These real rates that today give us an amazing ability to keep our yield up without really stretching. We're running now at an average rating of A-. You're hitting high 6s. Like, that's pretty good today. So I think we're trying to be in bonds. We're trying to be as boring as you could be, and take the risk in equities, which have a little bit of volatility to them, particularly single name.
A little bit less risk maybe in the bond market, but there's such an appetite, I guess I would say, for debt for the hyperscalers, et cetera. How's that affecting how you can sell all of these bonds? I was really surprised yesterday with the Google Alphabet offering that it was so oversubscribed.
Mike, we're living through something, and so one of the real benefits to all the financing that has to come, data center, hyperscaler, U.S. Treasury, UK, Japan, is we're actually going through a pretty historic demographic that is supporting this demand for yield, insurance companies, life insurance, pension. So it's amazing. If you price assets right on the debt side, you can place an awful lot of debt. Now, that being said, I mean, the hyperscalers have clearly widened quite a bit. And so you're getting the levels. Like I say, these real rates, if you're a pension today and think, gosh, I can defease a good portion of my liability stream at these real rates, it brings a lot of people in, particularly if you get some spread on it. And you're watching that play out. Like, I would say one thing, I mean, the supply is not going to stop coming. And, next week we get a lot of Treasury supply. So, in terms of interest rate exposure, we feel like we don't have to be in a rush to add much interest rate exposure and just like clip coupon.
All right, Rick, you're going to stick with us. We have to see how this market opens up and would love to get your commentary on a continued market reaction to this jobs report. And just to check on where we are with less than 5 minutes until the opening bell, we continue to see a rally as yields come in now by 5 basis points. The front end of the curve, as you would expect, outperforms even more. That's down by about 7 basis points this morning. Brent crude continues to fall as we await the latest on the Iran war. On the other side of this break, we'll have your opening bell and more with Rick Reeder.
We actually just expanded the set of customers that have access to Mythos. I think it's about an additional 150 organizations around the world in 15 different countries. And really our approach to Mythos has always been, there's a time component to it. So we released it initially to cyber defenders. So some nonprofit groups, some governments, some organizations that are critical infrastructure for protecting against potential cyber attacks. And just like in any kind of security vulnerability situation, you have to give the defenders a head start. The technology, AI models are going to keep advancing. If it's not us, one day releasing a Mythos level model, another AI company will. But it actually matters who you give access to first and how long they have to patch some of the vulnerabilities that Mythos was capable of revealing. And so we're taking this very cautious, very tiered approach, which I know in some ways is frustrating because people really want access to the model. But I think, again, as a company that's founded on these principles of being ethical, being responsible, we felt it was important to give access to the organizations that were capable of really helping us defend against some of these risks, and then slowly widening that circle to more and more critical infrastructure until eventually we feel it's safe to release it more widely.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Two bells to go until your weekend. This is Bloomberg Open Interest. I'm Danny Burr alongside Michael McKee. Matt Miller still off. At the moment, we are seeing a rally both in the S&P and the NASDAQ. The NASDAQ outperforms as this is a longer duration asset class and continues to get so with all the infrastructure the hyperscalers are doing. We are about 0.3%. That's how much we need to gain in the normal cash session to reach a new time high. Loma Negra opening the bell down at the New York Stock Exchange. They're an Argentinian cement company celebrating 100 years. It's a very long time. They are down year to date, despite Michael McKee telling me that apparently the industry is very optimistic that hyperscaler and data center building is going to help them out. Down at the NASDAQ, Latigo is opening the bell. They are a biotech firm and they're IPOing. So congratulations to them. Apparently the CEO and the CEO's daughter is in attendance. And you should always bring your family to the bell ringing because it is very cool. Just some earnings to go through that we got. Airbnb, they boosted their outlook. Global travel demand is strong, particularly in the US and Europe. Those shares move up 8.6%. And the open DraftKings, a surprise earnings miss as a sports betting giant deals with growing competition from prediction markets. Shares are still up though, 1 1/3%. Take-Two up 2.5%. They also missed earnings. They do have their November release of Grand Theft Auto 6 coming out, which is expected to be the biggest video game debut of all time. So markets overall are rallying, as are this bond market, led by the front end as we get rate hikes priced out. We are back with BlackRock Chief Investment Officer of Global Fixed Income, Rick Reeder. Rick, okay, so this basically takes, in your view, a hike off the table. I wonder about cuts, though, because when we had spoken about a month ago, you said perhaps we still could get cuts in the back half of this year. Do you think that's still a possibility?
So, listen, you still have a Fed committee that is generally hawkish. You still have a committee that is more focused on inflation than the labor readings. So, listen, I think it could still happen. You'd have to see some deceleration in economic conditions. You'd have to see, we think core PCE is going to come into the high 2s, down to the high 2s. Next year, we think you're going to get in the mid 2s. Can you still get it done this year? I think so. But listen, I think you have to. One thing I've learned about investing, it's not what you think they should do. It's what they're going to do. And today, the structure of that committee clearly is we're going to fight inflation and use the rate tool to be that tool till you get there. So, listen, I think they still could. I just think hiking doesn't make a lot of sense today.
Pre-interpret Wednesday for me, though, the CPI. We saw a big drop in market expectations, sort of a knee-jerk move after the labor report. What's it going to take to move one way or another in the fixed income markets on Wednesday with CPI?
Yeah, it's a great question, Mike. You've gotten a couple of softer prints on inflation recently. We think we're in this mode of getting 0.2s type of numbers when you look at core, and then I was looking at the numbers for core PCE, maybe a little under the 0.2 monthly reading. So, yeah, listen, if you got something significantly aberrational to that, that would certainly move markets. Listen, if the number came in significantly higher, which would be incongruous with what you've seen over the last couple of months, listen, is the Fed going to be on alert for that? Yes, I think so. You know it's better than anybody. I mean, I think this, what the chairman has stated, what Chairman Warsh has stated, is not just one number that he's laser focused on. He's looking at the panoply of readings, and our sense is inflation is slowly moderating. But it'll be interesting to see that report, like you say, that comes out Wednesday.
Rick, I do wonder, obviously yields are coming in now, but we have had a 30-year yield that has been stubborn and stubbornly moving higher above 5.2 at one point. Now it's obviously below 520. Do you think that this market is at all reflecting its concerns about credibility over the Fed and Chair Warsh?
I'm a little surprised at the concern around whether it was the last FOMC meeting or, some of what I thought was a little bit harsh on credibility. I think reduced forward guidance is not terribly intimidating to market participants. So I don't really think, can we get more from the Fed in terms of the metrics they're looking at, in terms of the structure of what is going to be important to them going forward? I think so, and I think we'll get more details around that. Listen, Annie, I think we're getting a lot of supply of product. You're pushing real rates up because you're getting a financial transmission that is historic in terms of whether it's fiscal supply that's coming from not just U.S., but obviously, pressures, and whether it's UK, Japan, plus the amazing amount of supply we're getting into the credit markets. So I think it's more that than it is anything else. And like y'all have said, I mean, we still have some stickier inflation that is keeping these rates up. So anyway, those are where I would put what's the influences.
Hey, Rick, just super quickly, because we're about to talk to our tech reporter, Ed Ludlow, about all the AI debt coming in, and we talked about it just a moment ago. You talked about what it does to the IG market. Do you think it changes the attractiveness or the pressure on the Treasury market at all, getting all that supply from the AI hyperscalers?
I mean, whenever you push that much supply on the market, you think about there's a crowding out effect. I mean, listen, the U.S. Treasury is still the behemoth in terms of issuance, but you take what's coming in IG, asset backs on the back side of it through data center. So yeah, I just think we're getting a lot of supply, and all markets, including government bonds, are reflective of that.
Hey, Rick, we always appreciate your time, especially on a Jobs Friday. BlackRock's Rick Reeder. And at the top of the hour, Mike and I will discuss the economy with White House Director of the National Economic Council, Kevin Hassett. Please send us your questions if you have any. Let's now bring in Bloomberg Tech host Ed Ludlow. Ed, this has been a question. We're just speaking with Rick there about AI issuance that's vexing the entirety of the market. But can you walk us through exactly what we've had from Alphabet? Because it seems like the supply, yes, it's large, but the demand, it is surely there.
Yeah, I mean, the latest from Alphabet is $25 billion in US denominated. I think that what's interesting is you now have to stack Alphabet, Amazon, not just in their dollar denominated issuance, but they've looked at the European markets and other non-dollar markets as well, right? And the message from the tech issuers is we won't overwhelm you with supply. But what Rick was talking about is that supply has exploded. $200 billion in dollar bonds this year, versus just, I think it was north of 10 billion from high-grade tech companies a year ago. So clearly something's changed. And the main point that maybe I think Rick referenced was that there's been poor trading after issuance, where essentially there's lots of $25 billion bond deals like Amazon, Nvidia, SpaceX are case studies outside of Alphabet that quite quickly fell below issue price. And that's just facts, that's data. How the market feels about it longer term, you just have to wait and let's talk about it in a year from now.
Well, you said the companies have said we're not going to overwhelm you, but they keep coming back to market and they keep finding that they need more money. Is it likely to continue?
They need more money. I mean, the other thing that has not changed is there's a rationale for needing to raise, not just through debt markets, right? Alphabet's interesting because it also has very big activity in the equity market. And they continue to sort of maintain the idea that demand for compute is running way ahead of their current ability to supply. And that capital greases the wheels of building real world infrastructure. But because they have visibility on that demand on a multi-year horizon, they're willing to raise the money now to expedite that build out. I mean this with the greatest respect to economy. This is not like the dot-com bubble or the financial crisis. These tech companies are completely different beasts to what you were covering in those eras, right? They have balance sheets that you just wouldn't have even heard of at that time. So everyone's pretty sanguine about it.
Yeah, but sometimes there are echoes, rhyming pieces of history, even if it's not exactly the same. And Ed, part of the conversation then had been, you know, all of this issuance just showing something as a top. And I think SpaceX maybe is interesting and constructive in all of this because there were a lot of fears that with the lockup expiring yesterday, 911 million shares eligible to come into the market, that it would mean a huge problem for SpaceX. But Ed, that's not what we saw. This is a company that rallied 6% yesterday and is up another 3% this morning.
Okay, so thank you for showing the 5-day chart. This is SpaceX this week, up 10.5%. It's its biggest weekly gain since the week that ended Friday, June 19th, the first full week of trading post-IPO. Obviously, there have not been many up weeks in the interim, right, if we're saying that that's the size and scope, right? It's the longest weekly gaining streak since the week of July 3rd, which, yeah, it hasn't been going up. There have been many other catalysts, like earnings was a catalyst. Prior to earning, the stock behaved unusually. There was a lot of short covering going into the lockup expiration. And if you know, there's a chart in the Bloomberg story of what happens with the lockup through to June of next year when Elon Musk's Class A shares come in. You know, there's a lot more to come. People are still trying to understand the business model as much as anything beyond the mechanics. And one thing I found really interesting as a final data point is 911 million shares hit the market. I think 250 million shares changed hands. So, you know, I think it's just taking time for people to say, you know, for what reason are you buying this stock? And is this a rocket company, or do we believe the AI story that was the mainstay of this week's earnings report?
I have to say, like, when I asked my question to you a mere minute ago, it was like SpaceX is up 3%. As we've been talking, it was edging up near 5%. So a lot of volatility in this thing. Ed, thank you so much for joining us. Looking forward to Bloomberg Tech. That's Bloomberg Tech host Ed Ludlow. Catch him in about an hour and 20 minutes time. Let's get a check on your markets. About 20 minutes, or 10 minutes rather, into your trading day with an overall market that is up 0.3%, despite the fact that there are more stocks that are trading down than are trading up. So breadth isn't fantastic, but NVIDIA, Amazon, Broadcom, Microsoft, these giants are trading more heavily to the upside, which is helping us outperform. Palantir, with their strong earnings this week, continues. Airbnb, they posted strong results, lots of demand in the US and Europe, so Airbnb shares up 14%. On the downside, you have energy falling as the price of oil falls, so Exxon, one of the biggest losers there. Eli Lilly, so some healthcare stocks also falling alongside Alphabet, Berkshire Hathaway. So a little bit of a risk-on sort of trade happening now. I think you'll also see that when we look at the sectors, just kind of more of the safety stocks like healthcare. Let's see, healthcare, yep, that one's down. Energy down, staples, utilities, financials. And then you have consumer discretionary doing well. That's probably some of the earnings we have. And I mentioned those big heavyweight tech stocks doing well today. So Infotech up 1%. Coming up, Silospora concerns weigh on Sweetgreen's annual outlook, and now they have to worry about jalapenos too. We're going to take a look at the salad chain next. This is Bloomberg.
Historically, bubbles were characterized by a notion of if you build it, they will come. In the late 90s, when we were building out data networking equipment, people were putting huge amounts of fiber in the ground on the assumption that it would come. And economists like to go back for reasons that are unclear to me to the railroads. They were also, if you build it, they will come. What is unusual about AI right now is the builders are so far behind the demand, it's absurd. We have a backlog of more than $25 billion of demand. That there are none of us, not AMD, not NVIDIA, that can keep up with the demand that your employees are driving. That's in a lot of ways the opposite of a bubble. We are chasing. Our customers and their customers are moving at the speed of software, and we're moving at the speed of real estate, data centers, right? And so we are behind.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
Let's hear from the sell side this morning and get you your top calls. With that is Nora Melinda. Hey, Nora.
Hey, Danny. First up, SpaceX. You know we can't get enough of it. Argus upgrading the stock to buy, saying it's encouraged by how quickly the company's AI investments are paying off, and it likes the growth ahead. Shares of SpaceX up about 4% this morning. Now from space back down to Earth. Gap sliding down 1.2%. That's after a downgrade to equal weight at Wells Fargo. The firm says it's worried about Old Navy, saying the brand has some issues with its product mix and isn't giving shoppers enough value. And Wells says there's no quick fix here, which could mean more pressure on earnings ahead. And finally, Sweetgreen still down double digits this morning. Wall Street isn't exactly rushing to defend it either. TD Cowen cut its price target to just $5, pointing out that sales were already coming in soft before the cyclospora outbreak. And TD isn't alone. Citi, Oppenheimer, D.A. Davidson, and UBS all cutting their targets on the stock as well. Those are your top calls. Danny?
Nora, thank you very much. Let's get more on the food industry. After those Sweetgreen earnings, we're joined by Bloomberg consumer reporter Red Brown. I guess, Red, it doesn't really matter whether or not Sweetgreen was subject to the outbreak, but the very fact it happened enough has shied people away from ordering salads.
Yeah, I mean, I think we all sort of joke about it right now. Like, is salad safe? Can I eat this, right? Like, it's just, and I think that, you know, as that happens across the population, that has an effect. And then you have to kind of layer on top of that when it comes to Sweetgreen. Like, they were already sort of sliding. The sales were soft. People do not want to spend, even for their cheaper options, these wraps that they've rolled out, which they were talking quite positively about, but it's still a $15 lunch, right? So it's just it's really bad timing for Sweetgreen. They were trying to do some things to kind of turn things around, but now we have this sort of just overarching feeling that I don't really want to eat a salad. I'm not sure about a salad. I'm already not sure that I want to spend that much money for something, that it just sort of compounds now for Sweetgreen. And we're seeing now the impact of that. You know, they've basically doubled the slowdown for their sales expectations for the year. So they see that this is going to be a continuing problem for them as well.
Other loser today, Wendy's, missing and saying they're scrapping their forward guidance.
Yeah, Wendy's, the new CEO is kind of coming in here and making kind of drastic changes. That's been a company kind of in the slide for a while as well. It's interesting too, just given the context of Burger King getting really strong results, McDonald's making some moves to get back into the positive direction over the past year or so. It's like Wendy's really is this one that's falling behind. It's a shame because with Wendy's, like, they do have sort of higher quality. They're seen as sort of a higher quality product, but it just hasn't been able to kind of translate into an upwards kind of sales trajectory for them. So it seems like they're shoring up the balance sheet to maybe make some bigger moves in the future, which is kind of seems to be the thing that's resonating with customers. If we think about Starbucks, think about Chipotle, the two kind of top performers in the restaurant space this quarter, they've both made investments into their kind of physical, real estate to get people in the doors. That's what people want to see right now. They want to they want to go to a nicer restaurant. They want to feel that value when they go in.
That's kind of where I wanted to go with this, Red, because we're at the tail end of a lot of the restaurant and food and consumer earnings. Is that the takeaway for you, that the companies who invested in physical spaces are outperforming, or is there something to like the menus or the value that they're offering consumers to the ones that outperform?
Yeah, I think in general, and this is like consumers, companies overall, which we've been paying a lot of attention to, but restaurants are a really good example of this, is listening to your consumers again is really important. I think in the days of, the early, post-pandemic years, everyone had money and it was just easy to kind of spend, right? It didn't really matter what you were putting on the plate in this instance. People are willing to shop out, right? But now we're getting into this instance or this moment like where you need to really give people, intentionally give them what they want. So Starbucks, Chipotle are listening to their customers. They're trying to keep their prices in check. They're giving them new things that they want to try, new flavors. That's really popular right now. And the companies that don't have this sort of capital to do that, Sweetgreen, Wendy's, both good instances of that, they're the ones that are going to be kind of falling behind in this moment when people are feeling pinched.
Hey, Red, thank you. Fantastic work all week this week. That is Bloomberg's Red Brown covering the latest consumer earnings for us. Coming up, leverage ETFs are becoming so-called momentum monsters that are changing how investors trade. That's coming up next. This is Bloomberg Open Interest.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
The leveraged ETFs have really created a momentum problem, as I said. Sometimes it's good momentum, sometimes it's bad momentum, sometimes it's at the last 30 minutes of the day, and it changes the dynamic of a trading day.
Bernstein's Alex Shaloff discussing how leverage ETFs are changing how investors trade. James Seyfert of Bloomberg Intelligence has been discussing how leverage funds have gone from reflecting stock moves to helping create them. And James joins us now. James, can we get into the structure of this? How is it altered and that these are having such a driving force in this overall market?
Yeah, I mean, they're still a small piece of the pie, but they're adding on to market moves theoretically. So if you're a levered long product and the market goes up, when they rebalance at the end of the day, they have to buy more to get that same sort of exposure. So they are, like you said, contributing to the momentum of the driving of a stock market. And the same happens when it goes down on the long side of the asset of the position. Then you take into account the fact that most of these assets are in long products, and the ratio peaked at about 19-1, long to short. So a lot of money isn't on the short side that would kind of offset that. But again, I come back to the fact that these are still relatively small, at least here in the U.S. There are some areas of single stock ETFs where they are getting large and impacting the underlying market more frequently. But this just comes back to there's leverage in the market. We just saw a hedge fund blow up. Like, this is part of the market, and leverage ETFs are, yes, they're getting bigger, but I don't think they're like completely driving what's happening here.
Well, another issue in the whole market there is this latest Bitcoin hack. How's that affecting the ETFs? Because this came out of a cold storage.
Yeah, so this wasn't Bitcoin itself that got hacked, for everyone listening. But what ended up happening is a wallet provider, somebody that you would store this Bitcoin with, they had a bug in their software firmware that didn't provide enough randomness. Cryptography, any sort of cryptocurrency, you can't back in and guess what somebody's password or secret code might be. In this case, there wasn't enough what they call entropy or randomness to the number that was generated. So we ended up with over $100 million now in hacked Bitcoin. And as we predicted, as soon as we wrote a note earlier this week, this was going to cause inflows to the ETFs, because there's a lot of people that believe, if you want to hold Bitcoin, you need to hold it in a cold storage wallet. And this has just shaken the masses, and we've seen it in the flows. We've seen $750 million come into the ETF so far this week, which is one of the strongest weeks we've seen so far in the last quarter or so.
That's really interesting, James, that it has that effect and doesn't make people question the credibility of holding crypto assets themselves. Is it just fair to say that there is a base of believers in crypto that they'll just shift the way that they own the asset class versus maybe rethink owning it at all?
Yeah, I think that's part of it. I mean, the fact of the matter is this isn't a hack on the cryptography. It's somebody who is selling a product didn't do a good job at the one thing they really should have been doing is what it comes down to. But part of it also could be people just needed to they had coins on a wallet that could be theoretically compromised, and they didn't trust the system they had set up at the time, and they decided we need to get money into the ETFs as a stopgap right now, and then they'll figure out maybe a hardened cold storage solution for themselves. But for the most part, I think, yes, there's a lot of people that still believe in this asset. If you look at the price, it's gone down a little bit. For the most part, we've been trading sideways for a long time now, and this really didn't impact the price, despite what I would say is this is like just as bad as FTX in some regards to some hardcore Bitcoiners. This has really shocked the foundation of what some of the people believe.
Can you quickly explain to me, though, why people don't take this one step further and say, well, the ETFs have to hold Bitcoin? And with all the hacks going on, that could happen too. So even if I'm not holding the Bitcoin itself, but shares in the ETF, I could be vulnerable.
Yes, I mean, theoretically, you do have a whole bunch of custodians, institutionalized custodians like Coinbase, BitGo, Anchorage Digital, Fidelity, Gemini even, but they have much more hardened protocols around how this Bitcoin is stored. They use what's known as multi-signature storage, so it's not just one key that needs to be guessed, it's multiple that needs to be guessed. So there's all these hardened ways that institutions, but at the end of the day, yes, there's no risk that, your exposure to S&P 500 stocks is going to get hacked out of an ETF. However small that risk is for Bitcoin ETFs, it's still a risk that you have to consider. It's disclosed in all the prospectuses. But the process of generating those random numbers, those private keys, is way more intense and way more secure than what happened with the cold card wallets.
James, appreciate your time this morning. James Seyfert from the ETF Bloomberg Intelligence team, and tune into ETF IQ on Mondays at 12 p.m. New York time. Coming up at the top of the next hour, Kevin Hassett will talk about the latest jobs print, Fed inflation, and the Fed outlook. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Trading day is about to start.
And you're already looking for that edge.
The Opening Trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your Opening Trade.
Only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
We have a jobs report that we want to hear the White House's perspective on, especially after the president had made clear that he prefers that when you have strong data, you have lower interest rates. He likes that kind of immediate reaction, although you can argue that that's not what usually happens. So it'll be interesting to hear how the administration responds to negative data in terms of a negative surprise, jobs lost for the month of July, and a positive reaction in the bond market and the stock market as well. Sean Tucker here with me, Stacey Vanek Smith. This is Bloomberg Intelligence. We'll be covering the economy, the markets. We're also going to have a couple of conversations about earnings because we're nearing the end of the big earnings season and approaching the beginning of consumer earnings season. A lot of companies telling us how consumer spending is faring in the last 3 months. All right, let's head over to our colleagues on Bloomberg Television as they begin their conversation with the White House Director of the National Economic Council.
Welcome to our global TV and radio audiences. I'm Danny Berger alongside Michael McKee. U.S. employers unexpectedly cut 23,000 jobs in July, following a downward revision to May and June figures. Let's bring in White House National Economic Council Director Kevin Hassett. Director Hassett, great to see you this morning. And I know you've been saying post in reaction to this surprise loss in jobs that you're mostly looking at the unemployment figure, and it fell. However, as Mike just pointed out, labor force participation also fell, which is the reason that occurred. So looking at the figures and the state of this jobs market, are there any areas at all that you are concerned about?
Right. Well, first of all, you know, I've been talking about these numbers with Mike for how many years, Mike? 20 years? And so he really does raise some good points. And the thing that I would say is that because of our border policy and because of deportations and the retirement of the baby boomers, then labor force participation is kind of on a downward trajectory, which means that the break-even jobs number, that is the jobs number you need so that unemployment rate doesn't go up, has gone from maybe 120, 130,000 a few years ago to maybe about 40,000 now. And so what it means is that what the market is used to looking at, it's like a normal tread the water kind of jobs number if it's around 100, is no longer true. If you get a number like 100, then that's really like a great number, and it should make the unemployment rate go way down. And so that's like the technical big picture. Digging into the numbers, there are some things that really jump out at me. That it was like private sector job creation was, right about at the break-even positive number. It was government employment that went down a lot, about 50-something thousand. And the other thing is that we see in the hospitality sector, the end of the World Cup is really clearly in the data too. If you exclude those two things, you had about 100,000 number, and that's consistent with all the other indicators, like the purchasing managers being really high, unemployment insurance claims being about the lowest they've been since World War II. All these other indicators suggested, the market was right when it expected around 100, and given that there's just a minor correction that gives you about 100, I think suggests that's what the truth will be. But we need to see future numbers before we can make a final judgment, and that's why it's great to have a person like Mike around to help us think about things.
I agree, Kevin, for what it's worth. I absolutely agree.
Well, predictions are hard, especially about the future, as Yogi Berra said. We're both economists. Let's get wonky here. The possible growth, potential growth for the United States or any country is based on the size of the labor force, whether it keeps growing, and productivity. And you're taking credit now for the size of the labor force essentially going down because of the immigration policies of the administration. So is that a good thing for the economy overall?
Yeah, I mean, what's going on right now is if we do the old potential GDP calculations, then you add productivity plus capital deepening plus, labor force participation or labor's contribution. I think that one of the things you see in productivity is that it's probably running north of 2.5%. Capital spending probably adds at least 1% to that. So before you get to the labor story, you're looking at a 3.5% GDP number. And I think the labor story is still going to be positive. I just think that it's not going to be as positive as it typically has. If you go back over 40 years, the labor story adds about like 1 or 1.5% every year to GDP. I think now it's likely to be about half of that or a third of that.
Essentially,
you see that, by the way, you mentioned the hourly earnings. If you look at the weekly earnings, they're actually up relative to inflation quite a bit, about $1,000 overall for all Americans, about $3,000 for manufacturing workers, $4,000 for construction workers. And so there is something going on, too, where people are something in hours that's going on that's offsetting the participation.
President watching in the Oval Office is just saying, you got your point in, Kevin. Good job about that.
I don't know if he's watching, but I'll find out, I can tell you.
People we've talked to so far today are basically saying this is a non-event, even with the negative number for the Fed, because it shows the labor market is stable, if nothing else, and they can focus on inflation. I'm wondering, though, why the president is saying things like Kevin Hassett can do what he needs to do. The labor market was stable under Jay Powell, and the president was really mad at him all the time. Why is he giving Kevin Warsh so much more runway, even though conditions haven't changed all that much?
Right. Well, I could say that the president, there have been some news stories that the president's talking to Kevin Warsh, and of course he is, and he talked to Jay Powell too. But the other thing is that Kevin Warsh and the president have a very close long-term relationship from New York City, from Florida, and they talk about the economy all the time, and I talk to Kevin as well as does Scott Besson. And so that's like not really news. And the fact is that there's somebody at the Fed now that the president is 100% sure is going to do what's right based on the numbers and not play partisan games. And you
Hassett,
heard me mention some of the partisan games that I think they played in the past.
I just wanted, apologies for jumping. I just wanted to pick up on the point of the conversations because you mentioned about the economy. Are they talking about monetary policy as well, or is it just like broad economic advice?
I've not been listening to the conversations, but I'm sure that the president doesn't say, hey, you got to do this or that to interest rates. He respects the independence.
Well, given that line of communication is open, I wonder if we could do a little bit of scenario analysis. Let's say that this Fed does hike. There was an FT report saying that perhaps the chair, Warsh, might hike if the data continues as it is for September. What do you think the president's conversation would be like with Fed Chair Warsh should that happen?
The president is going to respect the independence of the Fed. I'm highly confident. And when it's very, very natural for the president to do something like say, hey, Chairman Warsh, what do you think about today's job number? And that's a very normal thing for him to do. But I think that's the way you should think about the bounds of the conversations.
Forgive me for asking this, but I've been dying to ask you this question since you brought this up last Friday. You said that the biggest danger to the economy is that socialist, communist Democrats actually have a big victory in November. What is socialism in your mind?
Well, you know, Mike, that I, as CEA chair, wrote a chapter about it in the economic report of the president. Was widely criticized because people said, oh, there's no way the Democrats are socialist. I didn't say Democrat anywhere in the report. I said, here's the risk of socialism. But then I wrote a book, The Drift, Stopping America's Slide to Socialism, because I believe socialism, we are sliding towards socialism through that party. And so socialism is when the government owns the capital and then hands it out to people, is a very simple definition. And so let's just say, hypothetically, the government decides to have grocery stores where it sets the prices and tells people like when they can get in and get the cheap stuff. The history of this is that the grocery stores end up being empty, prices don't matter because there's nothing to buy. And over time, socialism leads to, you know, public disorder, and you see it in Venezuela, you see it in Cuba, and so on. And so it's a terrible path to go. But I think that what people underappreciate is that the policies that have been advocated by Democrats since President Trump took office, where, hey, you could have wealth taxes, you could have really high taxes on income, you could have really high taxes on capital gain, they've been basically, you know, sliding towards socialism for a long time. And so while the new people are a lot more charismatic than the people in the Senate, I think the policies that they're advocating, Medicare for all, you know, like, come on, Hillary Clinton's healthcare policy was about that, right? And so that I think that that's the uncomfortable thing that Democrats have to come to terms with, is that these socialists are actually advocating things that Democrats have advocated for a long time.
Well, if government ownership of means of production is part of the definition there, then the Trump administration has taken shares in Intel, MP Materials, Trilogy, Metals, Lithium Americas, and they've got the golden share in U.S. Steel. Why is that not socialism?
Yeah, because it's not control. So, for example, the Norwegians have a sovereign wealth fund. They own maybe about 3 or 4% of U.S. equities. That's not socialism. They're not going in and telling the management what to do and so on. And so I think that one of the things that President Trump and Howard Lutnick have noticed is that in the end, the U.S. would be way better off if we have something like a sovereign wealth fund. And we're certainly putting up firewalls to make sure that the government can't come in and micromanage those firms.
We just heard from Rick Reeder of BlackRock, you know him well.
Yeah, I do, yeah.
We need to see something on the fiscal side to try to get the economy moving and companies spending again. Does the president have any plans to propose something like that, or are we kind of stuck until after the midterms, and or if the Democrats take control of one of the houses, we're stuck for 2 years?
You know, I think that Rick's call for, you know, some kind of stimulus package, I guess I haven't seen what he said, feels completely inconsistent with all the data I'm seeing right now. And so I'd have to see what Rick was saying. But right now there are, you know, obviously we're watching closely the welfare of the American people, but we haven't had meetings where we talk about a stimulus bill.
Director Hassett, you know, it's often that great leaders need to be ones who surround themselves with people who can deliver them hard truths. And it's a strange time in this economy. Many things are changing, be it AI or impact of higher oil prices. I wonder what those conversations are like. How often are you coming to the president and delivering him advice that's maybe hard to take, that parts of this economy maybe need various efforts? How often are you having those difficult conversations?
You know, I obviously can't talk about specific conversations with the president. I was in the Oval with him last night. We talked about a wide range of issues, and he doesn't really have much patience for yes men. And so when you go into a meeting in the Oval, the one thing I can say is that you cover a wide range of topics and a wide range of opinions, always.
All right, what do we think is going to happen now with Iran? And the reason I ask that is because everybody also that we have talked to says that, boy, it would sure do a lot if we got that war over with and prices came down for energy.
Mm-hmm. Well, again, I'm not involved in the negotiations with the Iranians. I don't have any insight. It's not, you know, it's stronger than yours on the specifics of the negotiations. I could say that we've done an enormously good job stabilizing global energy markets despite this disruption by doing things like increasing production through pipelines, getting the Jones Act waived so that American energy can move to the coast. And that's one reason why, while energy prices are higher than we would like, they didn't go nearly as high as a lot of the people on your shows were saying, right? People were saying we're going to be stuck at $150 oil just a few months ago. And so I think what that means is that all of these steps that we've taken in increasing energy production, especially in the U.S., means that when this is resolved, then prices are going to drop a lot. And I think that that is something that's being priced into futures markets, and it's actually affecting decisions today because if you buy oil today somewhere, then it usually takes about 2 months to be shipped. And so it really puts a downward pressure on prices today.
Now, I got to put you on the spot again one more time here in an area that you do follow, and that is the budget for the United States. The president's budget would add a lot more to the debt. That means more bonds have to be sold, and we were just talking with a lot of people this morning about how much private debt is coming to the markets, especially from the AI sector. How much do you worry about interest rates going up and the country having to pay a lot more because there's a lot of demand for bonds right now? A lot of demand to sell them, rather.
Well, I mean, the point is that what the president has done is he's put out a budget that gets the deficit to GDP down to almost nothing over a 10-year window. We've taken significant steps to achieve those goals by, for example, reducing federal employment by more than 300,000 workers. And I just got a briefing on the vice president's fraud task force yesterday that, wait do you see, there's going to be tens and tens of billions of dollars just in a year. So multiply that by 10 to get the deficit effect of fraud that we've stopped, that the vice president's team is stopping. And so we're 100% focused on the deficit in the long run. But we also, at times, when we spend less money on international organizations, we can spend more money on the defense things that keep us safe. And so we're changing things, within the bundle, but we're definitely shooting for lower deficit over time.
Just combining these two ideas, Director Hassett, of taking action and what you were mentioning before with higher oil prices. This is a president who has signaled out big oil, both Exxon and Chevron specifically, amid this ongoing crisis. What steps is this White House going to do in order to act on the idea that big oil is contributing to the inflation we're seeing in higher prices?
Well, I think that, big oil is heavily concentrated in the U.S. It's something to keep an eye on. But the bottom line is that the global energy price story is a positive one compared to what people thought. And I think that the things that made it positive are going to make prices drop very, very quickly once this is resolved.
Director Hassett, when you say too concentrated, they're just too big. Is it a kind of an antitrust issue, you think?
As an economist, you could look at something like the Herfindahl Index and just think about what share of the market does any business have, and that's something that is a source of investigation for people at the FTC and the Justice Department. It's not something that's within the purview of the NDC.
Understood, Kevin. Thank you very much for your time this morning.
Thank
That's
you,
the
guys.
White House National Economic Council Director, Kevin Hassett.
We have known each other for years.
All right, and that was tuning in to Bloomberg Television, where Danny Berger and Michael McKee were speaking with the White House Director of the National Economic Council, Kevin Hassett, on the heels of what some would call a disappointing jobs report, in that U.S. employers unexpectedly shed jobs for the month of July. We do see gains in the equity market because the thinking is a weaker labor market removes the need for the Fed to raise interest rates in the near term and perhaps reduces the risk of rising rates as well. Let's bring in Matt Griffin right now. He is checking out some stocks that are on the move. I'm Scarlett Fu with Stacey Vanek Smith. This is Bloomberg Intelligence. Matt, get us started. What are you looking at?
Well, I've been looking at one consumer name all morning, Scarlett. That is Under Armour. They are lower after forecasting a sharper than expected drop in revenue this year. So that stock, ticker UA, down more than 5%. The athletic retailer expects their sales to fall by a mid-single-digit percentage for the year. They saw only a slight decline before, and they say they're grappling with a challenging consumer environment across a lot of the world. I mean, North America, Asia, Europe, the list of regions that they laid out goes on. It doesn't necessarily mean that the whole sportswear industry, though, is doing badly. This company has been in the middle of its own turnaround effort. They're, dealing with the separation from Steph Curry, for example. Investors have rewarded that lately, but what Bloomberg Intelligence says about this report is it shows they're not really benefiting as much as you'd expect from some of these big sporting events. So consumers are spending on sportswear, but they're going to Nike, maybe they're going to Adidas instead. That weighing on Under Armour today. Another decliner is Sweetgreen. The fast food salad chain slashed an outlook for same-store sales after the outbreak of illness caused by the Cyclospora parasite. That stock is ticker SG. It's down 13% and bringing a year-to-date decline to about 25%. So the salad chain, they now expect their same-store sales to fall as much as 8% this year. That's a decline about twice as wide as they previously forecast. And again, really citing the parasite outbreak there, D.A. Davidson said there are good signs under the hood here about their ongoing turnaround efforts. So, they're investing in promotions. They're trying to add some lower cost items to the menu to address some consumer concerns about the business. But what those analysts said is the traffic improvement from that has just been derailed for now by these health concerns. Worth noting, Sweetgreen, they say their supply chain has not been affected. They don't even serve the iceberg lettuce that's been connected to the outbreak, but consumers are generally very cautious about fresh produce right now.
Yeah, I have to admit that I don't see a lot of people carrying salads around the office these days.
No, I think that's absolutely right. Skill by association, if anything.
Absolutely. All right, Matt Griffin, thank you so much. Matt Griffin with our Stocks on the Move. And for more conversations like this, subscribe to our Stock Movers Reports, 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. And just a reminder, for those of you listening and you are a Bloomberg.com subscriber, you can help shape the conversation on Bloomberg Radio by submitting questions for experts and guests on our show. You can visit Bloomberg.com/Ask Radio. This is an exclusive feature for Bloomberg.com subscribers and terminal clients. Be sure to check it out on Bloomberg.com/Ask Radio to join the conversation. All right, let's hand things over now to John Tucker for a check of our Bloomberg Business Flash.
All right, Scarlett, this flash brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM insured municipal bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. So that subpar jobs report lifting stocks. Say what? That's because the data is pushing yields lower. Claudia Somm at New Century Advisors says the weak jobs report should take Fed rate hikes off the table, at least for now.
So certainly on the consumer side, this is not good news. I mean, paychecks are such a key driver of consumer spending. Not the only driver, but this is a soft reading.
6 of the major industry groups in the S&P 500 are higher, led by consumer discretionary like eBay and Amazon. They have best performing stock in the S&P 500 right now. Shares of Airbnb up close to 16%. A company boosting its annual revenue forecast for a second time this year, citing robust demand in the U.S. and Europe. So the S&P 500, 30 points higher, 77.41 in the index. The Dow up 112 points. NASDAQ Composite Index up 243 points. Got to do those yields. The more policy-sensitive 2-year is down 6 basis points, 418. The 10-year yield 4 basis points lower. That is at 4.63%. And OpenAI's highly anticipated consumer device expected to be a donut-shaped smart speaker without a display. It'll be priced at more than $300. Designed to be easy to carry around. It's going to have features like speaker grills, microphones, and lights that demonstrate when it's listening. Oh, sure, when the light's on, it's listening.
You're saying that it's listening when the lights aren't on?
I'm just, raising the possibility. I'm not being paranoid. I'm just
No. The phone definitely listens, and lots of devices listen.
I don't know, Well, anyway, we check the markets and other stuff for you right here on Bloomberg. Right? Don't get me in trouble. I'm John Tucker. That's your Bloomberg Business Flash. Hi, Stace. Hi, Scarlett.
Hi.
Hello.
Happy Friday to you. Thank you so much, John Tucker. This is Bloomberg Intelligence. Stacey Vanek Smith and Scarlett Fu here. Paul Sweeney is off for the day. Stacey, it's so good to see you in the studio.
Thank you, Scarlett. I'm thrilled to be here.
You host a weekly podcast, Everybody's Business. What do you have on tap this week?
That's right. Well, this week we talked actually about the Cyclospora outbreak and how that is affecting the sales of salads and other things, especially at Taco Bell. They've rolled out a new product called the Enchilado, which is basically a burrito that has no lettuce in it.
Ah, okay. Burrito X lettuce.
Burrito X lettuce, exactly. And then we also talked about the midterm elections and how big business is looking at things right now, especially with a lot of voters may be going to the extreme right and extreme left, where big business is not a priority as it is right now, and kind of how they are thinking about positioning themselves.
Well, the news changes so quickly day to day, so maybe bowing out of it is an option, although it seems like there's cost either way, right? No matter how you position it.
Yes, absolutely.
All right, well, let's talk about one of the big businesses, or one that aspires to be a big business, and that would be Under Armour. It's the athleisure company, athletic wear company. Maybe athleisure is pushing it a little bit. Poonam Goyal is senior U.S. e-commerce and retail analyst here at Bloomberg Intelligence. And Poonam, Under Armour, it feels like it's been this reorganization, restructuring story for a while now. Where are we in that reorganization, restructuring story for Under Armour? Because the stock performance today shows that there's still some way to go.
Been through this turnaround story several times over the past 2 decades. So clearly, it's happening once again. Now, what I'd say for them, I think they are focused on the right things. The question is, will the consumer respond? Right-sizing inventory was down just 3% in line with the sales decline is a positive sign. That said, it was interesting that they called out that the consumer is actually weak, because when I look at competitors, some of the larger ones like Adidas and Nike, they're actually doing pretty fine in North America. And I think that may have to do with just their bigger moat and also the World Cup and their bigger presence there.
Yeah, I was wondering about why demand was softening with Under Armour. I know Under Armour is kind of a middle of the market brand. Is part of what's happening here maybe that the demand for kind of middle of the road brands is softening, while maybe demand for higher end brands is gaining ground, or is it something else entirely?
Yeah, I think it's a mix of a few things. So first, I do think that it has to do with the higher end customer is doing better than the mid or the lower end. So we do see that across the spectrum. That said, Under Armour, while it is middle of the class, it's not Nike or Adidas, but it is still a strong brand when you think of athleisure, especially compared to like some of the other brands that are up and coming. I think Under Armour does still in North America have across the board, not just in metro cities, a name. That said, I do think the last quarter weakness does stem a little from just when you think about what was going on, especially in the U.S., it was all about the World Cup. And Under Armour doesn't really have a meaningful presence there. So when consumers are shopping the stores, when they're going online, it's just not the brand that comes front and center. That said, Under Armour is largely apparel, right, with the exit of Steph Curry. So that differentiates it from where Nike and Adidas sit, which are predominantly footwear brands with an apparel offering.
I'm so glad you brought up Steph Curry, because I feel like that's how a lot of people encountered Under Armour if they weren't wearing, the cold tech or heat tech shirts that the company made. What do we know about what happened there and how Under Armour is thinking about maybe replacing or finding another celebrity endorser or celebrity partner to work with it?
So I think replacing Steph Curry isn't an easy task, because when they signed Steph Curry wasn't the Steph Curry that we know today, right? It was a younger talent, and it was also probably more in line with what they could afford, as Nike and Adidas have deeper pockets than Under Armour to support some of these brand collaborations. That said, I think the focus now is on just developing the right product. They're going back to their DNA, they're going back to the basics, which is, can we develop a product that speaks for itself and it doesn't need a brand ambassador? It's a hard task, and yes, you can do that for some things, but in athleisure, you do need that brand endorsement, that athlete credibility to really rise further along. for them, I think the one product that they've been talking a lot about, and they actually talked about it several times on the call, was a bouncy T-shirt, which is it's a really cool product that they've developed, and it's innovative, where you can wear this T-shirt, you can wear it to the gym, you can wear it to the bar, and you can wear it every day. And it kind of fits the whole spectrum of your lifestyle. So that T-shirt is doing really well, and they're looking to use that as a stepping board to kind of launch more products and really drive customer interest.
Okay, the bouncy T-shirt, I'm looking online, $65, and it has a 4.9 star rating. This is just a plain T-shirt that looks good enough to wear.
But it bounces.
I don't understand how a T-shirt can bounce. I'm not sure why it's called bouncy.
Come on, get on board.
When you wear it to
the fabric
gym
doesn't
and
stick
then
to you.
wear it out, does it like deal with your sweat, or is it just that its style is such that you could wear it to the gym and then out?
Yeah, is this a performance wear?
It's everything. It's performance, it's going out, and it's every day, which is what makes it so versatile. And that's what they're basically saying, that this is a versatile T-shirt that you can go to the bar on Friday night, you can wake up and go to the gym Saturday morning, and then you could wear it throughout the day. It works for everything, and it's done really, really well for them. It is, I would say, something that's working. And if they continue to innovate in this manner more extensively, they could start to gain some traction, but that's not going to happen overnight. I think there's still, to your original question, a long way to still go from here before we can say that we see a straight line up. At this point, it's still very mixed.
All right, Poonam, thank you so much. Poonam Goyal joining us. She's our senior U.S. e-commerce and retail analyst. Stacy, this is a 4-way stretch sweat wicking tech and fabric that looks and feels like your favorite cotton tee. It feels like it's really just leaning into guys who don't want to change after they go work out.
It just looks like a T-shirt. Yeah, it just looks like a T-shirt. Maybe I have not experienced the bouncy T-shirt.
Right.
Hopefully they wash it at some point after going to the gym before going to the bar.
If there were a shirt that you could wear to the gym and then would instantly dry off and you could go to the bar, I would buy that shirt.
I'd be a buyer. Yeah, absolutely. All right, let's ask Matt Shenholm to save us here. He is our media litigation analyst. Matt, have you ever heard of the bouncy T-shirt from Under Armour?
This one's new to me. This one, yeah, I can't help much there.
Okay, all right. Well, we're going to dig into this. We're going to find someone who has it and has worn it. All right, Matt, you're joining us because the FCC has removed nationwide cap limiting local TV ownership. That's quite a headline. What does this mean in your world?
Yeah, so the media environment has changed a lot over the past couple decades, but FCC rules haven't. And so broadcast TV station owners for years have been stuck with this limit on how big they can grow. The FCC rule said no company can reach more than 39% of U.S. households. And what the FCC did yesterday is scrap that rule and say, look, we're not going to have this numeric limit on companies anymore. So this presents a really big opportunity for companies like Nexstar, Sinclair that own the TV stations across the U.S. to grow larger because they're not, hamstrung by this long existing FCC rule anymore.
What does this mean for media consolidation? I feel like there's always this statistic we hear that there are these 6 conglomerates that now control 90% of U.S. media. Is that likely to get more extreme? I mean, that doesn't seem like necessarily a great thing for voters.
Right. So this, when you listen to FCC Chairman Brendan Carr, he said, this is really about empowering local TV stations so they can compete with those big national media companies. Right now, those stations really have very little leverage when they negotiate with ABC, CBS, NBC, and with cable companies when they have to get their media distributed. So in Brendan Carr's view, this is about sort of empowering a new set of entities in that media ecosystem, the owners of these local stations that right now are, they're limited, or previously were limited by this FCC rule. They could only get so big, so they had no leverage. This gives them more of a voice, in Brendan Carr's view, against those national media companies. So maybe it leads to a little more competition in that space.
So this is deregulation essentially, and the broadcast industry has been waiting for it for a long time. Which companies are going to jump on this and make a move?
So Nexstar has already jumped on it with its acquisition of Tegna, but there was sort of a legal cloud around whether they could do that. You know, by acquiring Tegna, they went way beyond the 39% U.S. ownership cap, and the FCC at the staff level said, you know, we'll waive that requirement. Don't worry about it. That was sort of legally questionable. This is the right way to do it, to do it through a rulemaking to actually change the rule. So it's an opportunity for Nexstar to get past legal hurdles on its Tegna acquisition. A company like Sinclair could also look at this. It featured prominently in the company's earnings call a couple days ago. There could be opportunities to grow much larger, go way beyond the 39%. But one big and important footnote: there's going to be a legal challenge to all of this. That's coming next. It's not totally clear the FCC can do what it did, or whether only Congress can do it. That's going to be the fight that plays out next.
What is the legal challenge exactly?
So in 2004, Congress told the FCC, let's set that limit, that ownership limit, at 39%. And it said, FCC, change your rule to make it 39%. The question is, when Congress did that in 2004, did it mean that the FCC can't update that rule later? Is it only Congress's call? And there are strong arguments on both sides that you know, the FCC says, look, we still have our power to modify our rules. Congress didn't take that away. The other side said, no, Congress was pretty clear. We want 39, and it said that 5 times in its statute, 39%. So it's not clear that the FCC can use its general modification power. That's going to have to play out in appeals court and in the Supreme Court. Did Congress give the FCC its general discretion to update its rules, or was this a call that Congress reserved for itself?
All right, Matt, one final question before we let you go. From where you sit, Paramount, Skydance, Warner Brothers Discovery, is anything going to happen in the next couple of weeks?
Yeah, I mean, so lots of moving pieces on that on the antitrust side, and Jen Rhee is really our go-to on all of those questions. So, you know, really interesting questions there as state antitrust enforcers have stepped up when the federal regulators have taken more of this deregulatory approach.
All right, appreciate it. Matt Stettenhelm is our Bloomberg Intelligence media litigation analyst joining us from Washington, D.C. Stacey, we had a jobs report that is helping the stock market, but is not great in terms of headlines because we saw employers shed workers for the month of July.
Yes, 23,000 jobs, and also a lot of people seem to be dropping out of the workforce, which is also a bad sign for employers and for all of us, for spending and everything.
Yeah, so the participation rate moves in the wrong direction. The unemployment rate does decline. So on the face of it, it looks like a very mixed report, but what you need to know is that it is giving equities a boost because it removes the need for the Fed perhaps to raise interest rates in the near term. It's also helping bonds rally, the 10-year yield now at 4.63%. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker with Bloomberg News with this Bloomberg Business Flash. Major stock averages pushing higher, and the theme that investors have latched onto for the moment is the Fed now less likely to hike interest rates after the pretty crummy jobs report. Yields also in the driver's seat to some extent. They are lower because of the data. The 2-year down 5 basis points, 4.18%. The 10-year down almost 4 basis points, 4.63%. Chris Verone at Baird Strategas says, if nothing else, the stock market is resilient.
Well, I would say on balance, this has been a very good rally, certainly the last week, but just go back the last 6, 7, 8 weeks, they threw everything they could at this market, whether it was bond yields, whether it was oil, whether it was the war, and the best they could do was maybe a 2 or 3% drawdown in the S&P.
The S&P 500 right now up 35 points, 77.45 on the index. The Dow Jones Industrial Average up 121 points, 54,007. And the NASDAQ Composite Index up 256 points. That is a rise of just about 1%. Some of the individual movers, you talked about Sweetgreen, pairing some of the earlier losses still down close to 10%, slashing the same-store sales forecast for the full year, citing decreased demand because of the outbreak of that contaminated lettuce. And you also have shares of Wendy's. They're actually up right now, 1.7%. They pulled their forecast. It's still trying to turn things around at Wendy's. And a quick look at SpaceX shares. They are up today, up 10%. So the hottest buy of the summer, a $10 gift card to Dunkin' Donuts. Paze has introduced a promotion to entice more consumers to try out this digital wallet for e-commerce transactions. So if you activate Paze on your credit or debit card and spend $10 or more, you get reimbursed $10. Works for
Free
as many.
money.
Yeah, works for as many as 10 transactions per card at
So
retailers.
$100 of free money.
Yeah, I mean it's the Paze craze.
Do you
Get
have
on
to spend
board.
it on donuts?
I'm not a donut. I am a Dunkin' Donuts coffee fan. That's the only way to go.
So you have to spend on Dunkin' Donuts or Dunkin',
one of the
place.
qualified retailers. So,
Did
you tell me before Tom's on board this now?
Tom Keene has talked to me about Paze and something about how when he spent on it, he got 12 times points on his Chase card. So he's up on it in a way that I hadn't expected. Have you ever heard of Paze, Stacey?
I had not heard of Paze. But I'm also not very good with credit card points and that whole system. Some people are excellent at that, and I think if you can hook those people in, you probably have a pretty good business.
Right, because they're the early adopters. I'm super into the Reddit threads and the subreddits on like how to maximize your credit card points, but they've brought up Paze a lot, and I didn't know what it was. But John, you were telling me that it's like Google Pay or Apple Pay, but by the banks?
The major banks put it together to sort of compete with them. So this is their payments method.
Oh, the major banks who back Zelle, right? It's the same guys as Zelle.
Exactly, yes.
Okay,
Let
all
me
right.
check the
Well, there you
markets
go.
for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett, Stacey.
Excellent. Well, Scarlett, as you know, the markets are up across the board this morning. One of the reasons why, which is always such a strange thing for me, is the disappointing jobs report. The fact that jobs were lost and that people are dropping out of the workforce makes people think that interest rates are less likely to go up.
And so that's good for the stock market, and that's what we're seeing in terms of gains in equities.
Yes, in certain ways, the markets only have eyes for the Fed. But here to help us kind of break down what's going on with the markets is Sylvia Jablonski, CIO of Defiance ETFs. Welcome, Sylvia.
Thanks for having me. Glad to be here.
Well, tell us, if you will, what you are seeing in the markets right now. I mean, I guess in reaction to the news this morning, but also maybe more broadly.
Yeah, sure. I mean, I think you said it pretty well, right? The markets have a lot of eyes for the Fed, and the kind of the lack of information, the lack of guidance and transparency and things like this is unsettling to markets. And then when you get a data point that, you know, refers to or perhaps is related to not raising rates, the market tends to be happy about that. But I think overall broader picture, you know, we've had more than 60% of the S&P report and 85, 86% have beat on EPS. we're running at like a 47% year-over-year growth rate. So earnings has very much been a clearing event and a very positive catalyst for the market over the past couple of days. I think that's why the market has just been rallying. You know, you see the largest companies in the universe, the AI hyperscalers, continuing to spend, but what they're also continuing to do is show year-over-year increased revenues, increased demand, you know, increased contracts and all of these things. So it kind of brings that legitimacy, that monetization that the market was looking for to the whole picture. And I think in the near term, that's making the market rally. The other thing is we think stability that we have with geopolitics. You know, I think that'll be something that could ebb and flow in terms of the daily market performance as news comes out of Iran and the Middle East and things like this. But for now, you know, the big things that were pulling the market back have stabilized.
Yeah, it's very touch and go when it comes to those oil headlines because every day brings something new. I'm curious about rising bond yields. I know that bond yields are lower today because of what Stacey had just told us about with this disappointing jobs report, perhaps reducing the need for the Fed to go in there and raise rates. But on the whole, borrowing costs are rising. The 10-year yield has steadily grinded its way higher since late February. And I'm not sure that there's anything in this report that changes that trajectory. So how do people think about making sure that there's some, I guess, ballast in their portfolio to offset, you know, all that growth? If bonds are not the way to go, where do you find that?
Yeah, I think, you know, it's a tricky one because I do think that so much of it will just be directly correlated to what the Fed does with rates. You know, even though, as you said, you know, bond yields are moving and things like this, I think what the market tends to really listen to is not even so much the day-to-day moves, but it's what the Fed plans to do and what the trajectory of the Fed will be. But, you know, to that effect, I think rates having, you know, kind of fallen, which could be, you know, superficial really for the last couple of days, and oil and gas prices having fallen is really what the market wanted to hear. But to better answer your question, like what do you do, right? Because one hasn't been the hedge for, you know, we haven't had this kind of 60-40 or standard hedge offset here. So what I will say is broaden diversification, right? You can do things like look at the NASDAQ, like an XIGV, look at the NASDAQ minus the software stocks, look at an XMAG, which takes out, you know, the MAG 7 from the S&P 500 and gives you that broadening out trade to the other sectors. But you know, overall, I still think that there are a lot of, you know, places to put money to work, and you know, the new money could go to the AI power and infrastructure, to the bottlenecks of AI as this trade continues to soar.
Overall, this earnings season has been pretty positive, I would say, and I think there have been a lot of worries, at least underneath the surface, that maybe the markets are a little bit over their skis. I mean, it's been such a bright spot in the economy for so long now. Do you think that the economy or that the markets are out over their skis a little bit, or do you think that the fundamentals support what we've been seeing?
I think for now, the fundamentals support what we've been seeing. You know, we'll have to see where it goes from here. You know, the tricky thing about what we're seeing now is that earnings expectations, you know, I think the market pulled back quite a lot ahead of this earnings reporting season here. And the reason why was because of this. A lot of investors were saying, you know, stocks are really inflated and expectations are way too high. How can they possibly meet and beat and things like this? And, you know, here we are, 47% year over year again, right? 7th consecutive quarter of double digits. So I think as the bar goes higher and higher, it will be harder and harder to impress the market. And that's more what I worry about. But in terms of, you know, these corporations, look at, you know, companies like Amazon, 37% year over year growth, you know, Oracle, Microsoft, Azure, Google, you name it. The AI hyperscalers are just taking off, producing and leading the market. So as long as they continue to do that, I don't worry as much about the valuations.
Very quickly, Sylvia, before we let you go, feels like we've gotten some of the big data points, some big earnings out of the way, and now we're going to enter kind of the dog days of summer. What's going to be the catalyst going forward on the corporate news side? Because most of the big earnings that really move the market are over. Well, NVIDIA, except NVIDIA.
We have, NVIDIA will I think be a big one, right? And then that'll really move all of the semiconductor stocks, I think, whether it's the Microns, the Broadcoms, the NVIDIAs of the world. But yeah, I think it'll be geopolitical news and the Fed. It's as Stacey said, all eyes are on the Fed, right? It's only eyes for the Fed. So we'll have to see what happens there.
All right. Sylvia, always a pleasure speaking with you. Have a great weekend.
Thanks, Scarlett.
Sylvia Jablonski is, of course, the CIO at Defiance ETFs, joining us from New York. We have gains in the equity market led by the NASDAQ, which is up more than 1%. The S&P 500 adding 0.5%. Bonds also in rally mode, sending yields lower.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Okay, this is Bloomberg Intelligence on Bloomberg Radio. Paul Sweeney is off for the day. Stacey Vanek Smith and I are here. And of course, there's a lot to get to this hour. We have to talk about what's going on in the markets because this was meant to be a jobs report that would really highlight how inflation is the issue in the jobs market. The labor market is very stable. And I guess underneath it all, Stacey, the jobs report does reinforce the stability of the labor market, but it was still a shock to see a negative number for the month of July.
Yeah, I mean, I think overall, it's always important to remember that historically speaking, our jobs market is great. We have under 5% unemployment. That is historically an amazing job market.
Yes.
But it's just been so middling for such a long time. And I think that is of concern. To have a powerful, healthy economy, you need a powerful, healthy jobs market. And it seems like it's kind of waiting to go in one direction or the other.
I think that's a really good way of putting it. And you look at earnings, and that's something that everyone's keyed in on because of inflation. And it feels like we're just kind of middling along there, which raises all kinds of concerns about people's spending power and how that has really dissipated in this era of rising prices. And speaking of rising prices, if you were to disconnect your cable bill, your big cable bundle, and actually just pay for individual streamers like Netflix or HBO Max. And then if you're a sports fan on top of that, some people are looking at $2,000 streaming bills to be able to follow their favorite teams, especially if, I know you're from Iowa, right? Des Moines?
Idaho. Boise.
Excuse me.
No,
Boise.
They get mixed up all the time.
I'm so
but
sorry.
We
That's
don't
such a
have.
New Yorker
We don't
thing
even
to do.
have the sports prowess that Iowa does, sadly. But we have some. We have the Broncos, the blue AstroTurf.
Okay,
That's
okay.
us.
So
That's
if
our,
you wanted to watch your out-of-state team or,
Oh my
an out-of-state
gosh.
team, you'd be paying up.
It would cost a fortune.
It would cost a fortune. Randall Williams is our senior reporter, Bloomberg Business of Sports reporter here with us. And Randall, this is something that, the sports leagues kind of created this monster where people can't watch the games that they want to watch. And it gets super confusing to figure out where and how to watch a game.
It can be. I think that I am indifferent on the subject, generally speaking, because I do agree that most of the NFL's games are watchable if you are a casual watcher. Let's say you just want to watch the highlights. There's Red Zone that's available for $15 a month. Now, in your case, yes, you would have to pay out of pocket, and that can be a serious problem. Sunday Ticket is not cheap, and I remember a time when my dad was a big Sunday Ticket subscriber, and oftentimes DirecTV, the provider that used to sell it, would give it to him for free because of his loyalty. That pretty much does not exist anymore, and so the cost of this is continuing to rise across all of sports.
Yeah, it's something that frustrates a lot of people. I want to stick with, some of the big sports headlines for the week. And one thing we learned this week is that Live Golf, I guess some people call it a renegade golf league, but, the rival upstart golf league to the PGA Tour, has found an investor and now looks like it can live on. What do we know about this supposed lead investor?
So what we know about this investor is that, like you said, it is going to give Live Golf a lifeline. I think Bloomberg reported earlier this week that it's BC Partners, its credit arm. And so the question now is, how does Live Golf survive? There have been a bunch of cancellations and different questions about players, about if the events are going to go on, about staffing, about hirings and firings. And that's the main question. It's like, how does this event and how does this organization continue to survive long term without the Saudis who invested over $5 billion into the organization?
And just a quick note that Randall will be on Bloomberg Money later on today on Bloomberg Television to talk to us about the latest in golf, because we have the PGA Tour new CEO, Brian Roloff, joining us at 12 p.m. with Tom Keene and myself.
Well, there is also big baseball news. The San Diego Padres had a huge sale, an MLB record, I think, almost $4 billion. Talk a little bit about that. That was, that seems like quite a major thing.
The Padres sale is a incredible number because if you think of the most valuable teams in baseball, the Padres don't come to mind.
I was surprised.
But the organization punches well above its weight. They've been second in attendance in terms of overall fans for the 81 games and home games the last 2 years, only trailing the Los Angeles Dodgers, who of course have, I believe, the largest stadium in the MLB. That is incredible for a local market like San Diego. If you think about San Diego as a sports market, the Chargers left for Los Angeles, and the Padres are all that's remaining. And of course, the new owners are going to be tasked with jumping in there, managing the team, and of course, competing for a World Series.
Multiple bids surpassed $3.5 billion. We're talking $3.9 billion. What were people thinking it would go for?
I think people knew that it was going to go for more than the Mets. It's just been enough time, and the Padres are a premier organization in baseball. But $3.9 billion, you have to think, the Phoenix Suns sold for, I believe, $4.5 billion or around that. The Charlotte Hornets were $3 billion. The Dallas Mavericks were $3.5 billion. And so the Padres going for this number is high, but if the buyer wants it at that price, then that's ultimately what it's going to sell for. And it was high, but you got it.
And before we let you go, Gianni Infantino, still at FIFA, still there?
He is for now. I mean, his re-election will come next year, and UEFA is standing by some of their statements about not wanting him long term and losing trust in him long term. So now the question for Infantino and FIFA more broadly is going to be, can he regain the trust, and what does his relationship with FIFA and UEFA look like going forward?
All right, Randall, thank you so much. Randall Williams, our Bloomberg Business of Sports senior reporter, joining us. And of course, he will be on Bloomberg Money with Tom Keene and myself at 12 p.m. on Bloomberg Television. And just a reminder for our listeners in the U.S., you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network coast to coast 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research because the next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business App.
Good Friday morning. This is Bloomberg Intelligence, broadcasting live from the Bloomberg Interactive Broker Studio in Midtown Manhattan. We are also streaming live on YouTube as well. Stacey Vanek Smith joining us in studio today. Paul Sweeney is off for the week, or the day and the weekend. Thank you for doing this.
I am thrilled to be here, Scarlett. This is very fun.
And you are, of course, the host of Everybody's Business. It's a weekly podcast, right?
Yes, indeed, from Business Week. Yeah, we cover all kinds of things. In fact, this week we covered RFK Jr.'s new cooking show.
Oh, okay. I don't even know how to respond to that. That just triggered a whole bunch of wow. Okay, be sure to check it out. Stacey Vanek Smith, Everybody's Business, with her co-host Max Chafkin. We have a lot to get to this hour. We're going to check in with Amy Glazer. She's Senior Vice President with Adecco US on this surprising jobs report for the month of July. We also have Matthew Gastel. He's our Head of Muni Strategy and Research here at BI to talk about munis, give us his mid-year outlook. Frances Newton is joining us as well. She's the CIO of Tuttle Wealth Partners to give us her outlook for these markets. Michael Halen talking about Sweetgreen and Wendy's as well. All right, all that coming up, but just a reminder that Bloomberg.com subscribers can shape the conversation on Bloomberg Radio by submitting their questions for experts and guests on our show. Be sure to visit Bloomberg.com/AskRadio for this exclusive feature for Bloomberg.com subscribers and terminal clients. Visit Bloomberg.com/AskRadio to join the conversation. All right, John Tucker, let's bring you into the conversation for our Bloomberg Business Flash.
All right, we're data dependent, so let's start there. It's not often we get breaking economic data at 11 o'clock New York time, but the New York Fed one-year inflation expectations coming a little bit lower than what economists surveyed by Bloomberg were looking for. 3.63%. The expectation was for 3.69%. S&P 500 right now on track for a record close. If we stay at these levels, you have 7 of the 11 major industry groups in the index higher right now. Consumer discretionary is in the lead. The S&P 500, 39 points higher, up 0.5%, 77.48 on the index. Dow Jones Industrial Average up 133 points, and that's a rise of 0.25%, 54,024. The Nasdaq Composite Index up 273 points. That is a rise of 1%. Employers cutting jobs in July. Hiring in the prior 2 months was revised lower, all suggesting the labor market weaker than previously thought. Bad news? Well, good news for stocks. Stocks hate nothing more than high interest rates. And Andrew Hollenhorst at Citigroup says the weaker jobs report takes the pressure off the Fed and Chair Kevin Warsh.
It really takes the pressure off in terms of a September rate hike. It would now look a bit strange. I think it will look even stranger after we get some cooler inflation data. Let's see how that plays out. We have a big report next week.
Right now, the 2-year yield, 4 basis points lower, 4.199%. The 10-year, 2 basis points lower. That is at 465. I also want to bring you this. I mean, we've been monitoring things on Capitol Hill. So Senator Bill Cassidy has been speaking, the Republican senator. All eyes were on him because, you know, he's one of these key votes for Todd Blanche. He now says he will support Todd Blanche to be the next
Was
Attorney
he one of
General.
those YOLO senators? There was a small contingent that was willing to stand up and not.
We
vote
didn't know
along the
after
way the
Susan
president.
Collins. We didn't know, so everything turned to Bill Cassidy at this point because he was one of those who was in question. But so anyway, with his support, this likely paves the way for the confirmation for him to become the top law enforcement officer of the United States of America. Anyway, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Stacey and Scarlett.
All right, thank you so much, John Tucker. This is Bloomberg Intelligence with Stacey Vanek Smith and Scarlett Fu. Paul Sweeney is off for the day, enjoying the beach and enjoying his long weekend. We have a lot of green on the screen when it comes to equities, when it comes to bonds. So let's bring in Lisa Mateo. Hi, Lisa.
Hi.
It's so good to see you in the office here, in studio. Usually, of course, she's on Bloomberg this weekend, so she's prepping madly for the upcoming
we're
shows.
prepping for the show.
Yes, but you are also doing us a favor and telling us about some stocks that are on the move this morning.
Yeah, I'll start in the what's down first. We'll start on the downside. All right, so fast food salad chain Sweet Green. I love a good salad, but it's hard when you're under a cyclospora outbreak, and that's what their problem is right now. Their shares were down as much as 13%, but they cut their annual outlook. They expect full-year sales at their locations to fall as much as 8% this year, and that's compared to a drop as much as 4% for comparable sales. So decreased demand, yes, because of the outbreak, but also the stock lost nearly 27% of its value after that surge of cases. They say their supply chain is not affected by the outbreak because restaurants don't serve iceberg lettuce, and that's what this is affecting, is the iceberg lettuce. But now there's another issue with jalapenos. So that's the issue. They removed the jalapenos from the supplier that was tied to a salmonella outbreak. So it's a tough go for them. Chipotle, Qdoba, they also, of course, removed those peppers. But the bigger picture, I mean, the company was already dealing with the declining traffic. They were trying to do cheaper options. They were trying bigger portion sizes, limited time offers, doing all the things. They even reduced the number of restaurant openings. But the CEO said the results are just not where they need to be.
What else are you looking at this morning, Lisa?
I'll give you another downer. Sorry.
It's okay. It's that kind of morning,
Yeah, it is. Under Armour, okay, ticker UAA. Their shares were down as much as about 7%. So basically, they forecast a sharper revenue decline than expected. They expect sales to fall by mid-single digits digital rate per year. It was just softer demand in key regions, particularly North America. You had Asia Pacific as well, Europe, the Middle East. Its CEO is saying the company's dealing with just challenging consumer demand environment. That's what they're saying. They've been trying to kind of turn the business around after declines in sales continue to decline. They've been cutting down their product offering, reducing discounts, doing things like that. But what's also adding pressure to them is the impact of tariffs. We've been talking a lot about that. And the big thing, too, is that separation from NBA star Steph Curry. They had this 12-year partnership, and now, you know what, he's going on to other things. And that was a big downturn for them.
Absolutely. Last stock on your list.
Yeah, really quickly, Maple Bear doing business as Instacart, ticker CART. Their shares jumped as much as 11% at the open. That was the most since February, so this is on the upside. Shares were up as much as 10% since then. Forecast for third quarter gross transaction value beat estimates. And what analysts are saying, I'll just point to Morgan Stanley quickly. They said strength in user growth spend per user is a notable indicator of a healthy and growing online grocery market. I don't use my Instacart, but my sister loves it. And she uses it all the time.
I'm a fan.
You are a fan?
I am a fan. Yeah.
I am a fan of not paying extra fees, so I don't use it.
Me too. Thank you.
There are a lot of fees, but it's very convenient.
Correct.
You take your groceries on the subway.
Oh, that's true. Okay, good point. All right, Lisa, thank you so much. Lisa Mateo, co-host of Bloomberg This Weekend. You can catch her and Christina Ruffini and David Gura every Saturday and Sundays from 7 a.m. to 10 a.m. And, of course, check out Stock Movers available on Apple Podcasts, Spotify, or anywhere you listen. Stacey.
So, Scarlett, obviously the big headline this morning is jobs. We lost 23,000 jobs in July. The unemployment rate ticked down, but apparently that's because people are dropping out of the workforce. A lot of people speculating about what this jobs report might mean, and for markets, but also for the rest of the economy. And we have a great person here to help walk us through this. That's Amy Glazer, Senior Vice President at Adecco. Amy, welcome.
My pleasure.
So, Amy, talk to us about this jobs report. It's been a big point of discussion all morning. What do you see when you look at it?
So, July can be one of the more tricky months in the employment data due to seasonal adjustment effects, particularly in education. And while today's headline is certainly disappointing, what really stands out to me is that we're still seeing millions of job openings. In fact, job openings still outpace job seekers. Layoffs are relatively low, and we're continuing to see hiring in critical industries like healthcare. In fact, when you strip out the government losses, you actually saw the private sector increase in jobs in 33,000. So it's not a cause for panic yet. Although the labor market may be cooling a bit, it's not freezing.
And there are a lot of questions about the leisure and hospitality sector because those kinds of jobs got a boost right around the World Cup. But maybe, the World Cup was still running in July, so maybe not as much as we thought.
There certainly could be some noise due to the World Cup as well. I would caution people not to take this one data point as we're looking at other trends as well. So time will tell. We'll see what August and September look like. I fully expect the September surge to again rally us in the upcoming months.
Overall, Amy, are you bullish or bearish on the job market? Because I feel like we've been having this discussion, the job market's been in sort of a similar place for quite a while now, where we're not quite sure which direction it's heading in, where overall, historically speaking, it's in quite good shape, but it's not looking as strong or as vibrant as we want. Are you overall optimistic or pessimistic?
Overall optimistic, especially in the long term. So in the near term, we may still continue to see some volatility, but I do see employers are still hiring. They're not firing, and it's just a bit slower in terms of they're being more selective in who they hire. And the conversation has shifted from get me somebody today to get me the right person at the right time.
What are you seeing, Amy, in terms of AI and whether it's actually replacing certain jobs or how people are incorporating it into their work and therefore there's less demand for contractual workers?
Often caution people, AI will undoubtedly change jobs, just as the internet and automation did. But historically, innovation creates new opportunities alongside this disruption. And we're seeing job creation. You see data centers popping up all over the place. So in construction, new job titles being created. So what I really caution candidates, job seekers, and employees to do is be open, be flexible, and be willing to learn some new skills and traits to keep up with society. I always say, you're not going to lose your job to AI, but you might lose it to somebody who embraces it and uses it better than you do.
All right, that's a good way of putting it. Amy, thank you so much. Amy Glazer, Senior Vice President of Adecco, joining us from Florida to talk about jobs from where she sits. All right, we were talking with John Tucker earlier, Stacey, about these Dunkin' $10 gift cards that have become like the thing to do, the thing to get this summer.
Yes, I hadn't even heard of it. I didn't even know what the thing to do was.
Well, and it has to do with this marketing campaign by Pays. And Liana Baker, she is our managing editor for Deals. Usually we're talking about corporate M&A, but in this case, we're talking about deals for consumers. Liana, what is Pays, this digital wallet, and why are they seemingly giving out $10 gift cards?
Thanks, Scarlett. So I'm sure you've heard of Zelle. So it's the same banks behind Zelle have now come out with Pays. It actually came out a few years ago, but no one was using it because no one knew what it was and it wasn't taken anywhere. So to help popularize this digital wallet, there's just amazing deals this summer where they're essentially just giving out free money. And this is all backed by JP Morgan, Bank of America, Wells Fargo. These are just some of the banks that own the company which owns Pays.
So why are they doing this? Why didn't they just stick with Zelle? Are they getting something out of this that they weren't getting out of Zelle?
Sure. So there's a core business reason behind this. So whenever there's a credit card transaction, there's something called interchange fees, which is sort of jargon for, the fee that is paid to the banks for, helping process these transactions. But when there's a credit card transaction on Apple Pay or PayPal, for example, the banks have to give a cut of those fees to Apple, to PayPal, to Google. So by making their own digital wallet, their own competitor to these payment services, they're essentially keeping more fees for themselves. So ultimately, if this does become a popular way to check out online, it could be a really big business opportunity here where they just, don't have to pay a cut to Apple anymore.
Okay, so in order to disrupt Apple Pay and PayPal, these big banks are offering consumers ways to get these $10 gift cards. John Tucker was telling us something like you can get up to 10 of these $10 gift cards, so you could get $100 in free money. Is that right?
Right. So I don't know how many credit cards you guys have, but I have, let's say, 4 or 5 cards. So that means I have actually $500 in credits. There's no cap on how many cards you could use, but each card has only up to $100 in credits. It does not work on Amex. It only works on cards that are associated with the backers of Pays, which, as I mentioned, Bank of America, Wells Fargo, Capital One, JP Morgan, but that's a lot of credit cards. And some households, some of the people I spoke to, people have $1,000, $1,500, and these credits expire September 10th. So there's a bit of a, hustle. And even after the story appeared, a lot of people are reaching out to me asking me how they activate this. So just go on your bank app, however you look at your credit cards, go into your digital wallet. And
just keep talking because we're going to have to sign up. So keep talking. If you don't hear us asking questions.
There's a lot of steps, and it's a little clunky, but it is in your credit card apps for all of these cards, and you should get started. It doesn't just work at Dunkin'. Dunkin's one of the only places right now where you could get gift cards, but it does work if you check out at Wendy's online. It works at Sephora, Macy's just rolled it out. So there's a few ways to use it, but if you don't want to shell out too much of your own money, try to only spend just, $10. You need to spend at least 10 to get 10 back.
Okay, so beyond the initial promotion, though, is this a good deal for customers? Is it different from Zelle? Or the fees more or less?
So for customers, it's great because, it's free money. Some people compared it to the gambling apps, a few years ago that were offering just, free bets to get customers
or they're just
to use
luring
it.
you in.
It's a way to lure you in, but they're also pitching it, the banks, as a way, it's a more secure way to check out. You don't actually have to enter your credit card info. So once you activate Pays in your bank app, it's all through your banks. So it uses your Face ID to check out. So it's supposed to be like a more seamless and secure way to check out for items online. And they're targeting people that don't use Apple Pay, like, let's say, my parents' generation that are skeptical of online payments. That's really who they're going after here, people who might only be comfortable transacting through their bank.
Leanna, how much did you have to dive into Reddit and some of these credit card forums for these tips? Because there are people who are really, really obsessed. And, I might be one of them, but I might not be.
It was like, Scarlett, aren't you deep in subreddits about this?
Perhaps. But, there are people who, have figured this out, right?
That's how I first uncovered this story, actually, because it is one of my hobbies to look at maximizing credit card points, and it really does dip into the zeitgeist around using credit card perks, because it is sort of a perk, but it also works on debit cards, so that's a fun fact. But yeah, tons of Facebook groups out there. Some booted me out when I said I was a journalist, but lots of people are sharing strategies because it's not super straightforward. And the retailer list is changing by the day. And, some retailers have been, blocking some of it because there's just been so much activity during this promotion.
Okay. Leanna, thank you so much. She is managing editor for Deals, in this case, a consumer deal, not a corporate deal. I don't know about spending $10 for StubHub. There's no way you can buy anything for $10 on StubHub.
That's true. It's a little discount, I guess.
Yeah. All right. This is Bloomberg Intelligence on Bloomberg Radio. Good morning, everyone.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We are brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Stocks higher, bond yields falling. All on speculation. The Fed won't be forced to raise interest rates anytime soon. That's because we saw a big, sharp slowdown in the jobs market with the numbers out this morning. Inflation does remain a concern, but today's data may give policymakers more reason to remain patient. Airbnb, best performing stock in the S&P 500 after their earnings. Shares right now up 15%. And overall, the S&P 500, 45 points higher, up 0.6%, on track for another record close, 77.56 on the index. The Dow Jones Industrial Average up 138 points at 54,023, and the Nasdaq Composite Index up 310 points. That is a rise of 1.2%. $32 for an 8-ounce cup of coffee. Yes, it's here. A London-based watch house expanding to a 4th location in Manhattan this week. We plan to open a store next year in Los Angeles, scouting for spots in cities like Austin, Chicago, and Miami. The luxury coffee chain and the Bambino Estate at $32, the most expensive item on the menu at its newest location in Midtown Manhattan. And we check the markets and other stuff for you right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM insured municipal bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength, build a stronger tomorrow with BAM Mutual. All right, let's talk Munis right now. And we managed to drag Matthew Gastal in. He's our head of Muni strategy and research at Bloomberg Intelligence. He's also the host of a new podcast as well. What's the name of your podcast?
Oh, Masters of the Muniverse. Yes.
Good play on Masters of the Universe.
Thanks so much for having me on. I know we've done Real Yield and TV together, and it's fantastic to come over here after 25 years in Morgan Stanley and JP Morgan. So much going on with podcasts and with TV and radio, but a lot of exciting stuff.
Well, welcome to the Bloomberg ecosystem. It's far and wide. I want to start with how bond yields, treasury yields have kind of been all over the place over the past week. At the end of last week, the 30-year yield was at its highest in almost 20 years. You know, the 10-year yield was at like a 1.5-year high. We've come back down, especially today. But what has that meant for the muni market?
Sure. So it's meant quite a big deal. And I would say that in kind of looking at some of the price action that we're seeing recently, we're working our way through our 3rd consecutive year of record issuance in munis. And that supply has been extremely well received, right? When we look at everything from the perspective of relative value ratios of munis where they're trading versus other taxable counterparts, whether it's treasuries, agencies, or credit, whether it's credit spreads, right, extremely tight. Oversubscription rates in the primary market, also very healthy. Basically means that we're kind of, we're seeing this period where it's not only a matter of supply over the course of the past 3 years. What we're looking at is we think it's more of a story going over the past 20 years, right? And what that means is, and this will kind of help to relate a little bit to what's actually happening with rates right now, specifically when you go back and let's say we go before the great financial crisis, you see the treasury market has grown in size roughly 6 to 7-fold, right? Not to say that we're modeling ourselves after the treasury market, but that just kind of gives you a feel for the market breadth. On top of that, the corporate bond market has actually increased in size about double, right? It's doubled in size. The muni bond market has only increased in size by about 40%, right? So herein, when we look at all these other measures of growth, whether it's GDP, whether it's personal income, whether it's M2 money supply, whether it's tax revenues, right? You have these benchmarks where technically munis that market growth hasn't basically kept pace, right? And as a result of that, the market's kind of telling us with ratios, with spreads, with oversubscription rates, that it can receive the supply and maybe it wants to receive some of the supply. What that means from the perspective of rates is that we've been trading very tight, right, and very rich to treasuries and to other taxable counterparts. And what that means is, okay, so now if we're in a period where we see rate strength, basically we don't really have to move so much because we're already rich. It's almost like other rates, other kind of areas, asset classes are coming down to join the party. What it does mean, though, is that we're very susceptible to rate weakness. So if other yields go higher, we have little choice but to follow, and there'll be a crossover redirection of capital.
So what about the states and local governments themselves? Obviously, there's a huge infrastructure funding gap. I think it's close to $9 trillion.
Yep.
Are munis helping to address that right now, or how does that factor in?
So that's the perfect question, and it's kind of been one of the major initiatives as far as what we've been discussing in our research here at Bloomberg Intelligence is that, okay, so we have this market, right, where we've noticed really significant borrowing austerity over the course of the past 20 years. And again, to go back to what we were saying, when we were looking at ratios, spreads, right, oversubscription rates, the market's telling us that it can receive much more supply. To your point, now we kind of transition and we say, okay, from the issuer perspective, what do we need, right, as far as infrastructure needs and demands in the nation? And the American Society of Civil Engineers have basically forecast that we have close to $9 trillion. You hit the nail right in the head as far as those needs. On top of that, we also have, to be fair, an energy transition, right? Not just here in the United States, but also the world, right, with renewable green energy, right? So we're in this period where the market can receive the supply. We have significant demands or needs, right, in order to be considered in good condition. So it's almost like this really important marriage between the two of them. The one thing that I would probably add just very quickly on top of that is, due to the value of the federal tax exemption, right, post TCJA in 2017, we have the federal exemption in many states, right? We have the state and local exemption. We have the 3.8% Medicare surtax exemption. And now, even after one big, beautiful bill, we still have some limitation to SALT, state and local tax deduction. So that means in some sectors of the curve, investors are actually yielding or earning close to 7% TEYs. But when you factor in the reduction in the cost of capital because of the exemption to states and local governments, we're actually very close to being in line with historical borrowing averages. Hence, there's kind of like this nice equilibrium, if you will, between issuers and investors, not in the broader rates environment, but in munis at this time.
So, you mentioned tight spreads. We know that corporates are squeezing out treasuries. What's happening on the muni front? Are corporates squeezing munis?
Yeah, well,
I just got like 20 seconds to answer this, though.
Yeah, so long story short, fundamentals in munis coming out of the stimulus are extremely strong, right, from a fiscal balance sheet perspective. But the big thing there is it's not a fundamental dynamic. It's mostly technicals. We've seen, of course, that net supply growth to be so low that investors are now dipping down the credit curve, or have been for a long time, to try to generate or find some type of yield, right? So that's hence compressed the spreads, and we're really not keeping up as far as the pace is concerned with other markets. So that's, of course, helped, and it kind of helps to kind of push this advocacy, if you're more of a passive investor, toward buy and hold with high quality, because there's not as much compensation for the lower risks. So.
All right, Matthew. Such a pleasure to have you in studio. Thank you so much. Matthew Gastal is head of municipal strategy and research at Bloomberg Intelligence. He is also the host of Masters of the Muniverse, available on Spotify, Apple Podcasts, and anywhere you get your podcasts. All right, Stacey, you know a thing or two about Grand Theft Auto, the video game franchise, right?
Yeah. I mean, I know it's really huge. I actually had a cousin who sold a song to Grand Theft Auto, so it was one of the songs that you might hear on the radio in a car inside of the game. And it was a really big deal for them. They actually made quite a bit of money. It's a huge, very wealthy universe.
Yeah, it's a cultural, totem, basically.
Yes.
So many people live in that universe. And we're going to get a new update, Grand Theft Auto 6, GTA 6, for those in the know, at some point. Nathan Naidu is Bloomberg Intelligence technology research analyst. And Nathan, I say at some point because it feels like we've been waiting for the release of GTA 6 for months, if not a year. I remember talking about this quarter after quarter after quarter.
Yeah, actually, people have been waiting, especially fans. You say cultural totem. I think it's more like a cult at this point. Fans have been waiting for 13 years. That was how long ago the GTA 5 was released, and there is such a strong pent-up demand for this franchise. Yeah, exactly. And even in the last 13 years, still 18 million people play it every single month across PC and console, and it remains the third most played game of all time as of March. This just tells you how much there is a demand, and you can see the shares of Take-Two, the parent company, actually is trading up today. And that tells you that even though the guidance, which we think is on the conservative side, people still believe that the games might actually perform better than what the company is saying.
So this might sound like a naive question, but why did it take them so long to get this new version of the game ready? I am seeing here that the CEO has said that the expectations around this are, quote, terrifying.
Yeah, it is quite terrifying because, you know, there's a lot of estimates pointing to, I mean, as many as 85 million unit sales at the top end, based on sell side estimates, but I'm a lot more conservative on that front. And why it takes the company so long? It's a huge production. It takes more than $1 billion just to develop the game. And for context, I think a Star Wars or the Avengers movie cost like $500 million, and it's a long. There's a lot of aspects that go into the game. It's not just selling it upfront; it's also sustaining recurring sales for more than 10 years. I mean, because GTA 5 continued to perform in the last 13 years, and every year it continued to churn out, you know, 300 to 400 million in revenue to Take-Two and Rockstar, the maker of the game, even after upfront sales was captured in the first year. And GTA 6 should prove to be able to do the same. And actually, we can see in the online mode of GTA 5, which is the current version, like people still spend about $60 a month to play the game. And that's, for context, 3x the standard ad-free Netflix subscription. So there's actually, for those who pay, there's a cult following and people continue and they just can't get enough of this game. And you know, it's high budget. I guess the company just want to make sure they get it right because it's literally the make or break game of the century.
Nathan, we only have like 20 seconds left, but I'm curious. I'm sure they make this game available to reviewers. Do they make it available to analysts early?
No, there's no early access. But there's pre-orders momentum that we can gauge some early wins. Yeah, there's pre-orders, and pre-orders apparently is blowing past expectations. Like Newzoo is estimating that pre-orders is at 200 or more million globally, and you know they're expecting upward of 5 billion by end of November in gross sales. I mean, consensus is only pegging this at 4 billion or below. So that tells you how consensus even is being a bit conservative on that front.
All right, Nathan, thank you so much. Those are some big numbers there for this, the cult of GTA 6 due to come out, I believe in early November 19th to be exact. Okay, Nathan Naidu, our Bloomberg Intelligence Technology Research Analyst, joining us from London. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with his Bloomberg Business Flash. So the July jobs report shows 23,000 jobs were lost last month after some pretty substantial downward revisions to the prior 2 months that were reported. And the unemployment rate, that did fall to a 4.1%, but that's because workers continue to leave the labor force. So stocks are higher, right? That's because this data tells the Federal Reserve you probably don't need to raise interest rates at this point. Neil Dutta at Renaissance Macro says, meantime, the performance of the stock market is still closely related to artificial intelligence.
I mean, in some respects, it's defying gravity. It's very much supported by earnings related to the AI infrastructure build-out. I mean, in many cases, even industrial stocks obviously are sort of derivatives of the AI semiconductor trade.
And right now, the S&P 500, 47 points higher. That's up 0.6%, 77.57. The Dow Jones Industrial Average up 100 points at 53,986. And the Nasdaq Composite Index is up 347 points, up 1.3% right now. As far as the yields, after the employment data, two-year yield is lower, down over 4 basis. I'm going to call it 5 basis points at 4.19%. The 10-year yield right now, 3 basis points lower at 4.64%. So that, to some extent, in the driver's seat for risk assets. Bad news at the mall. This is a mall up in Syracuse, which is,
what's it called?
and the thing is gigantic. It's like one of the biggest malls in the country, Destiny USA Mall. The bondholders, these are the commercial-backed securities, which are secured by things like property and malls. The bondholders facing a loss of $350 million.
Wow.
So that was good enough for one of those red headlines crossing the Bloomberg terminal. We check the markets and the mall right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Scarlett and Stacey.
Thank you so much, John Tucker. Do you still go to the mall?
I like a mall. I grew up going to malls. I still like a mall, but sometimes the mall I grew up going to is still around, but it's a little
worse for wear.
Yes. Lot of open spaces in the mall now.
A lot of vacancies.
But like John was just saying, it is maybe not a banner day for malls, but a banner day for the markets. Things are up pretty much across the board, and this is after a pretty solid week. And we have Francis Newton, economic strategist and chief investment officer with Tuttle Wealth Partners, here to talk markets with us. Welcome, Francis.
Francis, can you hear us?
I can hear you. Can you guys hear me?
Now we can.
Excellent.
Oh, beautiful. Happy
Wonderful.
Friday.
Thank you. Happy Friday to you. Talk to us about the markets today and maybe slightly more broadly what you've been seeing in recent trends.
So we have a bunch of interesting things going on today. First of all, we had that massive sell-off in the AI trade that's broadly recovered. And the thing about it is people were asking me, is this the beginning of the end with the overvaluations and blah, 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 all this, is it in a bubble, et cetera? And I would contend that probably not, as long as our M2 money stock remains high. That means there's tons of liquidity in the system. And anytime there's tons of liquidity in the system, it's going, things sell off, things look a little cheaper. That internal AI trade rotates constantly. The liquidity is going to flow into those lower prices and keep us elevated, which is why we're nearing all-time highs, despite the fact that we have not resolved Iran, and despite the fact that, oil has touched the pre-war prices and has kind of baked itself into a range now, but rates have not gone back down. Even with this morning's jobs report, rates initially backed off, but they're kind of coming back up to where they were. So that's an interesting dynamic.
Yeah, that is interesting. I guess it feels like the path of least resistance is for higher rates, regardless of whatever signaling may or may not come out of the Federal Reserve. If that's the case, where do you go for some fixed income? The idea of fixed income, not necessarily the asset class of fixed income.
I mean, I could spend hours on with you guys about that. We at Tuttle are not a fan of bonds as a hedge in general. There's been more volatility in the bond market than there really has been in the stock market since COVID. And, you know, the problem is when market sell-offs occur because of higher rates, obviously yields are inverse to the price of bonds and people actually lose a lot in bonds. So we are favoring property and casualty insurance stocks because they're mostly bonds on their balance sheet, but they are running to not lose money instead of bond funds running to outplay the index, even if the index is negative. We also like preferred shares. People have to be careful and selective and educated and have a little bit of an underwriting capability to pick the right preferred shares, but you get a coupon on that. And then we also like pre-merger SPACs, very quintessentially pre-merger, because you kind of have a floor price and those floor, you know, that cash that's being held until there's a merger goes into treasuries. So we think there are better ways to access bonds than traditional bond ETFs, just because your access to bonds through those ETFs is much more sensitive to the kind of the volatility in rates.
Now, the bond market's much bigger than the stock market, and people do tend to trust it more just because it's quite so global in nature. Does the fact that the bond market is flashing red in certain ways, that doesn't make you nervous about the stock market?
Well, it does make me nervous about the stock market, but the thing about it is it will increase volatility around the stock market. Right now, the valuations and the all-time highs are based on the AI CapEx spend, and that correlates with liquidity. And the M2 money stock typically correlates with the S&P 500. When it goes inverse on the correlation, either the S&P falls to meet the money stock or the money stock rises to meet the S&P, and we don't see that breakdown yet. We do not yet see a blowout in credit spreads yet. So kind of those things where you'd say, yeah, rates is really threatening the stock market prices. Those mechanics are still well in play. We just haven't seen that flashing yet. As far as the bond market, the bond vigilantes, I don't know if we're allowed to say that on
we can.
Bloomberg, but we can. Excellent. No, they obviously came out and they sent a very strong signal to the Fed. And when you really look at it, the bond yields are the things that have Trump backing off, you know, whether you go back to Liberation Day or, you know, some of this with the war in Iran, because that is really the Achilles heel. We have to have continuous demand in the bond markets to paper over our debt, and our federal debt is extremely high. And so that's the thing that really moves kind of what the administration is doing. That's the thing that really moves what the Fed is doing. So I would say they're probably leading the charge.
If you want to steer clear of the AI trade, or at least look for shelter from the AI trade within equities, where do you go for that?
The best place to go is the halo trade, which I'm sure you guys have talked endlessly about. Those, you know, heavy asset, low obsolescence. What does that mean? It's sort of a new thought around the value play, right? The value play was like you go look for cheaper stocks, either price to earnings or price to book, and then, you know, they may be underpriced and then you may get a good deal on them. But now you have to confront the fact that they may be underpriced because they're getting disrupted or they're going to become obsolete. So now you want to go find stocks where they have tangible assets. You still have the railroad. Now, maybe AI is running the train schedules, but AI does not replace the train or the tracks. And those are probably going to be less volatile as the AI trade in and of itself, and now it's becoming more of a debt trade than a free cash flow trade, is volatile.
What are some of the industries that you look at that are maybe included in the halo trades?
Oh, it could be anything with hard assets, but mainly energy, you know, things that just we rely on as humans, transportation, you know, things that we just infrastructure-wise can't live without. So much energy is going to be involved forever in this new AI component that could become volatile around kind of different legislative measures, but it's just not going away. That demand is not going to diminish. And so I think that that's a pretty safe play. The way we like to do it is we like to take kind of the all-weather permanent portfolio. You know, we have an ETF that is, you know, backed by Porter Stansberry, and, you know, he likes those Lindy stocks that have made money for 100 years.
Right.
And we like to layer on top of that the thematics with the active trading. Mm-hmm. The active trading is important so that you don't get stuck in this bottleneck volatility. But that's kind of how we like to look at portfolio construction.
Francis, thank you so much. Francis Newton is economic strategist and CIO at Tuttle Wealth Partners, joining us from Tampa. This is Bloomberg Intelligence on Bloomberg Radio. Stocks flying high this Friday.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Hi, everybody. This is Bloomberg Intelligence. Stacey Vanek Smith filling in for Paul Sweeney today. I'm John Tucker, just jumping in for Scarlett. She's going to run to do her TV show. You know, on a day like today, what would be better than a Frosty?
Very little.
Have you ever had one?
Of course I've had Frosties.
But you know what? Nothing better than a Frosty on a day like today. But I might be the only one thinking that. Well, Stacey and I might be the only ones thinking about that. Wendy's pulling its outlook, also cutting their dividend. Dave Thomas is probably rolling in his grave.
Oh, I loved those ads.
Yeah.
He was great.
What was the other one? Where's the beef?
Oh, where's the beef?
Michael Hanlon, Bloomberg Intelligence senior restaurant and food service analyst, joining us now. Where's the beef? Or no, what's the beef with Wendy's?
Listen, I'm going to take the other side of that trade. I bet you Dave Smith is somewhere smiling. And
Dave Thomas, wasn't it?
I'm sorry, Dave Thomas. Yeah, is up there somewhere smiling because new CEO Bob Wright, who had previously worked for Wendy's for quite some time, has a really good plan to bring this brand back to glory. And he and his new CFO, Steve Cirulis, they did a phenomenal job turning around Potbellies. And I think it was a great first call for both of them. Yeah, sure, they cut the dividend and they retracted 2026 guidance, but that's really just to give them some time for their turnaround plans to start gaining some traction.
So what is the turnaround plan? Because I feel like this is such a tough moment for food companies. I mean, beyond just Cyclospora, but, you know, prices are going up, margins are getting thin, consumers are getting pickier. What is the plan?
Yeah, there's a lot of low-hanging fruit here because this brand has been severely mismanaged for some time. And so number one is going to be revamping the menu and making sure that there's everyday value on that menu. And what I mean by value isn't necessarily price. It's what you get for what you pay. You know, Bob Wright on the call mentioned that, you know, people come away feeling that the experience was worth it, you know, and being happy about their overall experience when they leave a Wendy's restaurant or drive-through. There's also a lot of low-hanging fruit in terms of operations. Operations have slipped. We see this when chains are struggling, right? When franchisees aren't making money in a restaurant, you know, they're going to pull labor, and then this ends up causing, you know, operations to slip further, right? And so there's an opportunity here for some retraining, adding labor back to the restaurants, and marketing. I mean, this chain had done such a good job with marketing for so long. You know, to your point, you're talking about the old "Where's the Beef" ads, but even, you know, more recently, like they had a great online presence with social media, a very snarky Twitter account that got a lot of attention. You know, I remember some years ago when Fortnite was in its heyday, they had a collaboration with Fortnite, and they had the Wendy's, you know, a Wendy character in the game that you could find in the kitchen of a restaurant, and all sorts of cool stuff and that's really fallen off, right? And so, you know, there's a lot, you know, digital, improving the digital marketing and the digital experience, loyalty, things like that are going to be another point of emphasis. And then the last one is like making the franchisees money. Right, you have to make your franchisees money so that they're motivated to build new stores. So those are the 5 primary points for this turnaround plan.
Okay, so they're telling the franchisees at this point, be patient. I guess that's the same message to investors at this point. When does this start to take hold? How patient do they have to be?
Well, listen, first of all, you know, I don't know. I bet you franchisees that listened into that call were very happy with it, right? Like what Bob said was, you know, this chain is not run by private equity groups. The franchisees are family-owned, people that he knows personally, right? And so, you know, what he said was turning this brand around was personal to him, right? And so, you know, I think the franchisee base is going to be energized, right, by having a guy in there that they know that has had a lot of success turning around Potbelly, that did a great job when he was with Wendy's, when Wendy's was, you know, a pretty solid competitor in the quick service space. So I think franchisees are happy with the change at the top. You know, how long is it going to take? It's going to take time. The good thing is they're lapping really, really weak comps in the second half. So management said that same-store sales are going to be down similar to what they've been down, which was down about 6% plus in the first half in the U.S. We think they're sandbagging it a little bit because comparisons are going to get easier through year end, and we think as a result, results are going to go from bad to less bad. You know, but the real turnaround will probably kick in sometime in 2027.
Another company we've been hearing a lot about this morning is Sweetgreen. They've just been getting hammered. Apparently, sales are way down a lot because of the Cyclospora outbreak. What are you thinking for them?
And say in 20 seconds, because that's all we have.
Yeah, listen, that company was in dire straits prior to Cyclospora. Obviously, this impacts them a lot more than everybody else because they sell a lot of salad. But they had their issues heading into this outbreak.
Okay, so it's more, I hate this word, idiosyncratic. Thanks, Mike. We appreciate it. Michael Halen, Bloomberg Intelligence, Senior Restaurant and Food Service Analyst from Princeton this morning. Stacey Vanek Smith, it has been a pleasure. Thank you very much for stopping by today. We appreciate it. And you'll be back, I think, Monday.
I will.
All right. We'll look forward to that. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on SiriusXM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on SiriusXM Channel 121, presented by Golden Crest Metals. Stay tuned for the latest news and industry research. Top stories, global business headlines are coming up right now.
From ABC News, I'm Chuck Sievertson. Todd Blanche has just enough support from Republicans to become the next Attorney General. He could only afford to lose 2 GOP votes, and 2 Republican senators already said they plan to vote against his confirmation. It all came down to outgoing Republican Senator Bill Cassidy, whose primary opponent received President Trump's endorsement. On the Senate floor today, Cassidy said he would support Blanche's nomination.
The choice is not between perfection and Mr. Blanche. It is between Mr. Blanche and another acting attorney general who may not run the department effectively under President Trump and who indeed may not be as good as Mr. Blanche.
The economy's top job generator continued to struggle in July. ABC's Jim Ryan says non-farm payrolls came in at a loss.
The consensus was for a net gain of 83,000 positions last month. Instead, the Labor Department has reported a loss of 23,000 jobs. The same report shows the no hire, no fire employment market still dominates. At 4.1%, the unemployment rate was essentially the same as the June figure, as was the number of unemployed Americans at 6.9 million.
A setback for this President Trump construction project.
In a 2-1 decision, a panel of judges at the D.C. Circuit Court of Appeals concluded that President Donald Trump exceeded his own authority when he set out to build a $400 million ballroom at the White House without congressional approval. The majority writing, quote, each president is a temporary tenant, not the owner of the White House, and that only Congress has the right to approve the changes. The ruling doesn't take effect for 2 weeks, and the Trump administration is expected to appeal to the Supreme Court. Peter Haralambous, ABC News.
Ukrainian long-range drones hit a warehouse of Russia's biggest online retailer in the Ural Mountains. Pakistan, Turkey, and Saudi Arabia have signed a mutual defense agreement. You're listening to ABC News. In Thailand today, a student opened fire at a high school outside Bangkok, killing at least 7 people, including students, teachers, and administrators. Officials say the 14-year-old also appears to have killed his 2 grandparents in the family home earlier in the morning. They say he took his own life at the school. More restaurant chains are pulling peppers off the menu. They're linked to salmonella. Sweetgreen now joining Chipotle and Qdoba.
Several national restaurant chains use the jalapenos tied to that salmonella outbreak. The CDC says it requested additional funding in the federal budget for food safety and has a dedicated team now supporting the outbreak response, working closely with the FDA and state health departments. And there are some positive signs on cyclosporiasis. Cases in the epicenter of Michigan, they're leveling off, and health officials there say eating bagged lettuce is now safe with the contaminated products off the market.
That's ABC's Lara Spencer. Amanda Knox is doing stand-up now. Knox was convicted, imprisoned, and later acquitted of killing roommate Meredith Kirscher in Italy 19 years ago. Kirscher's sister, Stephanie, tells Sky News that her family would like Knox to move away from Meredith's name.
The violence surrounding the theme is not appropriate for a platform at a comedy show.
Knox's show called Cartwheel, referring to a story claiming Knox did cartwheels in the police station after Kirscher's death. Chuck Sievertson, ABC News.
Live from Washington, D.C., This is Balance of Power with Joe Matthew.
Cassidy bows to Trump one more time. Welcome to the Friday edition as Republican Senator Bill Cassidy of Louisiana announces that he will vote to confirm Todd Blanche as the nation's Attorney General, despite strong misgivings and President Trump's decision to end the senator's political career. We're going to bring you the latest on a dramatic day on Capitol Hill with airplanes waiting at DCA when we talk to Nathan Dean coming up from Bloomberg Intelligence. Democrats converging on Michigan to get a piece of the action after this week's big primary there. We'll explore the divisions inside the party with our political panel. And what happened to the jobs? We'll also look inside this surprisingly weak July jobs report with Michael McKee. We'll dig into the market action today with Mike Regan, and that's where we start with the great Charlie Pellet. The Friday trade post-jobs. Charlie's live in New York. How's it going, Charlie?
Right now, higher across the board. Joe Matthew, happy Friday. Jobs Friday with the S&P now up 47, up 0.6%. A sharp slowdown in the jobs market driving stocks higher. Bond yields are falling, all on speculation that the Fed will not be forced to raise rates anytime soon. Right now, the Dow is up 95, climbing by 0.2%. S&P giving us a baseline up 0.6%. NASDAQ up 1.2%. NASDAQ 100 index up 1.3%. And the SOX, no stranger to big moves, both to the upside and the downside. The Philadelphia Stock Exchange Semiconductor Index up today by 2.5%. The VIX back below 15, the 2-year 4.20%, the 10-year 4.65%, and the 30-year 5.20%. Gold, meanwhile, up 2.5% to $43.45 the ounce. West Texas Intermediate crude up 1.3%, $78.31 a barrel, and Brent right now 83.62, a gain there of 1.3%. So again, we did see a slowdown in jobs. Administration reaction from Kevin Hassett, the White House Counsel of the National Director of the National Economic Council.
Private sector job creation was, right about at the break-even positive number. It was government employment that went down a lot, about 50-something thousand. And the other thing is that we see in the hospitality sector, the end of the World Cup is really clearly in the data too. If you exclude those two things, you had about 100,000 number, and that's consistent with all the other indicators like the purchasing managers being really high, unemployment, insurance claims being about the lowest they've been since World War II.
NEC Chair Kevin Hassett. Earnings news, Airbnb soaring after boosting its annual revenue forecast. Airbnb shares up by 15.2%. The rally for Hertz continues. Hertz shares up another 11.4%. We heard from Lyft this morning. The ride-sharing company up 3.7%. Rival Uber up by 5.7%. Recapping stocks higher. Oil advancing as well. West Texas Intermediate crude up 1.3%. S&P now up by 0.6%. And that, Joe Matthew, is a Bloomberg Business Flash.
All right, my friend, thank you. Down to just the last of us, by God. You need Charlie Pellet on that wall, especially on a jobs day, and we'll be back to Charlie in about 15 minutes with more on the markets, holding forth atop the Gilded Tower in New York that is our world headquarters. It's great to see you. Welcome. You made it to the threshold of the weekend here on Balance of Power. Bloomberg Radio, streaming live on YouTube, where you can find us by searching Bloomberg Business News Live. It's a great way to consume the program unless you're in the car right now flying around Boston, Washington, New York. It's great to have you either way because we've got a lot to talk about. And we still have a lot of questions to answer when it comes to geopolitics, the war in Iran with oil prices moving higher, although the President of the United States single-handedly goosing solar stocks. They're on fire today. As Charlie was talking, I'm looking at First Solar, up almost 5% today, and they're all ticking higher. Enphase, Array, T1, Next Power, and it's because of this polysilicon EO that you might have heard us mention on the late edition of Balance of Power. He got in the Oval Office, signed some executive orders last evening, ordered new 15% tariffs and a price floor for imports of polysilicon derivatives, including silicon wafers and the photovoltaic cells and solar modules that make up a solar array. So yeah, it's buy time apparently for the solar stocks. Everyone's getting their due, isn't it something? The so-called rotation that we will discuss a little bit later on this hour with the great Mike Regan. He's going to join us along with Michael McKee, as a matter of fact, to dig into the jobs report. Shockingly weak today. It was a decline, in fact, instead of the expected increase of 85,000. But we start with politics here on Balance of Power, and it's a big day if you're working in the Senate, because there's a jet at National Airport that's revving up right now waiting for you. I'm not kidding. We talked to a senator last evening, and I don't want to name names because I don't want to get anybody in trouble, but it was last evening on the broadcast, who said what the lawmakers do is they schedule like 3 flights. They're allowed to put 3 on the board. So you put one up tonight, then you put one up tomorrow morning, and maybe like lunchtime tomorrow, in the hopes of getting on one of those flights, and the airlines will give grace to the lawmakers for the other flights that they don't make. So they got all these stacked up, and they're looking at John Thune in the Majority Leader's office wondering, what are you going to do to us, Mr. Leader? Is this a working weekend? We did just check off the Attorney General, it looks like, because we've got government funding to deal with. Clarity is, well, we'll talk to Nathan about that. Appears to be on the side of the road to be managed another day. And we've got the Attorney General to potentially confirm before everybody runs out of Dodge. So let's bring you to the floor. This was 10-something this morning. Remember the YOLO caucus? There's not a lot left of them today. Bill Cassidy just cashed in his chips, having held up the vote for Todd Blanche as Attorney General. He had huge misgivings, remember? This is the man whose political career was ended by Donald Trump in a primary that he lost in Louisiana. So Bill Cassidy this morning says, I'm going to make an announcement, 10:40 a.m. I'll tell you how I'm going to vote. He gets all of Washington roped up. Everyone's got C-SPAN here. We had it on the terminal to find out the big news. And here it is.
This is not a referendum on President Trump. It is a decision regarding Mr. Blanche in very specific circumstances. All considered, I will vote for Mr. Blanche. I'll be criticized for this vote. What's new?
So he's a yes. And that's pretty much all we needed here, and it looks like a go for Todd Blanche. What'll happen to the rest of it? Can we get all this done? Because there's a 5-week recess waiting for everybody. And I started working already on the Russia sanctions bill. We got a whole bunch of nominees. We got a CR to fund the government. And there's only one man who can tell us what's going to happen. If you have a terminal, you probably called him today already. It's not very often I get to spend a Friday with America's dad. My good friend Nathan Dean is with us, the chief U.S. policy analyst at Bloomberg Intelligence. You're in the office today. This must be a big deal. All right, let's tick through them.
Yep.
Blanche is as good as done?
I think so.
We have an attorney general.
Yep.
Does that happen when they come back, or they get a floor vote as part of this whatever free-for-all tonight?
You know, I'll say is like, don't underestimate, like you were talking about, don't underestimate the desire to get out of town on a Friday night. So, you know, look, when it comes to Attorney General Blanche's or the nominee, whether it's today or in September, it really doesn't change things all that much. He'll still be, you know, the head of the Department of Justice between now and then. Yeah. So, you know, I think this is, if I'm Senator Thune and I'm trying to think of like what it is that I want to get off my plate today, the most important is that CR for December 11th. Because if you get that CR off your plate, there's only 14 working days when they come back in September. If you get the CR off that plate, it kicks the can over to the House. It becomes the House's problem. That opens up a couple of days for you to deal with things like clarity or the budget resolution. So if I'm Senator Thune, the CR is the one thing that I want to get done today.
Got it. Do we need a timing deal, or can he just kind of force everyone to get this done because they want to leave town?
Yeah, no, look, I mean, like, this is where he's going to have to use his relationships to say, look, I know you may want to drag out the process, but, it's supposed to be 90 with thunderstorms tomorrow. Do you want to be here with Washington, D.C.?
Right. He's talking to Democrats, though, in that case, right? So they need to get on board with the timetable.
They do as well, but they don't want to be here either. I mean, look, I think it was on one of your programs earlier this week, somebody said, like 90 to 95% of the senators don't want to be here right now. And so, I'll just say is that, look, in Washington, it takes forever. But I even think Patrick Mahenry said this yesterday on the early edition. They get more done within the last 4 hours before they leave than they do in the 4 months prior to that. Right. So I could see a lot of momentum later this afternoon kicking in.
Awesome. I love that you listen to this program when you're not on it. Thinking about some of the dysfunction that Mr. McHenry was talking about yesterday makes you wonder what kind of magic can happen here. Does the Russia sanctions bill fly? I know that's not really it doesn't have an investment angle, but if we start getting momentum, even with the nominees, that could help bring passage to everything else we're talking about.
Yeah, I mean, when it comes to the Russian sanctions bill, I mean, look, this bill has overwhelmingly bipartisan support.
Sure does.
I mean, this should not be a controversial bill because what it does is it gives President Trump another tool to levy tariffs. Now, from the investable angle, we are telling our clients, look out, because if President Trump does get this power, then if you are China, Turkey, India, or have companies exposed to those countries, you may get into a scenario again where you wake up at 3 o'clock in the morning Eastern to check the European markets, and there could be a Truth Social post saying there are new tariffs going up on Turkey or new tariffs going on India as a result of this.
Okay, got it.
So there is like this volatility risk that would come from this bill. But, you know, I think because due to the overwhelming bipartisan nature of this bill, you know, I think that they can probably seal this one fairly quickly. Well, I can't remember off the top of my mind if there's one or two senators that may try and hold it up, but this bill, if President Trump wants it to pass, this bill should pass.
Okay, got it. Clarity is another matter. This thing has been just a brutal process to follow.
Yep.
Your phone's been ringing off the hook for months, years? Well, I don't know, since we've called it, since the president came back to the White House. And now it appears it's not going to happen until they come back. Is that the death knell that some are making it out to be? Or could there be enough relief in a lame duck to get this done?
So I'm still optimistic, but I am going to probably lower my odds. My note will be out Monday or Tuesday. I'm going to sleep on it over the weekend.
All right.
I do owe a couple of mea culpas to some clients because I was fairly confident it was going to go before August recess.
Sure.
But the thing to keep in mind now is that we need to start preparing for a world of where clarity doesn't happen. And in that scenario, the SEC and the CFTC are going to start pushing out rulemakings to provide that clarity within their own powers that they can do that. That's great for crypto platforms like Coinbase and Robinhood. It essentially gives them until the end of the administration to operate in a regulatory-friendly environment. Now, if you get a new Democratic administration that decides to take a different view on this, then you probably within the first 6 months of 2029, maybe into bleeding into 2030, that's when the momentum will shift, and you really need to be careful because enforcement risk increases. So if I'm investing in Coinbase or Robinhood, at least from the regulatory perspective, I mean, don't get me wrong, there's a whole bunch of other issues with crypto at the moment, but from the regulatory perspective, if I don't get clarity, I at least get to operate for the next 2 years in a friendlier regulatory environment.
Okay, it's interesting, by the way, but Bitcoin is higher at the moment, not by a lot, but it's up 1%. There isn't a freak out, at least in the actual commodity space. But talk to me about the other side of this story. What do bankers think about nothing being passed? What does this mean for community banks worried about stablecoin yields and deposit flight?
Yeah. So, you know, it's not so much, it's mostly concerned about what is the future of banking. Is it going to be crypto? Is it going to be TradFi? But at the end of the day, that clarity for Coinbase and Robinhood means the banks may be operating at a disadvantage for the next couple of years.
So you get new odds next week.
Yep.
All right. You heard it from the source. Our dear friend Nathan Dean, have a great weekend. America's dad is not coaching until the fall. Good luck with the kiddos. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks higher, bond yields are falling on speculation that the Fed will not be forced to raise rates anytime soon. This after this morning's jobs report. We'll have a whole lot more with our Michael McKee coming up in just a moment on the employment outlook. S&P right now up 41, 77.51 where we stand, back above 7,700. We are looking at a gain now of just about 0.5%. The Dow up 93, Dow Industrials up 0.2%. NASDAQ and the NASDAQ 100 index both up by 1% or better. The Russell 2000 index of small cap shares also gaining. Right now, the Russell 2000 index is up by 1%. All of this with the stocks up by 2.2%. That is the Philadelphia Stock Exchange Semiconductor Index. 2-year currently at 4.20% with the 10-year 4.64%, the 30-year 5.20%. Spot gold is rallying 2.4%, 43.42 the ounce. West Texas Intermediate crude 78.44 a barrel, up 1.5%. Barrel of Brent 83.73. Brent crude now up by 1.5%. Sweet Green shares down by 6.2% after cutting its annual outlook due to reduced consumer demand for fresh prepared foods during the cyclospora outbreak. And Sweet Green has been trying to win over diners with cheaper options. Even so, sales at established locations down 6.2% in the second quarter. Also out with earnings this morning, Under Armour, that stock now down by 4%. Recapping, S&P higher by 0.5%. And for on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcast. I'm Charlie Pellet. Back we go to Washington, and once again, your host, here he is, Joe Matthew.
Okay, Charlie, thank you so much. Connecting the dots once again between Washington and Wall Street on this Jobs Day. Everybody's celebrating the fact that the thing came in much weaker than expected because it's a whole interest rate game now, right? It's good news on Main Street, bad news on Wall Street, or something like that. Interest rates are a bit lower here and stocks are higher, as Charlie's mentioning, and it all seemed to turn around about 8:30 this morning when the jobs report hit. It's just a huge surprise on the number here. We were looking for 85, 87,000, and we actually got a loss, never mind an increase in the number. And when you look under the hood at some of these portions of the report, Michael McKee will put a finer point on that, but we saw a bunch of declines. Leisure and hospitality, the participation rate was off a cliff. We're down to the lowest since the 1970s. So we talked to Kevin Hassett about it this morning on Bloomberg, the NEC chair, live from the White House, who of course, put a good spin on the numbers, and here's what he said.
I think the labor story is still going to be positive. I just think that it's not going to be as positive as it typically has. If you go back over 40 years, the labor story adds about like 1 or 1.5% every year to GDP. I think now it's likely to be about half of that or a third of that.
Elizabeth Warren out with a statement. Job growth in May and June was revised down by more than 100,000 jobs. That's true. Job openings have fallen, more people out of the labor force than any time on record. Is that true? And wage growth slowed. That is right, straining families' paychecks even more as they struggle to keep up with Trump's inflation, unquote. Of course, the top Democrat on the Senate Banking Committee. Michael McKee has been talking about this since it came out, and he's glad to say with us now. We go straight to the source. Live from New York, Bloomberg's international economics and policy correspondent. Where did everyone go? I mean, we're hearing like the FIFA unwind. Is this immigration influenced? What do you make of it?
Well, we can't say for sure, but we think that the leisure and hospitality decline, the total of 40,000, is probably related to FIFA. Not completely, but there were a lot of people hired to be in restaurants and bars and retail establishments who weren't needed after it was over, and to some extent probably weren't needed during the event itself. A lot of places reporting business was slower than they had anticipated. But the real issue was in the education departments of local states, because there were 50,000 people in theory off the payrolls there. And I think what happened is it was a seasonal quirk, the way they seasonally adjust the numbers, because normally those people would fall off in May and June when schools close, and for whatever reason they showed up in the July report. So that'll get reversed. But there is a good point that both Kevin and Elizabeth Warren made it, that job growth has slowed. And we see that in the revisions to the prior months, and we see that in the rest of the jobs report, because even areas where there's normally strength in the jobs sectors that usually have seen some strength, they were maybe positive, but lower job creation in the month of July.
I'll tell you, participation rate, and by the way, I just want to clarify, excluding the pandemic, was the lowest since the 1970s. When you see a number like that and then earnings come in below forecasts, what does that tell you? Shouldn't fewer workers push wages higher?
Well, that would be the classical theory, but what we're seeing here is reduction in supply at the same time there's a reduction in demand. There's fewer people out looking for work right now. The labor force has fallen, as Senator Warren said, and a lot of that has to do with the president's war on immigrants and then baby boomers retiring. And so there are fewer people looking for jobs, and so that should push up wages, except there's not a lot of demand for people at this point. So the unemployment rate falls a little bit, and average hourly earnings fall. And the bad news for the White House is that average hourly earnings are now on a year-over-year basis well under the inflation rate. So they're going to have to figure out something to do about that, or some way to talk about it, because that's not good news for their midterm prospects.
Right. Yeah. Well, so just in our remaining moment, what's this doing to your view on the Fed? Is the market right to change expectations on a hike?
Well, you see this every time we get a new data point. The market moves around. It's really about inflation still. And so the Wednesday CPI report is going to be key, and the markets will reset on that, their views of what the Fed is going to do. On the margin, it makes it a little less likely they need to hike. It certainly doesn't mean they need to cut. So it may portend more of a hold, but we'll see when inflation comes out, and we'll see what the markets do. Then I think everybody goes quiet until Jackson Hole.
We will meet next Wednesday with more to talk about here. Another brick in the wall with Michael McKee. Thank you, sir. Have a great weekend, Mike, as always. Bloomberg's international economics and policy correspondent on a jobs day. We only bring you the best around here as we turn to the market reaction. You've heard Charlie talking about it. It's been, well, pretty darn positive so far. Interest rates are lower, not by a lot. Couple ticks on the 10 and the 30, 4 ticks on the 2-year. And the S&P 500 is daring to move higher. Again, not by a lot. We're up about 0.5% right now. NASDAQ's looking better. It's up 1%. And we've been all over the place this week, but we've had some really strong moves. A couple of days ago, some of the best moves we've seen in the market in years, frankly, with, all 11 sectors in the S&P 500 moving higher. Do we continue this as we churn through the end of earnings reporting season? Mike Regan joins us now, Bloomberg News managing editor for equities. We got both sides of this story covered. And Mike, it's great to see you. How are we feeling about the jobs report this morning as kind of a new catalyst to lift markets higher with interest rate pressures easing? Can this rally keep rolling?
Yeah, Joe, I mean, we've clearly, we're solidly in that bad news is good news for the stock market sort of regime again, because as you pointed out, those yields have come down. Not a huge drop at this point. They're kind of creeping back up, but still down on the day. And when you look at the market leadership this year, these companies, the chip makers and the big tech companies benefiting from this AI boom, I mean, that's a very highly leveraged trade right there. Maybe not necessarily from the investors buying those stocks, but from the companies themselves are obviously engaged in a huge debt binge to build out all these data centers. So that makes them even more sort of sensitive to interest rates than they had been before. And they were already very sensitive. But obviously, when you're borrowing hundreds of billions of dollars to build out these data centers, buy these chips, hire the construction crews and all the materials you need, that makes them very sensitive to the interest rate environment. So a lot of the volatility and turbulence we've seen in the market in recent weeks is really tied to what the bond market thinks is next. Obviously a little confusion about what exactly to take away from Kevin Warsh and his comments and sort of this lack of forward guidance that the market had gotten used to. But clearly, when you see a number this disappointing in the payrolls data today, it takes the chance of a rate hike in September, if not completely off the table, certainly to the edge of the table at least. And we see that in the futures trading, the short end interest rate trading, that the chance of a rate hike in September is much lower now than it was, and that's really allows those AI trades to go off to the races when they see this rise in interest rates sort of turn around a little bit today.
It's pretty textbook. I mean, gosh, we're getting to be pretty predictable here. Once again, defensive names are cycling lower, and there's a bid under most all tech. Micron is losing ground here, but most of the Mag 7 are higher, chips are higher, and that'll be the way it is until the story is the reverse, probably in the next couple of days when oil moves up or interest rates move. With all of that said, Mike, a lot of analysts are just pointing to the fact constantly, and I know that we climb a wall of worry and all that, but the fact that we haven't had a legitimate 10% correction in a long time. Are we cruising for one?
I mean, I think it's always a risk, especially in this sort of late summer, August period. It's just a notorious period for stock market volatility. But on the flip side, if you do sort of take a step back and look at this earnings season that we just are almost all the way through at this point, I mean, the growth has been astounding, and not just in the tech sector, but I haven't looked at the numbers today, but I mean, we're looking at high 20s to almost 30% earnings growth for the S&P 500. That's almost unheard of. Now, if you really want to look for the cloud and the silver lining there, you could say, well, is this peak earnings? Are we going to head back down? And that's a valid concern. But it's been pretty broad-based earnings strength, and my colleague Jeff Morgan had a really interesting column out today.
Don't you love hearing peak earnings? Go ahead, finish that. I'm sorry.
I was saying my colleague had a really interesting piece out today looking at how margins are improving because of AI, not just for tech companies, but really all the customers of them as well.
Don't you want to keep hearing peak earnings, bubble, right? Because once everybody's convinced that this thing is going to last forever, that's when we run into trouble.
Certainly another risk, that complacency risk is always there. Your guess is as good as mine. Augusts tend to be a volatile month. We'll have to wake up on Monday. And obviously, the elephant in the room is the Iran situation. Where is this elusive deal to reopen the strait? Will it come, and what will oil do? I mean, that tends to be sort of the most important topic, is watching where that oil price goes, because the bond yields will follow it higher or lower, and the equity market will react in kind. So, another sort of weekend of watching the news flow and seeing where we are with that situation.
Thank you, Mike Regan. You go on the beach this weekend?
I am actually hitting LBI tomorrow, so
good job. All right. If you're around next week, I'm coming up to New York. I want to see you. Come on the program. We'll do this together.
Absolutely.
The great Mike Regan with us live on Bloomberg. By the way, oil prices, as Mike reminds us, they are a little higher today. We're up 1.5% for WTI and Brent. West Texas Intermediate, $78, Brent at 83. It's on to Michigan and our political panel next, only here on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all holding on to gains. Jobs Friday. We've got stocks advancing. Bond yields are falling on speculation that the Fed will not be forced to raise rates anytime soon. The S&P currently at 77.47, up 37 now. That is a gain of 0.5%. The Dow up 73, higher by 0.1%. Both NASDAQ and the NASDAQ 100 index are up by 0.9% or better. Right now we have got the Russell 2000 index also gaining 0.9%. The SOX is up by 2%. That is the Philadelphia Stock Exchange Semiconductor Index. Right now, the 2-year 4.20% with the 10-year 4.65%, the 30-year 5.20%. Gold up $100 the ounce to $43.40, higher by 2.4%. Traders keeping an eye on crude. West Texas Intermediate 78.25 a barrel, up 1.2%. Barrel of Brent 83.62, up now by 1.4%. As we have been reporting, employers cut jobs in July. Hiring in the prior 2 months was revised lower, suggesting the labor market is weaker than previously thought. The unemployment rate fell to 4.1%. As for the broader economic and market backdrop, Julia Coronado is president and founder of Macro Policy Perspectives.
There's just so many sources of uncertainty. There's just been massive shocks across sectors, from tariff policy, from shifts in regulatory policy, from changes in the drivers of GDP growth. The war is far from over. There's an election coming up that could change the policy landscape.
Julia Coronado of Macro Policy Perspectives, interviewed on Bloomberg Open Interest. Deal news on a Friday. Dream Finders Homes has agreed to a roughly $916 million deal to buy rival Beazer Homes USA. Right now, we've got shares of Dream, DFH, up by 2.5%. Beazer is down by 1.2%. Again, recapping the Dow, the S&P, NASDAQ, all higher. S&P up by 0.5%. West Texas Intermediate crude 78.17 a barrel. WTI right now higher by 1.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That Joe Matthew is a Bloomberg Business Flash.
Thank you, Charlie. He'll come back around top of the hour at 1 p.m. Eastern Time with another check on Wall Street here. See if we can keep the good feels alive as we head for the closing bell on a wild week here. I'll be deeply curious to see what the indexes did for the week when it's all said and done. And you will find that out on the late edition of Balance of Power. That starts at 5 p.m. Eastern. Right here, yes, on Bloomberg Radio and YouTube. Search Bloomberg Business News Live to catch our video feed. Are you ready for the Socialism Telethon? This is what America's looking for, right? On their TV sets, the 9th and 10th of September. This is the whole new idea of a midterm convention, because the ones every 4 years that the networks are reluctant to run as it is are clearly not enough. You know, there's a reason why we have these conventions every 4 years. It's not just like a video brochure for the party, and there's a lot of that. There's an actual nomination that takes place. There are delegates, you know, they travel from around the country, they gather by state, and they vote on a nominee. Delegates, superdelegates among them, depending on the party. And there's only going to be one this time. Democrats decided not to do it. Republicans are going for it. They've chosen Dallas for the location, and they're going all in on a midterm convention. As I mentioned, September 9 and 10 at the American Airlines Center. And you better believe Bloomberg's mobilizing. We'll have all kinds of coverage down there. Kaylee's going to be going. Am I supposed to talk? Probably not supposed to talk about that, but you can mark it on the calendar. Kaylee Lyons, Julie Fine, Republican Party in Dallas. I'm watching. We're finally learning, though, about what they're going to do. It's only going to be 2 days, and maybe this will not come as a surprise, but they're going to have the first night keynoted by Mr. J.D. Vance, the vice president, and the final night, yes, President Donald Trump, who will be in the hall for the entire thing. Somewhat more that we have learned. I guess Marco Rubio is going to be a speaker. And they're going to have a video trove, as I read at Axios, of Democratic candidates like Abdul El-Sayed, James Talrico, and others saying crazy things from over the years. This is, I guess, this is the socialist telethon that we're talking about. Every day, Americans will be up there along with the vice president's anti-fraud task force. What kind of a show is this going to be? There'll be RFK Jr.'s Maha movement on stage. Maybe he'll do some cooking. Have you seen the new cooking show? And celebrities as well, as we read here. So I guess we'll have Kid Rock and others. The question is, will anyone run it? Networks already give the parties a hard time when it comes to primetime coverage. That's why they kick them over to cable news. And you do wonder how many of these guys are going to get on TV. Rubio, Bessent, and other admin officials will have big speaking roles, as will UFC figures. Now, before we get there, it's on to Michigan. This has already started, and it's a fascinating thing to watch after this week's duke out in the state of Michigan between Democrats. The aforementioned El-Sayed won that primary, and now everybody is getting on an airplane to go to Michigan. You need a piece of the action here. Try to harness the energy. The first to show up, Mayor Pete. Yes, former Transportation Secretary Pete Buttigieg headlining a unity rally today in Detroit. There's a lot of those going on. They had the Unity Pancake Breakfast yesterday. They'll probably have the Unity 5K this weekend. Andy Beshear hit the ground on Wednesday, did a business roundtable. He's not stumping with anybody, but he had an event with the pipe fitters, and you know what that means. Gavin Newsom will show up tomorrow for a grassroots, I read, close touch swing. He's got stops all over the place and will consider the thought of, stumping with El-Sayed. Mark Kelly called this week to check in. Maybe he'll show up soon. Ken Martin on the phone. Is Michigan now the center of the political universe in America? Let's assemble our political panel. We've got a great one today. Bloomberg Politics contributor and Democratic analyst Jeannie Shanzano is with us, Democracy visiting fellow at Harvard Kennedy School's Ash Center, and always great to see Maura Gillespie, Republican strategist, Blue Stack Strategies. What do you think, Maura? Prime time with Kid Rock? Is anybody going to carry this, and what will be the impact on campaigns? Is this a fundraising event? Because obviously it's not a nominating convention, so why are you doing it?
I think this is very much interesting timing as well, given that the president has just given this interview earlier this week or yesterday, saying basically that he doesn't really care what happens in the midterms because he's not running. He's already won his race. And so how much he feels like supporting other Republicans, he's not really sure. But yet he's going to have this not convention. So I do think that's interesting timing. I do think it's a platform for the president and his team to fundraise. I think it's their effort to see how much of an impact they still have and what kind of a draw they can have. Impact, I mean, by what they can get the networks to cover, and draw by who shows up and how much they're willing to pay to show up and watch them on stage. And so, unfortunately, I don't think this necessarily helps Republicans who are looking to get elected when you have some big fanfare thing. I don't know how much it will cost to go. I don't know what the price tag is on it as of right now. But I think when you juxtapose that with the cost concerns we have in this country right now, it's not a great look.
Well, I'm guessing, Jeannie, you're not going to Dallas. Correct me if I'm wrong. But I wouldn't be surprised if you were going to Michigan. I'm fascinated by this. After what was framed as a potentially damaging primary for the party, all the bad blood, you picked the wrong guy or gal, depending on the outcome. Democrats were angry at each other in this progressive versus moderate contest. Now we can't get enough of it. Are candidates like the ones I mentioned, whether it's Gavin Newsom, Andy Beshear, Pete Buttigieg, flying too close to the sun here?
No, Joe, all of our focus on the upcoming midterm, what we didn't realize was Wednesday morning started the race for 28, and they are all, as you mentioned, out in Michigan trying to test the waters, if you will. Andy Beshear, who you just talked to on Balance of Power the other day, he has been there, as you mentioned, hours after, or just even before it might have been, the race was called. He's going back next week. Of course, Buttigieg has this big unity fundraiser today. And interesting with Buttigieg, he remained neutral in the Senate race. or the Senate primary, which allows him to be a unifying figure today and going forward, again, testing the waters. And then, of course, Gavin Newsom, he seems to be everywhere, although interestingly, not yet with Abdul Al-Sayed, but they, I guess, are in talks to appear together. So everybody is out there trying to feel out what they can do about Michigan, because, of course, it is a must-win state, and it's sort of where the Democrats find themselves trying to unify these two coalitions. It's got to be done in a purple state and purple area like Michigan. So 2028, Joe, don't even worry about the midterms. We're off to 28.
Yeah. It sure feels like it. Maura, is Michigan the new New Hampshire, the new Iowa?
It's interesting, I would say, because I think that there are still a lot of concerns with this rift between the Democratic Party's kind of sides. I think that Al-Sayed, who had, said that he was fine campaigning with Hassan Piker, is going to be a line in the sand, I would hope, for maybe those more moderate and Democrats who care about what their reputation looks like if they align with someone like that. I think it's a decision that they will need to make, and I would hope that they're held account to it and they're asked directly about where they stand on someone like that being under their Big Tent umbrella. But I think when it comes to this race particular, the polls were wrong. They showed that he was ahead by 16, 20 points. I mean, I think that it was a lot closer, obviously. Yes, he still pulled out the win, but it doesn't show necessarily that the people who they thought were going to be behind him actually showed up.
Interesting. The Politico talked to some of the folks in Michigan about their view on this, including Mallory McMurrow, Jeannie, who, of course, this is the state senator said to be a rising star in the party. And a couple of months, when we go back a year, there were a lot of people thought this might be a layup, that she would in fact be the nominee. She came on the program here to talk about it. Dropped out of the primary last month. She was asked about the unity breakfast that took place yesterday. The pancakes, I understand, were fabulous, Jeannie. But also, what does Al-Sayed need to do? She said, to his credit, he asked for feedback about what he did well and where he could improve. What did McMurrow tell him he did well? He said, you got the message right. It was sticky and repeatable. What can he improve then? Being able to recognize there are good people, this is interesting, Jeannie, who just have a slightly different worldview is going to be really important. It is not turning everybody into an enemy. Is that the most important lesson for him?
I think it is one of them. And, to her credit, she not only left the race when it looked like she couldn't win it, but she has worked with Al-Sayed. She has endorsed him, of course, once he won the race. But he's got an uphill battle. You look at those numbers, and to Maura's point, you look at those numbers. If you took Stevens and you took her numbers and you put them together, it is likely Al-Sayed would have lost. Now, those are big ifs. But, even though she dropped, she still got some support at the polls. She was still on the ballot. So he does have his work cut out for him. And if this is big for the midterm, but it's also big for 28, because if Al-Sayed can't pull this off in Michigan in this environment with Trump's numbers so low and Michiganders so frustrated, then you're going to see the 28 team veer to the center, the 28 contenders, if you will, veer to the center. So this is about the midterm. It's about Michigan, but it's also about what happens in 2028. And so can he pull them together? I think he can. He's going to have to work hard, though. He only has 13 weeks to do this. So good news is he's asking for support, and he's also asking for advice from Michiganders who have been there and who are establishment and moderate and know how to appeal to both of these constituencies, particularly the working class and blacks, important coalitions for Democrats that he did not do well with.
Well, this is an awfully important moment for the Democratic Party. Maura and Jeannie, we have breaking news. It's not what I thought we'd be talking about today, but the president is very concerned about construction at the White House and specifically the ballroom. If you just give me a minute here, this came after an appeals court today ruled that President Trump must seek approval from Congress to build the ballroom, saying construction must stop. This is the U.S. Court of Appeals, siding with preservationists who sued to stop construction. The president just went on Truth Social with a post that's so long, I'll crash into the news here. Let's get to the point. This unjust decision, he writes, must be overturned by the Supreme Court in its entirety. Thank you for your attention to this deeply important national security matter. He always says they're going to put a drone port in there, right? The ballroom is going to the Supreme Court. Jeannie and Maura will be back in our second hour. Thank you both for a great panel. Kaylee's on the way in, and we'll welcome our global television audience to the fastest show in politics on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Wall Street celebrates the incredible shrinking job market. Welcome to the Friday edition as the July employment report brings a surprise decline in payrolls, even as the markets expected an increase of tens of thousands. Changing some expectations for a rate hike today, stocks seem to be behaving well as a result. I'm Joe Matthew alongside Kaylee Lines in Washington, and thank you for being with us here. We're back to bad news on Main Street, good news on Wall Street.
Yeah, I guess it depends on your view on how bad the news actually is, because yes, payrolls did decline by 23,000, plus you had downward revisions to the prior 2 months, but the unemployment rate ticked lower to 4.1%, which is the narrative that the White House is seizing on today. And the National Economic Council Director Kevin Hassett said that's the number he's watching, but then we have to consider unemployment is lower because fewer people are participating. Participation outside COVID is now at the lowest level we've seen since the 1970s.
Surprisingly low number here. That's not, incidentally, what the president is posting about, by the way. He's talking about the ballroom. This just hit right before we began this hour, taking the case to the Supreme Court after an appeals court today ruled that he must stop construction without the approval of Congress.
Yeah, and it's not clear that he can get approval of Congress on that or other matters that he prioritizes, like portions of the Save America Act, which are embedded, of course, in this budget reconciliation package that may or may not get a procedural vote in the Senate today. They're instead dealing with a few things. First, they're voting right now on a Russia sanctions bill that does have the votes to pass. While the vote count is not final, it does look indeed like that is going to be sent over to the House. Plus, the votes are there for the confirmation of Todd Blanche to be Attorney General after Senator Bill Cassidy said he will be a yes on that confirmation.
Pretty big moment this morning. Didn't see it coming. In some cases, when you announce you're going to have a moment like that, it's usually not as easy as saying yes, but that in fact is the case. So it looks like the United States will have a new full-time Attorney General. Be curious to see if they get it done before they leave town, though, when it comes to a full vote.
Yeah, the jet fumes are in the air. They might want to just get out of Dodge. We'll get to all of that this hour, of course, but we begin with these jobs day markets, and for that, we turn to Charlie Pellet in New York. Hey, Charlie.
Hi, thank you very much, Kaylee, and happy Friday to you both. Employers unexpectedly cut jobs in July. Hiring in the prior 2 months was revised lower, suggesting that the labor market is weaker than previously thought after surprising strength earlier in the year. Non-farm payrolls down 23,000. Stocks higher. Oil also higher right now. Let's begin with crude because West Texas Intermediate back above 78 a barrel, 78.13 right now, up 1.1%. Barrel of Brent 83.38 heading into the weekend, up now by 1.1%. S&P is a baseline at 77.44, up 34 points, up by about 0.5%. The Dow higher as well, up 78 points now, up by about 0.1%. We've got NASDAQ up 254, up 1%. NASDAQ 100 up by 0.9%. Big move for the stocks today. The Philadelphia Stock Exchange Semiconductor Index up now by 2.1%. The 10-year currently yielding 4.65%, the 2-year 4.20%, and the 30-year 5.20%. Gold up $93 the ounce to $43.32, up 2.2%. And again, WTI up by 1.1%, $78.12 a barrel. Earnings news, we've got Sweet Green shares plunging by 8.4%. The restaurant chain, the salad chain, did cut its annual outlook due to reduced consumer demand for fresh prepared foods during the Cyclospora outbreak. Also, we've got Under Armour, I should say, forecasting a sharper revenue decline than previously expected after earnings. Under Armour shares down now by 4.1%. Recapping, stocks higher, S&P on this Friday up now by 0.5%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And that, Joe Matthew, is a Bloomberg Business Flash. And Kylie Lines, too. There you go.
Thank you very much, Charlie Pellet, bringing us through these markets as we close out the trading week. And it looks like we maybe are on track to close out this week in Washington in the United States Senate, unless this does bleed into a Saturday session, as they've been taking care, as best they can, of a number of different agenda items. And if you've been listening or watching this program this week, you know that included the confirmation of Todd Blanche to be the next Attorney General. There was very much a question as to whether or not they could get to the requisite amount of votes to get the president, his nominee, confirmed, as they already lost Senator Susan Collins of Maine, who's up for re-election. As of 6 a.m. this morning, they had also lost the vote of Senator Lisa Murkowski of Alaska, and those were the only 2 votes they could afford to lose. A third would have tanked the nomination for the first time we've seen in decades. So it was all up to Senator Bill Cassidy of Louisiana, who took to the Senate floor in dramatic fashion to announce that indeed he would be a yes.
Mr. Blanche is not perfect, and he will tell you this. But the choice is not between perfection and Mr. Blanche. It is between Mr. Blanche and another acting attorney general who may not run the department effectively under President Trump and who indeed may not be as good as Mr. Blanche.
That's where we start our conversation with Josh Wingrove. Let's get the latest from the White House right now. Bloomberg White House correspondent live on the North Lawn. Josh, always great to have you. Was that the decision that lawmakers had to make, approve Todd Blanche in case, or to keep the president from appointing someone worse?
I mean, it's one way to frame it, I suppose. You know, as we know, the backstory here is Cassidy has been a foe of the president. The president's gone after him, supported a primary against him, and it really has not bit the president very much yet. Of course, we saw the same thing in Texas with John Cornyn. And so the question was, Cassidy didn't really have a lot of reason to go to bat for the president, and that's what made today's announcement pretty surprising. Senator Cassidy kind of choked up towards the end of it to give you a sense of at least the weight of the moment that he felt. But Trump world had been pressing for this, both sort of acknowledging that Blanche has been at risk, but also expressing confidence that in the end he would be confirmed, including, of course, after that deal to get him out of committee. And so in some ways, I think they'll be taking a victory lap here, but not be too surprised on it. Of course, what appears to be our new permanent attorney general or confirmed attorney general, former lawyer of the president, and it just goes to show you that Congress continues to back, essentially, or the Republicans in Congress in particular, of course, back what the president wants to do. So it's a surprising one. I suppose you could say in some ways Murkowski's announcement nodded to it, in that she might not have come out with her no vote had she not known that she had the wiggle room to do that. But that's just pure speculation on my part as I melt here like an ice cream cone on the North Lawn here on this Friday. But yeah, certainly they're going to be celebrating him in the in the building behind them.
Yes, indeed. We appreciate you suffering the elements for us. And one wing of the building behind you, of course, is not visible to our audience on television, and it's not visible unless from above. There's just a giant hole in the ground where the East Wing used to be. That, of course, is where the president wants to construct his ballroom, and a judge today ruled if he wants to continue to do that above ground, he must get the authorization of Congress. Cue President Trump taking to True Social, Josh, to pledge to take this case all the way to the Supreme Court. What do you make of that?
I think he continues to be very focused on the renovations on this building. Not only that, but the helipad, which we saw reporting, of course, this week, that they've been kind of ripping it up to go restart what he's doing. The risk for the president here is this is muddying his message, right? So he's going to take this to the Supreme Court, essentially keeps the fight going. He's talking about it on the stump. I was with him when he gave a speech in Vegas a couple of days ago. And that speech really focused on what he casts as the strength of the economy. He's talking about Iran and hoping it will end soon. He veers into the renovation projects regularly, including the ballroom. And the question is whether that is, ultimately what voters will respond to, right? Polls are showing voters are very frustrated with the state of the economy, that Trump is underwater on his handling of the economy, which is normally a strong suit for him in polls, and that his overall approval rating is at or near all-time lows. Trump dismisses these polls as fake. But I just think what we're going to continue to see as this legal fight drags on is just a profile from it, whether it's those or the reflecting pool, I should add. And the president just continues to be very interested in them. So I don't think I'm not surprised that he's going all the way to the Supreme Court. We'll see what they say. They've given him a lot of leeway to date, and so read into that what you will. But the saga on the ballroom will continue to go, and the president just keeps wanting to talk about it.
Can we ask quickly about jobs? Josh, this is a big story today, and we're about to talk to Jared Bernstein, who you used to speak with pretty often in the Biden administration, to get his take on these numbers. I haven't seen anything. Maybe I've missed it from the president. Are they celebrating this report to the extent that Wall Street is?
Yeah, I mean, Jared stood here often during the Biden administration, so I'm trying to keep his podium warm here at the Bloomberg tent. They are essentially shrugging it off right now with saying, look, these are high variance numbers. This is an aberration. They noted that the consensus estimate was higher, essentially saying that's a good thing, that maybe the experts are right. Of course, by the way, when the numbers beat consensus, they say, the experts don't know anything, so they couldn't pick their lane on that one. We'll see. But right now, I think Trump, one revealing comment from Hassett today is that one of the only economic indicators he says he's looking at is that unemployment rate. Kaylee, I believe you alluded to that earlier, and I think that is telling right now. Trump likes to talk about the strength of the stock market, all-time highs, all that, but one of his top economic advisors saying they're really watching that employment rate. And so I think that is telling. There continue to be mixed signals at best in the economy. Of course, if you listen to the president's speech, you wouldn't necessarily hear that.
All right, Josh Wingrove, we'll let you get into the air conditioning. Thanks for joining us, Bloomberg White House correspondent, live from the hot North Lawn for us on this Friday.
63% humidity.
Yeah, that's brutal. I don't envy Josh right now. We're in a nice air-conditioned studio ourselves. We have the good gig today. And, of course, as Josh alluded to, Jared Bernstein has braved those elements on the North Lawn of the White House many times during his tenure in the Biden administration as the chair of the White House Council of Economic Advisors. He's now Distinguished Policy Fellow at the Stanford Institute for Economic Policy Research and is back with us on Bloomberg TV and radio. Jared, good to see you, as always, here on Balance of Power. As Josh was touching on the end there, the White House says just look at unemployment, 4.1%. But I wonder in your mind how much that lower unemployment rate has to do with the 61.4% labor force participation rate and whether or not that actually is cause for concern.
First of all, it sounds like the labor force participation rate is awfully close to the humidity rate on the White House lawn. I don't know that those two numbers usually appear together. The reason they like the unemployment rate this morning is because it ticked down 1/10. If payroll jobs had been strong, they would have said they like that. So that's all just spin. One of you made, I think it was Joe a second ago, said something to the effect that the unemployment rate ticked down for the wrong reasons. And that's correct, and it's important. The unemployment rate can go down for two reasons. One, people looking for jobs leave unemployment, they get a job. Two, they give up. And that shows up as the labor force contracting. That's what happened in July. We saw a lower labor force, and we also saw lower employment, not just in the payroll survey, but in the household survey as well, the survey that measures unemployment, and that's actually been a sequence lately. So we've seen quite weak numbers on the household survey, and that's obviously a sign of increased lag. That said, 4.1 is still pretty low unemployment, so no reason to panic, but certainly a soft report.
Did they give up, Jared, or did they just go away? When you see a participation rate falling to, it's actually 61.4%, lowest since the 1970s when you exclude the pandemic. We've heard a lot of explanations here that include even the impact of the president's immigration policy. Where did everyone go, or are they on the couch giving up, looking for work?
Well, the problem with using the top line number, and we all do it, and it's right there staring you in the face as soon as you open up the report, is it also includes a lot of older people who have left the labor market because we have an aging baby boomer workforce. I can speak from personal experience in that regard. But if you look at the more narrow, what we call prime age, 25 to 54-year-old, we got a big tick down in the employment rate or the labor force participation rate in June. And a lot of people thought, well, that's surely going to correct in July because these numbers are noisy month to month. It corrected a tiny bit. But I think if you look at the trend year over year, or again, look at the prime age rate, you see some softness there. And so this remains to be a no hire, no fire job market with pretty weak job creation, relatively low unemployment, not a ton of layoffs, but real fragilities under the hood.
Well, and you have some softer wage growth as well, Jared, and obviously that has implications for the American worker, which is facing inflation and may not be seeing their wages keep up. But also, does it not have impact on the way in which the Fed is considering inflation here if you're not seeing the kind of wage price side of things that you might expect?
All really interesting and important questions that I dove into in my write-up this morning. 3.2%, that's the year-over-year wage growth. That's the lowest we've seen in nominal yearly wage growth since the pandemic. And by the way, if you stack that number up with a bunch of other wage reports, as you should, again, these can be noisy numbers, but if you take an average of everything out there, you get the same pattern. And so the folks at the Fed recognize that whatever inflation we're seeing isn't coming from the labor market. It's not coming from the wage side, but we know that the more hawkish contingent over there, which seems to be growing, are well aware of that, and they're still nervous about high and sticky inflation. That means that it's largely coming from the supply side of the equation, the tariffs, the war, along with some pressure from AI picks and shovels. The question for them is, can they really look through that? Or after month, year after year of missing their target, do they have to worry about this pattern dislodging inflationary expectations, in which case they would hike? But I don't want to let the consumer get lost in this picture. I mean, you guys started off talking about Main Street, Wall Street. Boy, are they going in different directions right now. 3.2% wage growth is almost certainly below inflation, which has been tracking well north of 3%. And we know that labor share of national income actually hit an historic low in the productivity report yesterday. So there's a real split between macro and micro these days.
A huge split. Jared, it's good to see you, and thanks for weighing in on all of this. I'm glad you're not sweating it out on the lawn today. Jared Bernstein, Stanford Institute for Economic Policy Research, of course. It's going to be an interesting opportunity here, Kaylee, to get the take of a fixed income specialist. Tom Tsouras, Managing Director, Head of Fixed Income at Baird Strategas, joins us right now from World Headquarters in New York to talk a little bit more about the market reaction and expectations for the Fed. Tom, thanks for being part of our conversation today. What does this mean for Kevin Warsh? Does it take off the pressure that the conventional wisdom is implying today?
Yeah, well, good afternoon, and thank you for having me here. Yes, absolutely. If you take this report at face value, then absolutely this takes that September and very likely even in October, December rate hike off the table. But as a previous guest mentioned, you kind of have to look at this report and say, well, there's some potential here that you got some variables moving in one direction. You got unemployment rate dropping, but it's dropping for the wrong reasons. There's a lot of variance in this report. So for now, if you just look at this for what it is, you'd say, okay, we got wage growth of 3.2%. That is certainly not inflationary. You have essentially job losses. That would be consistent with the Fed on hold in September, at the very least on hold in September.
Well, if the Fed does hold in September because you aren't seeing the pressures on the labor side of the equation, that would look to them to be concerning if they were to tighten policy, but you still see sticky inflation. If that's what we end up seeing in the CPI report, could that just continue to fuel the narrative, Tom, that the Fed under Kevin Warsh may be willing to let inflation get away?
Well, for those who want to sell that narrative, that will definitely fuel it. But for those who look at this and say, okay, well, why do we have somewhat stickier inflation? Well, we have goods inflation. And over time, I hate to use this phrase, but goods inflation over long enough periods of time does tend to be transitory. It does tend to average about zero. I'm still worried about the service sector inflation. So I would look at this report and I'd say, okay, we have a somewhat of a supply shock. It is predominantly driven not by tariffs, but by energy prices. And you don't tighten into a supply shock. That's a policy mistake. We've learned that time and time again. So if you're Kevin Warsh, you look at this and say, okay, I have goods inflation driven by energy prices rising. That is not something that I'm going to tighten into at this point, especially with a labor market that looks like on the surface it's softening.
Yeah. What's the bond market telling us more broadly here, Tom? We're down a couple ticks, but it was just a week ago, the 30-year crossed 5.2% and heads exploded in the market. Remember that day the Dow was down over 1,000 points? That was the Fed day. That's when there was great concern about Kevin Warsh's posture. We're still above 5.2% here, and the stock market is cruising along like it's not happening. What is this telling us about future prospects for our economy?
Well, what it's telling us is that we have a Fed chair who is finally willing to put the power of the purse back in the hands of the bond market. For the last decade and a half, we've had essentially a bond market that has been put into, for lack of a better term, a medically induced coma, where there's been no real ability to push back on fiscally imprudent policy. Now Kevin Warsh is, and he's the first Fed chair we've had really since Greenspan, who is willing to say, listen, the Fed's balance sheet is too large. It has resulted in a blank check to government, and that has to stop. So the bond market is saying Kevin Warsh, if he gets his way, is going to, at some point in time, begin to shrink the balance sheet, either in absolute terms or at least relative to GDP. And what that means is
vigilantes are unleashed.
Yeah, vigilantes are unleashed, and that's bad for both political parties, especially in 2029 and beyond. But as of right now, the bond market's got to look at this and say, okay, well, we've got to start building some risk premium into longer duration treasuries, because the balance sheet is not going to be a source of stabilization for long-term interest rates. That's really what is being said. That's what the market's saying. But there's this narrative that he's losing control of the bond market. Well, the Fed should have never had control of the bond market in the first place. The bond vigilantes, the way I like to think about it is, the bond market has always been the final check on bad government, whether it was by dictatorship or democracy. Let's put it back in the hands of the bond market and not in the hands of policymakers in D.C.
Well, so does the market actually force lawmakers to get the fiscal house in order? Because I hear what you're saying on the balance sheet, but there's no sign that the Treasury is going to be pulling back on issuance anytime soon. We're still going to have to borrow to finance pretty much everything.
Well, I mean, this is a slow process. It's not going to be all of a sudden the checkbook gets ripped up. If you were to look at this and say, what could Warsh achieve? It may take 3 to 5 years before the balance sheet, even in nominal terms, I should say relative to nominal GDP, has shrunken enough so that the bond vigilantes can really push back. So it's not going to be an immediate phenomenon. But what you're seeing is it's a gradual creep higher. And where are you seeing happen? Well, it's been happening in the 20s and 30s. 10s are still below their cycle highs, but 20s and 30s are inching higher and higher because there's less demand in those portions of the curve. 20s in particular, it's just a weak portion of the curve. So that's where you're going to see it the most.
Will the consumer price report next week codify this trend that we're talking about?
So here's the interesting thing. I think today's jobs report is a temporary reprieve from the September rate hike outlook. I think that inflation report next week is going to say the opposite, and that is that you're seeing inflation gradually trickling higher because of the second or third wave of we'll call it, of energy price escalation here. So that CPI report next week should be stronger or higher than expected, and that should bring the September rate hike right back onto the table.
All right, Tom Source joining us from Baird Strategies. Thank you so much. He's in our world headquarters in New York, joining us to break down these Friday bond markets after this jobs report and more holistically consider what things are going to look like under the chairmanship of Kevin Warsh at the Fed, as it has only just begun. And of course, as we were discussing with Tom, you are seeing a little bit of movement lower on yields today, specifically at the short end, down about 4 basis points in that overall sentiment that the Fed maybe won't be on the hiking path as soon as the market feared is lifting equities as well. So let's get a recap on all of that as we turn to Charlie Pellet, also at the World Headquarters in New York. Charlie.
Hi, thank you very much, Kaylee Lines. Right now we do have the Dow, the S&P, NASDAQ very much in the green, off-session highs, off-session lows. 35-point gain right now on the S&P at 77.45. That's an advance of about 0.5%. Dow Industrials up 106 on the Dow, gain right now of 0.2%. NASDAQ higher by 1%. The NASDAQ 100 index up 0.9%. The Bloomberg Mag 7 index up 0.5%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, up now by 2.3%. The 2-year 4.19%. The 10-year 4.65%, and the 30-year 5.20%. Gold, meanwhile, surging 2.3% to $43.37 the ounce. Spot gold up $98 the ounce. West Texas Intermediate crude holding right around $78 a barrel, up 1% right now. Barrel of Brent, $83.35. Brent crude up by 1%. Earnings news. Wendy's shares are advancing, up 2.3%. Wendy's withdrew its 2026 outlook. It also cut its dividend as its new CEO comes up with a recovery plan for the beleaguered brand. Wendy's up by 2.3%. Rival McDonald's down 0.6%. And elsewhere in the burger world, Shake Shack up by 0.5%. Recapping, S&P 500 index up 36 right now. That is a gain of 0.5%. Back we go to Washington. Balance of power continues. And once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you very much with the latest on the markets, and we bring you the latest from here in Washington as the United States Senate just passed, as we told you was on track to do so, the Russia sanctions bill that, of course, was championed by the late Senator Lindsey Graham. This is obviously no longer just a Russia sanctions package. It has been expanded to include Iran at the request of the president, and passage in the Senate does not guarantee its passage in the House, which wouldn't happen, of course, until after the August recess, but nonetheless an important signal that Washington is sending in terms of its willingness to apply greater economic pressure to the U.S. adversaries in Russia and Iran. And of course, it had to get over some hurdles, Joe, in order to get to this point, including a commitment that the U.S. Trade Representative Jameson Greer had to make to Democratic Senator Senator Raphael Warnock about the tariff authority that this gives the president. Part of this package is that the president can apply tariffs on buyers of Russian and Iranian energy, that the tariffs eventually would have to come down for countries that are no longer in the top 5 purchasers.
Yeah, this was a difficult decision for some. There was a time when it was thought to be a possible candidate for unanimous consent, knowing that it had been named for the late Senator Lindsey Graham. 86-11, the vote count, according to the cloakroom here and our reporters on Capitol Hill. Let's play this to the panel. Not what we thought we'd be starting with, but it's breaking right now. And we have Bloomberg Politics contributor Jeannie Shanzano with us, a democracy visiting fellow at Harvard Kennedy School's Ash Center, and Republican strategist Maura Gillespie, founder of Blue Stack Strategies. Great to see you both, ladies. Thanks for coming along. Maura, you worked on the Hill when Lindsey Graham's career ascent was taking place. And this, of course, is seen by many as his crowning achievement, considering the time that he put into supporting the war effort in Ukraine. 86-11, what do you think of the turnout and some of the concessions that were made, as Kayleigh mentions, when it comes to expanding the president's tariff authority?
I think overall, I think this is a victory for Lindsey Graham's legacy in terms of what he was working on up until his untimely death. You know, he was just getting back from a trip where he was with Zelensky, president of Ukraine, working on this and really trying and working with the president to try to remind him of the threats that Russia poses and pushing forward this bill, working across the aisle to get this bill forward and to get the votes for it. And so I do think with there being the added Iran war contingency there, I think it still is a victory for Senator Lindsey Graham's legacy, for sure.
Well, Jeannie, come in here on the concern that some Democrats had who, yes, did want to make sure that the United States was applying more pressure to Russia, but also were very, very concerned about extending more authority for President Trump to be able to enact tariffs and tariffs at a large scale. We're talking 500%, in some instances 100% in others in this legislation. How easy could it be for President Trump to abuse this authority, even with the concessions that some Democrats were able to extract?
Yeah, I think there's still concern. Obviously, this was in this Senate, of course, a bipartisan win. You know, you only had the 11 Democrats, the 1 Republican fall off, and that is bipartisan for sure. But the concerns are very real. You know, you were just talking about the economy. There are Democrats and Republicans who are concerned that this is what they call a prescription for bedlam. It's going to fuel inflation domestically, giving the president, who loves tariffs more than anything else, he tells us, this unchecked authority to weaponize tariffs. That's a big concern. You had Gregory Meeks calling it a Trojan horse. He was concerned about the bill's national security waiver. So there are a lot of concerns out there. You had some Democrats who wanted to wait until after the midterms. But by and large, this was a bipartisan victory. And I think the big question is now, is Donald Trump going to push this in the House? Because for it to pass in the House, where there is even more concern, he is going to have to get on the phone and make some phone calls and twist some arms to get this over the hump. I think he will likely do that, considering it extends his tariff authority, but it's going to have to wait until they come back from recess.
Pretty scary reporting, Jeannie, in the Wall Street Journal today. U.S. intelligence reports posit that Vladimir Putin could try to test NATO's resolve with a limited assault on an allied country in the next few years. The U.S. had previously assessed that Putin would not provoke a NATO country while at war with Ukraine, but that assessment has changed as Putin becomes more cornered. Does legislation like this make him a greater risk?
I think legislation like this certainly does. I think you add to that the way we have overextended ourselves in Iran, and you have people in the DoD world now saying that we do not have the capacity to defend our interests in places like Asia. That makes what is happening around the world, whether it's in Russia, whether it's in Ukraine, whether it's in Asia, whether it's in the Middle East, all of these things come together and make it harder for us to defend our interests, to help our allies, and to secure ourselves. And so I do think that is one of the concerns about this sanctions bill, but I think it has become more volatile and more likely considering our defensive weapons and our munitions are at what seem to be a historic low at this point. And the reporting the president has pushed back on, many people behind the scenes are saying he knows full well that we have a problem there. So yeah, I think this does give people like Putin, Kim Jong-un. I think it gives China, if they want to do anything in Taiwan, I think it does give them an opening to take those steps.
Well, on the munitions question, Maura, this is part of the reason why the Pentagon is asking Congress for more money. And there's supposed to be some $70 billion for the Pentagon in the budget reconciliation package, assuming that it can make headway in the Senate. It's not entirely clear what will be actioned before they break for recess or what will become of things come September. But especially if they are willing to pass a continuing resolution to fund the government and to keep funding levels steady, I wonder, Maura, what you're thinking about in terms of this Congress giving this White House and this DOD what it wants in terms of not only supplemental funding to refill our munition stockpiles, but also the $1.5 trillion defense budget that they've asked for.
I think the problem comes with transparency. I don't think Secretary Hegseth has been transparent remotely enough and giving Congress the answers they've asked for in terms of where the money is going, where it's being spent, and what the real state of things are at this current moment. I mean, when the president talks about having interest in so many places, right? Jeannie mentioned what's happening in Iran, what's happening, in Ukraine and Russia, but also what's happening in the Middle East, what's happening in Venezuela, what's happening in the waters that they've been. This conversation isn't just there, but our interests are in Greenland, what our interests are in Asia. There are so many different areas that the president has mentioned, talked about, Truth Social about. And Secretary Hegseth has shut down the Pentagon's press, essentially, and the opportunity for them to ask questions. And so I think before Congress, they need to be demanding those answers, demanding transparency and the numbers from Pete Hegseth on, well, where the finances are going before they write him another blank check. I think that's going to be really crucial and a hurdle that's going to be big for him to go over, because right now Pete Hegseth feels pretty empowered by the president to stiff-arm Congress, but also the press.
When we pull out and look at the situation with Iran this week, Jeannie, it's now Friday. We started this week with the President of the United States taking credit for canceling a wave of attacks that he said it would have decapitated the regime last weekend at the request of Iran's neighbors, suggesting that within 1 to 2 days, a deal would be had. He said this was going to go quick. We're not going to let this last forever. This is the 13th time he's done this. Now we're at Friday, and the president says talks are moving along, but we have no news. How important will it be for him to announce a breakthrough this weekend?
It would be wonderful if we saw a breakthrough, but I don't think we can hold our breath on that. I mean, the talks going on now that are moving forward are talks between Iran and Oman. It's unclear where the U.S. is on those talks, except in all likelihood, the best deal we get is going to be reopening the strait with Iran having more control over it than it did prior to this war. And for all the president's bluster, and if you listen to the Iranian media, you can hear the way in which they are making fun of the president for all of his bluster. How can we attack Iran if we don't have the defensive missiles to defend ourselves, our soldiers, our assets, and our allies in the region? We simply can't. The president knows that. So sure, we could use dumber weapons, but when you use dumber weapons, that means you send U.S. forces, U.S. military, soldiers potentially closer to Iran. And the president knows we cannot get in a ground war with Iran. The president's hands are tied on this. He doesn't like the word. This is truly a quagmire. And his best bet is going to be getting the strait reopened, easing some of these sanctions on Iran if we need to, and trying to press forward on a nuclear deal. And he'll be lucky if it's anywhere close to what the Obama deal looked like that he rescinded. I mean, this is truly a disaster foreign policy for the president at a time when he has in 5 months gotten our munitions capacity as low as it is, that we are now vulnerable around the world, as are the Ukrainians who are depending on us to assist there.
Maura, we have less than a minute left, but when it comes to the war in Iran, if senators are able to get out of town today, and the House obviously has been out of town, what are they all going to hear about it at home?
Wondering why the gas prices are where they are and what the plan is. I think there's a lack of understanding about what the plan is, and Jean just laid out what she thinks is the best case scenario for an outcome here. But there really is been no semblance of an idea of what we would want to get out of this and what we would the president says we are getting out of it, right? I think that he and Secretary Hegseth have not delivered a clear message to the American people, and members of Congress are going to hear it.
All right, Maura Gillespie and Jeannie Shanzano, our political panel on this Friday. Thank you so much for joining us. And of course, it's not just any Friday, it's a Jobs Friday. It's potentially the last Friday before the recess here in Washington. It's also a Friday that brings the debut of a new podcast here at Bloomberg. Our Town is a new investigative podcast series about a small Tennessee town at the center of a fight over American identity. Hosted by journalist Mariba Knight and Bloomberg senior investigative reporter Susan Bearfield. The series debuts today, August 7th. This is Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ 100 index, and the Russell 2000 all advancing here. Jobs Friday, a sharp slowdown, a surprise this morning in the jobs report. That's driving stocks higher. Bond yields are falling. All of this on speculation that the Fed will not be forced to raise rates anytime soon. The S&P up 32 now to 77.47, a gain of 0.5%. Dow Industrials up 97, up by 0.2%. NASDAQ Composite Index up 259. That is a gain of 1%. NASDAQ 100 Index also up by 0.9%. And the Russell 2000 Index of small cap shares up now by 1%. The SOX, the Philadelphia Semiconductor Stock Exchange Index up 2.1%. The VIX holding below 15 with a 2-year that's yielding 4.19%, the 10-year 4.64%, and the 30-year 5.20%. Gold, meanwhile, up 2.3%, surging $96 the ounce to $43.35. West Texas Intermediate crude, $77.91 a barrel, up 0.8%. Barrel of Brent also up by 0.9%. $83.24 a barrel. Airbnb shares are up 15%, soaring after boosting its annual revenue forecast after seeing robust global travel demand, particularly in the United States. Also in Europe, again, Airbnb up by 15%. Elsewhere in the travel industry, the rally in Hertz shares continues today, up another 11%. You recall it was up 29% yesterday after earnings. Recapping, S&P up 35 right now, up 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you very much. Of course, Charlie will be back for more updates on the market throughout the course of Bloomberg Business Week Daily, which begins at 2 p.m. Eastern right here on Bloomberg TV and radio. But you still have us here on Balance of Power for now. And as we've been discussing a lot on Balance of Power in recent weeks and months, due to the ongoing conflict with Iran and the increasing focus that has been put on the United States' military capabilities and supplies of critical munitions. A really important conversation happened earlier today with the U.S. Secretary of the Army, who sat down with our colleague Tyler Kendall, Joe, to talk about effectively what the Army is trying to do to speed things along in terms of not only getting these things produced, but also testing them as they try to brace themselves for the wars of the future, wars, as we're seeing in the present, that include more and more drone technology that, of course, is cheaper than what a lot of our interceptors have been costing to this point.
Yeah, this is all about accelerating the procurement process, and by way of testing, this is one way they can get to that. There are a lot of different ways that we'll be talking about expanding the defense industrial base, but testing these new ideas and this new equipment is awfully important right now. So the Army is opening up, Kaylee, 5 ranges to private industry for testing drones, counter-drone technology, other weapons we probably haven't even heard of yet. And yes, Tyler got on an airplane and she flew to Michigan to sit down with the Secretary of the Army, Dan Driscoll. They sat down at one of those training facilities called Camp Grayling. It's an Army base in Grayling, Michigan, to talk about this new program. Let's watch and listen.
This is a really big deal. It was a couple of months ago I was out at one of our test ranges, and what I heard was that industry on average was having to wait between 12 and 18 months sometimes from the moment they wanted to get on our test range until we could give them access. And fundamentally the problem with this is, if you think of these innovative companies, if you think of the primes, everyone needs to be able to test their product, and they need to be able to learn from that. And the innovation loop that comes from actually using your thing in the real world makes all the difference. And so when we slow things down in the innovation loop by 12 or 18 months at a time, that is just bad for soldiers, it's bad for taxpayers, and it's bad for companies. And so what we're announcing today is basically a new front door to access all of the U.S. Army's, or many of the U.S. Army's ranges. We're layering in international partners. We're going to give concierge access, and we are going to aspire to get these companies onto our range within 30 days every single time. time.
So then after they're on that range, I think a lot of these companies are probably wondering how quickly can they get into business with the U.S. Army? If you like what you see, how do those purchases work from there? What sort of timeline are you eyeing for that?
So under President Trump, what we've been able to do is we've been able to reallocate dollars we already had. And so we created almost a $750 million venture-like model that has allowed us to get industry on contract sometimes in under 30 days. That is unbelievable. I mean, I think if you looked historically, the fastest time I had heard anyone ever reference was like 9 months, but on average, it could be up to 2 years sometimes. And so our commitment to industry is we know that they need dollars from the U.S. Army in order to continue their innovation. We know that if we're asking them to come out and spend time with soldiers, get their products in the dirt and the mud, and to innovate, we have got to be there for them on the other side with actual hard dollars.
How are current conflicts highlighting the need for initiatives like this and for the U.S. Army to scale? Is there a new urgency here?
I think if you look at what's occurring in Ukraine, they have this existential risk to their nation that allows them to innovate very quickly. You would never want to have that risk as a nation. So what we're trying to do is synthetically create the conditions for innovation that can get as close to matching that environment as possible. And so one of the things we're doing here at Camp Grayling in September is we're creating an electronic warfare and an EW environment that is as close to what Ukraine has as we can create. We're inviting in small, medium, and large businesses from across our country. We're having soldiers come down, and we are trying to empower these incredible American innovators to do what they do best, which is to out-innovate the rest of the world.
So the Army lives off of annual budgets, right? How do you ensure that you're able to scale and grow initiatives like this in what is, I think it's fair to say, a pretty unpredictable funding cycle? And how much weight maybe does that put on the $67 billion supplemental package in terms of what the Army needs to get done?
So the quirk of the design of our democratic form of government is our funding is annual. It is oftentimes continuing resolutions, which means we can't do new starts on our spending. And that is full stop bad for soldiers. That is bad for our national security, and we must as a nation fix it. That being said, what we have tried to do is just accept that that has been the reality. I think 18 of the last 21 years we've had continuing resolutions. And so what the United States Army has been trying to do under Secretary Hexeth's leadership is innovate as fast as humanly possible with what we do have. And we feel very good that working with Congress and Senate and consolidating down some of our budget line items, we are getting more flexibility than we have had in the last couple of years, not as much as we had a couple of decades ago. And we are taking that and earning back the trust of Congress to give us even more going forward.
But is that putting any more weight on the supplemental funding request, the $67 billion?
I think we need the supplemental, we need the reconciliation, and we need the budget to be passed on time. That will lead to the most secure country that the United States Army can possibly give it.
So today is a lot about these low-cost interceptors, drones, counter drones. Can you talk to me about how you assess what that mix should look like when it comes to the higher-end interceptors in U.S. stockpiles?
So one of the big takeaways from Ukraine is the very first thing you must do is create a data layer. And what you want in your data layer is you want as many sensors and radars as humanly possible, and you want them to be able to fuse into tracks. And so practically what that means is you want to be able to give yourself and your allies as much warning as humanly possible. And so what the United States Army has been focused on in the last couple of months is what we're calling Operation Jailbreak, which is basically we have said we are no longer going to allow any sensor, any radar, any piece of equipment that we own to have data that is siloed. All of it is getting broken out, and all of it through APIs and SDKs is going to be able to share the data and receive data or actions. That is step one. Every new thing we're buying is already open source, so we're good. So once we have this data layer, and anywhere American soldiers exist, we want that data layer to be as robust as humanly possible. The next step is to layer in effectors or interceptors, and you want as wide of a range of options as possible. On the cheapest, lowest side, you want a 50 cal round that might cost $1, and you want to be able to shoot that at something that's really close. On the highest end, you might want a PAC-3 that's now $4.2 million or $4.4 million a shot. The key to defense in this layered concept is you want as many options as humanly possible all tied into an agentic solution with a human in the loop that can choose between the right option at any given moment. And so the answer is actually, there's no one perfect answer. Variability is the key to success for Conflict going forward.
In the final minute that I have you, how much will initiatives like today compress timelines? Can you give us any context on how many years you're looking at when it comes to the Army building up these stockpiles?
So I think if you take the math of what we believe for a lot of these most exquisite interceptors and most exquisite offensive weapons, if it was taking 12 to 18 months each time to come to the range, and we're consolidating that down to, I am saying guaranteed, but I don't mean we will pay if we miss, but that is what we will hold ourselves publicly accountable. If you can get to the range every 30 days, what we hope to do is cut out at least a third of the R&D time, which will make a huge difference for soldiers.
All right, that is Army Secretary Dan Driscoll sitting down with our colleague Tyler Kendall in Michigan earlier today. Really just underscores the sense of urgency around the defense industrial base and the procurement process that we've been talking about for some time. Who was it, Joe, that this week called it a bipartisan scandal that the U.S. finds itself in this position in regard to our stockpiles and our defense industrial base?
Pretty strong words here. We talked to too many people for me to bring that back. And the scary thing is, I think that was yesterday.
Was that yesterday?
Yeah, it's a good thing it's Friday. The Colonel will shed some light on this for us, I think.
Indeed, he will. Wayne Sanders, of course, is joining us, Bloomberg Intelligence Senior Defense Research Analyst and retired Colonel as well. Wayne, welcome back to Balance of Power. As we consider what the Army is trying to do here and effectively accelerating as best they can the ability for companies to test these new technologies, be it anti-drone, drone, or others, how far does this go? You heard what he said there about the realistic timeline compression to solving the issue the Pentagon largely finds itself in with time.
I think this is a great and positive step when you start looking at trying to change the ecosystem as a whole. So Secretary Driscoll really is trying to take requirements, turning them into outcomes. You know, he talked about the different types of authorities that have been granted. You've seen a lot more of OTA contracts other than transactional authorities. Those type of contracts allow them to put stuff on contract early so that it doesn't end up being a new start during the next continuing resolution. So by doing those and having these multi-year framework agreements, creating the demand signal that's long enough, you're starting to actually be able to move the procurement needle and the scalability needle that's necessary, especially given the way we find ourselves right now for missile depletion.
You know, we were talking to Richard Haas yesterday.
That's
Colonel Sanders, yes, of course, Council on Foreign Relations, President Emeritus. He was the one who I had to think about that for a minute. A bipartisan scandal. I'm wondering your thoughts on that, because both political parties have played a role in this to get us to the extent where we need such dramatic attention paid to our defense industrial base. How long will it take to make up for what he calls a bipartisan scandal?
Yeah, I would say probably about 3 years. The direction that everybody is going right now, especially when you look at the primes as well as the disruptors, they're moving in the right direction now. It has started. Yes, it has been a bipartisan problem. Even when I was at the Pentagon a few years ago, you know, there were these programs where everybody's saying, hey, we need additional capability. No matter what type of warfare we've been fighting over the last 6 months, we should not be out of the munitions that we are low on or anything else like that you've seen reported up until this point. So what's happening right now, though, is those ramps are turning into agreements. The long demand signals that Secretary Driscoll talks about is saying that it's getting beyond the FIDEP, the 5-year development plan, where these businesses normally come in and say, I'm not willing to invest $10 or $100 million into additional production lines because you may change your mind in 2 years. And so now these demand signals that go out 7 years and beyond with some level of make whole provisions that are built into the contract to say, if we change our mind, we still owe you a certain amount of throughput as part of this. So I think that you're going to see a condition of this. Lockheed talked about tripling their PAC-3 interceptors, quadrupling their THAAD interceptors, and then the PRISM is another one that's come up in the news lately as well, another long-range capability that they need to create an additional demand signal for as well.
We're out of time, Wayne. We just have about 30 seconds left. But as we await word from the president on whether or not there is a deal to reopen the Strait of Hormuz, and it's unclear what role the U.S. blockade will or will not continue to play, if we are short of munitions, how long can we keep up our current posture?
Yeah, the interceptor part is something that I am concerned about. Obviously, we know that we're low. It's just a matter of how low. And for national security purposes, I'm glad that the government's not talking about that part. So from that piece, but from a long-range precision munition perspective, we have plenty of gravity bombs and all sorts of things to continue to take the fight to Iran if necessary.
Colonel, it's great to see you. Welcome back, as always. Wayne Sanders, Bloomberg Intelligence Senior Defense Research Analyst. We always appreciate the insights. Alongside Kaylee Lyons, I'm Joe Matthew. We'll both be back here for the late edition of Balance of Power, wrap up the week on Wall Street, and we'll see if there's any breakthrough in talks in Iran. That starts at 5 p.m. Eastern, only here on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
Yes, indeed, everybody. It is Friday, and we are across Bloomberg platforms. Carol Masser, Tim Stenivek, live here at Bloomberg headquarters in New York City. We made it. It is a Jobs Friday. It is August 7th, 2026.
It didn't really go as planned.
It was a little bit of a shocker when it first crossed.
It was, but it's complicated, and that's why we're going to spend quite a bit of time digging into the nitty-gritty today.
It's always complicated. All right, we are going to get into it.
This one's especially complicated, right?
Yeah, we did see a sharp slowdown in the U.S. jobs market. We have seen it put some pressure on the equity trade. We've seen bond yields falling too. There's some speculation out there that the Fed maybe won't have to be forced or rush to raise interest rates anytime soon. So I got to say, this was definitely one of the focal points. We had SpaceX earnings. We had this. One of the key things for investors this week.
Right, next week, inflation. That's what our attention turns to.
We do indeed.
We'll get to that. We got a great roundtable coming up over the next hour. First up, we're going to have Mike McKeon, Deutsche Bank's Matt Luzetti here. We're going to go wide and deep on that jobs report, the economy, the rates, relationship between President Trump and Fed Chair Kevin Warsh.
The chatty duo. So we're going to get into that. Hey, plus another read on the labor market. We're going to do that with Indeed Hiring Labs. Laura Ulrich, she's going to be along as well. They've got a new survey. They're talking about AI and what it means for white-collar jobs. And then we're going to talk a little bit about sports, the future of FIFA, media rights, and all that good stuff.
Yeah, looking forward to that. That World Cup, by the way, the most lucrative ever. The sponsorships were everywhere.
It's those hydration breaks. That's what it was all about. And I guess
very controversial.
And apparently they may continue.
Breaks.
They may continue. Hey, folks, we'd like to hear from you. You've been sending in questions. Please continue to do so, and you can do it. Bloomberg.com/AskRadio. We've got a couple of questions already to bring into our discussion about the U.S. labor market. Again, exclusively for Bloomberg.com subscribers and terminal clients. Just send them to Bloomberg.com/AskRadio.
All right, we got a great hour coming up here on Bloomberg Business Week Daily. First up, a check of the day's trade and top business stories. Here he is, Charlie Pellet.
Hi, thank you very much, Tim and Carol. Indeed, green on the screen right now. Jobs Friday, the Dow, the S&P, NASDAQ all advancing. Even though we had a sharp slowdown in the jobs market, it is driving stocks higher. Bond yields are falling on speculation that the Fed will not be forced to raise rates anytime soon. S&P at 77.45 now, up 35. That is a gain of 0.5%. Dow Industrial is up 94. That is a gain of 0.2%. And NASDAQ is up 1%, higher by 263 points. NASDAQ 100 index up by 0.9%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, up 2.1%. The 2-year, 4.19% now, the 10-year 4.65%, and the 30-year is 5.20%. Gold, meanwhile, up $100 the ounce, up 2.4%, $43.39 on the precious metal. West Texas Intermediate crude just above 78 a barrel, has been fluctuating above and below 78, but right now it is up by 1%. Barrel of Brent, 83.43. Brent crude up by 1.1%. Keeping an eye on Sweetgreen shares, the stock is now down by 7.7%. It cut its annual outlook due to reduced consumer demand for fresh prepared foods during the Cyclospora outbreak. Also, we've got Under Armour shares trading lower as well. They're down 5.2%. Under Armour forecast a sharper revenue decline than previously expected as demand softens in several key regions. Recapping, S&P higher now by 0.5%. I'm Charlie Pellet. Tim and Carol, that's a Bloomberg Business Flash.
Right, it certainly is. All right, thank you so much, Charlie Pellet. So let's get to it, and let's get to the labor market and that report we got this morning at 8:30 a.m. Eastern. Here's just kind of some of the details. U.S. employers unexpectedly cut jobs in the month of July, and hiring the prior 2 months was revised lower, suggesting that the labor market here in the U.S. is weaker than previously thought after surprising strength, Tim, earlier this year.
The decline in jobs driven by cuts in government, leisure, and hospitality, also retail. Private sector payrolls rose by $30,000 for a second month. That was led by healthcare and social assistance. Manufacturing and construction payrolls, those continue to climb.
And then there was the participation rate. The share of the population working or looking for work fell to 61.4%, which, excluding the pandemic, was the lowest since the 1970s. Among those between the ages of 25 and 54, known as prime age workers, participation edged higher but remained near the lowest levels of the last few years. White House Director of the National Economic Council, we're talking about Kevin Hassett. He spoke earlier on Bloomberg TV and radio on open interest with Danny Berger and Michael McKee.
Labor force participation is kind of on a downward trajectory, which means that the break-even jobs number, that is the jobs number you need so that unemployment rate doesn't go up, has gone from maybe 120, 130,000 a few years ago to maybe about 40,000 now. And so what it means is that what the market is used to looking at, it's like a normal tread the water kind of jobs number if it's around 100, is no longer true.
All right, that, of course, is White House Director of the National Economic Council, Kevin Hassett, earlier on Bloomberg. Joining us with more is our own Michael McKee, who was talking to Mr. Hassett earlier on Bloomberg. He is, of course, Bloomberg TV and radio international economics and policy correspondent, joining us here in studio, along with, and back with us, Matt Lazzetti. He's chief economist at Deutsche Bank. Guys, thank you so much. I do want to kick it off with you, though, Mike. We've had a few hours for the dust to settle. Is this a report that was weaker? Like, what's the assessment here?
I think the bottom line, to just skip to the end of the book, is that the labor market is weaker than it had appeared, but it's not weak. It's not a problem for the Fed to have to deal with. And there were, as you mentioned, some quirks in the data this time. And everything Kevin said was true about with the labor force declining. You need fewer jobs to employ people so the unemployment rate can go down. And that is something that the Fed's going to have to think about in terms of what is the level of interest rates that keeps the unemployment rate steady.
We'll dig into all of this and more in just a minute. First, I want to bring in Matt Lazzetti, chief economist over at Deutsche Bank. Do you agree with Mike's assessment here that, yeah, on the surface it looks weaker, but it's not as bad as sort of the headline number?
Yeah, I think absolutely. You got a downside surprise on payrolls. You had the 100,000 of downward revisions to prior months. But I think what it does is it confirms that break-even number is just lower. So there's various Fed estimates out there suggesting that the break-even number could be as low as 0 per month. Mm-hmm. Over the past 3 or 6 months, we're running at 20 to 45,000 on headline payroll numbers. With that backdrop, we've seen the unemployment rate decline to the lowest level in 18 months. We've seen other measures of labor market slack actually tighten on the margins as well. And so I think it actually fits more with a story where the break-even number is quite low. We see payroll gains trending kind of around those levels, maybe a little bit above. Labor market slack tightening at the margins, but it takes away some of the upside risks to the labor market that the Fed might have been contemplating.
All right, so when it comes to, we've got actually a question I want to bring in from a viewer and listener. It's Mark in Toronto, and he says, what impact do boomers retiring have on the labor participation rate and unemployment make? And if we could address that. I have to say, I have some boomers in my family who've retired recently or in the last few years, and they have at least 3 or 4 of them that have left the labor market. Matt, is that something that is certainly at play here?
Absolutely. So if you look at the labor force participation over recent months, in June, there was a big decline in prime age, which I think you alluded to, and specifically the 25 to 34 age group. That partially reversed. I think the bigger structural trend is labor force participation for 55 plus continues to collapse. There's a question about whether or not that's worrying or not. I would actually argue that it's really in line with what you would expect from demographics. So if you look at different age groups with 55 plus, their participation rates are actually not moving around all that much. So what's happening is people are just aging into buckets where they work a lot less, where their participation rates are much lower. And we're, in fact, much closer to what I would expect from a demographics implied trend from the labor market.
Mike, what about the other end of the demographic spectrum? And that would traditionally be new entrants to this country entering the labor force and younger immigrants. We've seen that dry up significantly over the past few months. And it's certainly by design with this administration. You addressed that with Kevin Hassett a little bit in one of the questions that he answered. Does that work in our economy when we're not having enough kids?
It isn't good news for the overall economy, as we were talking about with Kevin Hassett. The size of the labor force is one input into what potential growth is. And if the labor force isn't growing, you've got to get more out of productivity, Kevin Warsh thinks you will eventually, not yet. So it is a problem for the economy overall, and you can see that in the overall participation numbers as well. Although prime age has ticked up a little bit, things have loosened up a little bit compared to where they were. But the demographics at the other end, as Matt was saying, that's been going on for quite a while as baby boomers from 1946 started retiring, and now we're past the peak of baby boomers being 65. So that'll be less and less of an issue going forward, but it still takes a lot of people out of the labor force.
Is it too soon? Well, I feel like there's a million things I want to talk about because demographics is things, I know we've talked with you about it, but I do think about longer term, if we don't allow immigration into the country and we have an older workforce, how much the economy here in the U.S. is at risk in terms of growth. Matt, is that something you guys are thinking about a lot or studying?
Sure. I mean, I think if you look at projections for population growth and the size of the U.S. population, as you look out 5 or 10 years, without positive net immigration flows, you have a declining labor force, you have a declining population. The U.S. is not the only economy, global economy that is dealing with these issues.
We've seen this movie, right?
Correct. We see these issues in various parts of Asia, Europe. Many of these economies are actually worse placed than the U.S. is from that perspective. But no doubt, we rely on positive net immigration flows as we look ahead. I think, as Mike mentioned, the hope is that productivity growth can pick up. It has been pretty robust over these past 2 to 3 years, and that can be the supporting mechanism for overall growth. So far, it's working out okay.
Yeah.
But that's a bigger question as you look ahead.
Okay, I promise go ahead, Mike.
I was just going to add on to this. There is one aspect of this that the productivity can't really solve, and that is the fewer people that are working, the lower the dependency ratio is. And so Social Security gets less funding, Medicare gets less funding.
Tax base, right?
That is an ongoing issue, and nobody has any idea when Congress is going to address this.
I keep saying if we're, robots are going to replace us or AI makes us more productive, but, robots don't buy lunch, or robots don't need their shoes shined, or robots don't need to go shopping for shoes. I'm just.
They need to be oiled, though.
It depends.
And maybe rebooted sometimes.
It depends. Mike, I want to get to the conversation with Kevin Hassett this morning. At one point, talking about hourly earnings, and he then brought up weekly earnings. You said something like, I don't know if the president's watching, the Oval Office saying, you got your point, though, and Kevin, good job. And Kevin said, I don't know if he's watching, but I'll find out. And I want to get both of your perspectives, but Mike, speaks to the president who watches a lot of TV. We know that, and responds. Is that typical of a president? Is it shows his involvement in what the message is that's getting out?
I think it's just unique to this president that he likes to do that, and he likes to hear people talking about him. And he spends a lot, from all the reports we get from the White House, he spends a lot of time watching television and watching the various news programs. I don't know that he was watching Kevin Hassett today.
But putting pressure on then his members of his team when they're on air.
Well, yes, but every White House does that in the sense that you're sending out a spokesman for the White House, so that person is not going to say, yeah, we blew it, this was a bad policy, or something like that. They're always going to try to present the best numbers. And I was thinking when Kevin and I were having that conversation, the old saying about you can torture the statistics any way you want to get the numbers that you want.
Right.
The bottom line to the White House, though, is that average hourly earnings are falling behind inflation. And whether you use one measure or another doesn't really matter because the public thinks that's happening, and that's their political problem.
Well, speaking of communications, you and Danny Berger asked Kevin Hassett about the communications between the president and Kevin Warsh. Let's listen to what he had to say.
There have been some news stories that the president's talking to Kevin Warsh, and of course he is, and he talked to Jay Powell too. But the other thing is that Kevin Warsh and the president have a very close long-term relationship from New York City, from Florida, and they talk about the economy all the time. It's very, very natural for the president to do something like say, hey, Chairman Warsh, what do you think about today's job number? And that's a very normal thing for him to do. But I think that's the way you should think about the bounds of the conversations.
Earlier on Bloomberg TV with Danny Berger and Mike McKee. Matt, I want to toss this over to you because Kevin Hassett also said that the president respects the independence of the Federal Reserve. And I'm curious, based on the reporting that we've seen around the conversations happening between the Fed chair and the president and what the president has said publicly and on social media throughout this term and his previous term, is the view now, is the market viewing that the president respects the independence of the Fed?
Look, I think we don't really know the context of the conversations that are happening. It seems like it might be more frequent than what has the interactions between the president and the Fed chair than in the past. If you look at market measures, I think what we like to look at are inflation expectations showing anything that is worrying. Are they suggesting that the Fed's credibility is at risk? I think last week you did see a notable rise in inflation expectations. I don't know that that was anything kind of tied to the president, but I think it was tied to Chair Walsh's specific comments around willingness to potentially raise rates, unwillingness to say that they were targeting 2% PCE price inflation, and just the overall conversation, I think, and the language that he used, I think raised some risks from a market perspective about whether or not the Fed would do what's necessary to keep inflation in check.
President Trump did an interview with Punchbowl today, and he reiterated his preference for lower interest rates, but acknowledged it is not the central bank chief's decision alone. So kind of making or taking a little bit of a softer tone in some of the criticism. I mean, when it comes down to it, I know we are already thinking, okay, what does the Fed do next? We've got inflation prints to get through, right, Mike? We've got more economic data. Who knows where the Fed will be, and Kevin Warsh and everybody on the FOMC at the next meeting?
Well, clearly you don't trade Fed funds futures. You're right. We don't know, but the people who do trade these things have to decide on a minute-to-minute basis what they're going to do, and they have backed off the idea of a September rate hike. But the important thing is we're going to have two more inflation reports, two more, well, one more after this jobs report, and so there's going to be a lot of data for them to hang a decision on. We don't know what that data is going to say, and so at this point it's too early to speculate. I mean, it's been going into this, everybody was saying, well, if we get a bad number, then the Fed might have to back off, and we got a bad number, so they're saying the Fed's going to back off. Now we're all on to, well, let's see what we get on Wednesday with CPI, and we'll make a decision.
It's our favorite part of the day.
Well, Matt, what should the Fed has a dual mandate, but. And I think for a lot of people the last few months have said, okay, the labor market is strong, so the focus should be on getting inflation down. After today's print, does that view change? Should the Fed still be squarely focused on that part of the dual mandate?
I don't think it changes. Clearly you had a downside surprise in payrolls, but if you think the break-even number is close to zero, you're actually running at or near those levels. The unemployment rate's at 4.1%. It is well below what the Fed thought it was going to be at the end of this year. It remains our best measure of labor market slack. I think you have a shift of risk distribution on the labor market. Now there's not as much upside risk. But September will be about the inflation data that we get over the next 2 months, especially if we get a bounce back in payrolls next month.
I mean, inflation's still a problem, right?
So in our view, it is. I mean, if you look at PCE inflation, which is what the Fed targets, it is the highest that it's been since 1992 if you strip out COVID. We agree with an evolving Fed assessment from many officials that it is more broad-based, it is more demand-driven, AI-related investment is a source of inflationary pressures. Underlying inflation is stuck closer to 3%. None of that changed today. We'll get an update on that next week from the CPI.
Okay, I want to just throw this last one at you, even though we don't have enough time, Mike. Lisa Cook, because in the conversation about independence of the Fed, since we heard from Kevin Hassett this morning, our Bloomberg News team reporting that President Trump has revived his threat to fire Federal Reserve Governor Lisa Cook over those unproven allegations. Update us here on this.
Well, they apparently sent Lisa Cook a letter that said the president is considering firing you because of the allegations of mortgage fraud, and you have 3 weeks to respond to this letter. Remember, the Supreme Court said that the president couldn't fire her, but because she didn't get due process. They didn't decide the legality of her particular case. And so now the White House is coming back and trying to follow the dictate of the court and give her the opportunity to respond. And we don't know how this will all play out, because even if she's found not guilty, the president could come back and say, well, yeah, but she was implicated or something. So this is just it's Friday, put it that way. And this is the kind of thing you get on Fridays.
Yay for the lawyers. That's all I'm going to say. Matt Lozzetti, Chief U.S. Economist at Deutsche Bank, thank you so much. And, of course, our own Mike McKee, Bloomberg TV and Radio International Economics and Policy Correspondent. We'll do more on the labor market.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. A move higher for the Dow, the S&P, NASDAQ. A sharp slowdown in the jobs market is driving stocks higher. Right now, we have got the S&P as a baseline up 0.4%, higher by 31 points. Dow Industrials up 0.1%, up 47. NASDAQ is up 0.9% with the NASDAQ 100 index up by 0.8%. The SOX, the Philadelphia Semiconductor Index, up now by 2%. We've got the 2-year currently yielding 4.19%, the 10-year 4.65%, and the 30-year at 5.21%. Gold is up $95 the ounce to $43.34, up 2.2%. A rally for crude back above 78 now. WTI at 1.1% higher. Brent, 83.49, barrel of Brent up by 1.2%. Bitcoin, meanwhile, at 64,763, up by about 0.6%. Airbnb shares up 15.3%. Airbnb boosted its annual revenue forecast after seeing robust global travel demand, particularly in the U.S. and Europe. Bears repeating Airbnb up by 15.3%. And that rally in Hertz shares continuing again today, up another 11.6%. You recall it was up 29% after earnings. Rental car company reported earnings that did top estimates. Again, Hertz shares up today by 11.6%. For on-demand news, 24 hours a day, subscribe to Bloomberg News now wherever you get your podcast. Carol and Tim, that's a Bloomberg Business Flash.
It is indeed. All right, Charlie Pellet, thank you so much. As we have been reporting, U.S. employers unexpectedly cut jobs in the month of July, and hiring in the prior 2 months was revised lower, suggesting the labor market is weaker than previously thought. Man, do I need a weekend? This is after some surprising strength earlier this year. We're going to stay on the labor market. We've been trying to look at this from different vantage points, and that's where our next guest comes in.
We've got Laura Ulrich with us, Director of Economic Research in North America at Indeed Hiring Lab. She's also a former senior regional economist and senior manager at the Federal Reserve Bank of Richmond, primarily focused on research related to higher education and workforce dynamics, which, by the way, we got some great questions from our audience coming in just about this. Yeah. She was also an economics professor and associate dean for undergraduate programs at Winthrop University. She joins us from North Carolina. Welcome, welcome, welcome. How would you describe today's payrolls report and how it changes your view of the labor market, if at all?
I wouldn't say it necessarily changes my view of the labor market. We at the Hiring Lab and Indeed have been kind of describing the market as a market that is cooled, not necessarily that is cooling. We're kind of bouncing along the bottom, and I see that as the same today as I really did yesterday. However, I do think it is important to acknowledge that the payroll employment report came in about 100,000 jobs below consensus today, and so that's notable, right? It was much softer than what people were expecting.
So I am curious too, and tell us a little bit more, if you would, Laura, about the activity you are seeing on the platform. What are the job listings? What are the jobs people are looking for? Give us an idea, and give us some context about data today versus maybe 6 months ago, or just trends, because you guys see a lot.
We do. We have access to a lot of data, both on labor supply and labor demand. I would tell you that we've been in kind of a, I wouldn't call it a steady state, because there has been a bit of turbulence, right? We've been bouncing a bit, but we've been at about a job posting index of 102-ish, between about 101 and 102 since about September of last year. So that's kind of what leads partially to our viewpoint in that this is kind of a cooled market that's bumping along the bottom. One interesting point, though, and you did see this reflected potentially in today's payroll employment report, we have seen some strength in some sectors where we were seeing considerable weakness before. So software development jobs, for example, are up 15% since early 2025, and we had seen considerable cooling in tech jobs. And in the payroll employment report, jobs in both information and professional business services were up today. So we are starting to see some of those, I would say, sectors that maybe are more AI exposed, that where we had seen a lot of softness to turn the corner a bit.
Okay, Brendan down in Maryland sent us a question during our last segment that would be great for you to weigh in on. It's about sort of these different areas of the economy and what you're seeing in terms of different sectors. He writes that it seems many jobs were lost in education. To what extent do you think these are permanent job losses, as many municipal school districts have exhausted and no longer can use the massive federal funding they received during the pandemic era?
Here's a great question. I did take note of that that data point this morning. I think that the loss of those local education government jobs, that could be a bit of an anomaly with some issues with the seasonal adjustments. I think it'll be interesting to see what the number looks like next month. I will say, though, much of my background is in education, as you mentioned, and there is considerable pressure both on higher ed, but also K through 12, partially because of federal funding cuts, but also because there have just been fewer and fewer and fewer students enrolled in public schools. And so if you look at enrollment for many of those districts, it's been declining. And so there's less need for staff and teachers at some of those districts as well.
Hey, I want to get to, because one of the things we talk about, Laura, when it comes to the labor market is the impact of AI, right? We're still trying to figure all of that out. And we thought, both Tim and I, when you talked about strength in software development jobs, we kind of were surprised at that.
Yeah, I thought the bots were going to do it.
Yeah. So that was interesting to us. You have done a new survey, the Indeed Hiring Lab Labor Market Outlook Survey. You talked to more than 100 U.S. economists and labor market experts. Tell us about the findings and what you heard.
Absolutely. So we're really excited. This is a brand new product for us. We released it earlier this week. So we'll be doing this on a quarterly basis where we ask over 100 very well-respected labor economists to predict what they think is going to happen both to unemployment rates, but also our own job postings at Indeed. And along with that, we're going to be asking them some special questions this time. We had a lot of questions on AI. It was really interesting for us to see the results because from a macro point of view, there wasn't a lot of disagreement amongst economists. Many of them did see that there would be a slight decline in job postings and unemployment and a slight increase in unemployment rates over the next year, but not a lot of movement. But the AI question got a much broader array of answers, I will say. A little over 50% of the economists that were surveyed, I think it's 57%, believed that AI would lead to job losses on net. About in the 30% thought it would lead to job gains on net, and then some are unsure. And I think that wide array of responses from, like I said, this group of very well-respected labor economists really shows how much uncertainty there is in what path this might go in. But I will say at Indeed, we're starting to see, I mentioned that growth in software development. Those jobs where we are seeing growth do tend to be what we're calling AI touch jobs. These are jobs that either have AI in the title, so think like AI engineer or machine learning specialist, something like that. Data center technicians, another one that's growing a lot. Or they mention AI as being a skill or a characteristic of the job in the job description. So those jobs are on the rise on our platform for sure. They're also on the rise in terms of what people are seeking. And so really from our vantage point right now, I would say today, from my perspective, it's much easier for me to point to some growth that we're seeing from AI in the labor market to actual destruction from AI doing people's jobs.
But as you pointed out in the press release, you guys said when a group like this converges on something like AI, as they did, right, in terms of the impact, it's worth paying attention. When it splits, that tells us something too. In this quarter, it did both. Is that fair in terms of how I'm reading it?
It did. We asked one really interesting thing was we asked the economists exactly what sectors do you think there will be the largest decline in jobs and what sector do you think there'll be the largest increase? And there were two occupational sectors from our data that ended up on both lists. That was software development and data and analytics. So some of the economists thought this is where we're actually going to see the most loss, and others thought this is where we're going to see the most gain. That was a surprise to me. I didn't expect to see the same sectors end up on both lists. So,
it's a reminder that we're figuring our way. People say we're early in on this, right? And understanding really the impact. I mean, we're trying to figure this out and we don't really know, right, longer term exactly how it plays out.
I totally agree. I think one thing that we do know, and we did another survey internally at Indeed where we asked employers if they were seeking what we defined as AI native or AI fluent talent. AI native talent has nothing to do with age. You can be a Gen Xer like me and be AI native, but it basically means that you default to AI technology to help you across multiple workflows. AI fluent is you still feel comfortable across workflows, but you don't necessarily default to it. And 45% of employers said they were actively recruiting AI native talent, but only 14% of workers in the survey considered themselves AI natives. So I think one thing we do know right now is people who do have AI related skills and talent are being hotly demanded in the labor market.
Well, let's make this a little personal, because our team told us that you have a couple of kids. I guess they're not kids anymore, but they're young men entering the labor market right now. And this is at, I think it's fair to say, a really interesting time to enter the labor market. You're talking about this AI fluency and being AI native. What do you tell them about the skills that they need to succeed in this market?
It's a great question. And yes, I have 3 sons, 16, 19, and 22.
I'm sorry for the third one that I did not mention.
It's okay.
You don't know who you are.
Okay. He won't mind. But the oldest just finished graduate school in data science, which in R&D data has been one of our softest areas. So you can imagine for me and the work that I do, doing the research that I do, but also living life as a mom trying to help this young adult. He has landed his first full-time job, which is excellent news for our household, but it was very tough. And what I kept stressing to him was that, in my opinion, it's really important for young job seekers to prove to companies that they are better off, the company is better off with AI plus them than AI without them. And that's a tough road to navigate right now, but I do think it's extremely important. So I think being an AI native is very important. I have stressed that to my sons and have stressed it to myself too, as someone who is older. Only 11% of Gen Xers in our survey even define themselves as AI fluent. And I've had to work hard as an older worker myself to become an AI native and to really dig into it. So I think it's something that, in my view, is extraordinarily important as we do go into this period that is going to be so uncertain, because I believe that for my children's generation, one of the most important skills they can have is adaptability.
I got to ask you about one more data point from your survey finding. We've only got about a minute or so left, but you guys found a larger majority, 57% of panelists said they expect downward pressure on the wages of college-educated workers over the next year versus 34% who said the same for workers without a degree. Forgive me, but just about 40 seconds. Why do you think that is?
Yeah, I think that the sectors that are most likely to be impacted, especially in the short run, are many white-collar sectors that college-educated people flow into. I'll say, too, we've done some work at Indeed looking at how that collides with the demographic shifts that you guys were talking about before. And what we've kind of predicted through this is that we might have an excess of workers moving into these white-collar roles with the combination of demographic shifts and AI. And so if that happens and supply exceeds demand, seeing downward pressure on wages would be pretty rational to expect.
All right, great stuff. Please come back and join us again. We would love to have you. Have a good weekend. Laura Ulrich, she's Director of Economic Research in North America at Indeed Hiring Lab. When we come back, we're shifting gears to sports.
Yeah, it turns out fans are staring down $2,000 in streaming bills.
What?
That's next on Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. A weak jobs report. Stocks are higher. Oil is rallying as well. The S&P now at 7736, up 26 points, higher by 0.3%. This latest jobs report weak enough to take some pressure off the Fed to raise rates, but not weak enough to signal that the economy is falling apart. The Dow up 34, up just under 0.1%. NASDAQ is rallying 220 points, up by about 0.8%. NASDAQ 100 index up by 0.7%, and the Bloomberg Mag 7 index up now by 0.4%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, up 1.9%. The 2-year currently yielding 4.20%, the 10-year 4.65%, and the 30-year 5.21%. Gold at $43.37 the ounce. Spot gold up 2.3%. West Texas Intermediate crude 78.20 a barrel, up 1.2%. And Brent crude, $83.49, up by 1.2%. S&P 500 index is on track for its best week since April. For the week, we're looking at a gain right now of just about 3.3%. A Friday corporate marriage. We have got Dream Finders Homes agreeing to a roughly $916 million deal to buy rival Beazer Homes USA. Shares of Dream Finders Home up now by 8.6%. As for Beazer, trading lower by 1.1%. Again, recapping here, stocks higher, jobs Friday, S&P up by 0.4%. Crude is advancing, WTI 78.24 a barrel, up by 1.2%. Carol and Tim, that's a Bloomberg Business Flash.
All right, Charlie, thank you so much. Yes, indeed, it is a Jobs Friday. It means we're getting into the weekend.
You got to earn that money to pay for the streaming services to watch all the sports.
Well done. I wasn't going to... Nice.
Thank you. Sometimes.
No moss growing over there. This story definitely caught our attention. Tim set it up so well. It's about one sports fan and what he's paying to watch all of the streaming channels and sports that he loves on streaming channels. And it turns out to be more than $2,000 a year.
Yeah, he's got to share some passwords.
Yeah.
Like, what is he doing?
We know what goes on at the Stenovic household.
Okay, why so much? As our team reports out, the rise of streaming services has made it difficult for U.S. sports fans to follow their favorite teams without special subscriptions, with pro leagues signing deals with multiple services and creating a bewildering schedule and some steep costs. We've got Randall Williams, Bloomberg News senior reporter, and the co-host of the Bloomberg Business of Sports podcast. That podcast is available at Bloomberg.com, Apple, Spotify, or wherever you get your podcasts.
Also means it's the weekend because it's dropped. Hey, good to have you here. Lots to talk about.
Thank you for having me.
Well, it's great to have you. We're going to get into the streaming costs. I feel like we have to go to FIFA, though.
Okay, we can start there.
Right, because last week we talked about, and it looked like they were trying to get outside investors and all this stuff. That's done, right?
It's dead.
They died after we talked to you.
No, literally, shortly after it died, and I think I ended up reporting on it like maybe 3 hours after, which is nuts. The thing that remains to be seen is if Gianni Infantino, the FIFA president, is going to win his re-election next year. He was, I would say, reaffirmed as president this week in Morocco, where I believe he said the final is probably going to be played there. But UEFA have not said anything different. They still are not supporting him.
Many people who are just sort of joining the conversation right now about FIFA and post-World Cup might not understand. I certainly don't.
I can paint the picture.
The tension between UEFA and FIFA. Was this just the straw that broke the camel's back, or have there been tensions for a while?
There have been tensions for a while. I think that when Gianni Infantino, of course, is looking at FIFA as a business, as most executives do, but there's also a purist mentality in all sports, in golf and tennis and football and basketball and everything else. And so you think about the innovations that Gianni Infantino, that's what he would call it, and say, like such as hydration breaks, commercial breaks that are used to sell ads. That's not typical in football. UEFA is very strongly opposed to that, and has even said in the Euros that they won't be doing it. But that is something that if UEFA was trying to maximize TV dollars, that they could sell. But they're talking about the purity of the game of soccer, and they're saying, no, absolutely not. So then you relay that into what's happened recently. FIFA made $15 billion from the World Cup. And then after that, they're going to be like, we're going to sell stakes. We're going to do this with Thrive Capital's Joshua Kushner. Yeah. And UEFA's like, listen, no, we've had enough of you, and we're going to be trying to probably get rid of you come next year.
Yeah.
Do they have the power to do that?
I think it's going to take some rallying, and there has to be another potential candidate. I have not seen any reports that someone has been trying to rally against him. It's just that they do not support him. I also don't anticipate that Gianni Infantino in 4 months is going to be able to change UEFA's mind. So who can UEFA find to really go up against Gianni Infantino? And the reality is, Infantino, as much as he has done with the Trump administration and for the World Cup, it's hard to argue that he hasn't done a good job. You make $15 billion the most ever. It's going to be hard to get rid of anybody who's just made record-setting profit.
And won't there always be that tension between FIFA and kind of the regionals?
Of course, because FIFA owns the World Cup, which is it's over the entire world. Whereas you have your CONCACAF, you have your soccer federation in South America, you have UEFA, and each of them have their own tournaments. You have the Euro, you have Copa America, but the World Cup is when everybody competes. So there's always going to be some tension there.
I gotta be a little jealous that this went so well. Just a little bit. So listen, there was a story on the Bloomberg too, the next World Cup and the money deals, Randall. FIFA exploring selling U.S. media rights for the next 2 World Cups together, which would keep the hydration breaks that boosted it, right?
Yes,
They're not going away, are they?
I don't think so. I mean, once you get a taste of advertiser money in 30 seconds and you got to think about it. This is exclusivity. At the Super Bowl and at other events, those 30-second ads sell for $8 million a piece, but they never really rerun. When you're watching the World Cup, you see the same ads over and over and over and over again.
Well, yeah, my son's like talking to me about Bank of America, Home Depot, and like he's 7 years old and never watches other commercials, and he knows. And by the way, David Beckham's in all of these,
of course.
So this is great news for David Beckham, I guess.
It's great news for all of FIFA's partners, because it really is one of the most exclusive advertisements that you can possibly have, because it's going to run in every single match across various continents and regions. So they are going to take this to market. They're probably going to shop around to whoever's willing to pay the most. But of course, you want the reach angle of this.
There's not 1 inch of that screen that is not taken up by an ad, even when the game is going.
Absolutely not. Everything is an ad in there.
I mean,
so much so that even the stadiums. Think about the stadiums. We're not calling MetLife Stadium MetLife. We're calling it New York, New Jersey Stadium.
That blew my mind. How the heck did they get that done?
I mean, they obviously have an insurance partner, and SoFi Stadium became Los Angeles Stadium, and so on and so forth. I just could not believe that they're willing to go that far to protect sponsors, but if sponsors are paying a premium, and that's what they're asking for.
So that's why they did it.
I think it's part of it.
Because but the naming rights that you get naming rights for a stadium.
But it's a protection.
You expect that name to be used when the stadium is mentioned.
It's twofold. The stadiums and their owners were willing. They wanted the World Cup, and they wanted those matches and that revenue that came from FIFA, and so they were willing to cover up the names. At the same time, FIFA is like, we don't want anybody profiting off the World Cup except for us and our partners. And so even if it's Mercedes-Benz Stadium in Atlanta, Hard Rock Stadium in Miami, there were banners that were hung up that said New York, New Jersey Stadium, and it's hard for me to say New York, New Jersey Stadium when the stadium is in New Jersey.
We saw it. We were like, is that a mistake?
It came down to the fact
stadium
that
in our backyard.
The host committee is called New York, New Jersey host committee, and so that's why the stadium was named that. But nonetheless, it is a bit far-fetched. I'm like, that's too far. But anyways.
We mentioned streaming costs coming into this. Media rights, what were they for the past World Cup? What might they be for the future World Cups?
I believe the media rights were around $485 million, around that $500 million mark. I believe they will probably go for double that. I mean, this was probably one of the most successful World Cups.
So if they sell them for $2 billion, you're talking about a $2 billion deal.
I'm saying at minimum $1 billion. I could see $2 billion, but that depends on who shows up and wants.
But that's U.S. media rights.
Yes.
But the challenge with that is going to be the time zone for the next
time zone.
It really worked in our favor.
Yeah, it's 5 hours, 6 hours ahead, I believe, in Spain, Portugal, and Morocco. I think it's doable. They have to figure out the schedule and when the players are going to be playing. We're not going to see it. I would be shocked unless the U.S. somehow ends up in the final in 2030. I would be shocked that if the number surpasses what it was this year, which was, I believe, 64 million viewers, which is probably the most watched soccer ever here in the U.S.
I think you're going to go.
I probably will.
Yeah.
If Bloomberg grants me permission.
You got 4 years to make it.
Are you listening, anybody?
Nah.
Rendell Williams, Bloomberg News senior reporter, co-host of the Bloomberg Business of Sports podcast. Check it out. You can find it wherever you get your podcast, also on Bloomberg Radio this weekend. Coming up, Stocks on the Move.